replaced his national security advisor Mark Waltz following a scandal over a chat group leak saying he would appoint him as ambassador to the United Nations instead. In the first major cabinet shakeup of Trump's new term, the president said Secretary of State Marco Rubio would now also serve as his interim national security advisor following Waltz's departure. Turning to tech, the US is weighing a potential easing of restrictions on NVIDIA Corp sales to the United Arab Emirates. Sources say President Trump could announce the start of a bilateral chip agreement during his upcoming visit to the Gulf, a strategic move as Washington balances economic ties and AI competition. Lastly, Mercedes-Benz Group AG plans to move production of another vehicle to the US as President Donald Trump's tariffs raise costs and threaten to make imported cars uncompetitive. The German automaker said in a statement that it will shift assembly of a core segment vehicle to the factory in Tuscaloosa, Alabama by 2027. Though Mercedes did not specify which model, its most popular import in the category is the GLC Sport utility vehicle, which sold 64,163 units in US the last year. That's all for today. Now back to you.
Dia, thanks a lot for that. And lastly, Manisha Gupta joins in with all the updates from the commodity space. Manisha, good morning. Some more support for oil prices now after Donald Trump's latest threat.
Oh, well, absolutely, yes. After that very sharp decline that we saw on Wednesday, Thursday clearly has seen a 2% of gain coming in for the crude oil prices. And Friday morning today, we are looking at some more buying there. Well, the U.S. has imposed new sanctions on Iran, saying that any country that buys oil from Iran will not be allowed business with U.S. and India is one of those as well. So we will really have to see on how that impacts the overall crude geography there. Having said that, Saudi Arabia also said that they're unwilling to crop prices with supply cuts. So that means there are more supplies coming in from the Saudi Arabia and the OPEC members for the month of May and June as well. So while we have seen some gains come in today, unlikely that you will see a strong surge or a run-up coming in for the crude oil prices. We are still trading below $60 a barrel when it comes for the U.S. crude prices. Profit-taking also has come in and very strong at the gold prices. 2% of decline overnight. We are trading at a 2-week lows. And from a $3,500, we are trading at a $3,200 an ounce right now. Not just gold, silver fell 1.5% overnight. We also have seen copper prices decline 5% on Wednesday and continue to trade on a weaker note on Friday morning as well.
Manisha, thanks a lot for that update there on crude as well as on precious metals as well. With that, we call time on this edition of Power Breakfast. A cautious start in the offing for our own markets, and Bazaar Morning Call comes up next to set you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios, coming out of a midweek holiday and, of course, going into the weekend. So it's one of those days, Friday morning. Cues are not looking all that bad. We've got 2 days worth of Wall Street to react to. I'm Prashant. With me, my colleagues Nigel and Survey. Guys, hi, morning.
Hi, guys. Morning. I hate to be the party pooper, but it's over. The fun times are over. Now, there's no trading holiday all the way till August, but April was a good one.
Well, that's right. And an eye on the cricket as well. IPL, Mumbai Indians, what a comeback. Start off slow, but currently sitting at the top of the table on a winning streak. I like what I saw last night.
1 or 2 now. I mean,
they're top of the table. Top of the table. They have a couple of games in hand, though.
Yeah.
But the fight back has been very, very good because we started off slow. But the way the boys have fought back, and yesterday was decimation of the opposition. So I liked what I saw.
A lot of good stuff. By the way, Wall Street also looking up. And yesterday was much better than the day before yesterday. As I said, we've got 2 days worth of market reaction to sort of react to. And, what we'll do is not go day by day, but just tell you the 2-day change. And I think that'll quickly give you a snapshot view of what the sort of incremental change really is. So the S&P and the NASDAQ, S&P 0.78% higher, the NASDAQ about 1.4%. This is through Wednesday and then Thursday. 10-year yield about 5 basis points up to about 4.2%. Dollar index is back above 100. And slowly, as interest in U.S. assets is coming back, and so is the interest coming back in dollar. I think last night what we saw, because the majority of the move to push the dollar index above the 100 came through yesterday, it was a bit of a squeeze, especially after the ISM numbers. Oil prices, 4% in the last 2 days, $62 a barrel is around where, actually under 62 is where Brent oil prices are now trading at. And we'll talk more about this. So it's the 8th consecutive day in green for the S&P 500. And we've only had 7 instances of an 8-day rally in the S&P since 2004. So, what we're seeing is, in a small way, kind of historic. Now, ISM manufacturing was the data point last night, which got a lot of attention. It's in contractionary zone, 48.7, but it was stronger than what expectations out there were. Day before yesterday, you had the GDP numbers for the first quarter, US GDP, and that showed that the economy actually contracted for the first time since 2022. There were other data points as well, continuing claims, initial jobless, etc. I'm not going into those, but these were the 2 big ones, really, to take note of. But I think the driver for the markets over the last 2 days was not really the economic data, it was earnings. And as we've been sort of highlighting and flagging off from the beginning of the week, so on Wednesday you had numbers from Microsoft and then you had numbers from Meta. And stock reactions last night, because numbers came post-market close on Wednesday. So the reactions, 9% on Microsoft, 4% on Meta. Microsoft Azure, that's a cloud business, has grown 30% on a year-on-year basis. Meta, CapEx is very, very strong. So it kind of, at the margin takes away fears around spends around AI, CapEx and other spends as well. And of course, last night, then you had Amazon reporting numbers and Apple reporting numbers. I think what basically happened is numbers for both are decent. Actually, Amazon, in the case of the cloud business there, which is AWS, the growth was 17%. In the case of Apple, China was a bit of a disappointment. $16 billion in revenues. Expectation was about 17. But otherwise, and there's a $100 billion buyback. I think after the numbers from Meta and Microsoft, expectations had spiked a little higher, especially on the cloud side. So I think against those heightened expectations, the numbers are being seen as slightly on the mixed side, especially in some areas. But stocks, we'll have to see, because the reactions, what we have is after hours. Amazon, last I saw, was down 4. Apple was down about 1.5%. Coming to oil, which is the other big trigger, especially for us here in India, oil prices are down 9% in the last 9 trading sessions. Down to 61 point something from 68 on the 17th of April. So 9 sessions, 9%. And of course, the latest news flow which came through was that Saudi Arabia saying that they can tolerate lower prices for longer. I mean, they're pledging more supply, and this is a marked change as compared to what we've seen from the Saudis over the last 3 or 4 years now. More later, but I think this is very, very meaningful in what we are seeing. Of course, I mean, tonight in the US, we get the US jobs print, which, again, is closely watched, but this is, the prior month. So we'll have to see how much attention the market pays to this. Now, just to sort of tie in the levels, remember, the other, at the margin talking point, I mean, what's been talked about across the board, I mean, on WhatsApp, of course, but, you speak with anybody in the market or outside India, Pakistan has been top of mind, right? And we've not seen anything in terms of military escalation so far. The question in my mind also is this. Is the market, if there was a little bit of risk premium being associated, especially by local investors, HNIs, retail, etc., is that also going to go down a little bit, go down the curve a little bit? Because institutions of the margin have been buyers in any case. So with that sort of backdrop in mind, the resistance for the Nifty, I mean, same, 24,545. The second level is the 61.8% retracement. But there's one more level, which is 24,457. That is the high that we saw on Tuesday. So these are the two levels, 100 points apart for the Nifty. Critical support at the 24,080 level for the index. Nifty Bank closed negative for the second straight session. And here, I think we are in a bit of a make or break kind of zone, at least in the near term. Resistance stands at 55,957, which is nothing but Tuesday's high. And then the support for the Nifty comes in at 54,723, which is the low that we saw in the last trading session, which is Wednesday. GIFT Nifty will give you a quick sense of how we are likely to start. It's about 17, 18 points higher. Surbhi.
Oh, yes, absolutely. Lots of cues to digest, from earnings here to earnings on Wall Street and, of course, all the macro data points. So let's quickly talk about this. First of all, let's start looking at the region. And what we're seeing is a fair shade of green, so it's not looking too bad. Most of the markets, including the Hong Kong markets, are up and about. Even the Japanese market is tracking a gain of about 0.5%. Hang Seng is up about 1.5%. So markets looking pretty okay for the time being. Now, on some of these big tech earnings that came out of US, Apple shares actually have been trading down about 4% in after hours. And that's because while the overall numbers were in line with the expectations, the market seems to not quite be satisfied with the services performance of Apple's business. Plus, the company has acknowledged that it's going to be taking a hit because of all this tariff talk. And right now, they see that hit as about $900 million. This is in the June quarter. But beyond that, look at what Mr. Tim Cook is saying. He's saying that there is actually no certainty, and it's too hard to tell. It's very difficult to predict the business beyond June and what the implications could be beyond June with all of this tariff going out. He did, however, mention on that investor call that half of the iPhones that are coming in for the US market, they're actually coming from China. Beg your pardon. They're actually coming from India. And the other big supplier is Vietnam. So therefore, he was telling investors that the over-reliance on China has been reducing for Apple. Speaking of China, they've finally acknowledged that they're talking. Yes, it's official. China has confirmed that the US is in contact on these trade matters. China is saying that the US officials have reached out through relevant parties multiple times. And they're saying that they're contemplating how to go forward with these talks. But again, the spokesperson has reiterated that the US should, quote unquote, correct all wrongdoings, which basically means unwind all the unilateral high tariffs that were announced, and then the talks can progress further. So let's see. But at least it's a silver lining, which is why we're seeing that reaction on the Hang Seng as well. Japan saw some macro numbers today. The unemployment rate has come out at 2.5% for March. It's a bit higher than estimates. The Bank of Japan yesterday concluded its meeting. It's left interest rates unchanged for now, as was expected. Very quickly, let's look at the last 1 month, just in context, how some of the Asian markets have done in response to the tariff threat. First, Wall Street itself, the Dow's lost about 3%. The S&P 500 has been down about 0.5%. And the Nasdaq is down about 1.5%. Now, let's come across to Asia. In China, the reaction has been, far more severe. The Hang Seng is down about 5%. The Shanghai Composite is down 2%. And now let's talk about the three markets which are seen as front runners to get that trade deal with the US, which is India, South Korea, and Japan. And all those markets, for that obvious reason, have been tracking gains. And if we talk about the gains, the Kospi is up about 2%, the Nikkei is up about 3%, and we are up about 4% in the month gone by. So this is how it's played out in April. However, for us, with this outperformance, the rally has kind of stalled. Consolidation around this level, 24,350 to 24,400. This is where the last two sessions, Tuesday and Wednesday, we've been stalling. And that FPI buy number was a little lower, the one that we got on Wednesday. In fact, the buying reduced to just about 50 crores. This is cash market buying that I'm talking about. Domestic institutions were still on the buy side. But I must add the caveat that with the buying that we've seen in the last 2 odd weeks, the net number, the inflow number for FPIs for April has turned positive. It's the first positive flow number this calendar year. FPIs have now bought total equity worth about 4,220 odd crores in the Indian capital market in April. So that's good news. Last but not the least, we'll of course look at all the earnings coming through. And also keep an eye out on the commentary coming in from the SEBI chief, specifically on the F&O market. And this is, he was talking to Lata Venkatesh of CNBC-TV18. He was saying that the second tranche of F&O regulations should come out within a month. So we need to watch for all the capital market plays very, very carefully. Let's see what these fresh guidelines will be like. He also says that they're looking at the NSE IPO constructively. And for mutual funds, there's good news because the SEBI chief has reiterated that right now SEBI has no plans of tinkering or reviewing TER. So that sword that was hanging, that seems to have gone away. So a lot of the mutual fund stocks, capital market stocks, they will be on my radar. Nigel.
Well, we had a very, very volatile close to Wednesday's trading session. And the factors that played out there was the Nifty had its weekly expiry that played out. There was that expectation that could be a bit of a skirmish on the border. And also most of HNIs, a lot of HNI community, they're sitting on the sidelines waiting for the border tensions to cool off. So that could be the reason that you saw a very, very sharp drawdown and then in fact a recovery. All of this in the last 25 to around 30 minutes of trade. What's going to be the big cue though for May? The FI flows. It's going to be very, very important. For the month of April, they turned positive. It was actually close to around $1 billion. If you look at the secondary and the primary market, you put it together. And it's important because India was one of the few emerging markets that did see FI inflows. And not just that, you'll say that we saw a positive number of around $230 million even in the month of March. This time around, though, you had the secondary flows that turned positive from the FIs, which is the first time after 6 months. So that's why the flows for May will be very, very important because that's been one part of the, the market that's actually been holding up. The FIs returning back or falling in love yet again with the Indian markets. Important cue to track. What about FIs in the index futures? Well, they added close to around 5,000 longs. They unbound some shorts as well. The short positioning has come down to close to around 53%. I normally like more shorts in the system because that gives you a reason to see a bit of a short covering bounce. So as we speak now, the FI net short positions, they have come down to the lowest level we've seen all the way since the start of October. October 2024 is when we had these FI net short positions that were very, very low. And right now as well, if you look at the short positioning, well, it's only at around 10,000 contracts or thereabouts. The clients, well, their long positioning as well has got totally unwound. And now the clients' net short positions are at the highest we have seen since October 2024. So client net short positions at the highest, the FI net short positions at the lowest we have seen all the way since October. You want some more shorts in the system, particularly from the FIs. Two strikes come up for you on the screen. The 25,000 call, very important, good amount of open interest built up. The hint is that in fact there was some out of the money call buying out there. In case the markets take off, all you lose is around 24 rupees. So that's the hint you got out there. But the line in the sand is the 24,000 put because that had a fair bit of open interest built up. And it gives you that broad range. On the downside, 23,800 needs to hold out. On the upside, the 24,500 needs to hold out. And the Nifty for the last 6 sessions, every day it goes to this mark. 24,350, 24,450, but it's unable to cross that mark. So that's the resistance zone. One reference point you have on the downside is the 200 DMA, and the crucial support, in fact, comes in at around this 23,800. So DMA as well as 23,800 is the mark we're looking at. The index that I'll be looking at today is the tech index. Nasdaq has found its mojo in the last couple of trading sessions. You had good numbers coming in from Microsoft. Yes, you have Apple as well as Amazon that will be reacting to its weakish numbers today. But I'll want to see whether or not the tech index can play catch up since the Nasdaq did well overnight. And there are talks about a US and China trade deal. And finally, what's the stock that I'll be looking at? Well, I'll be looking at Jio Financial Services because if you look at it, the stock fell harder and now it's trying to catch up. So in the last 6 months, Jio Financial Services is still a relative underperformer. It gets most of its value from Reliance Industries. So I'll keep an eye out on this because Reliance seems to have got its mojo back. We'll have to keep an eye out where Jio Financial can catch up.
All right, Nigel, thanks very much for that. That point about NASDAQ, important, because, we were talking about US exceptionalism going back. Will one quarter kind of get some of that mojo back, right? Especially around AI spends, etc.
And I think on Microsoft, the numbers are good. I think Sonata is one company that gets most of its revenue.
30%, 35% is Microsoft.
I think a little bit more. And if you saw in Wednesday's trading session towards the end, the street was trying to build in those expectations. Stock ended high with a gain of close to around 10% or thereabouts.
Absolutely. So lots to track and talk about. But Taimur Beg is now with us. He's Managing Director and Chief Economist at DBS Group Research. Taimur, thanks very much. US, the NASDAQ is up 20% from its April lows, Taimur. So there you have it. Consequential week, not this one, but the week before. And big recovery from the lows. What's the state of play with regards to sort of growth expectations out there with all this tariff talk and deals, etc., which are being spoken about? What's your sense, Taimur?
Decidedly poor. I'm not buying any of this rally or this expectation that things are going to work out. I just came back from Washington, D.C. after a week in the IMF World Bank meetings. And the feeling is that the discussion around trade is entirely political. It is not technical. It is not based on any analysis that can be seen at a level playing field by both the U.S. and their counterparties. And as a result, the signal for the markets would be very mixed and would be uncertain and volatile going forward. I met with people who have been privy to the discussion between the Japanese and the Americans, and I was told the discussion is entirely at a rather high level, political level, not the kind of discussion you want to have between trade representatives, technical discussion, specific tariffs, specific sector, legal aspects. None of those things are really on the table. And therefore, I think that the hope that the White House messaging, that a bunch of deals are on the table, we're going to see landmark announcements, and this will all go away, will be proven spectacularly wrong. And as a result, I think this relief rally that I'm seeing, to me, is more like a dead cat bounce than anything else.
Wow, that's quite something, Taimur. You've really made us sit at the edge of our seats and take notice, because that's very, very helpful perspective, given that you've been speaking to people in Washington. So from the market standpoint, and this is always the worry, right? First of all, will they get a deal or not? And even if they get a deal, okay, maybe it's not, say 145%, but even if it is 50%, or in India's case, even if it is, a couple of notches lower than 26, what does it really do? Let me go back to the main question. The market for now wants to look away from the recession and slowdown and inflation possibilities in the US. What do you think could be closer to the truth here?
I'm not particularly concerned about a major negative spiral as far as the U.S. economy is concerned. Let's also be, careful of characterizing the U.S. economy in the appropriate way. U.S. is a largely closed economy driven by domestic demand. The net exports contribution to growth usually is rather negligible. Now, what we saw in the first quarter data was an astonishing development where importers rightly expecting huge amount of tariff decided to front load a massive amount of their imports, and as a result, net exports contributed minus 5% to growth. If you correct for that, the U.S. economy actually had a pretty decent first quarter. Now, in the second quarter, we will see the opposite, which is exports will be okay, but imports would collapse, and as a result, whatever slightly negative number we saw in the first quarter would be given back, and we'll get, for the first half of 2025, something in the range of 1.5–2% growth. So I don't think the U.S. economy is about to crater. The market's expectation that a huge number of rate cuts are just around the corner because of a tariff-induced recession, I think would be proven wrong. The risk is on the inflation side. Regardless of where tariffs go, U.S. producers are clear in their signaling. They will raise prices. They are raising prices. We see survey after survey around that. And that would certainly make it very, very difficult for the Fed to provide accommodation to the monetary policy stance, which is what the White House is demanding. For me, as a result of these sort of expectation, I would be a pair of U.S. rates, not a receiver. And I would also expect that the U.S. dollar not to continue its downward move, but actually stabilize, because inflation expectations would feed into interest rate expectation, would then feed into people saying dollars selling is overdone, and we might go long the dollar.
All right. Hi, Taimur. Good morning, and in fact,
Good morning.
good to see you. And Nigel on this side. The last time we chatted, you were hinting that maybe, in fact, the risk reward for a rupee could be, on the appreciation side. And it appears the rupee, after going closer to around 87, it's pulled back. What's the course you're seeing out here for the Indian rupee? And your brief take on the estimates that you're working with for the Indian economy.
Correct. And I will basically start with the cue that you guys were giving earlier, which is that the FII flows have finally turned positive. And that is, of course, a rupee positive development, and a massive easing of oil prices, of course, is fantastic news for oil importers like India. So I think the rupee is enjoying several sources of tailwind, both in the inflow side as well as in the current account side. This will continue. Again, we should not all conflate all developments around tariff. There are certain macroeconomic developments that are taking place, which is certainly positive India. And also the realignment of supply chain, for what it's worth, should be positive, not negative. It may not be a massive positive, but the risk reward is on the positive side of the spectrum. So put it all together, a rupee smile, precisely when the dollar seems to be, not that much loved, is very much on the cards. Now, is there a substantial amount of additional upside to the rupee? Connecting what I said earlier, that if indeed U.S. interest rate expectations get a bit sticky, around that, we now actually don't expect any more of the compression of the yield differential, interest rate differential between U.S. dollar and EM currencies, then perhaps the rupee's moment in the sun can be, abating a bit going forward. We've had the big amount of rally already, maybe not much more left.
Very quickly, Taimur, when we say we talk about a deal, right? And India's been mentioned quite a bit. As an economist, what are you expecting? What kind of a deal when the document comes through? Will this be like a MOU? Will this be a framework kind of, okay, this is essentially what we will now agree upon. We will reduce here, you will reduce there. Not exacts, or are you expecting exacts, like a deal?
Absolutely not. I would paraphrase something that Donald Trump said during the election, that there will be a concept of a plan. There will be MOUs, there will be certain amount of promises made, but trade agreement, the kind of thing that EU and India has been trying to do for the last few years. That is a very long technical legal document. We're not going to see anything like that. We will see a bit like, the phase one deal that China and the US had signed during Trump 1.0. Certain promises to buy more, certain promises to sell less because, the trade balance has to improve, certain promises to buy less from China. That kind of stuff I would expect to see. A major trade deal, as we all know, requires technical people, multiple years, and those are legal documents, not something that politicians write down.
All right. MOUs, when we talk about companies and MOU for orders, etc., sometimes they translate into actual orders, sometimes they don't. But some kind of agreement essentially is what you're pointing to. Right. And I think that's fair enough. Thanks very much, Taimur. Appreciate you joining us. And it's a pleasure. Let's just quickly run you through the interactions which are lined up. 9 o'clock, you will hear from the Paras Defense Management. Stock is up and like a bazooka, over the last couple of months now. We have 9:20 Venugopal Gare of Bernstein joining us on the market outlook. 9:30 Sona BLW will be with us on their fourth quarter earnings. We have Bandhan Bank Management joining us on their numbers. Federal Bank Management will be with us at 9:50 to talk about their numbers. So lots of earnings related calls. And Coromandel International will be the last management we will be speaking with at 9:50. Lata in conversation with Lord Mark Sedwill, Chairman of the Geopolitical Advisory for Rothschild and Company on the global divisions post-tariffs.
Time to slip into a short break. A lot of stocks to track in our special Top 10 segment. For the time being, I give you a sneak peek into all the stocks we're going to be discussing. JSPL, NMDC, JSW Infra, PNB Housing Finance. 4 stocks will be reacting to positive news flow, while on the flip side, Eternal or Zomato, that one in fact will be reacting to negative news flow. Add to the list, we have Indus, Federal Bank, Bandhan Bank, Sona BLW, all of them will be reacting to negative news flow, while a lot of stocks could see a bit of a mixed reaction. Slip into that break, come back, we get into further detail on all of these names.
Welcome back. So markets across Asia have been holding on in positive territory, and the gains are anywhere between 0.5% to 1.5%. Let's pull up the implied open. Now, this kind of an opening across Asia suggests that we should be heading on the upside as well. There we go, 30 points higher. That's what we're getting on the implied open for the Nifty. Lots of stocks to track, as we just told you. Plenty of earnings and news flow. So let's straight away get to it with our team standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Mangalam, Eternal, I had a very quick glance at the numbers and not that great.
Not that great. So, there were two problems with Eternal earlier, which was that the food delivery business isn't growing as fast as the street was expecting, and the losses on quick commerce are ballooning faster than the street expected. And that's exactly what continued in the fourth quarter as well. So if you look at the food delivery GOV, it's at 16%. It's actually, a decline quarter on quarter as well. So that's been declining in terms of growth. And the company said sluggish demand and shortage of delivery partners has impacted business. And they've also delisted about 19,000 restaurants during the quarter itself. And the margins too were nothing to write home about. Quick commerce, while the GOV growth was fairly strong, 134% year on year and 21% quarter on quarter, that's slightly higher than what the street was anticipating. What was higher were the losses as well. So the EBITDA loss in Blinkit actually ballooned from 103 crores in the previous quarter to 178 crores. And out here, there was no respite coming in when it came to competition, because the management said competition is only going to intensify further in the near term. They are aggressively looking at market share and will not let short-term profitability goals come in the way, which implies that there is no near-term visibility when it comes to profitability on Blinkit as well. While in the long term, this may be business positive, in the short term, this may be stock negative, and that's something that I'll be watching out for today as well. Expect the stock to see some red today.
All right, Mangalam, thank you very much for that. That's Eternal for you. I think on Indus, the next one is Indus Towers. There is a bit of a disappointment, dividend disappointment really. Reema is here with details. Reema, morning.
Indeed, it's a dividend disappointment. Numbers are actually pretty good. The company's top line has gone up by 2.4% quarter on quarter. Year-on-year revenue growth has accelerated to 7.4% versus about 4 to 5% in the prior three quarters, Q1 to Q3. Tower ads have seen a big jump up, but that's boosted by the Bharti Tower acquisitions that the company did towards the end of the quarter. So that explains. Organic tower addition, according to analysts, seems to be largely similar to the prior quarters. But reported margins are lower. You will see a sharp dip. In Q3, reported margins were more than 90%. This quarter, it's at 56%. And that is fluctuating on account of how much they recover in terms of provisional doubtful debts from Vodafone Idea. So last quarter, they recovered a lot of money, which is why margins shot up to 92%. This quarter, relative to last quarter, it's lower, and therefore you will see the margin drop. Profits, therefore, have also seen a commensurate decline. But as you said, the street was expecting or was hopeful for some amount of dividend payout because the receivables from Vodafone Idea have pretty much come to nil now. But that didn't come out. But the company did say that they've constituted a committee which will look at all forms of cash return to the shareholders, or they'll discuss all modalities. So the street is hopeful that not this quarter, but maybe in the next quarter we could see some dividends. So the hope is still alive.
Okay, all right, Reema. Thanks a lot for that. Well, let's talk about the banking names. Abhishek joins us to tell us about Federal as well as Bandhan Bank. Morning, Abhishek.
Good morning, Nigel. So to begin with, Federal Bank, it's one of the weakest top-line growth that you are seeing in last 12 quarters or 3 years. P&L versus ARPOL, the ANA is, below ARPOL. However, the PAT is ahead of ARPOL as provisions have declined more than 50% on a sequential basis. YOY, take a look, 12-quarter low growth with respect to loan growth coming in at 12.15%, which has driven the ANA growth to be on the lower side at just 8.3%. Credit deposit ratio is at 7-quarter low of 82.8% versus 86.5% in the previous quarter. Now, operating profits have declined by 6.5% sequentially, which is the highest decline that you are seeing in last 4 quarters. Asset quality remains stable thanks to high write-offs. So, gross NP ratio is one of the lowest that you are seeing in last almost 10 years, coming in at 1.84% versus 1.95% in the previous quarter. Now, Bandhan Bank reported a weak quarter this time around with reference to the P&L. The NI was below our poll, and thanks to lower provisioning, the PAT was ahead of our poll. Now, AM growth is one of the weakest that you are seeing in last 7 quarters with reference to 9.8% YOY. So, YOY growth is one of the weakest in last 7 quarters. Net interest margin is at 9-quarter low. It has come in at 6.7% versus 6.9% in the previous quarter. Operating profits are down both YOY and quarter-on-quarter. YOY by 14.5%, while sequential decline is more than 22%. Slippages remained elevated at 1,750 crore versus 1,620 crore in the previous quarter. Annualized slippage ratio, one of the highest in the industry at 5.3%. Asset quality, take a look at gross NPA. It has inched up by more than 4% quarter-on-quarter. So weak set of numbers coming in from Bandhan Bank. Back to you.
All right, Abhishek, thanks a lot for that. I'm looking at two metal stocks. One is JSPL, the other one is NMDC. For JSPL, I'm looking at their numbers that they came out with. And on the top line, there was a big beat. So that was good. But on the EBITDA number that was reported, actually, it was lower. However, there was an adjustment of around 230 crores. So adjusted for that, actually, the adjusted EBITDA looks better than what we are working with. And the adjustment was on account of some provision for old GST. There was also some inventory cleanup for several years. So just adjusting for that, the numbers look good. On the top line, you'll say, how come they give such a big beat? Well, the volumes are much better. Came in at around 2.1 billion tons, much better than where the street was at around 1.95 to around 2 million tons on. They have cleared up some inventory and they increased production. So that explains why the volume number was better. Adjusted EBITDA per ton as well, both for the standalone business as well as for the consolidated business. Standalone, we have calculated, consolidated, they have reported. There is an improvement of close to 7 to around 800 rupees per ton on a sequential basis. And the street will like that. Moving to the debt, there was some reduction. So from around 13,500 crores, it's come down to around 11,900 crores or thereabouts, which is good because they've been doing aggressive capex out there. And the capex plan is virtually unchanged for the next couple of years, which is good because that's one of the key monitorables. They're saying that the sales volume number will move up from around sub 8 million tons to around 8.5 to around 9 million tons. Give and take everything, going with the positive reading out here. Valuations in JSPL's favor as well. Next up, we're going to NMDC. The street was waiting by for a price increase, and that's come up about. They've gone ahead and increased prices both on lumps as well as fines by around 440 rupees per ton. Good news, first price increase coming in all the way since January. And this is a little bit higher than the price increase that the street was working with of around 250 to around 300 rupees per ton. So it is anticipated, but the quantum is better. And the reason is that we have been seeing in the OMC auctions, the premium has moved up. So part of the street was expecting this, going with green on both these two stocks. But let's hop across to Sudarshan. He's tracking Sona BLW as well as JSW Infra. So take it away.
Morning, Nigel. So first talking about Sona BLW, it was expected to be a weak quarter because of that company was upgrading a software to its one of the largest customers, but the earnings have come slightly weaker than expectations. Also factoring PLI benefits, company has reported margin of 25.4% versus expectation of more than 26%. Also, company has a near-term outlook related to US trade issues remains a concern, and company is saying that its 3% of total revenue remains at risk. And regarding Scott Kubota's railway biz acquisition, it was expected that it would be completed by May 1. Now both the companies have extended the completion date to June 1. So I'm going with mild red for Sona BLW. Coming to JSW Infra, earnings were largely in line with estimates. EBITDA has increased more than 10%. Margin has come in at almost 50% versus Jefferies estimate of 48%. Also, company has reaffirmed its target to increase the capacity to 400 million tons from current capacity of 177 million tons. And for FY26, it's estimating revenue growth of more than 10%.
All right. So thank you very much for that. PNB Housing Finance is the next one. Abhishek has got more. Abhishek, morning.
Morning, Prashant. So sources tell CNBC-TV18 that PNB Housing may see a block today in trade. So a block has been launched. Seller is Quality Investment Holdings PCC, which is a Carlyle entity. The offer size is about 10.44% of the equity. So it's a clean out trade from them. Offer size is about close to 2,604 crores. Floor price has been priced at 960 rupees per share, which is at a discount of 5% to NSE's closing price day before yesterday. The broker is IFL Capital over here. Back to you.
Okay, that could be a pretty large block. Abhishek, thanks for the heads up on it. Back to Sudarshan then. Sudarshan, auto sales for the month of April. Is there any light at the end of the tunnel?
There are certain companies which have reported good sales, and if you talk about the sectoral PV sales have improved, while two-wheeler has presented a mixed picture, and also on tractor front things are looking good. So now we'll start with the companies which have reported a good set of numbers. The first one in the list is M&M, for which both auto and tractor segment sales have improved or basically have come in much better than estimates. Also good part for M&M is now in the passenger vehicle segment, it's number 2 player. It has now surpassed both Hyundai and Tata Motors. Now coming to TVS Motor, it continues to outperform its peers. Even in the month of April, its sales have increased 15% and is much higher than what our expectations were. Now coming to, and even for Maruti, sales have come in much better, not much better, it's like slightly better than estimates, but this time what has done good for Maruti is the compact segment like Baleno, Wagoner. Those sales of these cars have improved, but for Alto and Espresso, sales remain under pressure. Even in the month of April, sales were down by 45%. Now coming to Hero MotoCorp. It has seen a sharp drop in the sales for the month of April, and because of the production halt that company had announced from April 17 to 19 in its 4 facilities. But all the estimates had considered that. If you compare by the estimates, the sales are still very much down. It's down more than 30%. Last one is Tata Motors. It has seen an all-round decline. All the segments except 2 segments have seen a sales decline. Domestic CV sales have fallen 10%. PV was down 6%. And worst part is even EV sales have fallen 16%.
Oops, that's definitely an oops for Tata Motors and even Hero Moto, despite that planned maintenance shutdown, but it seems the sales have fallen even more than what was penciled in. Thank you for that, Sudarshan. Let's quickly then also round up the commodity market action. Actually, before we get to commodities, let's recap our list of stocks to watch. The ones that have positive news flow, let's get them on the screen. We have JSPL, NMDC, JSW Infra and PNB Housing Finance. The ones that have negative news flow are Eternal, which of course is for former Zomato, Indus Towers, Federal Bank, Bandhan Bank, Sona BLW Precision, and auto stocks are likely to see a mixed set of moves amidst April auto sales numbers. Okay, on that note, now let's go across to Manisha to get a roundup of the commodity market action. Manisha, good morning. So what's the latest?
Well, I'll start with the crude oil prices, Rupee, because we've seen 2% of gains come in the overnight market. But even with that, we are still trading below $60 a barrel for the U.S. crude prices. Well, U.S. has imposed new sanctions on Iran, saying that any country that buys oil from Iran will not be allowed business with U.S. That is what is adding premium to the markets back yet again. But having said that, there are statements from Saudi Arabia saying that they're unwilling to prop up prices with supply cuts. So you are looking at one, record production from U.S., second, OPEC and allies, including Saudi Arabia, is increasing production. And the third is that the markets are looking at weak U.S. and Chinese data, and that perhaps could continue to weigh onto the market. So it's contradicting as fundamentals, but nobody's expecting the crude oil prices to run away up from here. We are still trading at around $60, $62 a barrel for both crude varieties. I'll quickly talk about gold as well, because we saw 2% of a decline in the overnight markets here. So from an all-time high of a $3,500 an ounce, we are trading at around $3,200 right now. So $300 of a cut is what we've seen happen in the last couple of weeks itself. So with that, while we've seen 6% of gains come in for the month of April for gold, but it has been a sharp decline for the Indian markets as well, where from a lakh rupees, we are trading at around 92,000 right now. So good amount of profit taking is what we are working with in sense of gold.
Okay, all right, Manisha, got it. Thank you very much for that. With that, we do have to take a very quick break, come back on the other side, and then we'll have lots more for you, including, of course, a conversation on the fundamentals. So Siddharth Khemka will join in with a couple of stock ideas. Welcome back. So lots of numbers to go over. We have Siddharth Khemka to help us out a little bit. Siddharth, morning. Let's start with the banks first. Bandhan and Federal. Bandhan obviously is not too great. Federal, what do you think about these tier 2 lenders?
Yeah, good morning. A lot of numbers, yes. I think federal earnings overall look weaker compared to what some of the other larger banks had reported. I think there has been increasing competition, especially in the retail MSE, especially for the deposits in the industry, and that is kind of impacting the overall business. Going forward, I think the bank expects the CI ratio to be stable at around 52, 53 over the next few quarters. Loan growth should be better than what we are looking at currently, and I think the management is trying to improve that, as well as the asset quality, I think, continues to remain pretty strong. Net, I would say pretty mixed set of numbers, operationally in line, but increasing competition for deposits, as well as the challenge in terms of the loan growth. That could put some pressure on Federal. Bandhan, good set of numbers. But I think overall, the challenge remains to be seen in terms of how the microfinance business that improves, and we have seen that the operationally it has been in line. Earnings have been missed largely due to the lower other income, higher provisions. Margins have declined by 21 basis points on a Q-on-Q basis. I think the challenge will continue to remain in the near term as it tries to stabilize the microfinance business. That is a significant stress book that continues to put pressure. And I think again, between the two, we would be still neutral on Bandhan while we remain positive on Federal.
Okay, all right. Hi, Sid. Good morning. Good to see you in. What about Eternal? What's your take on the numbers? You know, for the industry, the street was working with big scope of growth. Profitability is not coming about. That could worry investors, right? What is your take?
Good morning, Nigel. Yes, good to be on the show with you. I think it's a catch-22 situation for a company like Eternal. On the one side, you have a very strong growth potential. However, the same is not getting reflected in the margins. A few quarters back, we saw the overall business doing pretty good. But now with increasing competition and with the capex being upfronted, I think margins will remain under pressure for the next 2 quarters, and that is where the challenge remains. That so if you see even for Q1 of FY26, we are expecting revenue to grow about 63%, but EBITDA would likely decline by about 14%. And someone who is looking at near term, I think the stock could remain under pressure. But what we like is that the long-term growth potential, both in the food delivery business as well as in Blinkit, we believe that if Blinkit, the company stops the capex right away, the adjusted margins could again improve to 3 to 4%, what they have been guiding for. But I think that will see most probably in FY27. In the interim, we remain positive. We believe any correction below 200 could be a good opportunity for long-term investors to buy to the stock. We continue to remain positive. And I said, we have a buy rating, and we have set a target price of 260, which remains unchanged post this quarter, because this quarter the earnings pressure was already factored into the estimates.
Right. Absolutely. Actually, at a net level, we had those Jeffries estimates. The actual net numbers are a little better than what was actually. But I mean, there's a lot of moving parts there, as you said. Indus Tower said, any thoughts? There's no dividend, but there's a committee which has been constituted to consider how to kind of return cash to shareholders. But the expectation was the 25-30 rupee dividend in the quarter, which has not come. What's your sense?
Yeah, definitely, Prashant. I think while the operational numbers are in line, the overall reported financials were impacted by several one-offs, including the tower purchases from Bharti Airtel in the prior period revenue, some provision reversals, and all those things. What clearly is that the Indus decision to defer dividend payments is negative so far as sentiments are concerned. Because if you see, this business is mostly a dividend play rather than a growth play. Already the lot of capex has been done, including Bharti Airtel, where the pan India 5G as well as the rural rollout has been done. So going forward, we do not expect any more tower additions, and hence the growth on that front will remain kind of muted. There is downside risk to the tenancy additions, as we see that there could be delays from Vodafone Idea's payment because of their inability to raise debt and in terms of capex spend going forward. So overall, I think it's a dividend play, and if the dividend is not coming forth, it's a negative sentiment. What we believe is that we have a neutral rating, and we see that risk reward remains fairly balanced with a target price of around 400, which is closer to the current odd levels.
Okay, all right. Request you to stay with us, Sid. For the time being, let's focus on Vedanta. The numbers actually were good, and the street is optimistic on the demerger. Let's check out what the management has to say. We're joined by Mr. Arun Mishra, the Executive Director, and Mr. Ajay Goel, the Group CFO at Vedanta. Hi, Ajay. Good morning, as well as Mr. Mishra. Thanks a lot for joining in. Let's focus first on your largest segment. That's the aluminium business. The EBITDA on a quarterly run rate has been holding around this 4,500 crores. Can you maintain it?
So if you look at from Vedanta's viewpoint, and of course, we got a home demand advantage. So aluminium in India growing at about 12-13%. And Vedanta is part of the global top decile cost curve. In that case, our margin remains intact, which is about $1,000 per ton. In that case, we do foresee that on every single quarterly basis, our EBITDA at aluminum business will be the same ballpark number, about 4,500 crores per quarter.
Interesting, Ajay. Then what kind of LME pricing are you working with on the aluminium business?
So if you look at maybe over the last 1 odd years, and the cycle of the pricing has remained strong. Again, it's driven by the global supply-demand dynamics. Now, coming to the current fiscal in the first month, given the whole tariff tussle, the pricing initially has taken a bit of hit in the first 2 weeks of April. But over the last 2 weeks, pricing is coming back. It is about now $2,500 per ton. Most consensus report shows the pricing will go back to almost $2,700 to $2,800 per ton.
Got it. All right. So that's about the aluminium business. Let's come across to you, Mr. Mishra. What's the production uptake you're looking at in the oil and gas vertical? Because some on the street, they believe that's been a little bit disappointing. How do you scale up from here?
As of now, we finished at about 97,000 barrels of oil equivalent per day, and this will go up to 110, 115 with the current visibility that we have. And of course, we are working on more and more exploration to see whether we have more reserves available. We are working on the gas project in Barmer. We are working on the ASP project. I hope these things yield results so that next year end, we are able to share some better results.
All right. Ajay, let's come back to you. You all have deleveraged the balance sheet. Can you tell us how is the debt likely to evolve from here on, both on Vedanta Resources, which the street gets a little bit skeptical on what the promoter entity debt is at, and also the listed entity, which is Vedanta Limited?
Two areas we have been guiding the market. Firstly, for the parent company, Vedanta Resources, our debt from 9 billion 2.5 years ago has now come down to 5 billion. And the 5 billion is our decade low debt. From the current 5 billion, we'll go down to 3 billion over next 2 years. That's about the Vedanta's parent, Vedanta Resources. In Vedanta India being an operating entity, we look at net debt to EBITDA, the ratio of leverage. This number was 1.9x, which improved to 1.2x as we closed the last fiscal. And from 1.2x, we will go down to 1x, which means our EBITDA will be bigger than our debt. So both Vedanta Resources, the parent company, and Vedanta India, both will get deleveraged in near future as well.
Okay, all right. We'll be waiting to see how the demerged entity pans out. But given that you'll have focused on the cost side, and there has been some bit of volatility on the pricing side, that's LME pricing, could you give us a guidance on the EBITDA front?
Say last year, you may have seen our EBITDA has grown by almost 37%. and that is quite it is our historical second best EBITDA. Now you'll appreciate in the current environment where pricing is slightly volatile, guiding the market on EBITDA will not be appropriate. Having said that, our guidance in today's earnings call, we have guiding the market that volume in the current year will be almost 10% higher versus last year. At the same time, cost and marketing premium will be 10% better off. And that would mean operationally, we are looking at 20% higher profitability in the current year vis-a-vis last year.
10% higher profitability in FY26 in comparison to FY25. Got that. The biggest query on the street is, what about the demerger? It's got delayed a little bit. When does the demerger see the light of day?
Well, you may have seen we have secured the approval of shareholders and the lenders in a meeting on 18th of Feb. And right now we are before the NCLT for the second motion petition. Demerger is absolutely on track, and we see demerger completing by September 30th.
Well, before we wind down on this conversation, let's come across to you, Mr. Mishra. The street always gets a little bit skittish. What's on the promoter's mind next? Is there any plans to sell the steel business or any kind of rejig that you're looking at in the international businesses, say International Zinc? What's the plan on both these two verticals?
So as of now, if you look at our steel business, we are totally focused on commissioning the 3 million ton expansion. And you are correct, safeguard duties are in. We should get the best out of the steel market in the current year possible. So that is our primary focus. Till the time the right valuation we get, because we believe that place has a potential of 10 million ton steel plant, and it should get reflected in the valuation if somebody is to offer. On the ZI plan, it's a part of the new vertical of the base metal business, inclusive of copper mine in Zambia and also the zinc business in South Africa. So there is no plan to rejig it with any of the Indian operations as of now.
Okay, see big potential for the steel business, looking at adding capacity. For the time being, the focus is on increasing capacity rather than selling it. Thanks a lot for joining in, gentlemen. Appreciate you speaking to us here on CNBC TV18. Well, time to slip into a short break. Come back, we'll get the technical calls going. Mitesh and Srikanth are waiting for you on the other side.
Okay, well, 7 minutes to go for the pre-open session to kick off. Mitesh and Srikanth are with us. Friday morning, gentlemen, good morning. Good to have both of you here. Mitesh, you go first. So 2 days in a row now. I mean, actually, the market's been a little subdued. And of course, last 30 minutes, market sold off as well. Last Wednesday, the last session. Stabilization, would you want to buy the dip that we've seen? What's your sense?
So, morning, Prashant. I think, very clearly the market has, after rally, is now showing signs of consolidation. I've been maintaining as much that we will most likely see a sideways market, which could be between 24,450, 500 on the upside to about 24,000 and maybe 23,850 on the downside. So I think that's the broad range I'm looking at. With that, buying on the indices now would be very clearly towards the lower end of the range. And stocks is something which we'll focus upon. So the idea is to use declines to buy into, because the short to medium term trend is still on the upside, but the immediate trend is slightly sideways. And look at stocks which are giving breakouts, and that's where your trading opportunities will arise.
Okay, so we will talk about stocks in just a bit, Mitesh. Shrikant, morning to you as well and happy Friday. What about the index? Last 2 days, the bulls' momentum seems to be, stalling just that little bit. But would you buy in to any dip or any pause?
Yeah, good morning, Surabhi. Good morning, Prashant and everyone. Yeah, of course, I think the overall trend of the market is still much stronger than the expectations. So whenever we are seeing some sell-off in the market, we are seeing good amount of buying interest. But at the same time, because of this long weekends and holidays, we are seeing some range-bound sort of activity in this market. So unless and until the market is crossing the level of 24,450, we are expecting market to remain in a range. But in case if we see the market is dropping to 24,200 levels, then there's certainly we should look for taking some contrabets in the market.
All right. Hi, Mitesh as well as Shrikant. Shrikant, by the way, since you spoke about the long weekends, there are no long weekends for the next 3 months or so. The next one is Independence Day, August 15th.
Oh.
If, that's a Friday and that's the next long one. So for the time being, need to hold on. We had a good dream run. Honeymoon period is over. Let's get to the stocks though. Mitesh, you go first. What's on your radar?
Nigel, I have a mix of buys and sells. On the buying side is HDFC Life with a stop at 730 for targets of 770. Maruti is a buy with a stop at 12,000 for targets of 12,700. And Apollo Tyres is a buy with a stop at 464 for targets of 485. And on the selling side is Excite. Keep a stop at, I think I've got the levels slightly wrong here. I'll just correct them. Keep a stop at about levels of 360. Look for targets of 332.
Okay, and Shrikant, what about your stock list?
We are expecting some short covering in tech companies, especially Infosys, which is consolidating within the range, and it is very close to its I can say breakout level. So from here again, the stock can move to the levels of 1575 or 1600 sort of levels. We can keep a stop loss at 1475 for adding long positions on Infosys. We may see some activity in TCS and maybe Tech Mahindra also in the near future. That's the view. We also like Bajaj Finance. It is down heavily in last 3 trading sessions. It is very close to its oversold levels and also at important support levels. So from here, in case if there is any recovery, then the stock can again move back to the levels of 8850 or maybe 8900. So we can keep a stop loss at 8540 for adding long positions on Bajaj Finance.
Okay. All right, gentlemen. Got that. We'll come back to you for some more questions and ideas in a bit. Right now, quick break. Back on the other side, we'll have the pre-opening trades, and also Amit Mahajan of Paras Defense and Space Technologies will join in. They'll talk about the fourth quarter performance. Welcome back. Just about 16 minutes to go before the opening bell goes off. Still in conversation with Siddharth Khemka. Siddharth, let's actually talk about some of these defense stocks. We'll be speaking to Paras Defense in just a short while from now, but they've made a huge comeback right now, whether it's sentiment, some of it is probably earnings as well. But tell us about Paras, if you have a specific take, if there's anything you'd like us to ask the management. Otherwise, what else from this entire bouquet? What are you liking?
Yeah, so unfortunately, we don't cover Paras, but what we do cover are two market leaders, Bharat Electricals and Bharat Electronics and HAL. So HAL is something that we recently initiated coverage. What we see is that these two players are market leaders in their respective space, in the electronics as well as in the aerospace defense. As you rightly said, defense has made a strong comeback. Earnings continue to be pretty strong. What we saw earlier was that valuations had gone to a premium level and they had corrected. And Q4, we saw not only a bulk of strong order inflows, execution was pretty strong, but the global geopolitical situation brought the focus back on the defense space. And that led to, again, I think, market looking at it from a positive view. That led to, again, strong re-rating. So what we, again, as I said, market leaders like Mazagon Dock, Bharat Electronics, Hindustan Aeronautics, we believe that this space of defense will continue to see strong growth for the next few years. It's a decadal story, and with India being at the center of, if you see globally also, being a neutral party, we have a lot of exports potential apart from the domestic market standpoint.
Okay, all right. Final question, Sid. Before we let you go, I wanted to ask you about my metal boys. JSPL's adjusted numbers actually were good. Vedanta at around 400, 420 rupees. Actually, that special situation makes it quite attractive. What the promoter does next, we don't know. And what Mr. Trump as well will do, we don't know. And NMDC has hiked prices. So among these three, do you like anyone?
Definitely. I think the entire metal pack, we like JSPL strong numbers. If you just switch to Vedanta, I think very performance came in line with expectations. Capex plans are progressing well. I think the management remains firm on its deleveraging plan going forward with higher cash flows, which would support the expansion plan as well as deleveraging efforts. Valuations are decent. We like the stock. Even JSPL, for that matter, I think pretty good set of numbers above our expectations. The completion of the ongoing Angul expansion, I think the crude steel capacity will rise by 65%. That's a good, strong new capacity addition. And again, the companies reduces debt significantly, coming down to 1.26x at the end of Q4. And going forward, again, the deleveraging plan continues. So we like the stock. We have a target price of 1050 there. NMDC, pretty strong Q3 numbers. Volume growth muted. Realization, I think now with the price hike taken, that will again start kicking in terms of growth going forward. But in all the three, the preference would be JSPL, followed by Vedanta, and finally NMDC.
Okay. All right, Siddharth, thanks very much for all of that perspective and all the stocks that we've discussed. We were just discussing the defense space, so let's actually get back to it. Paras Defense is the company on the radar. Now, Paras reported a really good set of numbers for the fourth quarter. Revenue and EBITDA margins have come in at pretty healthy levels. To talk about this and the order book trends, we have with us Amit Mahajan, Director Technical and R&D at Paras Defense, joining in. Amit, it seems to have been a fabulous quarter. I'm just going over the numbers right now. Your revenue is up 36%. Your EBITDA has jumped 133%. Margins come in at 26%. And obviously, profit is higher. Profit is almost doubled to nearly 20 crore rupees. So just tell us, was this a one-off because some lumpy order got executed and there was a P&L recognition? Or what is the overall trajectory? In the past, you've spoken about growing for the full year at about 40-50%. Do you still see those kind of growth rates? Give us some more color on where's the performance coming from?
Firstly, thank you and good morning for having me over. This is not a lumpy or one-off instance, as you can see. You see the Q3, we had already crossed the revenues of the last year. So we were already on the trajectory of the growth. The good order book, very, very strong order book, and amazing opportunities that are in the funnel or the pipeline, as we call it. These are the driving forces. The Make in India is right now, you can say the results of Make in India, you can see it on the balance sheet right now. And overall, basically the hunger for staying ahead of the technology curve. This has always helped us. We've always developed some products which are always cutting edge, and they give us the edge of giving us higher profitability. And that's something that can show off. In this year, we delivered submarine periscope. This is a product that we've been developing for some time. We always used to say that we'll become...
Well, Amit, good morning. Allow me to come in. Sorry, just running into market open, so compressed on time. So if you'll allow me, can you give us specifically, so 25 over 24 was kind of flat at the net level. This year, profits have jumped. I mean, doubled basically, 60 compared to about 30 odd crores. Give us a sense of what FY26 will look like on both top line and on the bottom line front as well.
So we are hoping that we will continue this growth of 40+%, and the profitability will also improve, because now if you see the products, now submarine periscope now will go in regular production, plus the orders that we have on hand, they are all orders which are more of production centric. So the development centric orders will continue, which will pave the way for future, but the current orders, which will in the next 2 to 3 years, we can see a steady growth.
So 40% top line growth you're saying, and just margin as well, because margins this year, at the end of this year, shot up to 27%. Will you sustain it there, or do you think they'll get even better?
We will sustain the margins, and we are hoping that they get better.
Okay, all right. Hi, Amit. Good morning, and good to hear your optimism. Let's focus on a couple of aspects. You mentioned multiple times about the order book. Could you just update us? What is the current number?
The current order book would lie anything in excess of 900 crores.
900
after the deliveries. So,
all right.
Yeah, but the good part is, and which I've always been directing us towards, that the opportunity funnel is swelling. I used to talk about 1,000, 1,500. I remember. Today I'm talking about 2,000, 2,500. So now this is where the translation happens, and the steady growth in order book, as you can see, is an effect of a very, very strong funnel that we've been maintaining for the last 2 years.
And what's the probability that you grab some part of that 2,000, 2,500 crore opportunity? In this year, what kind of order inflow number are you looking at? 900 crores is the order book. The funnel is looking good. How much of that can you grab, and what kind of an inflow should we be working with?
We calculate a funnel only when the probability of we getting that particular order is in excess of 60%, and to a large extent 90%.
Oh, all right. So
are you saying that from a 900 crore rupee order book, this year that number could swell to maybe somewhere in the vicinity of 2,000 crores? Is that what you're hinting at, Amit?
I'll try to detangle. What happens is, when I'm saying an opportunity funnel of 2,000, 2,500, not everything comes in a particular quarter or a semester. So what we have to look at, the opportunity is lying in front of the company. Now, how and when it comes, that's how it gets translated into an order book. We are hoping that we'll cross 1,000 in very, very soon. Much shorter timeline. Near term, we'll cross 1,000, and we will be looking at somewhere between 1,000 to 1,500 carrying forward.
Okay, all right. Amit, could you give us just the big products where you are really playing in, where you're looking to really grow aggressively? Just the headline products really. Yeah.
I'll give you 5 products. One, submarine periscope. Second, the air defense high power laser. Third is the EOIR systems in joint venture with Paras. Third is border defense system, which is coming up now in the last 1 month update, border defense system. And last but not the least, the space programs.
Okay, but these are not products, the last two. What do you mean, border defense system? What
Border
exactly?
defense system is a product. It's a surveillance system with a gun-mounted weapon system, and that's being controlled by a control unit. It's an end product.
Okay, and the space what you said, space program?
All the optical contribution of the company for space missions.
Okay, all right. So you're guiding for a 40% growth on the revenue front. Could you give us the revenue contribution? Defense engineering has come down a little bit, and now it's pretty much even key with optics as well as optronic systems. So how do you see the mix evolve going ahead?
So we would always want, as a company, for having optics and optronic system doing a little more. 60-40 is the ratio that we would look at, because optics and optronic systems always are influencing heavily the profitability part. But the defense engineering is doing very surprisingly good. They are matching up to the revenues that the optics and optronic systems group is doing. So we are doing about 52, 53 and 47%. That's the split. On the order book side, we are about 60, 65% on the optics optronic systems and remaining on the defense engineering. But defense engineering orders come faster and they get delivered faster. So I would look at that 55-45 is a good mix, but defense engineering sometimes plays its part and then does come close very to 50%.
Just finally, this MOU you signed with Microcon Vision, the Israeli company. Just share some more contours. I mean, how exactly will this play out? What's the revenue opportunity? I mean, I don't know if there's a tech transfer involved. Just very quickly, what can we expect and by when from this MOU?
I'll be very quick. With this MOU, we will be India's only company to venture into optical cameras for drones. Now, when we look at drones, all the drones worldwide, the camera systems are one of the costliest payloads you can put on a drone. And these cameras are managed and manufactured, developed only by a handful of companies across the world. Now, we've partnered with Microcon, where the whole tech will be manufactured in India and subsequently co-developed for newer cameras. So we are revolutionizing the drones, the surveillance drones, camera systems, which will be 100% manufactured in India.
And this is for all Indian use, or you plan to sort of put this out for exports as well?
This will obviously come for exports as well, because by this, we are also increasing bandwidth of Microcon, where Microcon will be able to reach out bigger markets and then get it manufactured in India for their consumption.
Amit, how many periscopes go into a submarine? 2, right?
One submarine, 2 periscopes.
2 periscopes. And what is the cost of periscope?
We initially started off doing a cost per submarine periscope about 30 plus crores.
Okay.
And now we're increasing that value to about 45 plus crores.
All right, got it. Thank you very much, Amit. Good speaking with you. Thank you for joining us here on CNBC-TV18, and good luck. So, I mean, from the April lows, Paris Defense, the stock is up 65%. So, I mean, 820 odd rupees and 1373 as of the close that we saw on Wednesday. Let's just quickly take a look at the stocks as well, because the pre-open has come to an end. We can start with Zomato and let's just see where markets are, pegging these stocks at. Eternal, that is. Eternal is starting 5% lower. If you can look at Indus Tower, which is the other one where there was numbers are strong, but dividend was the story really. Indus Tower is down 3.5%, and maybe we could look at auto numbers. So look at Tata Motors and Hero, which I think are the 2 disappointments for in the passenger space and the two-wheeler space. 0.5% lower on Tata Motors, and Hero is actually absolutely flat as well. So nothing on it, about 3,800 odd rupees. Let's just quickly run through some trades now. Mitesh is with us with his call. Mitesh, what do you have?
For the 9-10 side, I think I'll go with the buy on HDFC Life for targets of 770.
Okay, all right. Mitesh, thanks for that. By the way, insurance was a space which did very well on, actually over the last 1 week, and we've put out some 2 or 3 stories at the margin which seem to be positive for the space. So keep an eye out on HDFC Life, as Mitesh points out. Let's just focus back on Eternal for a quick bit with, of course, focus on the numbers and what the street made of it. Mangalam.
2 things that did not work for Eternal this time around in the numbers. If you look at it, the food delivery GOV growth has been slowing down. In fact, at 16% is the slowest that we remember in the last many quarters. And at the same time, we have quick commerce, which is seeing a strong growth on the GOV, but their losses continue to expand as the company navigates through stiff competition and accelerates their store expansion as well. Food GOV at 16%, much lower, sluggish demand environment impacting growth out there, and they also delisted about 19,000 restaurants during the quarter. That took away 2 percentage points of their sales out there. Quick commerce, good GOV growth at 134% year-on-year, 21% quarter-on-quarter, but Blinkit losses at nearly 180 crores on the EBITDA front is something that the street does not like, and there is no commentary of comfort coming into the management. They say competition is only likely to intensify further from here on, and in that they will aggressively look at growing market share and not let near-term profitability goals come in the way. So all these factors, while in the long term may be positive for business, in the short term are impacting the stock price.
Okay, and impacting the price in a big way, Mangalam. Thanks very much for that. 5% lower, and I think it's exactly what Mangalam said. It's not just about slightly higher losses this quarter. It's about what the company is indicating on the future. Back to Sudarshan, let's talk about Mahindra and Mahindra on the back of the sales numbers.
So in the four-wheeler space, M&M remains the strongest one for the month of April. Both its tractors segment and auto segment have reported numbers which are much better than estimate. Auto segment sales were up 18%. For tractor segment, too, sales have increased by 8%. And in the passenger vehicle segment, the good part for M&M is it's now number 2 player in the segment, surpassing both Hyundai and Tata Motors. And in auto segment, one thing which has been doing good for M&M on like each month, that is the SUV segment. And even for the month of April, SUV sales were up 28%, outperforming even Maruti.
All right, so thank you very much for that. We've got a couple of seconds to go for market open, and we'll have it coming up on your screen. We'll look at indices and we'll go down and look at individual stocks as well. What do we have? It's absolutely flat on the Nifty, 24,340 or so on the Nifty. The Nifty Bank is up, blinking red and green, nothing on it, but I think we are now turning back into the green a little bit. As I said in the morning, the question is, will some of the nervousness around the India-Pakistan border issue, which was keeping sentiment depressed, start to moderate a little bit it's not gone away, it's still a topical conversation, but as days roll on, will the market starts to feel a little more comfortable here. Small cap index is up 1/3%. I think you've got the mid cap index, which is also starting a little higher. And actually on the screen, it's all green. The Nifty heat map should come up on your screen next, and it'll give you a quick sense of how we are likely to start. It's all mostly in the green. Some actually 14, 15 names are in the red as well. I can see Eternal on one end and Adani Ports on the other end. Surabhi.
On Eternal, the price cuts that some of the brokers are talking about, or rather the earnings expectations cut, Motilal Oswal's estimates have been reduced by 52% for FY26 and some 20-odd% by FY27. So given by that stretch, it's not bad. The stock is seeing buying. It opened gap down, but it's already recovering very, very smartly as we speak. So that's Eternal out of the way. Let's look at the rest of the market. Adani Ports, 3.5% higher, and Adani Enterprises, which also reported numbers that looked good, up about 1.5%. Jio Financial is having a good morning, 1.5% higher. Hindalco, there's some buying on it, but I don't see too many other metal stocks. It's Hindalco, the lone ranger as of now. M&M, so it was just selling us best in class as always, once again, 1.5% up after the April sales numbers. Tech is doing pretty okay today. Wipro, Infosys, it seems to be a little bit of a NASDAQ rub-off effect. HCL Tech, etc., all these stocks up. Reliance is helping the bulls this morning, 0.7% higher. So is HDFC Bank. So it's the big boys at the crease, and they're keeping things, quite supported, well supported. On the downside, Eicher Motors, 2% lower. Bajaj Auto, 1% lower. Let's look at Hero. Hero is down about 1% as well. Hero's numbers for April, the sales numbers were fairly disappointing. But everything put together, 100 up on the Nifty, so not too bad, Nigel.
Well, that's right. From the broader markets, a few stocks that are moving around. Railtel, that stock is up close to around 8%. Massive move is what we're seeing out there. JSW Infra, that's up close to around 2.5%. Big volumes out there. Reliance Power, actually, we had some news coming in on the exchanges. They've done a deal for some offtake. So that's moving on very, very large volumes, massive volumes in the first couple of minutes. So that's moving higher. NMDC, after a few months, they've gone ahead and effective a price increase of around 440 rupees. What's more interesting is the price increase is higher than what the street was working with. So the street likes it. Jio Financial Services, we had pointed out earlier today that Reliance Industries seems to have found its mojo back. Most of Jio Financial gets its value from Reliance's holding, from the holding they have in Reliance. So it has to play a bit of a catch-up. Then, in fact, maybe that's the stock to focus on from here on as well. So I'll keep an eye out on that name. On the flip side, you have Sonata Software. The stock ended high with a gain of 13% in Wednesday's trading session. Anticipating good numbers coming from Microsoft. The numbers are good, but the stock seems to have priced in advance. So that's why that stock's down close to around 2.5% as we speak. And I think the sector of the day really is tech. That's opened up with a good gain. So let's pull up the IT index. You have the Bank Nifty that's up close to around 280 points. The Nifty IT index as well. We had lots of earnings coming in from, from the globe in the last couple of trading sessions. And it seems to have taken a hint from there because the NASDAQ as well did bounce back. I think pull up JSPL. That stock, in fact, initially did start off with a cut of close to around 3%. There was a lot of pre-positioning getting into those numbers. No big shocker, but it appears there is some routine profit taking that you saw. So that's why that stock is down close to around 2.5% or thereabouts. It's a good looking screen. Some of those shots that were taken in Wednesday's trading session could be in for a bit of trouble if the screen holds as it is.
So it's an 80-point up move on the Nifty at this point, 85 now. So actually 24,420 at this stage. Coming through. Let's just quickly, I think we mentioned PNB Housing. PNB Housing is the number 2 big volume-led gain of the deal. The block went through in the morning. It's got 6% gains now, 1,073 on it. Coromandel, we'll speak with the management later. That's the 4th biggest volume-led gainer. It's about 4.5% higher right now. Moil is up 5%. Moil is coming up with about 332 rupees. Again, it's got decent sized volumes for this point in the day. And Nuvoco, which also reported numbers, and I think there is strong profitability expansion. 8% on Nuvoco. Stocks at about 345 coming through. And I can spot a few more, UPL, NCC, etc. But I mean, volumes are still yet to pick up on some of these names at this point in time. I mean, on the downside, there is, some reversals, etc., which are going on. Phoenix Limited, the mall operator, is down 5.5%. And Eicher Motors is down about 2.5%. Federal, and the rest are all result reactions. I mean, I think we've mentioned those, which is Eternal, Indus Tower, Paras. As I said, 65% from the April lows. Paras is down about 3% post numbers. And Federal is down about 2% as well.
Just one word on Nuvoco. Those numbers were good. Actually, we put out a review and, the volumes were good. The profitability has jumped up as well. The debt has come down, which has been a problem out there.
Yeah.
The only concern is how do they ramp up some of those acquisitions going ahead? They have a con call later today, post-market hours. So we'll have to keep an eye out on the commentary. But the performance last quarter was good. And valuations palatable at around $70 on an EV per ton basis. Just one more word. We're looking at stocks, but I think we should pull up the Indian rupee. If I saw that correctly, the Indian rupee has strengthened and it's breached that 84-odd mark. Now it's at around 83.86. So good, recovery is what we've seen in the Indian rupee. Keep in mind, the dollar index was stronger overnight. That had breached the 100-odd mark. The yen, in fact, did show some weakness, but the Indian rupee seems to be the outlier. It's strengthened even more.
Money. The FPIs, maybe.
I think so month end, there's a lot of demand for dollars. Yeah. So we've we've turned the month, and I think there is a little bit of a pop which is going on there. And of course, I mean, the big driver has been very strong foreign flows, equity flows, which I think is the head. And for now, the rupee is the tail. In that sense, Venugopal Gare is with us, Managing Director, Head of India Research at Bernstein. He's with us. Venu, good morning. Good to have you back on the program. Thank you for your time. What are you telling investors? What should they do?
Thanks, Prashant. So we're telling investors to buy. So that's been the case since January. When I changed my view from being cautious to relatively more positive on the Indian markets, and as you know, my Nifty target is 26,500. We are still pretty much some time or some large gap away from there. So our view hasn't really changed in terms of what investors should do. We use the operating word selective, but this idea was more to believe that we'll have a 10 to 12% returns for the headline indices, especially the large caps this year. So that's where we are.
That's interesting. Venugopal, great to have you on. So are you still telling people to buy? Because there are those who are arguing that if you strip out all the noise around tariffs, etc., if you just look at growth, look at earnings, it's still patchy. I mean, perhaps still at risk of more downgrades for this year. So intrinsically, does this market still offer opportunity?
Yeah, so there's two ways to look at it. Number one is more in terms of near term versus the next 6 to 8 months. So this market is not going to be a straight line up. So you will see volatility given all the global factors. But at the same time, if you were to just compare the earnings element of the risk, the earnings element of risk was substantially higher at the peak of the market, middle of last year. It was fairly frothy, both for large caps and mid caps. To a large extent, you've seen downgrades and revisions through the year. Many fag-end downgrades that we see today is more, I think, accounting and calculation related rather than macro narrative related. So I would look at the underlying positives, the fact that we have essentially started to improve on the macro front. We are relatively less impacted on the US tariff regime. That's the second positive per se. We're heading into perhaps a decent phase with respect to the rural environment. And more importantly, consumption and capex in our view are going to be better than what it was last year. So if we were to just rope in all these things together and also look at potential risk to global I would say, recessionary impacts, which could bring down global volumes where India is not that impacted, could bring down commodities as well. So that gives you that margin buffer, which could potentially positively play out when we look at earnings. So if not upgrades, we're definitely not in an upgrade cycle. We are perhaps not there in terms of a deep downgrade cycle as well going forward.
Okay. All right. Hi, Venu. Good to see you, Ben, as always. I recall when we spoke about consumption, the last time around, if I remember correctly, I think you all had added Jubilant. That was a stock that you liked. And I think Zomato was pulled out. How are you all, approaching the consumption basket from here on, given that, consumption is expected to improve as this calendar year progresses?
Yeah, fair point. So we did some tactical moves beginning of the year. Primarily, as you know, my consumption plays are DMart, Avenue Supermarts.
Yes, DMart.
Yeah, that was preferred over a trend. So that's why DMart was introduced in the India portfolio. Jubilant, as you rightly said, replaced Zomato. Not that Jubilant has returned much this year, but it's probably ended up protecting the downside. We do think QSRs, selectively, including stocks like Devyani, would do well for the rest of the year. Part of it is improving momentum in general. And small ticket consumption, I guess, is an area of focus for us. This is the real test because tax cuts do play out in terms of improving momentum for a part of that consumption universe. So unlike last year, where I was outright negative on consumption, I am still seeking opportunities and trying to selectively enter into areas where momentum either has settled or is improving and there are lower competitive risks. So I'm not getting back into Eternal yet, but I do believe a lot of those challenges are starting to reflect in the stock price. But still, it might take some time before I reintroduce stocks like that.
The stocks actually done really well today. The market's seen this in a slight positive way. Perhaps some of the reasons could be that Eternal this quarter has decided to shut down some of the businesses that it didn't see too much value in. For instance, this 15-minute delivery, their challenge to Swiggy's Bolt. Maybe the market's saying that, okay, this is sort of a cleanup and a more focused approach, and perhaps that's what is getting rewarded. But anyway, good pickup from the lows on the stock today. Venugopal, what about financials? Obviously, it's no longer a straight line. It's not, you can't paint everything with the same brush. There's a lot going on, especially in tier 2. I mean, NBFCs, for instance. Shriram was a bit of a disappointment. We've seen some issues, wrinkles with Chola as well. So, how are you looking at lenders and what would you pick? What would you strictly avoid?
Yeah, so my idea of being overweight in financials this year was a pretty broad-based one because I had a fairly large overweight. So this was my highest overweight sector heading into the year. Part of that was my view that cycle is essentially going to favor growth. A change in dispensation with respect to approach to liquidity from RBI, which was more visible from December last year, also gave comfort. So lower regulatory scrutiny, these are all the aspects which positively play into the overall financial sector in terms of opportunities. So the way we were looking at it was banks. I wasn't a big fan of NBFCs per se. Of course, you can selectively pick things here and there, but my portfolio was stacked up more towards banks, followed by insurance, which was more defensive for me as well this year, given that a lot of the regulatory noise I felt had already reflected in stock prices. So these are the two ways in which we've been essentially trying to play the financial sector. And I think the question from here would be that, look, this sector is already outperformed. So does it really make sense to remain invested? I really think it's still early stage in the sense that, look, stocks have moved up, but they're still not as costly as they used to be in the past. And relatively, you don't really have other sectors which are cheap. So we're still playing for the next 10% return from here. And I think financial sector can over-deliver on that.
No, got that. Venu, what's on your small cap list?
Yeah, I mean...
whatever you've published. I mean, so it's out in published reports, yeah.
Yeah, so, I mean, look, honestly, I'm not too small cap heavy.
I know. But what is on that? So that's why.
So, small cap is a part of my India main portfolio at this juncture. I guess the only stock I have can be categorized as small cap is Jubilant. That's the only one perhaps from what I recollect. There's nothing else small capish. I used to have a separate mid portfolio where we had some ideas last year, things like Dixon or Keynes and others. But that SMID portfolio is largely suspended this year because we don't want to really play a pure SMID strategy. It can be extremely risky in terms of a volatile environment.
Yeah. Venu, in terms of feedback from foreign investors, and you do a lot of these trips to the US and other parts, and you meet a lot of the large allocators, what is the feedback on India now?
Feedback on India is a bit mixed. Global investors were underweight in India in February. They were overweight on India in July. So firstly, it tells you that positioning-wise, perhaps they are not the best judge in terms of approach to India. But leaving that aside, I guess most of them are progressively looking at India in a more positive light as compared to other countries within EM universe. Part of it is driven by recovery in macro, and part of it is driven by the broader theory that India is less impacted in times like these when there is global upheaval on the trade front. Does it mean that there's going to be a major allocation shift from China to India? Tough to say, given the relative valuation differences are still very large. But I do guess that my thinking was FII outflows were done. So in March 15th or something, I had written this report, which was based on 100 meetings, which primarily said that if you're already underweight and you've seen such a large swath of FII outflows, you should not see any more outflows. So FII outflows bottomed out. Incrementally for the rest of the year, are you going to see a massive resurgence of flows? That is tough to say. A lot of volatility factors out here, and also depends on DM to EM shift in money, which is still a question mark at this juncture. So EM funds need to be able to raise money for us to see incrementally a lot more allocation to India. But overall positive. I actually saw domestic funds being a bit more negative and cautious with respect to India. And I guess part of the questions that you asked in the beginning around earnings, there is a general worry that there could be earnings risks. So domestic funds seem to be more cautious than international funds.
Okay, all right. I remember the FI holding in the Indian markets had gone down to the lowest we've seen in more than 10 years, when it came down to that, I think 16.5%, 17% or thereabouts. And now the hot money is coming in as well. And as we had that chat with you, Venu, seems like the street was listening in. The markets have moved to the high point of the day. We have hit the highest levels since 17th of December. But as you're making that important point, earnings could still be at a bit of a risk.
Just to conclude this point that Venu is also making, Venu, completely take your point, right? Domestic funds and domestic investors are more wary of earnings. FIs are not. But from their perspective, I mean, this is still best in class, right? In a world which is, God knows, recession, degrowth, what we have in terms of tariffs. So perhaps that's what's getting in the FI buying. But thank you very much for joining in. Great conversation this morning. Thank you for being with us.
All right, let's focus on our next management then. Sona BLW, that's the one that we're going to be looking at. We have with us Mr. Vivek Vikram Singh, the Managing Director and the Group CEO at the company. Hi, Mr. Singh. Good morning. Thanks a lot for joining in. Well, the stock started off a little in the red, but it's recovered from the lows. Before we get to the margins and other aspects, let's talk about the globe first. We have this entire tariff situation that's playing out. According to your analysis, how much of your business is at risk owing to these tariffs that have been announced close to a month ago?
Sure. Good morning, Nigel.
Morning.
The globe's still round, so it's still spinning. The world goes on. The tariffs bit, I think there was a recent relief announcement, which has been fairly positive for our customers because most of them are actually, almost all are domestic assemblers in the US. So it's been fairly positive. But I'll just break it down. We have about 40% exposure to the United States. 30 out of that 40 is direct to OEMs and 10 is to tier ones. Out of that 30, 20 is in HSN codes, which are actually not covered under auto HSN codes. So they are in reciprocal. So there is about 10% tariff right now. Let's see what the BTA negotiations and how they go. And if it goes positively, I think that's at pretty much no risk. The remaining 10% is pretty much done in the US for our US customers. So it's US to US. And there too, the impact is pretty much nothing. Now come to the last 10%. So we've done a line-by-line, program-by-program analysis. And what we've concluded that 70% of it is, I would say, places where it's very, very hard to replace us with anybody local. 3%, I would say, is what could be at risk in the worst case scenario of our total revenue. So that's where it's at as of today. Now, tonight, someone can announce something else and things can change. But as of today, this is where it stands.
You know, Vivek, I'm hoping for a good weekend. I hope he doesn't announce anything today. But let's focus on a couple of other aspects. You know, X of the PLI, actually the margins were a little lower than what the street was working with. The street has taken it in its stride because after opening up in the red, the stock has actually recovered. What is the margin guidance you can give us for this year? And also, if you could help us out with what kind of a rough revenue growth you're looking at. It appears for the time being, the risk of losing business will be low single digits. So if we are to give an estimate as of now, if things change, then we won't hold you to this guidance, but otherwise a range on the revenue aspect as well as margins.
Yeah. So Nigel, in the last 4 years that you've been talking to me, I've never given guidance. So I'm not.
But nothing wrong in trying again, right? You could give us a range. I'm sure you'll want to give us a hint at least. Since you've given us a 3% number, I said maybe you'll want to give us a growth guidance number as well. Go for it.
No, growth guidance is something we have intentionally stayed away from. And right now, when signal to noise ratio is perhaps the lowest it's been in the last decade, it is a very bad precedence to set. So we won't give growth guidance. We will have growth, of course, because we've also added a new business, right? That starts from 1st June. The railway business starts getting added. So a lot of things to look at. And on 2nd May, to be honest, to figure out what the impact of tariff that are going to come into play on 3rd May is beyond my abilities.
Okay, got that. Vikram, hi, good morning. Prashant here. You said 3% of total revenues can be lost to lower cost suppliers in the worst case because of tariffs. That's your assessment.
Correct. And they're not really lower cost. They're lower because at one, they are not lower, but when it becomes 1.25 to our customers, of course, it becomes different. But see, in this scenario, right, the only people who can do it is people who have local capacity in the continental United States. Not anywhere else, because everyone else has the same problem. Actually, prices for our customers just went up by 25% for everybody. That's what they've done. For the HSN codes that are not covered in auto part list, they went up by 10%. So unless there is capacity and capability to do that part in United States, it is not possible to touch our business. And even that takes 12 to 18 months in our ability to shift.
And that 30%, 40% exposure to the US, you said 30% is to, so 30% it's the reciprocal part, not sector-specific tariffs, right?
So 30 is to OEMs. In that, 20 is reciprocal, 10 is non-reciprocal, but that 10 is where we are actually supplying within the United States to our United States customers. Second, this tariff relief actually, for most of our customers, the domestic value addition is greater than 80%. So if you look at the rebate for the next 2 years, they have to shell out pretty much nothing to cover all the cost of the extra import tariff.
Vivek, hi, morning. Just one final point on tariffs and this whole global situation. What is the mix right now? If I talk about the total revenue pie for Sona, how much is exports, how much is domestic, and what are you looking to maintain given all of this volatility and the shifting positions internationally?
So we don't segment by exports, we segment by end markets because we produce everywhere in the world. We have a plant in China, 2 in Mexico, 1 in the US, 7 in India. So it's 40% exposure to US, 30% to India, 24, 25 to Europe, and 5, 6, whatever the remainder to rest of Asia, China plus Southeast Asia.
Okay, so now just tell us, because you also have exposure to Europe, let's leave out US, which is the whole tariff situation, but your business to the US, is that taking any kind of a hit at all because of delays in decision making or sentiment shifting or, OEMs being unsure about what they want to do in terms of expanding their supply lines?
Great question, Suki. So we have actually in our earnings call called that out, that although we don't know anything yet because it's just April, right? April had no impact. We do think that there is a possibility that there will be general slowdown everywhere in every single market. And what that will be and how much, we don't know. Also, it will depend finally on what these tariffs settle at, right? So far, nothing has happened. But if this does happen, I mean, a global trade war would not be good for anybody. You cannot hide from it.
Yeah, no, absolutely. And I think that's the bigger one, right? The indirect impact, the slowdown, which will, I think, affect everybody. And that's absolutely impossible to quantify. Vikram, we're out of time, and I wanted to ask you about humanoid robots. That's the interesting stuff.
Yeah, that really caught our eye. But maybe just 10 seconds. What exactly are you looking to do there? A humanoid robot?
Okay, so I'll try to be very quick. Humanoids are where electric vehicles were in about 2015, 2016. That's when we started getting into electric vehicles. 50 to 60% of the BOM of a humanoid robot actually comes from parts that are well within our capability set.
BOM is bill of materials. 50 to 60% you can make. Yeah, basically.
Yeah, so gears, actuators, motors, these are the things we make. Prashant, anything that moves needs a motor, it needs a gear system, and it needs some sensors. So you can theoretically go into everything that moves.
We will have you back on. We will have you back on.
Yeah,
I think these are a very, very interesting space. I mean, and there's a lot to talk about here. Thank you very much for joining us with that perspective, and great to get that. Bandhan Bank is the next company that I want to focus on. Numbers came through. And we have, I mean, the question with Bandhan, of course, it was a bit of a weakish quarter once again. The question is have we seen the worst? And will things start to improve dramatically over the next few quarters? That is the market expectation. We have Mr. Partha Pratim Sengupta, Managing Director and CEO at Bandhan Bank. Sir, thank you very much for joining us. Good morning, Prashant here. So my question is exactly that, sir. Have we seen the worst? You know, over the last few quarters, we've seen Bandhan kind of recognizing bad loans, etc., at a very accelerated pace. You know, taking all the pain in. Have we seen all of it with this fourth quarter numbers? And will things look much better from here out?
Precisely, I can say another 2 quarters will be a challenge.
Okay.
But not to the extent what we have seen in Q3 and Q4 of the last financial year, that is 24-25. The delinquency book is definitely improving. So the slippages would be much lesser. But yes, the microfin segment, as you know, that the entire country has been affected. And we are also not insulated again from it. So a little bit of challenges would be seen in Q1 and Q2 of the current financial year. But Q3 and Q4, we are expecting a very good, I would say, for results from the microfin segment. And definitely, I think going forward, the things will again be as better as we have seen in the previous 2 years back, especially in the pre-corona period. So this sector is showing improvement, but albeit at a little bit slower pace. That much I can say.
Q3 numbers, that is October to December, numbers should go back to where they were pre-COVID, basically, by Q3.
We are expecting that, yes, definitely there will be much improvement, Q3 and Q4 of the current financial year. Q2 and Q1, I would say that, yes, the slippages won't happen, but definitely at a much lower pace. The rate would be much low for that. We are seeing that there is a sequential improvement in our delinquency book, which is a very good sign.
Okay. All right. Hi, Mr. Sengupta. Good morning and good to see you in. Nigel on this side. Give us some numbers. How do you see the credit cost panning out for the remainder of this year? You're guiding that better times ahead. So in the first half of the year, what will it look like? And then how do you see a recovery from there?
So you see the credit cost for the entire financial year was 2.9%.
Yes.
And the way we are going forward, I think this year we may end up something around a little bit over than 2. So the entire year we are aiming at around 2.3, around that. But again, this will depend on a lot for that year. The first of all is that we have to decrease our loan loss provisions. So that will definitely come because we are now very adequately provided. You see our PCR ratio, including a write-off, is almost 87%. And without PCR also, we are about more than 73.7%, so which is almost 74%. The microfin book is almost close to 79%, the PCR. So we are sufficiently provided. So going forward, we are finding that with the improvement in our loan book, and that also you have seen that we are now turning more universal. We are going towards our secured books. So our secured books percentage has increased from 42% to 50%, 50.5 during the last year. And our target is that we should reach by 55%, 50 in the next 1.5 year or 2 years for that. So that is our goal. So with this secured book position, definitely I would say the quality of assets would be better. The microfins area of this segment is also showing some improvements. So from Q3, Q4 onwards, it will come. So our target is that within next 2-3 years, we should contain our credit cost and bring it below 2%. So that is our target for the year, and we are working on that.
So 2.9% comes down to 2%, and just going through a couple of notes, I believe that in the next 3 years,
this year will be around 2.3, 2.4.
2.3, 2.4, and then gradually you're looking to take it to around 1.5, 1.6 over 3 years is what I understand.
Yes,
got it.
Absolutely.
So we got the near term and the longer term guidance. Give us two key numbers then, sir. What is your advance growth you're expecting for this year, advances, if you could help us out with that? And how do you see the NIMs panning out as well?
So, number one, regarding advances, we are looking for a 15 to 16% growth for this year. And as we have aimed, and we have also tried from last year, and we have been successful, that our deposits growth would outpace the advances growth. So, deposits growth, we are increasing a little bit more than the advances. CD ratio, as you have seen, that we have brought it to 90.5% for that year. So almost that same ratio would continue, but maybe a little bit high or low. Going forward for the NIM, you see the NIM would be moderated. We have told very clearly from Q3 onwards that as we are moving towards a secured book, our NIM would be moderated, and it will be further moderated a little, but the volume would definitely increase so that there is an overall improvement in the actual figures in the profits.
So where should we, on a steady state basis, where should NIMs be? If you can give us some guidance.
So we are around 6.4. We are looking. We are steadily coming down. So you see this quarter it was around 6.7. So it may come to around 6.4 around.
To about 6.4 or so. Got that. You said you should go back to pre-COVID kind of performance post starting third quarter, right? You would have recognized all the old stress, new stress, of course, we'll have to see and take it as it comes. And you're not alone. The industry is facing it. Could you give us a sense of, when you say go back to pre-COVID kind levels, what are we exactly talking about, sir? Just give us some sense.
Let me tell you, by pre-COVID sense, I want to mean that the slippages would come down substantially. That is the thing. The NPAs would be contained at a much more higher level. Number two, for the day. So, and this is, I'm talking about the microfin sector. The other sectors, as you have seen, that our book is quite healthy, whether it is the corporate book, which has got a little bit more than 1% as NPA, so which is quite healthy for the day. The housing, finance, whatever the NPAs are there, most of the cases are legacy cases, but that is also being now contained. In respect of the wholesale banking, and I have told you the other sectors also in the retail. So I think the book is quite better for that year. So there is no worry on those fronts. The only worry that is coming is from the microfin front, and where is witnessing that the delinquency level sequentially is coming down. So that is a great signal that going forward will definitely come down.
All right, very quickly, sir, before we let you go, your OPEX spend has moved up. I think you have guided for that, which took your cost to income ratio to around 54%. What do you end this year with? If you could tell us, because you've said you're going to continue to focus on that aspect. And also the ROAs are still very, very subdued. where do you see the ROA headed? Both these two, cost to income ratio and ROA. Go ahead, sir.
So as regards cost to income ratio, while the Q4 is high, it has always been high. It has always been high in the previous quarters because, many of the costs come in the Q4. But if you look at the whole year figure, it is around 48.56%. So that is, I think, quite reasonable. So we have added people as we moved into the other sectors of the businesses. We have also invested in technology, and there will be further opening up branches. And also last year also, I'm talking about 23-24, we have opened close to around 240-50 branches. So all those costs have added up on a full year basis during the previous financial year. So that has actually led to an increase in the cost income. But now we are waiting for getting returns from what we have invested. So going forward, I can say that while investments in our resources and investment in skills will continue, but definitely whatever we have invested in the past, that return would be coming. So the cost to income ratio would be contained, and it would be contained at the same level around 47-48%. That's what we are aiming at. This is the first thing. And regarding the return on assets, so you see the overall return on assets was 1.5%. Our target is that we should reach close to 1.8 as soon as is possible. But again, as I've told you, that this year, maybe the return on assets will be around 1.5, 1.6 from the simple logic. Because previous year, Q1, Q2 has been good. Q3, Q4, there were challenges. This year, we are expecting Q1, Q2 will have challenges, but at a much lower level. And Q3, Q4 would be good and maybe better than what we have done in Q1, Q2 for the last financial year. So going back, simple trade, I can say logically that 1.5, 1.6 ROA, we will be able to achieve this year.
All right. Thank you very much for joining us. Good speaking with you. It's a pleasure, having you with us with that perspective. Look at the market go. There's a really good bounce. 200 points now on the Nifty, 24,540. And you got some 2.5:1 in terms of advances to declines as well. So overall market doing very, very well. Financials is what we are continuing to focus on. I think we have the Federal Bank management with us.
Well, that's right. Let's get straight to Mr. Harsh Dugar, the Executive Director at Federal Bank. Good morning, sir, and thanks a lot for joining in here on CNBC-TV18.
Good morning, Nigel, and thank you.
Let's get to a couple of aspects then. Your growth has slowed down a little bit. Could you tell us what is the outlook from here on? I believe that you're planning on outpacing the industry growth from here on. So what kind of growth are you looking at for the industry?
Okay, so I'll take a step back. I'll speak about the quarter first. If you look at it, 1/4 of our assets was basically in gold and housing loan. And housing loan, we had consciously decided to go slow, given that the pricing was sometimes bordering towards irrationality. So that was one. And gold, because of the regulatory announcements, and there was a little bit of an ambiguity, and different players were interpreting it different way, led to a marginal degrowth. But if you look at it otherwise, we have been growing some of our assets, which we have been saying the medium yielding assets, in a reasonably good manner. If you look at our MSME book, it's been growing at 20% YOY. If you look at our cards business, it's about 19%. So we're looking at growing our core mid-yielding assets and high-yielding assets in a significantly better way. So the idea would be to have a thrust and focus more on the medium-yielding assets, and subsequently, as we progress during the course of the year, on the high-yielding assets. So this is how we are. In terms of how we are guiding, we have always been saying that 1.2 times to 1.4 times of the nominal GDP growth is where we are looking to peg our growth rate on advances as. So this is where we would like to guide the markets at.
Okay, in percentage terms, so what would that be? You're aiming to deliver around 1.2 to 1.5 times of banking system growth, right? So what are you factoring in for the banking system then?
So we are seeing that banking system looks to grow at about 12%, 12 to 13% is what people have been saying that. So we've been saying that about 15 to 17% would be a broad range. It obviously depends upon the outlook. The tariff wars have also created some sort of an ambiguity in the minds of many of the corporates. So we look at how this shapes out. But broadly, what we are guiding is about 1.2 to 1.4 times over and gain market share on the advances piece.
Okay, got it. All right. We're just hoping that tonight we don't hear anything coming in from Mr. Trump. Everyone wants to have a good weekend. He doesn't seem to be giving everyone, too much of sleep. But let's focus on your business. Where do you see your CD ratio settle at?
So CD ratio is about 83% odd. We've been saying that about 85%. We plan to we always believe in fund before you lend kind of an approach. The good part is in the last couple of months, the pressure on deposit has actually eased out. RBI has actually infused substantial amount of liquidity between a CRR cut, OMO operations, and other steps taken by the RBI. So there is surplus in the system right now. Deposit rates have fallen. So to that extent, I would say that the CD ratio doesn't look to be under pressure at this point in time. And also the advances growth for the system as a whole, if you ask me, has slowed down a bit, partly because of the unsecured PL is slowing down, the corporate book in general for the system as a whole slowing down. So the CD ratio is not under pressure for us or for the system as such now.
Mr. Dugar, hi, good morning. Could you give us a sense on, so high-yielding loans, is that, as a total percentage of total loan book, what is that at?
So as a percentage of our total loan book between high and very high yielding assets, just about 5%. This constitutes of credit card, PL and MFI loans. So in credit cards, we've seen a growth coming in and we've seen a reasonably robust growth. In personal loan, because of the stress in the system last financial year, we had consciously gone slow, but we're looking to getting this back again in this current year. MFI, we would like to wait and watch for 1 or 2 more quarters to see how things seems to be bottoming out. And there seems to be some green shoots in terms of collection efficiency improving. But there are certain states where we are still watching very carefully as to how that will shape up. Karnataka, Tamil Nadu now after the recent announcement. We would like to be watching it closely before we take a call to grow this book. We grow the MFI book for sure, but not at this point of time. We would like to take a bit of a pause, be a little cautious and calibrate the growth.
This sharp, it's only 5% of the book, but it's this sharp deceleration, right? About 10% growth now compared to 20% plus same quarter last year. Some of it, of course, is deliberate as well, as you're pointing out.
It was quite conscious, yeah. It was quite a conscious call. See, it's easy to grow this book. It's never difficult for any bank for that matter to grow this book. It's a conscious call that you don't want growth over asset quality. And asset quality remains because it's more important that you get back your money, what you lend. So that's what the focus is.
Yeah. So on an overall basis, what were loan yields at in this quarter, the quarter gone by, and what can we expect on margins? Is there going to be a slightly downward pressure, even with rate cuts, etc., coming through?
The yields we obviously did because we've already seen 2 repo cuts. One happened in Q4 and one in the current quarter. So definitely the yields are under pressure and likely to be because most of the people are expecting 2 further rate cuts to happen, if not more, at this point in time. So there will be, and what typically happens, the yield comes off before the cost of deposit starts coming down, right? So the NIMs will always do a catch-up with a lag. So we do expect the NIMs to be under pressure. Answer is yes. Now, how are we addressing this issue? There are a couple of things which we have done. If you recall that we already on the first few banks to cut down the rates on a savings bank by about 25 basis points. So that's come after the 2 rate cuts. That's number one, which would help us. Second, the thrust is more on the CAR piece of it when we're doing a deposit mobilization. So if you look at it, the CAR growth in particular for the bank has been very good in the last financial year. We grew about 35-36% in the last financial year on the CAR piece itself. And that's zero cost funds for us. So the share of CAR in our overall book was at 6%. And today in March 25, as we spoke about, was well above 7%. So the mix in the liability side is also changing. That's the second part. Deposits have also been repriced, but that will be for fresh. And hence the benefit of a lower cost of deposits will come with a little bit of a lag. On the asset side, 50% of our book is actually repo linked. So that obviously faces pressure. But over here also what we are looking at doing is we can do the interest reset at T+1, which we are on the few banks. We're looking at moving it to anniversary dates plus 3 months, which is regulatory permissible. So this will give us some time of a lag to reprice our asset book also. Another piece on the asset side is regarding the asset mix, like I mentioned earlier. So the focus will very clearly be on the medium yielding assets, commercial vehicles in particular. We are looking to grow that book sharply. We grew 35% last year, and we're looking to grow that also this year. MSME remains a clear focus. We grew out the MSME book as a whole, we grew about 20%. We're looking to grow that again in a significantly better manner. So between a good asset mix, managing your yields, because of the repo cuts, looking at fixed rate loans wherever we possibly can, are the various steps which has been taken by the bank in terms of ensuring that we kind of reduce the pressure on the NIM.
All right, closing comments before we let you go, Mr. Dugar. NIMs, what does it mean? The benefits of lower cost deposits will flow in with a lag. You also said yields are a little bit under pressure. What is the NIMs you should be working with? And I'm looking at the slippages. Last couple of quarters, it's been ballpark around 500 crores. How is this number likely to pan out? Please go ahead.
So if you look at it, our asset quality has been at a decadal best. Our GNP at 1.84 and net NPA at 0.44, which has been good. Our credit cost for the quarter was about 26 basis points, and for the full year, just about 38 basis points. We have been consistent of being conservative and ensuring our asset quality. So I don't think we see a threat. We've been guiding the market at 40 to 50 basis points in terms of credit cost, which is what we are maintaining at this point in time as well. And we don't see, very frankly, any significant stress or anything blowing up which will cause any kind of a concern. The MFI stress, which was of a concern, seems to be bottoming out. We'll watch for a quarter or two more, but this is where we are at. So if I have to guide you for an asset quality in terms of credit costs, I think we are guiding at about 40, 45, 50 basis points.
Got it. We'll leave it there. Thank you very much, Mr. Dugar, for joining us. We wish you all the best of luck as you get into F526. We take a quick commercial break here. We connect with the management of Coromandel International on the other side on their fourth quarter numbers and outlook. Okay, welcome back. You've got the market, which is up 250 points. I mean, this is looking good. 24,600 is where we are now trading at, which is at the day's highest point. I mean, actually, been trading for about an hour, but that's the picture. For the week as well, by the way, we are up about 2.25% now. And of course, today's 1%, adding quite a bit to the overall situation. Coromandel International is the next company which is on our radar. Reported a good set of numbers for the fourth quarter. Overall results are better than expectations, while margin growth came in slightly below estimates. We are now joined by Mr. S. Sankar Subramaniam, Managing Director and CEO at Coromandel International. Sir, good morning. Good to have you here. Prashant this side. Let's just start with specific segments. What kind of volume growth are you seeing for the nutrient and CP segments for F526?
Good morning, Prashant. Thanks for talking to us. As you said, Coromandel has reported a good set of performance for Q4 as well as for the full year 24-25. Thanks to overall good agriculture environment. As you know, the Rabi season, which completed, was very good. India is likely to report another year of record food grain output, thanks to supportive government policies as well as the resilience of the farmers. And Coromandel, being in this space, has reported a good growth in volumes. In fact, on a quarterly basis, fertilizer volumes for the quarter has been significantly higher, by 19%. It moved up from 5.9 lakh tons to 7 lakh tons. And also on the full year basis, we have achieved a record volume of close to 40 lakh tons of NPK fertilizers. And our SSP volumes have been 7 lakh tons. So overall, it's been a good, satisfying year on the nutrient side. But I'm very happy to note that even the agrochemical business segment has grown now very well. We have grown by 24% revenue growth in Q4 alone. And for the full year, we have achieved 7% growth. Thanks to our increased volume of exports from active ingredients, improved price realizations, and introduction of new products in the agrochemical space. We have recorded good growth in the profitability of agrochemicals, which has moved significantly from 290 lakh tons to 290 crores to 363 crores. Looking ahead, I'm sure we will continue to maintain this growth trend. Of course, in the case of fertilizers, it's a function of capacity and continue to operate the plant at full capacity utilization. As you know, last year we announced a project to add the capacity of 1 million ton of fertilizer, which will come through in the year 26-27. And we are also embarking on debottlenecking projects that will aid the growth in volumes in the year 25-26. In the case of agrochemicals, definitely we look forward to a high double-digit growth in the revenue terms and supported by good profitability with the introduction of new molecules and as well as new products which are in the pipeline. And also on the retail front, where we are one of the largest player in the agro segment with our own retail outlets. We have added close to 100 retail outlets in
Sorry, just to running a little short on time, so allow me to come in. So high double-digit growth in agrochemicals in FY26. On the nutrient side, sir, what should we expect?
In terms of the volume, we will try to expand our volume by 5 to 6% because it's a function of capacity what we have, and already we are operating at full capacity. But as and when the new capacity comes up in the year 26-27, we should be able to increase our volumes. So next year we can expect 8 to 10% of the volume growth on fertilizers, including the traded volume.
Okay, all right. So hi, good morning. Good to see you, Ben. Tell us about demand and crop protection. How is that? And since you have gotten, you've done some inorganic growth, NACL is going to be coming into your fold. How does it change the dynamics, your market share, as well as profitability going ahead?
No, in fact, we do expect revival in the agrochemical space, which witnessed challenges in quarters in the earlier year. And coming years, we do expect the improved price and improved sentiments and increased demand for agrochemicals and the introduction of new products from our own portfolio, which we are able to see a good growth in revenue. And the NACL, still we are ready to get the regulatory approvals. Maybe too premature for me to comment on that. But overall, we see a good recovery in the price trend and the demand uptick is there. So with the good onset of monsoon expectation, the Kharif, all the IMD predictions indicates a positive monsoon. So we do expect increased demand for agrochemicals, both in the domestic market as well as in the export market.
No, I get that. Overall, sir, can you give us a sense of what FY26 top line can grow at?
In case of nutrients, as I mentioned, 8 to 10% of the revenue growth. And in the case of crop protection, it will be a high double-digit growth on crop protection segment. And we are looking to expand our retail footprint from currently what we have 900 stores, likely to go up to 1,400 stores. And that will also aid the growth of agri inputs across. Besides that, we are also looking to grow our service business, which is drone spraying services, which we are expanding across India. And also we are trying to do seed marketing for fertilizers in the northern markets, anticipating our new capacities. So all this, we can expect double-digit growth in top line and supportive EBITDA as well.
Just one quick question, sir. Is there any senior management sort of changes, etc., which are being contemplated at the company?
No, as we have communicated after our quarterly results, Mr. N. Srinivasan, who is our Murugappa Group veteran, has joined us as Executive Vice Chairman. His financial acumen, his business expertise will definitely help as Coromandel embarks on this journey of growth in the next few years. And also there is a change in our Chief Financial Officer. Jayesh Sadagopan has decided to move on, and we have got Deepak Natarajan as the Chief Financial Officer. All this has been approved by the board in the last board meeting.
I see, Mr. N. Srinivasan, Vice Chairman at joining. Of course, as you said, Murugappa Group veteran there. Thank you very much, sir. Good speaking with you. Appreciate your time here on CNBC-TV18, and we'll speak again. Thank you. We'll just focus on what's happening in commodity markets. Manisha is here with what is top of mind. Gold certainly is not top of mind. Gold prices actually from the recent highs are down about 5% or so. The other one, I think, which Manisha will talk about is oil. Big drop, big drop, Manisha.
Well, the wrong guess really, yes, but crude oil prices did see a decline of 2% on Wednesday. But one thing that also has seen a very sharp decline coming in, Prashant, has been the copper prices. Fell 5% on Wednesday, saw some more decline in the markets yesterday. The US fell 5%, while the LME copper prices declined by 3% on Wednesday. It has been a very sharp decline that we have seen come in for copper, and I'll shortly come to the fundamentals as well. But traders have been unwinding arbitrage positions across US, LME and Shanghai. Those are the three important major trading markets and the global markets there. And we have seen premiums and discount work there. So we've seen a huge unwinding. And the unwinding has happened because the China is headed into a long weekend. It's a 5-day holiday, Labor Day holiday in China. And that really has led to markets being shut there. And we have seen a lot of unwinding happen because of that there. Well, markets also are reacting to the weak US GDP data. The numbers clearly have surprised on the lower side there. And when you look at the China PMI number, that also came in at a 16-month lows. We've seen export orders at the lowest since 2022. So very weak economic numbers coming in from US and China has been yet another reason that you saw a sharp decline come in for copper prices. Well, US is reviewing potential tariffs on copper imports, and that has kept the copper prices on the higher side. But with the easing of tensions between US and China, that has led to some profit taking coming in, not just in gold and crude, but in copper as well because of that reason. The copper prices, though, could be looking at some support going forward because there are supply concerns in Peru. The two important mines, Antamina and La Bambas, are looking at unrest with the workers there, and that can be supportive. But most importantly, what the copper prices will react to going forward from here is really going to be the International Copper Study Group numbers that came in over the last day. Well, if you look at the markets, they are anticipating a surplus going forward. We did see a surplus in 2024-25, could be looking at almost a double of a surplus there, and above 200,000 tons of a surplus is anticipated for 2026 as well. Now, the ICG also is talking about the world mine production, and here as well, the numbers are quite on the stronger side. In the last few years, we've seen mine production increase by 2%, and while 2025 is anticipated at 2.3%, next year could be higher at 2.7%. So we're looking at higher mine production and higher inventories as well. So surplus is what the street is working with. The world smelting capacity also is expected to increase by 2.9% in 2025. And when you look at copper smelting, it is about Asian markets here, whether it's about China, India or Indonesia. This is where you will see higher smelting capacity coming from. Take a look at the demand numbers there as well. So while in 2024, we saw demand gain up by 2.8%, it is anticipated lower in this year because of tariff concerns and recession concerns as well, weak economic data as well. And when you look at the consumption, that is expected to go even lower, below 2% in the next year. And that is what really seems to be bothering the copper prices. So while we have seen all-time highs in US for copper in this year, whether those prices will come back yet again in this year, the street expects that not to happen. What is that in focus today is going to be the US non-farm payroll data. While the longer term for copper is still under pressure, the near-term cues clearly would come in from this data.
Absolutely. And that's later today around the time that US markets open up. Manisha, thank you very much for that. So that's commodities in focus. We take a quick commercial break here. On the other side, it's our special segment. It's the economy. Lata in conversation with Lord Mark Sedwill of Geopolitical Advisory for Rothschild and Company on the global divisions post-Trump tariffs. Stay tuned.
Welcome to It's the Economy. In the past month, geopolitics has become a more important factor for corporate boardrooms and financial markets than probably it has ever been. Most corporates are not designing capex plans, not deciding what product they would make and where they would make, because tariffs would depend on what they make and where they make. Geopolitics has become so important. So today I have with me a guest who can perhaps help us understand how the current geopolitical turmoil will pan out into geoeconomics and what may be its end game. I have with me Lord Mark Sedwill. He is the geopolitical advisory for Rothschild and Company. He has in the past been UK Cabinet Secretary. He has been National Security Advisor for the United Kingdom and has served in diplomatic positions in several countries in Asia and the Middle East. Lord Sedwill, thank you very much for sparing time.
Thank you so much for giving me the opportunity. Very good to be here.
Well, so let me start at the for an Indian audience. You know, this entire US-China war, in India, people try to look at the optimistic angle by saying that we are probably going to be beneficiaries because production may partly shift to India, or in a Cold War between US and China, US may lean in favor of India. Are these fair assumptions?
Yes, I think they are. I think there are opportunities for India. And I think one of the things that is not well appreciated, actually perhaps in Beijing or Washington, is that the world is not actually going to coalesce into a sort of blue team and a red team, one around the United States and one around China. Many countries, and India probably most prominent among them, have a strong tradition of non-alignment. Now, it's a different non-alignment to during the Cold War, but India, Indonesia, Brazil, Saudi Arabia, South Africa, indeed many European countries are determined to have a positive relationship with China and a positive relationship with the United States and not be forced into a choice between the two. And as you say, there is an opportunity for India, partly because the Chinese economy is not booming to the same extent it was before. Labor costs are rising there. The population is actually now declining. It's a fast aging population. Yes. So there are natural economic reasons for production to move offshore from China to the ASEAN nations, to India. But of course, there are political reasons as well because of this tension between the US and China. And so I think India has very real opportunities in the decade ahead.
But would some of these be taken away because China could come with reprisals against those who are seen being favored by the United States? They even seem to have threatened some countries. The old African proverb, when elephants fight, what happens to the grass? Could there also be negative if one leaned in any fashion?
I think that's right, which is why I made the point about non-alignment. I mean, people use fancy new terms for it, but fundamentally it's the same phenomenon. So India has always had that tradition, and so I don't see India and other countries taking the position they're taking as essentially putting at risk some kind of retaliation, because India isn't going to align 100% with the United States and it isn't going to align 100% with China. Of course, there are risks in this. Both sides might try to put pressure on other countries essentially to do that. But India's a big economy. India's going to be the third largest economy in the world within the next decade or so. And so India's too important a country to essentially have to buckle to that kind of pressure. And let's not forget, it's many Chinese companies themselves that are actually offshoring production into ASEAN and into India. It isn't simply Western and Indian and other businesses doing that, but Chinese businesses themselves are doing it just for economic reasons, because they want to find places where there's a big consumer market and indeed where labor costs are lower.
No, they're already approaching India for those reasons, and it is India which is being wary because we have had border skirmishes quite recently.
Yeah, indeed.
Now, coming back to China's trump cards, if I may call it that, they do have a very dominant position in heavy rare earths and heavy rare earth magnets. Can they really drive a very hard bargain against the United States? Can they bring the entire EV production to a standstill?
Well, I think there are risks of that. As you say, they have, depending on which one you look at, they have a near monopoly in the production of some of those critical raw materials. And of course, they've become dominant producers of batteries, dominant producers of solar. and so on. But of course, they also need markets. So they could, should tensions, political tensions between the US and China rise, that kind of risk could manifest itself, whether sanctions from the US or essentially China choking off production. But the United States needs this Chinese production. China needs markets. And one of the things that is wholly different to the US-Soviet relationship during the Cold War, and I think we still must refer to it as the Cold War and not the first Cold War. We're not yet in a second Cold War, and let's hope we can avoid that, is that the economic relationship between the US and China is so much deeper than it was between the United States and the Soviet bloc. And there are strong incentives on both to avoid tensions getting out of hand because of the economic damage, as well as the security risk, but because of the economic damage that would be done to both countries.
No, you put your finger on it. The difference between the US-USSR conflict and the US-China conflict is that US and USSR were unconnected subsets, whereas US and China are completely entangled sets.
Exactly.
And therefore messy. So what may be the end game? Will it be just that a part of the Chinese production comes back to the US, or reality changes just a bit, or will it be very drastic? What does the end game look like at this juncture?
I think it's difficult to say. I mean, clearly, the tensions between the two have been rising for some time, and one of the very few issues on which there is a bipartisan consensus in Washington is that China is now this strategic rival to the United States, and I think they've realized that there are economic vulnerabilities. I chaired a panel for the G7 countries back in 2021 where we looked at exactly this question of economic resilience, and we realized that point you made about the Chinese monopoly in the production and refining of critical raw materials was and is and remains a vulnerability. They've invested in it, the rest of us haven't. And we need to create much more diversification if globalization is going to continue. So there are some scenarios in which things deteriorate very sharply, particularly if there were a crisis around Taiwan, for example. There are scenarios where they reach a new equilibrium, where essentially their economies disentangle in some of the high-tech, defense, most sensitive areas, but the bulk trade continues, and that happens in a sort of normal and evolutionary way, where some of that production moves to India or to Vietnam or other countries, some of that production continues. And I think what's in everyone's interests, India's interests, Britain's interests, and actually America and Chinese interests, is that they manage their way through this so that there is a flaw to the deterioration in their relationship, but it doesn't get out of hand.
That seems to be the best case that you are drawing up. Okay, what's the worst case? Before you come to the worst case, in your scenario, is a Chinese attack on Taiwan or even usurping Taiwan a possibility?
It's clearly a possibility in that the president of China, President Xi Jinping, has told his forces to be ready for military action in Taiwan by the end of this decade. That doesn't mean it will happen, but clearly they have that in mind, and they've always threatened military action were Taiwan to declare full independence from China. So that remains a risk and clearly remains the point of tension that is most dangerous between the United States and China, because it's the one that could bring them into direct confrontation with each other. One of the things I take some heart from is that despite all of the tensions and conflicts around the world, the US and China haven't really come into direct confrontation with each other so far, and both governments seem determined to try to avoid that happening. They have a highly competitive, highly rivalrous relationship, but neither wants it to get out of hand. So there are clearly risks that it could. Taiwan is probably the most acute risk, but notwithstanding the pressures, notwithstanding the punitive tariffs that the Trump administration has imposed, there remains a relationship, and they remain determined to avoid that relationship deteriorating to the point of confrontation.
Well, I'm going to ask you a directly economics question.
Please.
Do you expect that there is going to be disinflation because a lot of Asian countries will have, slack extra output, and which they will try to, push around within Asia, therefore disinflation? Or can it be inflationary because everyone erects barriers against Chinese goods, or because of supply chain dislocations? What's the more likely scenario?
I think inflation is the more likely scenario globally. But of course, the point you make is there could be pockets of disinflation, or actually quite big zones of disinflation for the reasons you say, as supply is diverted. But the inflationary pressures are quite strong. First, as we learnt during COVID, completely globalized supply chains can create monopolies. By the way, the one we've talked about of critical raw materials is not the only one. There are other monopolies in other parts of the supply chains, including in some quite everyday goods. And as countries seek to create greater economic resilience, onshore, reshore, nearshore, etc., that inevitably, and optimized for resilience, not just cost, that creates an inflationary pressure. Tariffs and protectionism create an inflationary pressure, and we appear to be moving into a protectionist period between the United States and the EU as much as between the United States and China. And of course, the same goes for the US-India relationship. So that's inflationary as well. And big deficits are also inflationary because they drive up inflation and thus interest rates. And so the factors, the up arrows, if you like, overall I think outweigh the down arrows, and that we are probably in a period of structurally higher inflation than we have been really since the financial crisis. But of course, there may be zones of the world, there may be countries where the numbers go in the other direction.
I don't think central bankers are prepared for this. At least in Asia, we are talking more about disinflation. This can be a nasty surprise. Exactly. Let me come to the other part of the global theater where there's war. The US, the Russian-Ukrainian conflict. We don't have time to discuss a lot of the intricate questions, but how may the end game be? Will it be like the old Poland and Hungary, which were like kind of colonies of, with only friendly governments of the old USSR? Or will it be like Afghanistan, where the armed conflict goes on and then, Russia retreats at some point? How is this ending?
Well, very difficult to say how it will end, but I think in the immediate future, it seems now that the impetus to try to stop the fighting, create a ceasefire, and then some kind of an arrangement around that, details highly controversial and still being hammered out, that feels as though that is the likely next phase. The truth is the war itself is pretty much at a stalemate, and neither the Russians have been able to make much territorial progress, and the Ukrainians haven't been able to expel them from their territory. And so some kind of ceasefire deal looks likely. That will probably mean the conflict stabilizing along, broadly speaking, the current lines, with Russia in occupation of significant parts of Ukraine. For Ukraine and for certainly Western governments, they will not concede sovereignty, Russian sovereignty over the areas they occupy. They will regard that as occupied land. And of course, we have many other conflicts around the world where there is land that is occupied, sometimes for a very long time, sometimes for many decades, yet the conflict itself has stabilized. Whether that's a ceasefire line, a line of control, a green line, yet to be determined. That seems to be the likely outcome in the immediate future. Okay. And then whether there's a long-term settlement, I think, yet to be determined.
Okay. Well, finally, what about the I won't call it hegemony, the dominance of the United States and the dollar? Logically, if the United States wants a surplus with every country, we won't have enough dollars for dollar as a medium of exchange. Is a little bit of de-dollarization likely?
I think we're seeing some de-dollarization. I don't think there isn't really an alternative reserve currency out there. People sometimes speculated about it, but the renminbi isn't convertible, so that isn't even a possibility. The euro has never really achieved that status. But it does seem likely there'll be some de-dollarization. We're already seeing, for example, some oil now being sold in different currencies to the dollar. And of course, what we've also seen in the past few weeks, since Liberation Day, the day that President Trump imposed, or at least announced, he didn't actually impose, announced all of those tariffs, was the bond market became quite volatile. Yes. Not just the stock market, but the bond market. And of course, that is having an effect on the dollar's status as well. But there isn't really an alternative, I think, in the immediate future. I think a risk for the United States is they may lose some of the benefits of being the reserve currency if essentially some de-dollarization, even at the margin, starts to happen.
Lord Sedville, thank you very much for sparing time for us in CNBC.
Thank you so much.
Well, that's the key takeaway. We have not yet understood the dangers of inflation. We are probably going to see more globalization than we are giving it credit. Probably a large part of globalization will be preserved, and we can't do without the dollar. There isn't much de-dollarization. Those are the key takeaways. Thanks so much for watching. It's The Economy. After a break, time for Chartbusters.
East Street opens in the green following bullish global cues. Nifty rises above 24,500. The Nifty Bank bounces back. Autos and metal stocks lead the gains.
Adani Ports is higher in trade on the back of a strong showing in the fourth quarter numbers. The EBITDA rises 24% from a year ago. The profitability as well jumps up.
Maruti trades more than 3% higher after a good session in the previous trading session as well. April auto sales come in slightly better than estimates. Total sales rise 7% year on year.
Industar slips only 5% despite a good fourth quarter as the lack of dividend disappoints the street.
Bunch of other stocks in focus. PNB Housing Finance climbs after nearly 1.7 crore shares exchanged in a block deal. Nuvoco Vistas rally 6% after record volumes in the fourth quarter, whereas Go Fashion too surges on the back of strong fourth quarter numbers.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as you could see, shortly we'll have on the top of the screen, yes, we have the green on the screen. The Nifty Bank, the IT index, and the breadth of the market as well. Things looking good. Let's see whether or not the bulls can go into the weekend on top.
They should, Nigel. You know, all check boxes are being ticked. Yeah. The Nifty is doing well. It's being led by the autos. The banks are doing a lot better after having underperformed, and the broader markets as well. More stocks advancing than the number of stocks which are declining. The only thing which is better is that tomorrow is a holiday. Yesterday was a holiday as well. But a bunch of companies on our radar. First up, we have Skipper. The company posted an overall good set of numbers in the fourth quarter. They reported their highest ever quarterly revenue and profit. And this is after a sharp uptick that they got, or rather ably aided by the uptick in their other income as well. Sharan Bansal, who's the director of Skipper, joins in to discuss the quarter gone by in more detail. Sharan, let's start with FY26, the basics. You know, FY25 saw a revenue growth of 41%, record revenue coming in from both engineering and polymer segment. What is your guidance in terms of revenue and margins for FY26 from where you look at things right now?
Hi, Mangalam. Yes, we've definitely had a very good year and quarter. Back in FY23, we had taken on a target to double our revenue in 3 years' time, and I'm happy to report that we have been able to achieve that in just about 2 years. Going forward, even on this elevated base, we feel there are very, very strong opportunities available in the market. The company is carrying an order book of 7,000 crores plus. So based on the order book, looking at the market opportunity as well as our capacity expansion, we feel that 25% revenue growth from here on as well, and for the subsequent years also, should be very much possible.
Okay, 25% plus growth. Congrats, Sharan. I recall speaking to you a couple of years ago or so, and at that point of time, you had put out big guidance. And as you're saying, you're maintaining that. So good on you. But let's get a couple of more details. Profitability, is still hovering around the 10% odd mark. Should this be the range that we should be working with? And the other positive, that I would like to highlight, besides the revenue growth in your numbers, is that the working capital days have come down. Is it sustainable? Can it get even better?
Very good point, Nigel. And yes, the profitability, we do expect that there's headroom to grow. One reason is that we are going to see much more revenue coming from T&D now than our non-T&D revenue. Non-T&D historically has been a lower margin business for us. So both in terms of bottom line as well as working capital, we expect the coming year to be even better than what we've delivered. On the working capital side, yes, we have made some improvements. There are certain more optimization that we can achieve, both in terms of inventory as well as working debtor number of days.
So can you talk about the margins? I mean, how much more can margins improve? And since you spoke about T&D, what is the contribution of T&D to your revenues right now? Where does that go? What's the margin differential between T&D and others?
T&D revenues now in the coming year will be 80% plus for us. So you can say majority it will be T&D, and normally non-T&D revenue is about a couple of percentages lower than T&D. So that's where we are looking to go ahead.
All right. We missed the margin number. We would like you to give us a broad range. What can that look like? And you're saying there's scope for improvement on working capital days. Sharan, we love numbers. Give us a number. What should we work with?
I think on a net basis, on the working capital, we are at just about 90 days right now. We feel that there is scope to bring this down by another 10 to 15 days in the coming year itself. And in terms of margin guidance, of course, look, I would love this to become 12% overnight. However, long term, we do have an aspiration to get to 12%. Now, how soon we get there? Again, it's a matter of time.
All right. You recently secured a multi-million-dollar order in the US as well. If you could give us some details around that. And also, the larger point, there is a fair amount of uncertainty for exports to the US. How much do they contribute to your overall revenues, and would the tariffs impact you?
Good question. Currently, the US is a very small portion of our order book and revenue. We have secured our first medium-sized order from there, and we are expecting larger inflows from that market. We don't see tariffs as a negative for us. Rather, we believe that the ongoing trade tensions between the US and China will open up further opportunities for players like us and for products like us, which are non-commodity, and there are high amount of engineering and labor component. We certainly feel the opportunity is only growing for us long-term in the North American market.
So if you could give us some numbers around here as well, how much does US account for in your overall scheme right now? Because exports is just about 12% of your order book. You won some orders from the US. How do you intend to take that forward?
Let me put it this way, that currently our export order book is just about 12% of our overall order book. And obviously the US is a very, very insignificant portion of that. I'd like to club the US along with other developed markets where we are focused on, which is Europe and Australia. For our overall exports, the target is to take it up to 50% of our order book over the next 3 to 4 years. And out of that 50%, we would like 50% to come from these developed markets, which is North America, Europe, and Australia. So I'd like to give a guidance in that sense, and that is the opportunity that exists in all of these developed markets thanks to the growth of renewable-led power transmission.
And if I remember correctly, these businesses from developed markets give you relatively better margins.
For sure.
Okay, all right. Let's wind this down then with a couple of more details. You have some capacity that's coming on stream, I think 75,000 tons or thereabouts. So do you believe that demand is strong enough to absorb this? Point number one. Point number two, what kind of capex number can you guide for the year? And the third point is, where does it take your debt to? So on the additional capacity, the capex and debt. Please go ahead.
Okay. So in terms of additional capacity, yes, we've done capex last year as well. So we have about 75,000 tons of new capacity coming online in Q1 this year. That will take our capacity to 375,000 tons. We are looking to add another 75,000 in this financial year, taking us up to 450,000. In terms of capex, we expect to spend similar amount what we spent last year in the range of 200 to 220 crores. And in terms of demand, we believe that there is a very, very long runway, and we are seeing the beginning of an investment super cycle in power transmission. So honestly, look, the market looks good for the next 10, 15, 20 years. We believe that even if we continue to grow, and our aspiration, as I mentioned earlier, is to become the largest manufacturer for T&D structures globally, which will happen over the next 3 to 4 years, we will see enough of a demand scenario over the next 10, 15 years to take care of this enhanced capacity.
What about your debt? Because your net debt is up nearly 31% from 440 crores to nearly 600 crores. Then you have around 220 crores of capex coming in as well this year. What happens to that? What's the deleveraging plan here?
I think what will happen is that, so again, we have strong cash flows to make to take care of whatever capex we are doing. If you look at our net debt number and add interest-bearing acceptances on that, then you would see that actually that there's been a reduction over last year. So compared to about 1,200 odd crores, we've actually brought it down to 1,100 crores for the net debt plus acceptances number. And like I said, that's come on the back of our improved working capital cycle. Further improvement will help in further deleveraging on an overall basis. In terms of long-term debt, we don't have a lot of long-term debt, so we're fairly comfortable, in terms of the debt equity that we are maintaining, which is below 0.6 right now.
And so comfortable on the debt aspect, do you see any need to raise some equity, capital? Because I have my ear to the ground, and sometimes, the rumor is that maybe, in fact, Skipper could be looking at tapping the markets. Any truth, or do you want to downright deny it?
I would rather say that, look, we don't have any urgent need for equity. As I mentioned, the company has strong cash flows and internal accruals to make sure that our growth plans are intact and they are comfortably met. At the same time, we're always open to good quality investors coming on board as part of our investor book. We have some good quality FIIs who are invested into the company today. And we're always open to inviting more and more good quality investors.
Sharan, any conversation as of now? Have you received some interest? Say in the coming year, could we see some equity infusion?
No, I'm sorry. There's no nothing on the immediate horizon which I can share with you.
All right. Take that point. Thank you so much, Sharan, for joining in and giving us those details. 25% revenue growth on a 41% base this year, with improving margins, the long-term target being 12%, currently around 10% as well, and capacity increasing over this year and the year after by almost 50%, something that we'll most definitely keep an eye out on. The stock up 7% on the back of those results. With that, we'll take a short break. In fact, before we do that, let's get you some ideas of profit coming in from our colleagues at Money Control Pro. Khushbu Rai of Money Control Pro joins in with a stock that she's tracking. Khushbu.
In today's idea for profit, we have Emami Limited. Emami is a market leader in cooling hair oil led by the Navratna range. The company is well placed to benefit from a favorable summer season supported by strong rural rebound. The rural account for around 50% of the revenue and is a big volume driver. Emami's summer-centric portfolio, that is Navratna range and Dermicool, will likely drive strong volume growth in the coming quarters. The company has reported resilient performance amid the weak urban demand, thanks to the better execution in the core business and favorable seasonality. The company is also expanding its non-seasonal portfolio through acquisition and brand extensions. Emami has also initiated robust strategy to revive the stressed brands. We believe that Emami's focus on execution to capture the rural growth recovery should be visible in the coming quarters. Further, it has a strong presence in the niche personal care categories with low penetration, which will likely drive demand in the medium term.
Let's take a short break. Come back. On the other side, we have B. Vijay Kumar, who's the CMD of LG Balakrishnan and Brothers, joining in to discuss their quarterly numbers. Stay with us.
Welcome back. Well, as promised, let's get straight to our next chat. We have LG Balakrishnan and Brothers. The company reported a pretty subdued set of numbers actually in the past quarter. But what's the way ahead? To help us out, as always, we have Mr. Vijay Kumar, the CMD of LG Balakrishnan. Hi, sir. Good morning, and always good to speak to you, sir. You have achieved a revenue growth of close to around 10% in the past year. For this year, what kind of a revenue growth could we look at? And also margins, well, they have been at around that 16% or thereabouts. So clear out both these two basic numbers first, revenue growth and margins.
Thank you for having me on your show. Good morning to all the viewers. And we've done exactly what we foresaw that we would do. For the future, we expect that we will continue the growth rate of 10%. And with the current scenario in the world, we expect that we will have an opportunity to grow up to maybe even 14%.
Okay. And margins, sir? Margins has been a little bit lower. I think you were targeting 17%. I think it's a little lower than that. Should this be the broad band?
Margins dropped 1% because of the American situation. Maybe going forward for one quarter, I foresee that there will be a further drop in margins, maybe another 1%. But it should pick up again in the second and third quarters.
All right, so margin should pick up again in the second and third quarters. I remember you telling us that, exports, which are 13% of your sales, continue to be a bit of a worry point for you. So, I mean, just trying to understand what is the kind of steps that you are taking to improve upon that. And a couple of triggers for you would be ramp up of LGB Steels and the industrial chains business. How much do they contribute to your business right now? And what's your target contribution from these businesses over the next couple of years, sir?
We've done about 30 crores in industrial chain. And we hope to do about 150 crores going forward. In steel, we've done 80 crores this year, the last quarter. We hope to do about 200 crores next year.
All right, so steel from 80 goes to 200 and chains goes from 30 to 150. What about exports? Where do they go next year?
Export, I would think that we will stay stagnant at what we are doing. I hope there won't be a drop. The American tariff has to also stabilize, because when America catches a cold, when coughs, we all catch a cold.
But this time around, sir, from a market perspective, actually we had a cold first. So when America caught the cold, actually we were getting better, at least from a stock market perspective. But normally, I think in a global scenario, I think that's the way it plays out. Let's focus on a couple of more aspects. EV, that's a segment that you've been looking at. What kind of a revenue contribution can we look at in FY26, FY27 as well?
I can't foresee any, I can't say anything about EV growth because whatever we expect, it has not happened.
Okay.
And the growth in EV has been very big.
Yes.
The IC growth has been far more than what we projected. So I would not forecast anything for the EV growth. But
okay.
we are ready with products for EV, like the gearbox and specialized chains. We are also concentrating on belts.
Yes.
So if it happens, we are there.
But as of now, there is no visibility.
There is not great visibility. The turnover is very small.
And this 10 to 14% revenue growth guidance that you're giving us, this includes both the segments, industrial chains, as well as the LGB steels?
Yes, all put together.
All put together. Got it. One more question with regard to replacement revenues. As a percentage of your total revenue mix, what is it?
It's about 32%.
Okay. There was a trigger that a higher replacement revenue would actually be better for you. So where would you like to take this number?
I think that will be flat. I don't expect any additional growth in percentages.
So aftermarket share remains between 30 to 32%. And what about the new facility? I mean, you did speak about the RGB steels. You spoke about the industrial chains business as well. What about any other new capex that you are planning?
We have spent about 50 crores on acquisition of property in Bawal, Haryana. And we will be moving one of the plants in Haryana, that is Manesar, to this facility. This facility will be about 200,000 square feet, and Manesar at this moment of time is about 50,000 square feet. So this will be moved to the bigger facility because we expect better demand. We need to put in more machines, and that will be a separate project by itself.
Got it. All right. Mr. Vijay Kumar, when we have spoken in the past, you had told us that the promoter holding, you look at upping that. It's been steady for the last few quarters in that ballpark 34-35%. In the coming year, should we expect the promoter holding to move gradually towards that 40% odd mark? If yes, how do you do it? Will you do a preference or will you buy from the open market?
I don't think we'll do another preference right now. Though the window for preference is open, we have to study and then we would like to look at the market conditions and then decide.
What about the transmission and metal forming mix? Where do you expect that mix to be going forward? I remember that being around 80 to 20%.
That's going to remain the same. It's going to be flat.
All right. And what proportion of your business growth, how will that, correlate with the growth in the automobile industry itself, in the two-wheeler industry, the motorcycle industry, so to say?
Yeah, we will match the same growth.
You will match the same growth, no further or no lower than that?
No.
All right. Thank you so much for joining in and giving us all those details for the next year. Margins around the similar vicinity, maybe some improvement towards the second half of this year, with a 10 to 14% sort of revenue growth coming in, 30 to 32% in the aftermarket sales, and more importantly, growth coming in from their chain business as well as their steel business is what LG Balakrishnan is talking about next year. With that, we'll slip into a short break. As we do that, here's a small programming note for all you viewers. CNBC-TV18 and HSBC are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact, and shaping the future. Nominations are now open. What you can do is scan the code and submit your entry for the SME Champion Awards Season 2. The market's come off a little bit. When we started the show, Nifty was above 24,500. Now it's 24,450 itself. JSW Steel, Bharti Airtel and Bajaj Auto are the ones which have taken a bit of a knockdown. We have Kotak Mahindra Bank as well, which is off the highs, currently at the low point of trade. So we'll just keep an eye out on these stocks. But the one which is zooming ahead is Eternal. Reported a weakish set of numbers, but from the lows, the stock has actually rallied about 8%. So two things are happening in Zomato. One is that the food gross order value is growing at a lot slower clip than expected, and the margins are staying steady out there. The company is attributing this to the weakness that we're seeing in consumer sentiment itself. And add to that, the lack of delivery partners also impacted their business. During the quarter, they shut 19,000 restaurants as well. So that accounted for about 2 percentage points of their overall GOV growth in this quarter. But more importantly, Blinkit. If you look at that, quick commerce was supposed to be the valuation driver for the company. The GOV is compounding. It's grown at around 134% year on year and 21% quarter on quarter. That's higher than what the street was anticipating. But what's also higher is the losses. So the losses have ballooned to around 180 crores on the EBITDA, and that's because of a couple of factors. One, high competitive intensity. Secondly, higher cost of customer acquisition. And thirdly, the accelerated store expansion plan that the company is doing. Was there any sign of support coming in for the company? Well, not on the competition front. They said that it is only getting more intense and they will aggressively look to grow market share and not let short-term profitability goals come in the way. They've added 294 stores right now. They had the 2,000 store target for the next year, but it looks like they will do that in the middle of this year itself. So the street, I think, is liking the long-term aggressive approach as against the short-term profitability worries, which is why the stock is recovered from the lows. But remember, it is still fairly off the highs.
All right, so that's a stock that's seen a big recovery from the day's low, but in fact, from the recent high, it's still off. Just to highlight a few stocks before we wind down. Force Motors, it appears that one's feeling the force. The stock is now up close to around 10%. We had highlighted this in our mid-cap microscope piece, that this is the focus on premiumization theme. For the time being, big volumes. I'm not sure whether there is any news flow. The stock has now moved up close to around 11% or thereabouts. A couple of other notable movers. Sonata Software. Remember, they get most of their revenues from Microsoft. And in fact, Microsoft's numbers are fairly good. The stock saw a big surge ending Wednesday session 10% higher. Today, it opened up in the red, but it spiked up yet again. So that's another stock that I'm looking at. And Tejas Networks. The stock has got absolutely beaten out of shape. I think it's down more than 15% in this week itself. It's trying to find some kind of stability. It appears there is some kind of absorption of that selling, and that's why from the day's low, the stock is up close to 3%. We'll wrap up on this edition of Chartbusters. Stay with us. Trading Hour comes up next.
Good morning. Welcome to Trading Hour. It's a Friday morning. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Hormuz Fatakia. Well, we started the week with gains and looks like we're ending it with gains too. It's just that we've come off from the day's high. You know, pull up that intraday chart. The intraday high on the Nifty was actually closer to 24,600. So we've slowly given up gains. We're still holding up in the green, up about 0.5% on the benchmark indices. But as you can see, we're off from the session highs. What's helping is the green across the Asian market screen. So whether it's the Japanese markets or the Hong Kong markets, indices there are up more than 1%. And once again, it's so much about individual stocks and earnings reaction.
Oh, absolutely. And that is showing up on the screen as well, right? Even the Asian markets are higher. The Dow futures are higher. Of course, after the Chinese statement of evaluating trade proposals with the United States. But of course, there are plenty of earnings reactions within the broader market space. Of course, there are no Nifty companies reporting results today. But the broader markets, look at Godrej Agrovet now, the top loser on the Nifty 500, down 11.5% in the earnings reactions list. Phoenix Mills too is down 6.5%. Newgen Software reporting results today is up 13%, and it's seen a similar surge last week as well when the stock had gone up by around 10.5%. So Newgen Software is the top gainer on the Nifty 500 now. Railtel is the other one. It's been holding on to those gains from early morning, 12.5% higher there as well. And of course, there is Indus Towers, a disappointment when the numbers front maybe not, but of course the anticipation of a dividend, the bonus, that has been delayed, and that's what's weighing on the stock, I guess.
Oh, indeed. Indus Towers is down nearly 5%. But bear in mind that hopes of, Vodafone Idea's situation improving, the recoverables from there, the hope of dividend, the stock is up 90% in the last 3 years. So it's been a big outperformer. It got re-rated, and today you can see some amount of disappointment. You spoke about Newgen, numbers expected today, and the stock is surging. Well, for Newgen, we have to watch the growth rate, because in the past, the company's growth rate used to be 20-25%, and in Q3, it slowed down to 18%. Right? So, we'll have to watch whether there is another, quarter of slowdown, or they can get back to the 20% kind of growth. So for Newgen Software, clearly it's going into the earnings with a fair bit of optimism, but the growth rate, if it can get back to the 20% plus mark that it used to enjoy historically, will be exciting, because last quarter it dipped to about 18%.
The stock has been down 35% so far on a year-to-date basis. So some bit of underperformance, and that some reversal from the lower levels as well. It has a 52-week high of around 1800. The stock currently at 1100, so 13% higher on Newgen Software in anticipation of results. But the focus is also on auto stocks, because the sales numbers came in for the month of April yesterday and today as well. Sudarshan is joining in with more on that. Sudarshan.
So overall sales for the month of April have come in as per expectations. The one segment which has done the best is the passenger vehicle segment. And for two-wheeler segment, sales have been largely mixed, and even tractor segment has seen some improvement. So we'll start with the company which has reported the strongest sales is Mahindra & Mahindra, and has reported strong sales for both its segments, auto segment as well as tractor segment. Sales for both these segments have come in better than estimates and also have increased year on year. And good part for its auto segment is M&M is now number 2 player in the passenger vehicle segment, surpassing both Hyundai and Tata Motors. Now coming to Maruti, it has also reported sales which was better than estimates, and good part is this time for the month of April, its compact segment, cars like Baleno and WagonR have seen increased sales, while one segment which has been under pressure for last few months, or say for last few years, is the sales of Alto and Espresso. Even in the month of April, sales for both these have fallen 45%, but overall total sales have increased year on year. It has come in at 1.80 lakh units. Now in two-wheeler segment, one company which has been outperforming its peers and also in the month of April has outperformed is TVS Motor, and all the segments have seen a double-digit growth. And if you look at the growth of export segment, there the growth was seen at 45%, and its electric vehicle, or say EV scooter, there the growth has been almost 60%. Exactly, it was at 59%. But again, in the two-wheeler space, one company which has been weak for the last few months, and even in the month of April, the sales were weak, was of Hero MotoCorp, and this time it has reported total sales of 3.05 lakh units. But in the month of April, it had announced that it had closed from April 17 to April 19 4 facilities, and that had impacted sales. But if you factor in that also, despite that, sales have come in below estimates. Expectation was that sales might be around 4.50, but it has reported 3 lakh units. Again, in the four-wheeler space, one company which has been weak is Tata Motors. It has seen decline all around except 2 segments, that is the heavy vehicle, commercial heavy vehicle and truck segment. All its segments have seen a decline, and especially EV segment, in which company has been the leader. But in the month of April, sales for EV also have fallen almost 16%. And today, Bajaj Auto and Ashok Leyland also have reported sales. Bajaj Auto has reported total sales of 3.65 lakh units, which is lower than our expectation of 3.85. Also for Ashok Leyland, total sales have come in below expectations.
Thank you very much for that. But the big loser in the auto pack is Eicher Motors. That's down nearly 2.5%. Still awaiting numbers there. Bajaj Auto down about 1%. On the way up in two-wheelers, TVS Motors, Hero MotoCorp. TVS Motors doing much better, 2% up. Hero MotoCorp with a gain of about 0.6%. And Maruti Suzuki is racing ahead, 3% higher on that. And Tata Motors looking up with a 2% gain. The stock of the week undoubtedly has been Reliance Industries. A 9% up move on Reliance Industries. Exactly a week back, it came out with numbers, and every single day it's been powering ahead. So it's Reliance Industries. Sudarshan, you want to quickly come in?
Because on Eicher Motors, the reason the stock has been under pressure because sales for the month of April, Royal Enfield sales were largely in line with expectations, but now company is going to report the earnings, and now there is an expectation that it's in the last few months it had seen an improvement in sales, mainly because of the increased sales in the lower end of the segment, and that might impact the margin. But as far as sales are concerned, it's in line with estimates. Also remember, stock in the last few months has outperformed all its peers.
Indeed, so interesting. They're in line with expectations. Of course, with an outperformance like Eicher has seen, in line does not cut it, right? With the street, he's seeing some bit of pressure on the stock there as well. But moving to corporate conversations, then Home First Finance is our first management on our corporate radar today. Their P&L momentum remains strong. Asset quality also remains stable. The NIMs fell on a year-on-year basis, but improved compared to the previous quarter. Now, to discuss the quarter gone by and the road ahead, we are being joined by Manoj Viswanathan, the MD and CEO at Home First Finance. Mr. Viswanathan, good morning. Thank you for joining in. Let's start off with the disbursement momentum, right? Your disbursements grew around 15.5% during this quarter. What did you end FY25 with, and what targets have you set for yourself, both in terms of disbursement growth as well as AUM growth for FY26?
We ended with 4,800 crores, 4,800 crores, which was in line with our original guidance for the year. And that's about 20%, 21% year-on-year growth in disbursals. And we are looking at a similar number or a similar growth rate for disbursals for the current year as well, for FY26. So that will be in the region of 5,600 to 5,800 crores of disbursals.
Okay. What about ROE? Are you looking to expand it? I think because your ROEs used to be sub 10% about 3-4 years back, and you've been steadily improving it. What does it stand at currently, and is there scope to expand ROEs?
So we have had a very good year in terms of return on equity. We delivered a 16.5% return on equity for the full year, and we actually exited the year last quarter at 17% return on equity. So that has been, so that is what we had, originally planned, that we should have a strong returns, and that's what we have delivered. For the current year, of course, the return on equity will be muted because of the capital that we have raised recently. So I just wanted to bring to your attention that we have done a QIP in April. So that has significantly increased our capital base. So the net worth has gone up from about 2,500 crores to about 3,750. So we did a QIP of about 1,250 crores. So because of the expanded equity, the ROE will be a bit muted, for the current year. But we again hope to catch up in the next 18 to 24 months.
What do you plan on using these 1,200 crores for, Mr. Viswanathan? Is it growth capital? You want to preserve it as a buffer? What are the plans that you have laid out for this?
No, it's absolutely growth capital. We have been growing at 30%. EUM has been growing at 30% over the last several years. And if we want to kind of sustain that momentum, we will need additional capital because our leverage is already touched 5 times. So if we want to keep that, under control, we will need more capital, and which is why we are going to raise the capital. So this capital raise should sustain our growth for the next 3 to 4 years.
Is there an inorganic growth acquisition in the pipeline?
No, we are not looking at anything inorganic. We are looking at growing organically. That is all. That has been always the DNA of the company.
So 30% plus AUM growth for FY26 should sustain, and you'd given an aspirational AUM target of 40,000 crore by FY30, I think. Will you be able to fast track that now that you've got growth capital?
No, our aim is to, we have made a long range plan, and our aim is to kind of stay with the plan. So there are, as part of the plan, there are many things that need to fall in place, and which we have, which we are working towards. So it is generally not in our DNA to accelerate, etc. So there is a certain plan that we've made, and we kind of we will stick to that.
Do you want to tell us your long-term plan? The 40,000 crore AUM is there, right, by FY30? Are there any other metrics as a part of this plan?
No, yeah. So the 40,000 is, I think somebody has rounded it off.
Okay.
What we have conveyed is the 35,000, between 35,000 to 40,000 crores.
Got it.
What about margins, Mr. Viswanathan? Over the sequential and even on a year-on-year basis, they have been hovering in that range of 5 to 5.5%. Where do you see margins going from in FY26, particularly in a declining interest rate environment?
So net interest margins, as we have always conveyed, is a function of how much the company is levered. So as you can see, last year the company was the most levered. So our margins were at about 5%. So what we generally operate at is a 5% spread for the business, and the NIMs then fluctuate between 5 to 6% depending upon how levered we are. So if we are under levered, now we are going to be under levered because we have just raised capital. So the NIMs will probably expand a little bit. But broadly, our business is a 5% spread business, and the NIM, the total income will be in the region of around 7.5%, including fee and other income. So a 7.5% total income is the core of the business.
So if there are rate cuts, and we've already seen some rate cuts, how will it impact your spreads?
See, at present, the rate cuts are, fairly small, and, the transmission has not yet started. So as the rate cut gets transmitted to us, gradually it will also get transmitted to customers. But broadly, we operate a fully floating rate book. So, whatever rate cuts we enjoy will have to be eventually transmitted to the customers.
What about asset quality, Mr. Viswanathan? It was relatively stable on a quarter-on-quarter basis and at around 1.7% this time around as well. Do you expect that figure to trend down as the situation improves? You see more recoveries, or do you see it remaining at around these levels as well?
The gross NPAs have been at 1.7% for a long time, for several quarters in a row, as you can see. The early delinquencies, of course, fluctuate a little bit. And if you see last quarter, our early delinquencies have actually come down substantially by about 30-40 basis points. But that again is, slightly seasonal. So there is, it floats in the region in between 4.5 to about 5%, the early delinquencies. But gross NPA likely to hold at current levels. And that is just the nature of the business. So 1.7% gross NPA is, I think, the way the business works.
What's your presence in Karnataka, exposure to Karnataka?
Exposure to Karnataka is about 5 to 6% of our AUM. Yeah, it's not very substantial.
Okay. Was there any impact of this e-Khata issue?
There has been some impact, yes, because, the registrations are getting delayed because of the e-Khata. But because our exposure to the state is not very large, it has not been a very large impact for us.
What was the impact you would assess? I understand it's not very significant, but
4 to 5 crores a month.
Sorry, how much?
4 to 5 crores a month of disbursements.
Okay. Were there any other, specific issues which have impacted your growth?
No, there is
positively or negatively?
No, I think overall, the environment has been supportive in terms of generating demand for affordable housing. And our growth has, growth has been as expected. I mean, we were looking to grow at about 30% AUM this year, which we have delivered.
All right, Mr. Viswanathan, thank you so much for sparing time and joining us today. Wish you good luck for FY26 as well. We take a short break, but just before we do that, there were some flashes on your screen just a few minutes ago about JSW Steel and that the resolution plan of Bhushan Power and Steel has been rejected by the Supreme Court, and that is weighing on the stock price now down to the lowest point of the day, 2.6% lower there at 1,000 rupees now is JSW Steel. We'll get you more details on this as they emerge. When we take a short break, the Nifty is still up 100 points, still off the highs of the day though. Up next, we discuss all things commodities with Manisha Gupta. Back with us here on Trading Hour, shifting focus to all things commodities, and Manisha Gupta is now joining in with emphasis on the topsy-turvy crude oil prices. Manisha, good morning.
Oh, well, yes, it has been topsy-turvy. That's the best way to explain it, really. What we are looking at in sense of crude oil prices right now is 2% of gains in the overnight market. And if you look at the Asian markets right now, there's a bit of a gain, as you can see, trading into the markets there. But even with these gains, the Brent is just about holding 62. And when you look at the US crude oil prices, they are still trading around that 59-60 mark between those ranges. Well, the US has imposed newer sanctions on Iran now. Remember, we've seen exports and various sanctions on individuals and companies as well come in on Iran. Now the US says that any country that buys oil from Iran will not be allowed to do business with US, and that is something that seems to be bothering the bears in case of crude oil prices, and we've seen some premium come in sense of buying there. Apart from that, Saudi Arabia also says that they are not willing to prop up prices by cutting any more production going forward. Remember, Saudi Arabia is a big chunk and a part of OPEC and allies, and they are going to be increasing production by 411,000 barrels per day starting 1st of May. And there's a meeting of OPEC and allies on 5th of May, which will talk about further increase in production for the month of June. So that is something that will keep the prices capped at these current levels there. Well, apart from that, the gains in US equity seems to be weighing onto the markets as well. And then you have the dollar index, which is back above trading at $100 rather as a point, and that is weighing on many of these dollar denominated commodities. Well, the first quarter GDP numbers coming in from US were on the weaker side. So has been the case with consumer confidence numbers in US, PMI data, factory numbers from China. All of that has been on the weaker side, will continue to weigh onto the markets. For the longer term, slightly, the markets do believe that you could see further pressure coming for the crude oil prices. But for today, it is going to be about the US non-farm payroll data that would give you the near-term reactions.
Thank you very much for that. Let's move on now to IndiaMart. They came out with their numbers on Wednesday. It was a flat sequential revenue quarter, a little bit of a sequential dip in margins, but still very healthy at 37 to 38%. Profit growth was quite high, 49%, aided by higher other income. Dinesh Agarwal, founder and CEO of IndiaMart, is now here to join the quarterly numbers. Thank you very much, Mr. Agarwal, for joining in. This is Reema here. So the first question is on margins. Now, you've always guided that historically margins, on a normalized basis should be 33 to 35%. You are operating at higher margins. What explains that? And when will you get back to margins of 33 to 35%?
See, if you really see, we have not been investing in the new customer growth because our churns are elevated. And that is what is also shown up in the functional P&L, where our sales and marketing expenses used to be about 17-18%, but we are only able to spend 13-14%. And that is the precise reason that the margins are elevated for right now. As we start to invest in growth and once we have the better handle on churn, I think the margin should, in the long run, trade between 33 to 35%.
So this problem of churn, it's been a problem now for a while, more than about 1.5 years. And when we speak to you every quarter, you've been saying you're taking steps to address it. Why is it, I mean, what's been the problem area, the bottleneck in addressing the high churn? And when do you think it'll get resolved?
Yeah, ma'am, this is a large horizontal marketplace with especially dealing with small and medium enterprises. And small and medium enterprises have their own churn. There are external economical factors, and there is a product market fit and changing expectation setting of our internet users over the last couple of years. So I think it's a combination of a lot of things. Even to get the first time right, it takes multiple iterations. We probably found them getting it right sometime around 2015. It has worked very well until 2022-23. And post-COVID scenario, I think we are reworking on retweaking certain assumptions that we were having during 2017-18 when we when we had lesser number of suppliers on our platform. Now we have a lot more number of suppliers, and we can do more local matchmaking within the suppliers. Similarly, now we have better tools for categorization of the suppliers and their products using the AI and the photos based identification. So we are working on some of those. Hopefully the result should be here soon.
Mr. Agrawal, good morning. Thank you for joining in. What about the results among the paying subscribers, sir? You had a decline in the previous quarter. Even in this time around, your growth has just been 1%. When do you see that stabilizing? Do you see that happening in the second half of the year, or do you expect this year to be a flat year as well for subscriber addition?
As I said, in the last many quarters, I have been saying that please wait for a couple of more quarters, and I have nothing more to say even today. So let's just we are keep working. We have done that multiple times in the past. I think it is taking much longer at this size and scale today. But I am pretty confident that we and our team would be able to find a better solution to this.
Do you think 2 more quarters, 3 more quarters? I know this is a tough one, Mr. Agarwal, to answer, but that's the question everyone wants to know. That because India Mart was such a high-growing company, high-growth company, just till 1.5 years back, and things have slowed down with fewer paying subscribers, the high churn, and therefore now you're not investing. So, when does it get back to what it was, say 2-3 years ago?
Yeah, that's what I'm saying. Let's just wait for a couple of quarters, and I hope I'm able to give you a better news.
Okay. Until then, margins will remain elevated.
Yeah.
All these things will get fixed together.
Yes.
Low churn, return of paying subscribers back to 5,000 rupees, and then margins coming back to 33 to 35%. All of them are tied, and they will all happen together.
Yes.
Okay. What about collections? We've seen a bit of an improvement in your collections, at least in Q4 versus the prior quarters. But again, it's still lower than the historical levels of 15%. Can you throw some more light on what led to the collection improvement and the way forward?
Yeah, so collection has 2 parts. One is the average collection per customer that we get, and that has been doing very well. So whatever growth that we got in 2022 and 2023, many of those customers have upgraded to Gold and Platinum. And currently our Gold and Platinum base accounts for about 75% of the overall collection and revenue. And there, even the average collection per customer is going up quarter on quarter. If you see last so many quarters, it has been almost 8 to 10% every quarter. While the second part of that is the number of paying customers. And since the number of paying customers, we have not been able to grow because due to elevated churn in the first year silver level, silver monthly and silver annual customers, that's where the second part of the customer collection growth is not coming. Otherwise, collection growth would have been in the higher double digits. So currently, until we fix the paying supplier growth, I think the collection will remain in this range.
The other bright spot this time around has been the improvement in ARPUs, Mr. Agrawal. It was up around 11%. Do you see any further scope of increase here as well?
I think in terms of percentage, no, but this will continue. About 8 to 10% of the ARPU increase will continue for at least next 1 year. That much I can say.
Okay, 8 to 9% improvement every quarter in ARPU, at least for the next 1 year, is what you have reasonable confidence about. What is the cash right now on the books, and what is the board thinking in terms of deployment?
Yeah, cash, we have about 2,885 crores at a consolidated level. And the board has declared a dividend of rupees 50 with 30 rupees dividend and 20 rupees special dividend. That takes away about 300 crores from here. We have about 1,678 crores of deferred revenue. So that leaves us with about 1,000 crores of safety cash for a company of our size. We will continue to accumulate and see if there are any investment or M&A opportunities going forward.
Do you see those deferred revenues trending down, Mr. Agarwal, anytime soon with 1,600 crores? Do you expect that to come down and accrue to your P&L statement? And part two is that you have 1,000 crores. You said you're on. You can try utilizing that 1,000 crore cash for M&A. Is there something on the lookout?
No, we always have been looking at these things. Last year, we made some of the follow-on investments. We also made a very good investments in ID5, and ID5 as a company has done very, very well. On your question on the deferred revenue, in fact, deferred revenue is the very healthy metrics for our future revenues. We have a current portion of deferred revenue at about 64% and non-current portion at about 36%. So that makes it about 20 months of revenue, pre-booked revenue, which is there in the deferred revenue. And that gives us the confidence that our revenue from operation, despite the collection being lower in the past few quarters, revenue from operations has been going in the double digits.
Okay. So last year, Mr. Agarwal, just one final question. Your revenue growth was 16%. In FY24, revenue growth was 21.5%. FY23, revenue growth was about 30%. What can you guide your shareholders for what IndiaMart is likely to do in FY26? Yeah, I know it's tough, but some sort of an indication to the shareholders.
Yeah, given the revenue growth always mimics the collection growth in the last 4 quarters or so. So if you really see the last year, entire year, the collection growth has been about 9%. And based upon that, we can assume that revenue growth will also come matching towards that side for the next year. Unless the collection growth improves significantly based upon the paying suppliers growth, the revenue growth will also come down to about 10%.
All right, Mr. Agarwal, we'll hold you to these numbers. Thank you so much for sparing time and joining us today. Wish you good luck for FY26. By the way, IndiaMart has recovered from the lows of the day, currently trading around 0.8% lower. What has fallen to the lows of the day, though, is JSW Steel, and that is after the Supreme Court verdict rejecting JSW Steel's resolution plan for Bhushan Power and Steel. And the Supreme Court has also mentioned that JSW Steel's resolution plan was illegal and it should not have been accepted by the Committee of Creditors. So these are lines coming in for JSW Steel, and the stock has now declined to the lowest point of the day. The Supreme Court has also directed the liquidation of Bhushan Power and Steel. Mind you, Bhushan Power and Steel, as per what Nigel's telling us, is that it was chosen as the winning bidder. JSW Steel was chosen as the winning bidder for Bhushan Power and Steel's assets in September of 2019. So it's almost after 5.5-6 years that this judgment has come in from the Supreme Court. We'll get more details on this as the day goes by, but for now, JSW Steel among the top losers on the index, 4.5% lower at the lowest point of the day. Reema.
Nigel was just writing because he looks at it closely. He's saying investments have been made, cash flows have come. So now to reverse this kind of a decision, which has been there in place for the last 5 years, is going to really hurt and cause a lot of uncertainty, and the stock is reacting to that. So far, we've not heard from the management of JSW Steel. We're just getting some lines from the Supreme Court that Ashmit has picked up. I think the matter is still on. I think the matter is still on. Yes. So we'll try and get you more details on that. That's the the big story right now. Get into a break. On the other side, market technicals with Mitesh Thakkar with his top trading bets. Stay tuned. Welcome back. Indus Stars is slipping, now down nearly 5.5%. Pull up that intraday chart, and the key reason is despite a robust Q4, the street is disappointed by the lack of a dividend announcement. What they have done instead is constituted a subcommittee to explore options for returning cash to the shareholders. You know, the street was very, very hopeful about an Indus Star dividend. The reason is because Indus Stars was a cash-rich company. They used to pay dividends till 3 years back. Then 3 years back, they stopped paying dividends. So basically, 23, 24, FY25, there were no dividends because the company had a lot of receivables from Vodafone Idea. But prior to that, it always paid a dividend, and the dividend payout ratios were fairly healthy. But now this year, after Vodafone Idea raised the QIP, then the government converted their stake, the receivables from Vodafone Idea to Indus Stars kept declining. So therefore, the street became hopeful because their cash flow is now improving and they are in a position to give money back to the shareholders in terms of a dividend. So the street was hopeful and the stock in a way also got re-rated. You know, the 52-week low was June last year of 292. From there, the stock rallied more than 30%. In the last 3 years, it's up nearly 90%. And if you look at the free cash flow number, there you have it. It has substantially improved. Next year, it won't look this good because, this year had this lump sum Vodafone Idea receivables, which, they got back. But the numbers, the free cash flow was very strong. So therefore, the street was hopeful. That said, all hope is not lost. Brokerages are basically saying that it didn't come this time, but it will come in the future. So Ambit is saying they expect the company to announce a dividend of 20 rupees per share in the next 6 months. They also anticipate a potential buyback similar to what they did in August of 2024, with the Bharti family unlikely to participate. Both Ambit and IFL have a buy call on Indus Stars because they also see valuations of Indus Stars vis-a-vis global peers is a lot cheaper. IFL's target price is 450, and in that, when you look at the breakup, they have assumed a dividend of 20.5 rupees. So looks like it's coming, but just not,
just
today.
not now. I guess we're hoping for that sooner or later, I guess. But brokerage.
Hindi mein na, they say der aaye, but durust aaye. So jab aayega, to then I think the stock will be supported.
Indeed, we look forward to that. Especially the retail shareholders, the smaller shareholders of Indus Towers will be looking forward to that. Either a bonus announcement, which would be the first one for the company, the buyback which they had done last year, or a possible dividend announcement which they haven't given in the last 3 years. But for now, 6% lower on Indus Towers, giving up some of the gains that it has had over the last 1 month. But Mitesh Thakkar is joining in now for a quick chart check and for some trading ideas as well. Mitesh, good morning. Thank you for joining in again. Well, we are off the highs of the day, still finding some barriers at around 24,500 is the index. Do you continue to maintain a cautious stance, or would you believe that this is the right time to enter, or would you wait for a dip? And of course, your trading ideas for the morning. Mitesh, I think you're on mute. Mitesh, can you hear us?
Now it's better, yeah.
Yeah. Please go on, Mitesh.
So, I think, the Nifty appears to me, getting into a range. We did actually get past 24,500, 550 zone today intraday basis, but I still believe that the position of the indicator suggests that, we will consolidate before we actually make a big move on the upside. So, I think if somebody is having long, then I think 24,250 now becomes a trailing stop loss. Broadly, it looks like 23,800 to about 24,500 kind of a range, give and take 50 points here and there.
What about specific stocks, Mitesh?
Yeah, I have a buy on Persistent with a stop below 53.80. Look for targets of 55.50 over there. And a sell on Phoenix Limited with a stop at about 15.75 for targets of 1500.
Thank you very much for that. Let's talk about Cognizant because they reported a steady set of Q1 calendar year 25 earnings. They've maintained the full year revenue guidance at 3.5% to 6%. I caught up with the management of the company to discuss the quarter gone by and how things will pan out. Listen in.
Thank you, Rima. Thank you for having us on the show today. It's a very uncertain time and it's also very complex for our clients. Some sectors it is more complex and more uncertain, in some sectors it is not. But effectively, when you have uncertain times, technology can be leveraged for productivity, efficiency, and creating opportunities for clients to thrive in the uncertainty, and sometimes underwrite that money for innovation purposes.
Ravi, we know the first order impact of the tariffs is on sectors like manufacturing, particularly auto, the consumer retail sector, travel, tourism, logistics. These sectors are feeling the heat. But is there a risk that the second order impact, which is on other sectors like BFSI, which is so far very resilient, that will come into play? I mean, are you preparing? I mean, are your clients worried about that? And where is it that we've seen, deal cancellation or deal pauses?
We haven't seen deal cancellations so far. We have, we have had a very resilient quarter. I would say there is going to be second order impact if there is uncertainty. I mean, even if there is one sector which gets impacted, financial services will have downstream impact, and there is going to be consumer spend, which is an important metric for financial services. If you just look at software development cycles, I think the industry is going to shrink because software is going to be written by machines. One of the other pillars which Cognizant is excited about is engineering products. The last 10 years, technology was deeply immersed into services industries. The next 10 years, I actually believe technology will be immersed into anything physical, making physical products intelligent, autonomous, and connected. And that will lead to more technology. Now, if software is written by machines, because of the elasticity of spend on software, you can actually drive more.
Vision for this summit and for its consistent, unparalleled leadership in taking India and Indian culture to the world. This summit is a powerful reminder of who we are and who we have always been. I speak to you as a proud citizen of our ancient land. And the theme of my keynote is taking India to the world. Long before the birth of the internet or even cinema, the influence of Indian culture had already spread across the globe. Taking India to the world is not a new concept or a new idea. The light of India has traveled far and wide for thousands of years. Hundreds of Buddhist monks from all over the world traveled on foot to India in ancient times in search of cultural and spiritual knowledge. In Japan and Indonesia, Hindu deities like Lakshmi, Saraswati, Shiva, Ram, and Ganesh are worshipped even today. The splendor of India's temple architecture can be seen in Angkor Wat in Cambodia, Borobudur in Indonesia, and the ruins of charm temples in Vietnam. Indian philosophy left a deep imprint on some of the greatest thinkers and philosophers of the world. We are a country enriched by the wisdom of its civilization, but equally energized by the throbbing energy of the world's youngest population. A country where sacred traditions meet modern dynamism in perfect harmony, where the rising power of our economy, soon to be the third largest in the world, meets our soaring global soft power. We are a timeless civilization that gifted humanity with the enduring ideals of Satya, Ahimsa, Ekta, and Aman, truth, non-violence, unity, and peace. A luminous nation that gave the world the wisdom of the Vedas, the Bhagavad Gita, and the teachings of Gautam Buddha and Mahatma Gandhi. Bharat is where it all began. India is the origin of Om, the sound of the birth of our universe, the birthplace of zero, Shunya, the beginning of the infinite, the home of Sanskrit that gave the world language, the land of yoga and Ayurveda, the pioneer in science and philosophy, from Aryabhat's astronomical calculations to Adi Sankaracharya's Advait Vedanta, the beacon of arts and literature, from our classical music and dance forms to the epics, Ramayana and Mahabharata. We are the very cradle of civilization, a cultural force whose time has come once again. Every civilization tells a story. Some tell it with power and might, but we have always told our stories with our soul. For over 5,000 years, from our Kathavachaks to the traveling bards, from our legendary folklore to temple murals, and from our epics to present-day cinema, storytelling has always been the heartbeat of our legacy. In the modern age, India's magnificent heritage and the soft power of our theatre, dance, music, cinema, writers, artists, and artisans have won the hearts and minds of people in all continents and corners of the globe. Friends, like all Indians, we at Reliance Foundation are great admirers and ardent supporters and passionate lovers of art. And we deeply believe in the power of our culture to heal, inspire, and unite. At the foundation, we regard it to be our highest duty to protect, preserve, revive, and honor India's priceless artistic legacy. It is with this spirit that we started the Nita Mukesh Ambani Cultural Center 2 years ago. Our vision is to showcase the best of India to the world and bring the best of the world to India. With the same vision, we started Swadesh, our humble movement to encourage and promote India's age-old arts and crafts on the global stage. Swadesh honors our traditional artisans who have learnt at the feet of their fathers and grandfathers, and whose every weave, every carving, every brush carries not just the touch of the hand, but the memory of centuries. For instance, the Indian sari, which is one of the fondest expression of our tradition. Today, our timeless 9 yards are weaving the India story across fashion runways, woven by our weavers with love and worn by our women with pride. wherever in the world they are, from Mother Teresa to India's missile woman, Dr. Tessie Thomas, to our Finance Minister, Srimati Nirmala Sitharaman, our lawyers to journalists, and from astronauts to change makers, all wear it as an ode to a legacy that has been passed down over thousands of years from their mothers, grandmothers, and great-grandmothers. That is the magic of our culture. It evolves without erasing. In most...
Okay, we'll keep cutting back to Nita Ambani. For now, it's time to get an update on JSW Steel. That's the big story breaking now. Ashmit is joining us from the courtroom. Ashmit. Okay, Ashmit, we'll try and reconnect with Ashmit. But just to react to... Okay, we'll go into a break then. On the other side, we'll continue the story. Ashmit joins in, and Nigel too will be here with us in the studio. Welcome back. As promised, it's straight away across to Ashmit now, who gives us the latest update on JSW Steel and what's come out of the court proceedings today.
Well, a major setback as far as JSW Steel and its plan for Bhushan Power and Steel is concerned. Bear in mind that this story goes back all the way to 2019. The whole insolvency process began in 2016. It went through the motions. In 2019 is when the NCLT had granted approval for JSW to proceed forward. Its resolution plan had been approved. It was nearly 20,000 crore rupees. Now, however, it has gone through the motions of challenge before the various courts and tribunals. It landed before the Supreme Court. The Supreme Court, from what we're picking up, is that it had taken objection to two aspects. Number one, the Supreme Court frowned on the fact that the resolution plan wasn't executed within the given time frame, which is a 30-day period, wasn't complied with, and that was the first ground for striking down this JSW resolution plan. The other is the Supreme Court has taken exception to how this transaction was had been gone through by JSW, bringing in equity and convertible debentures. The Supreme Court's rationale was that only equity could have been brought in as per the proposed resolution plan. So on both these grounds, what the Supreme Court has essentially held is that as far as JSW Steel's resolution plan is concerned, it was illegal, should not have been accepted by the lenders, should not be allowed to proceed forward, and on that grounds, the Supreme Court making it clear, sending Bhushan Power into liquidation. So trying to close the chapter there, coming as a shocker, however, for JSW Steel. We'll, of course, have to wait and see if they choose to take the legal remedy of maybe appealing against this order in the form of a review petition. We'll have to ask. We'll have to get a confirmation from them if that's the legal remedy that they choose. But for now, a definite setback coming in.
Setback indeed for JSW Steel, now 6% lower on the stock after this. And Ashmit, thank you for that update. But Nigel is joining in with more on this. And Nigel, tell us more.
Well, this is an absolute shocker, because as Ashmit said, that the process was initiated a few years ago, and JSW Group took over this asset in 2021. In October 2021, JSW Steel, that's the listed entity, had 83% stake in this particular entity. And as of today as well, the last presentation says that they have 83% in this entity. Why is this important? When this asset was acquired, it was a 2.75 million ton unit. That unit got scaled up to around 3.5 million ton unit. And as of the last recorded number, the Bhushan Power asset, it contributes close to around 4.5 million tons on JSW Steel's consolidated capacity of around 35.7 million tons. So 4.5 on 35.7 million tons means it contributes around 13% of the total capacity. What about profitability? I'm looking at the last few numbers, and the EBITDA front, as a percentage of the total consolidated entity, it contributes close to around 10%. This is going to be a shocker because JSW Steel took over the asset, they turned it around, they put in money, and suddenly if this is going to be liquidated, how do you account for all that money? Because they put close to 20,000 crores in this asset to take it over. And then, in fact, they put in further capex, and they also said that from 4.5 million tons, this capacity goes to around 5 million tons. So all of that is on the drawing board. How do you reverse all of this, with regard to the cash flows that have come in there, the capex that have taken place as well? So it'll be interesting to see whether or not there's a way out of this for JSW Steel. But otherwise, it's a negative. 10% of EBITDA, around 12.5 to 13% of capacity. It's come out of nowhere.
Oh, indeed. We've got, let's ask some of these questions. We've got senior advocate at Supreme Court, HP Ranina, now joining in on the show. And Nigel, do stay on to, throw in some questions. So first question is, will JSW Steel challenge, review it? Is there hope of any sort of, some sort of reconciliation for JSW Steel? And two, what happens legally now? The sunk cost into the asset in Bhushan Power, JSW Steel has invested in it, increased the capacity. What happens to that?
Well, on your first question, the answer is very simple. You can go on a review petition only if there is a fundamentally wrong error of judgment made by the Supreme Court, which I don't think is so in this case, because this is on the question of fact, that you had said that you would only issue equity shares. You went in for convertible debentures as well, and this was in violation of the earlier order which was passed. So that is why the Supreme Court has held that this is illegal. Therefore, it cannot be reviewed. You cannot review something on factual errors where the factual error has been created. Therefore, I don't think a review petition will work. But the only thing that can work is that the JSW can go back to the Supreme Court and said, okay, we will only go by the equity route, which was earlier mentioned by us in our settlement scheme. And we will not issue the convertible debentures. And therefore, please review the order based on this new fact, that year after we will only take the equity route to infuse funds into Bhushan Steel. So that's the only way to salvage the situation. I don't think any other way will work.
All right. So, Mr. Ranina, there is a hope still for JSW Steel to still retain this asset.
Yeah, they can. Because otherwise it would be a write-off. As you rightly said, they've sunk so much money into the company, it will be a complete write-off. And that will be a huge drain on the balance sheet of JSW.
Indeed, and the other problem is that it sets a very difficult outlook for the entire industry. For all these assets that get into trouble, and then you have some of these other companies that come in there. So it's not just for this asset; it will set a very negative sentiment for the entire industry. Just comment on that.
Yeah, I entirely agree with you. It will have a very, very dampening effect. And in fact, it will slow down industrial growth to some extent, especially for the steel industry. So the repercussions are substantial. And therefore, they can go back to the Supreme Court and said, look, these are going to be the repercussions. We have therefore decided to take the equity route alone. And therefore, please allow us to go ahead. That's the only way they can salvage the situation.
Right, Mr. Ranina, but I'm just surprised at the way, the amount of time this has taken place. Late in, I think, 2019 or thereabouts is when we started, hearing about the resolution of this case. JSW Group, I think they officially took it over in 2021. And at 2025, you're saying that something that was done earlier was amiss. Shouldn't this have been done earlier?
Yes, it should have been done earlier, but you can't help it. I mean, there may be so many other issues before the Supreme Court. Maybe there was a delay on the part of JSW itself. Their own lawyers may have delayed the matter. We don't know. But anyway, now nothing can be done. The judgment is final unless they come up with the original scheme of equity share issues.
So, Mr. Ranina, just to sum up, what you're saying is JSW Steel still has a chance. They can appeal against this and they can salvage the situation and probably go according to the Supreme Court's, verdict and retain this asset. And that would be good, not just for them, but for the entire system. Because otherwise, there is capex that's put in, there are cash flows that they have got back, and they have ramped up this asset from around 2.75 million tons towards 4.5 million tons. So it'll be a win-win-win for everyone. If in fact JSW appeals, then gets some kind of relief and goes according to what the High Court is saying. Is that correct?
That's correct. But it is not an appeal. It will be a review based on new facts. You can't appeal against the Supreme Court's own order. You can only ask them to review it. It will be a review based on the new facts which will be brought before the court.
And the new fact here, sir, will be that we will take over, we will complete the takeover only with equity and not a mix of equity and OCD. So they need to go back with that promise.
Absolutely.
Is there a possibility that the Supreme Court says no, no ways we want this to go into liquidation, or
No, I think if you point out all the repercussions of this order, the Supreme Court will, I'm sure, reconsider. They are not going to take a...
Got it.
Why did it take so long for, just once again, I know you spoke about it and we've been discussing it, but still, it's, the judgment could have come.
This is the unfortunate thing, our judicial system works very slowly, and this has always been a big problem. And we have always hoped that the Chief Justice will do something to expedite the system. But unfortunately, the whole system continues. It's become so big, so fundamentally, entrenched. It's very difficult to change the system.
Okay. All right. Mr. Ranina, we appreciate you joining in. Thanks a lot for giving us your first take. Once we get further details, we request you to come back on the channel. So that's the word that's coming in from Mr. Ranina there. As of now, the Supreme Court has, their verdict goes against JSW Steel. But JSW Steel has an option to go ahead and request for them to review the, this particular petition, because otherwise it's going to be a mess for everyone, for the lenders.
Sure will, right?
I mean, that's what Ms. Ranina says, that they have a case out there to request for review and then go according to what the Supreme Court is saying. Otherwise, it'll be very difficult to account for all the investments that have gone in there, all the cash flows that have come off as well. And for JSW Steel, it now contributes 10 to around 12% of their total EBITDA as well as their capacity. So we'll have to wait by to see how this goes. For the time being, it's negative, but all is not lost. One would have hoped that this happened sooner rather than later, because imagine you acquire an asset few years ago, 4 years ago to be precise, and then you get, get smacked back in 2025 itself. So I'm trying to get in touch with the JSW management. Hopefully one of the spokespersons as well come on the channel and clarify their stand.
Indeed. Just to confirm, so 10 to 12% of the EBITDA?
Yeah, EBITDA is around 10% as of now. In terms of capacity, 13%. Just to 12.5%, 12.6%, I think a rough calculation told me. And the capacity now is 4.5 million tons. That goes to around 5 million tons. At the time of acquiring this asset, it was 2.75 million tons. That went to around 3.5 million tons. Now it's at around 4.5 million tons, which is headed to 5 million tons.
It's interesting there.
And 20,000 crores was the total money they put on the table.
Oh, 20,000 crores. That's a big number as well. That has been pumped in by JSW Steel and showing on the price as well, right? 6% lower now on the stock at the lowest point of the day at 971 is JSW Steel. Of course, the two criteria cited by the Supreme Court include that they used optionally convertible debentures and not just equity, and of course failing to complete it within the prescribed timeline. And as Mr. Ranina also said, that the only way this can be salvaged now is a review petition that can be filed in the Supreme Court, and JSW Steel goes in to highlight the repercussions of such a move. But the call time on this edition of Trading Hour from Rima, me and the team that put this show together. Thank you for watching. We leave you with the Nifty just around 20 points higher now, with JSW Steel the top loser at the lowest point of the day. Counting down to earnings, there are a lot of them slated to be reported in the second half of the day. Halftime report takes the action forward.
Indications from China that it is open to talks with the United States fire up. IT stocks and energy are the biggest gainers, while consumer durables is in a soft spot.
Eternal says competitive intensity is fast growing, quick commerce is rising, but Blinkit won't take the foot off the pedal, spelling likely expanding losses. Even food deliveries by Zomato slow down.
Passenger vehicle sales improve in April. Tractor sales also beat estimates, but two-wheeler sales show a mixed trend. The SUV segment sees a strong growth, helping Mahindra & Mahindra take number 2 position in the PV retail sales.
SEBI Chairman Tuhin Kanta Pandey says there is an intention to find a solution on the NSE IPO with a roadmap that SEBI and NSE can agree on. He also says a second set of rules for F&O should be out soon.
Cognizant says 20% of its code is presently written by machines, and this could rise to 50%. They see developers writing codes with machines and the focus shifting from services to embedding technology in products. Hello and welcome to Halftime Report. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Ekta. As we speak, the markets have come off the high point of the day, and that's because of the big news piece that came in the last 1 hour or so. The Supreme Court has gone down hard on JSW Steel, and they are saying that that acquired asset, Bhushan Power and Steel, will have to go into liquidation. It's not just a negative for JSW Steel, it'll be a negative for the system itself, and also bankers will be wondering about, how things progress from here on. I think that's the reason some of these PSU banking names have taken a hard hit. JSW Steel, remember, they had bought this asset for around 20,000 crores. Well, let's focus on Mindspace REITs. That's the first management on the show. It reported a good set of Q4 numbers. The company recorded its highest ever gross leasing for the quarter at around 2.8 million square feet. To discuss this and more, we have Mr. Ramesh Nair, the CEO at Mindspace. Hi, sir. Good day, and thanks a lot for joining in. Well, give us a few details then. The DPU, I think, in the last quarter, it had gone up a little bit. For the year, what kind of growth are you looking at? And also, if you could give us a sense about how do you see occupancy span out for FY26?
Nigel, we have had an outstanding financial year and outstanding last quarter for the financial year. Our gross leasing for the full year was 7.6 million square feet, which is the highest since listing. Our net leasing was 4.4 million square feet, which is again the highest since listing. Our occupancy rates have touched 93%, which is again the highest since listing. NOI grew for the year by 9% and distribution for the year grew by 15%. Coming to the last quarter again, gross leasing was 2.8 million square feet and net leasing was close to 2 million square feet, again both highest since listing. Our NOI went up 13.2% in the last quarter and distribution went up 39%. We hope the occupancy rates, which are 93%, over the next over this financial year would go towards a 95% mark.
Okay, got that. All right. You've also said that that leasing demand. Basically, I want to understand what kind of leasing demand are you seeing from GCCs as of now? Is there a slowdown, or is it as strong as say a couple of quarters ago?
See, it's an evolving situation. We are monitoring it closely. Not seen any immediate impact on the leasing market. You may remember that the calendar year 2024, we saw a total net absorption of 50 million square feet, which is an 18% growth. I was checking the numbers of the property consultants for the first quarter this year, the first calendar quarter this year. Net absorption has again gone up 59%, close to 13 million square feet, and gross absorption again has gone up 28% to 20 million square feet, and vacancy rates the lowest in the last 3.5 years. So market doing well. The GCCs again in the first quarter have taken 45 to 50% of the overall demand, and the market is being dominated by big size deals, which we typically call as 100,000 square feet plus deals.
Okay. All right. Mr. Nair, you mentioned that, vacancy rates are the lowest that you've seen in 3.5 years. So it seems as though business is looking good for you. But any headwinds that you can point out to the demand that you could probably share with us in FY26?
Like I said earlier, not seeing anything as of now. For us, the good news, Ekta, is that we've done a lot of pre-leasing. The 1 million square feet building, which we just got completed in Pune, that is again fully pre-leased to a global energy GCC. The 1.5 million square feet building coming up in Hyderabad, which is going to be ready towards middle of next year. That's again been pre-leased to a global banking GCC. So, and a data center, 350,000 square feet is again been pre-leased. So we are kind of neutralized ourselves from where the market is, in case something goes wrong in the market, we have kind of de-risked ourselves from that.
Okay, fair enough. You do have 3 data centers which are remaining. Can you give us a sense in terms of when you expect the delivery to take place and what is the pipeline looking like as well in terms of incremental data centers?
So our data center portfolio today stands at 1.7 million square feet, total of around 285 megawatt. This kind of helps our portfolio from a long-term leasing. It's all long-term leases, 20-year plus leases, longer lock-ins. The first 2 data centers have already been delivered out of the 5 data centers. The next 3 would be delivered in a phased manner over the next 2 to 3 years.
Okay. All right. Just a quick, question with regards to demand as well. You just did speak about the GCCs, but give us a sense in terms of the SEZ segment, if you did touch upon that already or not. What is the occupancy that you're expecting within that space?
So we've actually been big beneficiaries of the government's demarcation rule change, which happened early last year. If you remember, early last year, the government had allowed part-wise, flow-wise demarcation of SEZ space. I was checking the numbers. Back then, our occupancy rates in Navi Mumbai was around 76%. That's now gone up to 86%. We have already demarcated around 2.1 million square feet of our SEZ space, vacant SEZ space, and leased around 1.2 million square feet of that. So that rule change has definitely helped us.
Okay, all right, fair enough. We're going to wrap it up on that note, Mr. Nair. Thanks very much for joining in and speaking with us. So that's Mindspace REIT talking about how vacancy rates are the lowest that they've seen in their GCC segment in 3.5 years. As of now, they're not seeing any sort of headwinds come in there. And the first and the second data centers have already been delivered. We take a short break, but before we take a break, here is some good news. Network 18 beats Times Internet to become the #1 news publisher on Comscore. News 18 races past the Times of India to be the #1 news brand in the country. And that's not all. At the social plus on platform leadership network level, Network 18 is the runaway leader as per the Social Plus MMX Comscore report for March 2025, with 315 million unique views, which is 55% more than the nearest competitor, Times Internet, at 202 million. News 18 also races ahead of Times of India in terms of Social Plus MMX cumulative reach. News18.com overall clocked 251 million unique views to beat the Times of India overall, with 183 million unique views as per the Comscore report for March 2025. As per Comscore social media metrics report, Network 18 is 2 times bigger than the nearest competitor, with a 54% reach within the 389 million overall social population. And speaking about Indian languages, in terms of Social Plus MMX cumulative reach, News 18 Indian languages is the leader in the category, with 182 million unique views as per the Comscore report for March 2025. Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Well, let's talk about one particular company. Mass Financial is the next management on the show. It witnessed what was strong disbursement on a year-on-year basis, but the net interest margin came under pressure. To discuss this and more, we have with us Kamlesh Gandhi, who's the chairman and the MD of the company, joining in to discuss this quarter gone by. Mr. Gandhi, hi. Thanks very much for joining in. If you could just start by talking about this disbursement growth, what led to this strength this quarter, and what are you guiding for?
Good afternoon. So if you see, our performance for the quarter in terms of disbursement remains steady. And we had always prioritized risk management and profitability over just the disbursement and the AUM growth. And just to add to that, we are satisfied with the efforts that we did as a team to maintain the quality of the assets during this very trying time. So going ahead, we would like to say that we will be in a position to grow anywhere between 20 to 25%. That has been our stated objective since long. And we will endeavor towards that stated objective.
All right. Hi, Mr. Gandhi. Good day and good to see you in. This is Nigel on this side. It's been a while since we spoke. So you're saying around 20% growth. That's in dispersals, right? What about AUM growth? Where do you see this number move? I think the last recorded number we have is around 12,100 crores is your AUM. How do you see this number trend up in this year and say with a 3-year time horizon?
See, when we talk about the growth, we usually talk in growth of AUM because the disbursements differs upon the product and the tenure and many other factors. But we try to maintain the growth on AUM because that really makes a difference in terms of our earning. So the AUM growth will be around anywhere between 20 to 25%, depending upon the market situation that we face from time to time. And yeah.
Yes, go ahead, sir.
And
you wanted to make another point. Please go ahead.
And as I shared earlier, the priority will be that how we maintain the asset quality given the current situation.
Okay. If you could just narrow in a little bit on the micro enterprise segment, what are you facing in terms of this quarter? What were the key trends that took place? And are you seeing any kind of improvement there? And what are you guiding for?
So as far as micro enterprise loans are concerned, just to share with you, one of the oldest financiers in this segment, we have grown in a very calibrated manner over all these years, have gained the niche expertise to manage this segment. So during this quarter also, there were some accelerated write-offs because of the overall situation. But overall, we could maintain the quality of the assets. And if you see that segment has grown at a slower pace as compared to other segments. So the growth in micro finance has been on a year-on-year basis at around 9%. And that was a deliberate move on the part of the company to be cautious in that segment.
Got it. Okay, all right. Let's get a couple of numbers going then. What kind of NIMs should we be working with from here on?
So we have always maintained that we'll have range-bound NIMs anywhere between 6.75 to 7.25%. Depending upon the interest rates and what yields we can charge at the market. If I talk about the current year we could maintain the yields at around 7.1%, the NIMs at around 7.1%, and that results into an ROF close to around 2.8%.
Okay. If you could just narrow down, Mr. Gandhi, on your two-wheeler and your CV segment, your commercial vehicle segment, both of those segments were quite sluggish sequentially as well if you look at the assets under management. Give us a sense in terms of the trends there, especially in the two-wheeler, which saw a decline of almost 3% Q on Q.
So that is a general market trend. Q3 is characterized by the festive season. So during festival season, the Q3 numbers are higher. So usually the Q4 numbers are lesser as compared to Q3, and that is in consonance with that trend. And even in our commercial vehicle segment, Q3 is usually strong as compared to Q4.
Okay, all right. But are you observing pain in micro enterprises, and how long do you think this pain will last?
I think the micro enterprise loans in particular will see some headwinds still on the asset quality for a quarter or two, depending upon the working of the company. But if we share our working, we have been very cautious and we have been in a position to maintain the overall net stage 3 asset, which is at around 1.62%. And even in micro enterprise loans, we could maintain it within the stated objective.
So I'm not sure if I missed this, but if you could give us your specific gross NPA ratio guidance going into FY26?
So we have always maintained a range bound NPA guidance. That means we will be anywhere between 2 to 2.5% on GNPAs and around 1.5 to 2% on NNPAs.
Okay. All right, sir. Appreciate you joining in. Thanks a lot for giving us some clarity. So just to revise those numbers, the AUM growth will be in the vicinity of around 20%. Your NIMs will hold at around 6.75 to around 7.25%. Thanks, Mr. Gandhi, for joining in and filling us in with all of those details. Well, time to slip into a short break, but as we do that, here's some good news coming in for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates. All of this at your fingertips. Download the CNBC-TV18 app now from the Google Store or the Google Play Store, or just scan the QR code that's up for you on the screen.
Welcome back. Well, definitely pressure in the mid caps at this point. So down around 0.7%. We have the advanced decline ratio as well, which is you'd say on the declining side. So around 1,800 stocks advancing to around over 2,000 stocks declining on the Bombay Stock Exchange. Just want to point out, however, that there are a couple of stocks which are managing to buck the trend at this point in time. So I just want to talk about a couple of these Nifty stocks. Bandhan Bank, there seems to be, some kind of relief rally which is playing out for this particular stock for the entire week. That stock has gained around 3% odd. So do watch out for that. And Reliance has done exceptionally well this this week. So that stock is up around 9% odd at current reckoning. It's the best performing stock this week. And separately in JSW Steel, that's the stock that we've been tracking from the past hour odd. That stock is now at the low point of the day, down around 6.5%, so trending lower as we speak for JSW Steel. Autos also not doing too great. So Eicher Motors is down 3% odd. Bajaj Auto also down around 2.5% odd at this point. But in fact, staying with the entire auto space, they all are in focus today on the back of their April sales figures. Sudarshan is here with more details on that. Sudarshan.
So auto sales for the month of April have come in as per our expectation. The segment which has done the best is the passenger vehicle segment. Both M&M and Maruti have reported sales better than estimates. For two-wheeler, sales were mixed. As far as the tractor segment is concerned, it has done better than estimates, but commercial vehicle has disappointed. So we start with the company which has reported the best set of numbers is Mahindra & Mahindra. Both auto and tractor segment sales were much better than estimates. And in the passenger vehicle segment, company has become the #2 player surpassing both Hyundai and Tata Motors. Now coming to Maruti, sales were slightly better than estimates. Good part for Maruti is this time its compact segment comprising of Baleno, Wagoner sales have done better and it has improved year on year. But one segment that has been under pressure is the sales for Alto and Espresso. Even for the month of April, sales have fallen 45%. But SUV sales have improved by 4 to 6%, and also the sales sales for other OEMs. So basically, company has an agreement with Toyota, and for that segment, sales also have improved year on year. And in two-wheeler space, the company which has done the best is TVS. It has been outperforming peers for the last few months, and it continues to do in the month of April also. All the segments have seen a double-digit growth, especially export segment, which has seen a growth of 45%. Another segment which has done growth of more than 50% is the electric vehicle, where growth was almost 60% year on year. Now, coming to Tata Motors, all the segments have seen a decline except two segments, that is the heavy commercial vehicle and truck. Apart from these, all the segments have seen a decline, especially electric vehicle, where sales were down almost 16%. In the two-wheeler space, the one company which has been reporting the weakest number is Hero MotoCorp. For the month of April, total sales have come in at 3.05 lakh units against our expectation of almost 4.4 lakh units, and this was because of the production that company had shut from April 17 to April 19 at 4 facilities. Today also, two companies have reported numbers. First from Bajaj Auto, where sales were below expectation. Total sales have come in at 3.65 lakh units against our expectation of 3.80, and it's mainly because of domestic sales which remain under pressure. And another is Ashok Leyland, where also sales were below expectation, mainly because of MNSUV segment, where both segment bus and truck sales have declined year on year. So overall, sales for the month of April were mixed. Passenger vehicle has done the best. Tractor is followed up. Tractor also has done better, but two segments that continue to underperform are two-wheelers and commercial vehicles.
Okay, all right, sir. Thanks a lot for that. Well, we'll slip into another snappy break. You come back. We'll focus on markets. We'll also connect with the management of Go Fashion, discuss their past quarter's numbers and the way ahead.
Welcome back. Well, definitely trending lower for the mid caps. As of now, the mid cap index is now down right 0.8%. So do watch out for that. The Bank Nifty is just about flat with a little bit of a positive bias. So it's going to move any which way just in the next couple of minutes. But nonetheless, let's concentrate on a little more in terms of numbers. We have Go Fashion, which is buzzing in trade after posting what was a strong set of Q4 numbers. It delivered its highest same-store sales growth in 7 quarters. Improvement in margins also were led by lower discounted sales. To talk more about this, we have Gautam Sarogi, who's the ED and the CEO of Go Fashion, joining in. Mr. Sarogi, thanks very much for taking the time out. Well, if you could just start by telling us about the same-store sales growth. You know, it's at a 7-quarter high. What was the absolute percentage that you clocked in terms of the same-store sales growth? And do you expect this kind of a trend to continue? What might you be targeting for FY26?
Yeah, see, I think last 6-7 quarters have been very tough in the retail industry. And we saw some sort of improvement in January and February. And January and February were positive same-store sales growth on a YOY basis. So Q4 was a good quarter for us. So we ended up with a same-store sales growth of about 2.11% on a YOY basis for Q4 versus Q4. So I think there is some recovery in demand, and we are optimistic and hopeful that the next 3-4 quarters also we should be able to report positive SSSG.
Okay. All right. So you're saying demand is coming back, right? That's the takeaway.
Yeah, there is definitely a slight improvement in demand, and that's what we witnessed through Q4.
So mid-single digit SSG should be gettable for FY26?
Well, internally, that's what we are going to be targeting.
Okay,
so
all right.
We will be as positive as possible.
Got it. What about margins? They've been in early 30s, range bound more or less?
I think we should be able to maintain margins over FY26.
Okay. Just give us a sense about, you know, the cost factor then. You're saying that you'll probably be able to maintain margins. What exactly are the input costs doing to the business now? Do you need to take price hikes? Can you, based on the demand scenario that you're seeing?
See, I think from our raw material pricing concern, our raw material pricing is very stable. And I think in recent times, our gross margins also had improved about 100 to 150 bips. So I think we see consistent gross margins over FY26. Of course, rent and salaries are two very large cost items in our P&L. So if you're able to clock positive SSSG, I think those two line items also will be in check. So considering that, I think we should be able to maintain healthy margins in FY26.
Okay, all right. What about the store addition plans? I think last year that was around 62, and this year you had bigger plans. So could you tell us what's the number of stores you're looking to add?
Yeah, so Nigel, I think we'll end up with at least 120 stores, if not more. And I think our pipeline of stores is very clear. So we would be delivering 120 or more stores in FY26.
Okay. Is that the plan that you always had in mind, or is that, say, a scale up or a scale down based on what you're seeing?
No, I think, look, in the past, we've always delivered 120 plus stores. Last couple of years, we've consolidated our store network. So, in fact, in FY25 also, we had opened about 104 stores on a gross level, but shut 42 stores at the same time. So, our net addition was 62. So, we are just basically increasing our store addition from 104 to 120 plus this year. And we don't see any major consolidations as far as store closures are concerned in FY26. So on a net number, we should be able to deliver 120 plus stores.
Okay. Correct me if I'm wrong, but you did have some plans of going global. Did you launch that store in Dubai?
Well, the store is going to go under fit out soon. So we are hopeful that the store should open before June 30th.
And what are you expecting from that particular store in terms of, say, sales, and what is the expansion that you're expecting, say, when you talk about a global expansion, since you are starting?
This international expansion, what we are doing, so for the Middle East, we are doing it through Apparel Group. So I think first step is to just first open the store. So we are not having any expectations as such. If the store does well, then probably Apparel Group will experiment with another couple of stores. So I think it's a pilot. So I think it's going to take its own time to mature. But from an expectations perspective, because this is the first time we are going there, so we are keeping expectations low. Hopefully, it should cross our expectations.
What does it mean in terms of the average selling price? That's been range bound as well, $750 to $800. How do you see this number moving?
So I think from a domestic India perspective, I think our average selling price would grow at about 2 to 3% on a YOY basis, and that this would be largely led by product mix. We are not looking to do any price hikes anytime soon.
Okay, no price hikes anytime soon. But you are also looking to expand into everyday wear?
Yeah. So I think, look, this is a new pilot we have thought of doing internally. See, from a Go Colors perspective, the consumer perceives Go Colors as a very functional, core, everyday product. And it's because we are limited to bottom wear. I thought this is a good time for us to expand our product portfolio into other categories of everyday wear. And ladies topwear is something which we've been evaluating for quite some time now. So we are looking to do a pilot and open about 15 stores in the coming couple of quarters. And this 15 stores is going to be largely from our existing network. So what had actually happened was, though our average store size is about 400, 500 square feet, many of our stores were above 1500 square feet. So we are selecting 15 stores of our existing network, which are greater than 1500 square feet in size. And we are going to be introducing these newer everyday wear categories in those such stores as a pilot.
Okay, all right. We're going to leave it on that note. Gautam, thanks very much for joining in and speaking with us. So that's Go Colors talking to us about the expansion plans in the quarter gone by. We do have a couple of numbers on your screen. Godrej Properties, where there's been a sharp dip in terms of the margins, around 300 basis points odd. So margins at 5% versus 8.6%, and the net profit too has fallen around 20-odd%. Newgen also came out with numbers. The stock shot up around 7 to 8-odd%. There was a profit growth of around 22%, which the company reported. So that stock has seen some amount of upside. Godrej Properties, not that much luck. That stock up around 1.6% at this point. EBITDA and profit looking weaker. Well, we need to take a short break, but before we do that, here is some good news. The Network 18 has beaten Times Internet to become the #1 news publisher on ComScore. News 18 races past the Times of India to be the #1 news brand in the country. That's not all. Network 18 is the #1 digital network in the news and information category as per ComScore report of March 2025. News18.com has 38% more users on native and social platforms than of Times of India. As per ComScore report of March 2025, Network 18 is way ahead of the Times Internet with over 55% more internet users on native and social platforms. Welcome back. Well, for a couple of stocks which are moving around, it's quite a lively market. So MOIL is up around 7.8%. That stock is buzzing around on good volumes also at this point in time. Separately, Godfrey Phillips is also seeing some amount of traction. So not that much in terms of volumes, but that stock is up around 2.3% at this point. IRFC is the other one. Mazgon Dock Shipyard, that stock has obviously, along with the entire defense space, seen a spectacular week. So that stock is up around 16.5% at current reckoning and has gained around 17% this month. Bharat Dynamics as well is not doing too great today. So that stock is down around 2%, but it's gained around 5% this week. So that's pretty much what's taking place in the markets at this point. It's a quiet day, you'd have to say, for the frontline indices, but the pain seems to be in the broader markets at this point, where the mid-cap index is currently down close to 1%. But overall, a consolidatory trend is what you'd have to say, which continues at least for the frontline indices, now with a negative bias. RealTel, however, is in focus. It's fired up in trade after reporting its Q4 numbers. Revenue and profit came in at a multi-quarter high. Vamakshi is here with more.
Well, that's right. Revenue and net profit has come in at a multi-quarter high for RealTel. When we look at the revenue growth, it has been very strong. Revenue has seen an uptick of almost 57%, but the EBITDA margin has come under slight bit of pressure. EBITDA margin has contracted by nearly 27 basis points, and largely this is on account of higher, it's a very sharp jump that has come in the expenses on projects. It's a nearly 86% jump, putting pressure on the margin. EBITDA too has seen an uptick of almost 54% despite that. The net profit, on the other hand, has come in at 113 crores. This is a 46% uptick. So overall, when you look at the numbers, they look quite strong. Now let's also look at the segment-wise performance that the company has posted. For their project work services, which has now contributed a significant portion to the company's revenue, the revenue saw an uptick of almost 91%. The margins too have seen a substantial improvement from 2.4% to 4.9%. So an increase in the contribution from this particular segment could also be putting some pressure on the margins. On the other hand, telecom services, which comes with a much higher margin, has seen a revenue growth of only 7%. PBT margin has improved by 103 basis points out here to 23.5%. So overall, when we look at the numbers that have come in from the company, very strong growth in revenue driven by the project work services, but the contraction in margin, a bit of concern, but nevertheless, the street is not paying any attention to that. The stock is firing up in trade on the back of a strong set.
Okay, all right, Vamakshi. Thanks very much for that. So that's on RealTel, but Marico is in focus as well. It expected to post its quarterly results today. And Mangalam is here to tell us what the street expectations are from the FMCG company.
Well, Marico has been doing well over the last 1 month or so. In fact, in the consumer space, it's been reporting better performance than all the other companies this time around. And the street expects that to continue itself, because the company in its fourth quarter update itself has said there will be stable demand trends amidst improving trajectory in rural. And they expect consolidated business at low double-digit growth, along with India business posting a sequential uptick in underlying volume growth. They expect marginal growth in operating profit, and that's something that the street has adjusted itself for, given the high prices that we've seen in copra. So overall revenue growth seen at 17%, close to around 2665 crores. The EBITDA grows just 4%. That means a margin dip of nearly 200 basis points, and the net profit grows around 5%. The number you're looking at is 335 crores. What the street is working with is a mid-single-digit volume growth, anywhere between 5 to 6%. This is largely in line with what the company reported in the third quarter itself. Parachute coconut oil saw some transient sluggishness in volume, so the management is positive about the next year. Saffola did well, and value-added hair oils also exhibited gradual improvement. That was a piece in their business which wasn't doing particularly well. That is showing some sort of improvement.
Thanks a lot for that, Mangalam. Well, SBI, that's the other company that will be reporting its Q4 numbers tomorrow. Abhishek gets us the key expectations. Abhishek?
Well, Nigel, to begin with, the NII growth rate on a YY basis could be one of the lowest that you are seeing in the last 20 quarters as per analyst estimate. So the key things to watch out is that the deposit growth to be lower than the system growth. MOSL estimates a deposit growth of 9.15% YY and about 2.7% sequentially. Advances growth rate to remain healthy again Motilal Oswal estimates advances growth of nearly 13.2% YOY and about 4.75% sequentially. The net interest margin can come under pressure both YOY and quarter on quarter. So Kotak Securities estimates a decline of 34 basis point on net interest margin YOY and 12 basis point decline on a sequential basis. Now operating profits could come under pressure. The absence of treasury gains this time around could hurt the operating profit. So Kotak Securities estimates a decline of nearly 30% YOY on operating profits and about 14.2% on a sequential basis. Now asset quality largely has remained stable for large banks. So expect slippages can remain stable or improve sequentially and recovery and upgrades to be on the lower side. So asset quality, however, is expected to improve on a sequential basis. Motilal Oswal estimates the gross NP ratio at 1.96 versus 2.07%. Now management commentary with respect to business growth, net interest margin and return ratios will be seen closely. Our polls suggest an ag growth of just 1.9% YOY, while profit can decline by 17.5% on a YOY basis. Back to you.
Okay, all right. But Abhishek, stay on. We have Kotak, which will be reporting its numbers as well tomorrow. Tell us what are the expectations?
Well, Ekta, Kotak Mahindra Bank, the NII growth rate could be one of the weakest in last 14 quarters and PAT can decline the highest in last 20 quarters on a YOY basis. So take a look at the key things to watch out will be the business momentum. Now, deposit growth and loan growth will be key monitorable factor given the fact that Motilal Oswal estimates deposit growth of just 5.5% YOY and loan growth of just 6% on a YOY basis. Net interest margin can decline YOY, however, can remain healthy on a sequential basis. DAM Capital estimates net interest margin to decline to 4.93% versus 5.28% in the same quarter last year. Now watch out for low cost deposit momentum. It has been on a declining trend over the last few quarters for the industry, but this time around the low cost deposit momentum has been strong for large banks. So Kotak Mahindra Bank has one of the highest CASA ratio in the banking sector. Last quarter it was around 42.3%. Now slippages can remain elevated. Watch out for the unsecured loans which can cause pain. Personal loans can see some slippages tapering off over there as well. Now asset quality expected to remain stable. Motilal Oswal estimates gross NPA ratio to be flat on a sequential basis around the 1.45 to 1.5% mark. Management commentary and outlook will be important with respect to business momentum as well as credit cost. Our polls suggest NII growth of 7.5% YOY and profit to decline by more than 9.5% on a YOY basis. Back to you.
Okay, all right, Abhishek. Thanks a lot for that. Well, for the time being, we'll slip into a short break. On the other side, Manisha Gupta will be joining, and she'll be joined by Vaishali Banerjee, the Managing Director, India at Platinum Guild International. Stay with us.
Welcome back, and joining us on the show now is Vaishali Banerjee. She's MD India, Platinum Guild International. Vaishali, hi, thank you so much for joining in here. You know, when you look at the gold price is trading at $3,000 an ounce and platinum in a discount at almost $1,000 an ounce, does that give buyers and industry as well a bit of an upper hand in sense of buying? How has been 2025 for you until now? And would you say Akshaya Tritiya sales, especially when it comes to platinum jewelry, also have done well?
Hi, Manisha. Good afternoon. Lovely to be here. And as you rightly say, I think this is a historic opportunity, if I would say so. And this is something that we are seeing globally, because at this kind of price differential, platinum is actually presented with a huge opportunity. If we look at from the consumer point of view, you know, it's possible to now have platinum across a range of jewelry categories, range of price points. And for the consumer, they can actually have their budgetary needs met with a high value, high precious, rare metal. So there's literally no need to have any kind of compromise on quality, on purity, on weight, and things like that, which are really important. So it does present a very, very strong opportunity. And this is something that we are seeing picked up here in India. And we are also seeing this picked up globally. And of course, globally, you know, there is this move from white gold towards platinum. And here we can see that the platinum uptake has really picked up. This, if you look at so far, if we look at the Jan-Feb demand was up at retail close to 15%. And Akshaya Tritiya, though the numbers are still coming in, looks extremely positive. So south of India seems to be up almost 18% in volume. And the rest of India, while we are getting numbers, I think what we've got so far is looking like a 12 to 15% growth. So strong numbers reflective of the real opportunity, both from a retail point of view, as well as from a consumer point of view.
Well, those are very, very strong numbers coming in, Vaishali. You know, just going back into history, I understand 5, 6, 7, 8 years ago, platinum was at a premium to gold, and that's how perhaps it just about continued for the longest time. How many years has it been that platinum now is at a discount? And when you look at the historical pattern as well, has that been often seen on charts?
So yes, it has been at a discount to gold for a few years now, but I think the delta has really increased as of now, and that has been so over the last few years we've actually been seeing this trend, and in India we have a lot of this bimetal jewelry, which is really platinum with some gold and 18 karat pink gold mostly because of from the design perspective. But what we've really seen is that the metal is very precious and very, very aspirational. And the quality of the metal is actually not depreciating, even though the price is at a discount. And that is seeming to be the consumer opportunity, and the people are tapping into, both from the retail and industry point of view, as well as from the consumer point of view. So we've seen this trend over the last few years, and last year and this year, it seems to be at this kind of difference, which is a huge opportunity, really. Because if you look at it, it's cheaper than 18 KT. So, you know, 22 KT for sure, but currently platinum is discounted to 18 KT. So you could get 95% pure metal in jewelry, and at a price that is less than 18 carat.
Vaishali, also, when it comes to the Indian markets, what is the kind of growth that you have seen on an year-on-year basis when it comes to buying into platinum?
So it's been a very robust market. So if I just discount the COVID years, we've always looked at initial years, of course, were very high because you know, it was a nascent market. But once the market has been established, we've always seen around 15%. If I would average it out, some years it goes up to 18, some years it is about 12, but around 15% retail, and fabrication is always ahead of that, because we've also seen a big growth in exports. because the US demand has grown, Europe demand has grown, so we've seen fabrication growth as well as domestic retail growth.
Just when I look at the markets on an international basis, we do understand, as per reports, that 2025 is going to be a third straight year that we are looking at a deficit in the global markets when it comes to platinum. Do you also see that supporting the prices going forward? Because platinum is one part jewelry, but it also is about industrial demand. It also is about green energy demand.
Absolutely. And that is why it is very, the price and demand is closely linked normally, and the deficit that you rightly said, and we therefore hope that the price would remain strong and and we see a price appreciation over the next few years.
Vaishali, also a final question then. How do you see India retail, India jewelers now give shelf space to platinum? Well, yes, it is increasing in size because of the price opportunity as well. But what has been your conversation here? Where do you see more platinum being bought into India?
Platinum is no longer only a large metro phenomenon. It has gone into tier 2 cities and so on. So, and all conversations are indicating that retail is actually expanding the range. As I mentioned before, very briefly, that the bimetal jewelry, which is an entirely new category for us. So it's not only just plain platinum with diamonds and other precious stones, but now also platinum with 18 karat gold. So I think the expansion of multiple range of jewelry and categories like this is automatically going to result in larger shelf space, because jewelry needs to be presented to the consumer at the store.
Okay, all right, Manisha, thanks very much for taking us through that conversation. Well, we need to wrap up on the show, but while we do that, just a quick update with regards to the markets at this point. It's a very quiet day, so the Nifty is just about lower by around 43 odd points. We have the Bank Nifty, which is just about treading water as we speak, and the advanced decline ratio, which is just about holding on the declining side. In terms of specific stocks, it is a lot about JSW Steel this afternoon, so we will be discussing that as the day continues. But that stock is at the low point of the day, down around 6.5%. And a couple of the auto stocks are under pressure as well. So Eicher Motors, Bajaj Auto, Hero Motocorp, all of these stocks are down anywhere between 2 to 3.5%. Pharma not doing too well today. So Cipla is down around 1.8%. Mankind Pharma, as you saw earlier on your screen, that stock is down around 3% at this point. On the upside, just watch out for a couple of the stocks such as Adani Ports, which is your top gainer on the Nifty. We'll take a short break, but stay tuned. Business Lunch up next. Market gives up morning gains with key indices trading near the day's low. Metals, consumer and realty stocks lead the fall while energy bucks the trend. Passenger vehicle sales improve in April. Tractor sales also beat estimates, but two-wheeler sales show a mixed trend. The SUV segment sees strong growth, helping M&M wrest the number 2 spot in the PV retail sales. The Supreme Court rejects JSW Steel's resolution for Bhushan Power and Steel and orders its winding up, citing a deviation from the approved plan of a pure equity deal. Experts say JSW Steel reverting to the resolution conditions may persuade the Supreme Court to review its order. Eternal says competitive intensity is fast growing, quick commerce is rising, but Blinkit won't take the foot off the pedal, spelling likely expanding losses. Even food deliveries by Zomato slow down. SEBI Chairman Tuhin Kanta Pandey says there is an intention to find a solution on the NSE IPO with a roadmap that SEBI and NSE can agree on. He also says a second set of rules for F&O should be out soon. Hello and welcome to Business Lunch, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra, your host this afternoon. Well, it's turning out to be a session where it is consolidatory, you'd have to say, for the Nifty. So currently at around 24,298 is currently where the Nifty is at, down around 37 odd points. And the Sensex showing a bit of an uptake, just about consolidating with a positive bias at this point. It has recovered on an intraday basis marginally, but not much as of now. We do have the mid-caps, however, which are under pressure, so 0.7% lower currently for the mid-cap index. And maybe the BSE small-cap index should show up for you as well to give you a sense in terms of how exactly the small caps are performing this afternoon. And you can see on your screen just about higher by around 0.13%. In terms of stocks, it's a very active day in terms of the frontline indices. So what you can see and have been seeing in the past week or is a lot of stock-specific action. So, for example, Adani Ports is higher by around 4% at this point. Indian Bank is higher by around 1.7%. UPL, Bajaj Finance, all of these stocks are showing some amount of traction on the upside. Reliance has been one of your best movers this week, so that stock is up around 9%. On the downside, there's JSW Steel, which is your top loser at this point. So that stock is down around 6%. A couple of the auto stocks, post auto sales, are not doing that great. So stocks such as Eicher Motors, Hero Motorcorp, all of these stocks are trending in the red at this point. Bharti Airtel, ONGC, all of these stocks are also showing some amount of a downtick at this point in time. So that's the overall picture. Broader markets at this point, Seat, Mazgon Docs, Paras Defense, a couple of your usual suspects continue to gain, and that is what is taking place at this point. Do watch out for Sonata Software. That stock is up around 30% this week. But let's talk about the top loser on the Nifty at this point. JSW Steel is under pressure. This is after the Supreme Court has scrapped JSW's resolution plan for Bhushan Power and Steel. Ashmit is here to tell us more.
Well, indeed, a big setback coming in for JSW. The Supreme Court setting the clock back by about 5 to 6 years as far as this entire CIRP insolvency proceedings are concerned for Bhushan Power and Steel. The big takeaway is that the Supreme Court was unhappy on two grounds. Number one, the Supreme Court was unhappy with how this entire process has taken much longer than what had been earlier decided. The resolution plan, there's a window for which there needs to be execution. The Supreme Court said it's been over 2 years since the NCLAT granted its approval, but despite that, there's been little or no forward movement. That is something that, in fact, the Supreme Court has taken very strong objection to. The other is how this entire transaction, where JSW is trying to take over Bhushan Power and Steel, went via the twin route of both the equity as well as optionally convertible debentures. And that, again, is something that the Supreme Court said it is not in keeping with the resolution plan. There's only so much leeway that can be granted, and that the Supreme Court, given the fact that there are multiple deviations from the set process as per under the IBC, the Supreme Court says that it has no option but to set aside this entire resolution plan. So bear in mind, it was in 2019 that the NCLT had granted approval, and since then things had begun to move forward. But the Supreme Court saying that both at the pre-approval and the post-approval stage. There are a number of violations that the Supreme Court can't keep its eyes shut. It will have to take action, setting aside that JSW resolution plan, with that sending the company, Bhushan Power and Steel, into liquidation, and therefore, in a sense, setting the clock back by about 5 years for this entire insolvency process. Back to you.
Okay, setting the clock back by almost 5 years. Ashmit, thanks very much for that. That stock is down around 6% On the same lines, we did ask the senior advocate at the Supreme Court, Mr. H.P. Ranina, if there was any way JSW Steel could salvage the situation. This was his response.
The only thing that can work is that the JSW can go back to the Supreme Court and said, okay, we will only go by the equity route, which was earlier mentioned by us in our settlement scheme, and we will not issue the convertible debentures. And therefore, please review the order based on this new fact that year after we will only take the equity route to infuse funds into Bhushan Steel. So that's the only way to salvage the situation. I don't think any other way will work. Because otherwise it will be a write-off. As you rightly said, there's sunk so much money into the company, it will be a complete write-off. And that will be a huge drain on the balance sheet of JSW.
Okay, so that's Mr. Ranina with his point of view there. But let's go back to Ashmit. Busy day for him. Government sources have clarified to CNBC-TV18 that only dues of spectrum acquired prior to 2021 can be considered for conversion to equity. Ashmit, tell us more.
Well, just to set the context, bear in mind that only recently we've seen the government stake in Vodafone Idea go up to as high as nearly 49%. That is, of course, under the dues to equity conversion scheme that the government had approved back in 2021. And since then, we've also heard reports of Bharti Airtel making an application seeking for conversion of its dues into equity. So that decision on Vodafone Idea had set the cat among the pigeons in terms of which dues can be converted. Now, we've reached out to highly placed sources within the government. What they're telling us is that the picture is very clear, that any conversion that is to happen will be happening under the cabinet-approved plan of 2021. And under that plan, what is very clear, and this is what government officials are telling us, the only dues that will be converted will be spectrum or AGR dues prior to 2021. The question that was being asked by many is that can dues for spectrum that was acquired in 2021 be converted? For 2022, can that be converted? The answer seems to be no. The indication falling from the government, from the DOT, clearly is that only dues prior to 2021, spectrum that was acquired prior to 2021, dues only for that can be converted as a part of this conversion scheme. Of course, having said that, officials also saying that merely an application does not mean automatic transformation, automatic conversion, that there will be application of mind. There is discretion that the government will have, and only in case-to-case basis will they grant their approval basis all the facts and circumstances of the situation. So no automatic approval, and importantly, the clarification coming in, only spectrum dues of spectrum acquired pre-2021 will be eligible. Back to you.
Okay, all right, Ashwin. Thanks very much for that. Well, let's focus on the other segment, which is making news today. Auto stocks are all up and about in trade on the back of their April sales. So Sudarshan's tracking that. He joins in with more.
So auto sales for the month of April have come in as per our expectation. The segment which has done the best is the passenger vehicle segment. Both M&M and Maruti have reported sales better than estimates. For two-wheelers, sales were mixed. As far as the tractor segment is concerned, it has done better than estimates, but commercial vehicle has disappointed. So we start with the company which has reported the best set of numbers is Mahindra and Mahindra. Both auto and tractor segment sales were much better than estimates. And in the passenger vehicle segment, company has become the number 2 player, surpassing both Hyundai and Tata Motors. Now coming to Maruti, sales were slightly better than estimates. Good part for Maruti is this time its compact segment comprising of Baleno, WagonR sales have done better, and it has improved year on year. But one segment that has been under pressure is the sales for Alto and Espresso. Even for the month of April, sales have fallen 45%, but SUV sales have improved by 4 to 6%, and also the sales that sales for other OEMs. So basically, company has an agreement with Toyota, and for that segment, sales also have improved year on year. And in two-wheeler space, the company which has done the best is TVS. It has been outperforming peers for the last few months, and it continues to do in the month of April also. All the segments have seen a double-digit growth, especially export segment, which has seen a growth of 45%. Another segment which has done growth of more than 50% is the electric vehicle, where growth was almost 60% year on year. Now, coming to Tata Motors, all the segments have seen a decline except two segments, that is the heavy commercial vehicle and truck. Apart from these, all the segments have seen a decline, especially electric vehicle, where sales were down almost 16%. In the two-wheeler space, the one company which has been reporting the weakest number is Hero MotoCorp. For the month of April, total sales have come in at 3.05 lakh units against our expectation of almost 4.4 lakh units, and this was because of the production that company had shut from April 17 to April 19 at 4 facilities. Today also, two companies have reported numbers. First from Bajaj Auto, where sales were below expectation. Total sales have come in at 3.65 lakh units against our expectation of 3.80, and it's mainly because of domestic sales which remain under pressure. And another Ashok Leyland, where also sales were below expectation, mainly because of MNSUV segment, where both segment bus and truck sales have declined year on year. So overall sales for the month of April were mixed. Passenger vehicle has done the best. Tractor is followed up. Tractor also has done better, but two segments that continue to underperform are two-wheelers and commercial vehicles.
Okay, two-wheelers and commercial vehicles both underperforming, something that we saw in Mass Financial's AUM as well. But staying with the auto space, sources tell CNBC-TV18 that the central government is likely to roll out an electric truck scheme to incentivize the sale of the same. Parikshit is here with more details on this story. Parikshit.
Well, yes, the electric truck scheme was a key part of the PM e-Drive scheme that was launched about a year ago with an outlay of roughly 10,600 crore rupees. Now, the outlay for the e-truck scheme will be 500 crores, and this will essentially incentivize the sale of electric trucks in the country. This is the first time that the government of India will be incentivizing the sale of e-trucks, and the government believes there is strong demand from sectors such as the port sector, cement sector and the steel sector, and there is a lot of interest from the industry to roll it out soon. So we believe that the guidelines have been framed. Also, industry consultations are over, interministerial consultations are over, and the scheme could be rolled out in less than 1 month. So this will be important for companies like Tata Motors, Ashok Leyland, Electra Green Tech, which already have electric trucks ready in their portfolio, and they are likely to benefit from this scheme. There is an electric ambulance scheme which is also on the anvil. While the guidelines for the same are ready, currently the industry does not have a production-ready model when it comes to electric ambulance. So the rollout of the e-ambulance scheme will be contingent on that. For the moment, the e-truck scheme is well on the way with an outlay of 500 crores, and it could happen in less than 4 weeks.
Okay, all right, Parikshit, thanks very much for that. So that's on the entire electric vehicle space. To watch out for Godrej Properties, it's off the highs because the FY26 guidance is actually lower for FY26 versus 25, where they expect that business development is seen at, I think, 26,000 crores. The business development is going to be lower than what they did in the previous fiscal. So that's the reason the stock has dipped from the high. We'll take a short break, but on the other side, we'll get you a roundup of what has transpired so far since Donald Trump announced Liberation Day on the 2nd of April. Welcome back. Well, you're still tuned into Business Lunch on CNBC-TV18 this Friday afternoon. Well, it's been a month since US President Donald Trump's Liberation Day. The last 30 days have seen a number of flip-flops and U-turns, resulting in a lot of uncertainty for economies, investors and companies across the world. But what is the ground reality and how has the US economy been impacted? Hormuz is here with a breakdown.
In a world obsessed with K-dramas, we've been glued to another drama over the last 30 days, and that is the tea drama. Donald Trump and his tariffs wreaked havoc on asset classes across the board in the early days of April, and as the dust settles, the ground reality is far from what Donald Trump claims or wants his followers to believe. Let's first take a look at what transpired during that 1 week from the 2nd to the 9th of April. Now, in a gala event which he termed as Liberation Day, Donald Trump announced a tariff on all countries, a 10% baseline for all of them, and different levies on top of that for different countries, including those regions that did not even have human population. Now, amidst this chaos, China remained defiant. On the 4th of April, it imposed a 34% levy on all US imports, which went on to increase to 125% over the next few days. Now, while global markets were smashed, the real drama was yet to unfold. Now, on the 7th of April, a tweet said that Donald Trump may consider a 90-day pause to his tariffs. The news sparked a 10% intraday recovery on the Nasdaq, but while the White House called this news fake. Just 2 days later, Donald Trump proclaimed on Truth Social that this is a great time to buy. Hours later, he announced a 90-day pause. The result, the US markets had their best intraday move since 2008, the third best on record. Now, Donald Trump claims that tariffs are good for the economy. Companies will begin to invest in the US. Billions and trillions will be poured into the US as revenue and so on. But has that actually happened? Well, not really, at least not in the first 30 days. The first quarter GDP came in at a negative 0.3%, the first contraction since 2022. Trump put the blame on that to the Biden administration overhang. That's not it. Inflation is still above the Fed's 2% target. The jobless claims that came in yesterday were at the highest level in 3 months. Trade deficit is at a record high. The front loading of imports caused the GDP contraction, and consumers are feeling the pinch. The consumer confidence is at a 5-year low. For an economy that is growing at an average of 3% over the last 2 years, out of nowhere, recession has gained prominence. And how? Brokerages project the odds of a recession between 40 to 65% to hit the US this year. Prominent Wall Street economist David Rosenberg goes one step ahead at 85%, while veteran investor Ray Dalio outclassed them all by saying that he expects something worse than a recession. Now, this tariff-related uncertainty has hit companies across the board. Many have suspended guidance for the year, some even for 2026. And when the world's biggest retailer suspends its guidance, you know that there is a reason to worry. But not only Walmart, there are other most automakers, airlines, medical equipment makers that are part of this list because they just don't know what will happen next. Of course, some have been resilient too. Coca-Cola is one of them. Big tech continues to spend. Rolls-Royce says tariffs are manageable. We'll see these names in this list as well. But what about asset classes? That should be divided into 2 buckets, the initial phase and the post-pause phase. The 3 US benchmark indices fell to 52-week lows between the 2nd and the 9th of April, and all of them have seen double-digit returns since then. The US dollar struggles, so does oil. Gold made new highs, but Bitcoin has outperformed them all, nearing $100,000 yet again. But you'll have to give one thing to Donald Trump. His tariff threats have had some of the biggest companies of the world suddenly loosen their purse strings to pour billions into the US as investment. Apple is planning a $500 billion investment in 4 years. TSMC plans for $100 billion. Lilly, Nvidia, Hyundai, Roche, all of them want to expand their presence in the US just to avoid any further tariff pressure. So where do things stand today? After a month full of kabhi haan, kabhi na, China's Commerce Ministry finally said that it is evaluating overtures from the US for possible trade talks. That has calmed some more frayed nerves on Wall Street that the 2 sulking countries will finally get onto the negotiating table. When does that happen? Nobody knows. When do deals with other countries happen? Nobody knows that either. Now, although the Trump administration has hinted at positive steps being taken towards deal with India, Japan and South Korea, the contours of the deal remain unclear. The status of talks with other countries also remain unclear. And lastly, the big question, What happens if the deals are not signed within these 90 days? Another pause? Another extension? Well, your guess is as good as mine. It's been 30 days to this tea drama, and with this back and forth, this confusion, this lack of clarity, everybody around the world finds themselves in a situation where you're reminded of this immortal line by the late Hasrat Jaipuri, "Yahan kal kya ho, kisne jana?"
All right. Thanks very much, Hormuz, for that interesting take. Thanks for joining in for that. Well, focusing on Wall Street and that side of the world, Apple shares fell in extended trading despite reporting second fiscal quarter earnings that beat expectations. As the CEO, Tim Cook, says, it is very difficult to predict tariff costs beyond June. CNBC's Steve Kovac has more details on what was said during the earnings conference call.
Tariffs just dominated the conversation on the call, which is winding down right now. And let's talk a little bit about what Tim Cook has been saying about managing the supply chain. Now, he told myself before the earnings call happened that he expects over half of iPhones sold in the United States in this current June quarter to have been produced in India. And on top of that, it's not just India, it's also Vietnam and other countries like that. For example, for accessories like AirPods and watches, all of those products that are sold in the U.S. end up being produced in Vietnam. But China is still important. Tim Cook saying on this call that for the rest of the world, excluding the United States, the vast majority of products are still going to be made in China. That includes everything from iPhones to iPads to Macs. If you live in Europe or if you live in another country, that is likely going to be made in China. But what we're seeing here, Melissa, is Tim Cook's managing of the supply chain. A lot of this actually began during COVID, during all those lockdowns in China, where they had to expand outside in order to get basically product out the door and overseas. And that is really kind of paying off in a different way now with the tariff thing. And what we're seeing in the June quarter, they're still able to guide revenue growth, and they're still able to mitigate the effects of these tariffs with that $900 million in charges there. But really pay attention. India is going to keep ramping up for USA products, Vietnam as well.
Okay, all right. We need to take a short break now, but here is some good news for our viewers. India's business news leader is now a click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back. You're still tuned in to Business Lunch on CNBC TV18. Well, as the day 2 of the Waves Summit progresses, Maharashtra Chief Minister Devendra Fadnavis launched the new Nifty Waves Index along with the NSE CEO Ashish Kumar Chauhan. The newly launched Nifty Waves Index aims to track the Indian media, entertainment and gaming industry. All right, well, following the launch of the Nifty Waves Index, my colleague Madiha caught up with NSE CEO Ashish Kumar Chauhan to get an insight into the new index and began by asking what motivates NSE to launch this particular index.
In a way, when this Waves conference was being organized to kickstart and to kind of ensure that the creative economy is harnessed well and also coordinating with each other well by meeting in the same place, Honorable Chief Minister Shri Devendra Fadnavis's office called me and said that can you have an index which represents this creative economy. and we requested our index company, and they have created this index called Nifty Waves Index, which basically covers all the virtual activities from music to gaming and in between everything. And that's where I think this is a unique index. It has been done specifically for an industry we believe is going to grow leaps and bounds going forward.
Do you think this is going to drive more investments into these companies that are now a part of the Waves Index?
Absolutely, highlighting this particular industry in the way of index, because the Waves in the conference is going to, in a way, end at some point, but the Waves Index will continue to make waves. So naturally, every person who is interested in this particular industry will keep on watching what's happening, not only to the industry as a whole, but also the different components, because there are 7 different components or the streams that have been identified. And that's where overall this Waves Index is going to be a large and longer legacy, a continual legacy of this particular conference.
And how do you think this is going to help these entertainment companies attract investments, especially from foreign investors?
It highlights the way the Indian entertainment industry works, the creative industry works, and that's where going forward those investors, especially abroad, they tend to invest via index funds more than individual securities, and that's why this kind of index gives them an idea that there are many more companies in the country, not very few, and many more companies are going to come, and they will be included in the index as and when they become large enough to be counted.
Okay, all right. Well, now let's get into some other general news. Earlier today, Prime Minister Narendra Modi commissioned and inaugurated the Vizhinjam International Seaport. Let's listen in to what he had to say.
अभी इस ट्रांसशिपमेंट हब की जो क्षमता है वो भी आने वाले समय में बढ़कर के 3 गुनी हो जाएगी। यहां दुनिया के बड़े मालवाहक जहाज आसानी से आ सकेंगे। अभी तक भारत का 75% ट्रांसशिपमेंट भारत के बाहर के पोर्ट पर होता था। इससे देश को बहुत बड़ा रेवेन्यू लॉस होता आया है। ये परिस्थिति अब बदलने जा रही है। अब देश का पैसा देश के काम आएगा।
All right, that's the Prime Minister, but on to some geopolitical updates now. Parikshit joins in to tell us on the latest on tensions between India and Pakistan. Parikshit.
Well, first of all, Pakistan has violated the ceasefire along the line of control for the 8th straight day. They've been using small arms to fire at Indian posts. Now, these are multiple locations across the LOC where the firing is taking place, such as the Akhnur sector, the Baramulla sector, the Kupwara, the Poonch sector as well. And the Indian Army has been retaliating effectively. Now, we've also warned Pakistan in the Tuesday DGMO talks. These are talks that happen every Tuesday, that Pakistan must not indulge in any ceasefire violations, and we also warned them very strongly. At the same time, we are looking at military exercises which are taking place. So this is India preparing itself for any eventuality and keeping all options open. Now, there is a lot of support that has come in from US congressmen. At least 100 US politicians have sent messages of support to India. We've also received a lot of support from the US government, such as J.D. Vance, who in his latest statement has said that he hopes that India's response does not provoke a regional conflict. At the same time, he called on Pakistan, saying that if Pakistan, to the extent responsible, must cooperate with India to investigate and hunt down the terrorists. We saw a very strong statement from Pete Hegseth, who is the US Defense Secretary. He spoke to Rajnath Singh and later said the US supports India's right to defend itself, and we stand with India and its great people. The US Secretary of State Marco Rubio had also spoken to both External Affairs Minister Subramaniam Jaishankar and also Pakistani Prime Minister Shehbaz Sharif. He called for restraint, at the same time telling Pakistan that it must cooperate in investigating this unconscionable attack. So clearly, messages of support from the United States, but overall asking for restraint.
Okay, all right, Parikshit. Thanks very much for that. So that's the latest. Well, moving on to some updates from the national capital. Heavy rains have lashed parts of Delhi in the early hours, causing waterlogging and traffic disruptions. 3 Delhi-bound flights were diverted due to the rains in the early morning. However, according to an advisory issued by the airport, flight operations have now returned to normal. The IMD has put out an alert informing about the severe weather in parts of Delhi NCR. All right, that's all the time that we have on Business Lunch. Stay tuned. Midcap Radar comes up next.
The final 2 hours of the last of the truncated weeks before we embark on a long 5-day week run. You're watching Midcap Radar live from the CNBC-TV18 Motilal Oswal studios. I'm Hormas Fatakia. With me, as always, is Vamakshi Dhoria. Vamakshi, good afternoon. Well, we are slightly off the highs of the day, though, but still there is some recovery from lower levels. So it's a neither here nor there sort of a case, but there are a lot of earnings reactions that you have to watch out for.
Well, absolutely, Hormas. Lots of earnings trickling in, and the mid-cap end of the market particularly is not doing as well as the broader indices, but the small cap index particularly, if you look at the small cap 100, that is up nearly 0.3%. So there's lots of action. So let's get started with some of the top headlines. Markets give up morning gains with key indices trading near the day's low. Metals, consumer and realty stocks lead the fall, while energy bucks the trend.
The metals index has slipped over 1%, dragged predominantly by JSW Steel after the Supreme Court has dismissed the company's takeover of Bhushan Power and Steel and has ordered its liquidation, citing a deviation from the approved plan of a pure equity deal.
Passenger vehicle sales improve in April. Tractor sales also beat estimates, but two-wheeler sales show a mixed trend. The SUV segment sees strong growth, helping M&M wrest the #2 spot in PV retail sales.
Godrej Agrovet, Phoenix Mills and Indus Towers are among the top losers on the Nifty 500 after their fourth quarter results, while RailTel, Moil has surged. Nugent Software has come off the highs after its results.
23,400 or thereabouts, that is where the Nifty is at. But you know, there's plenty of action that is happening in the broader markets. The advanced decline ratio has been flip-flopping, and as of now it is in favor of the declines. The Nifty Pharma Index is the top sectoral loser for now. The Nifty IT pack, on the other hand, has picked up steam, especially given the kind of moves that we saw in the US market. But you know, plenty of stock-specific action, and we have now Hormaz, who has actually moved across to the wall. And in our special segment, Mid-Cap Movers, he is here with a comprehensive list.
It's a neither here nor there, right? You're heading into the weekend, so it's only fair to say that the market is lacking direction currently. But we'll start off with some of the gainers in the broader markets. Also, there is some recovery from the lower levels. And you can see Jubilant and Grevia there, 7.5% higher. Timken India surged to the highest point of the day, 7% higher there as well. Credit Access Grameen has had a good day at the office, as is CRISIL, building on to the results that it reported earlier this week. Now, also some of the earnings reactions, as we just mentioned to you in the headlines, predominantly negative earnings reactions. Look at Godrej Agrovet now is down 12%. Phoenix Mills is down 8%. Indus Towers has seen a slight recovery from the lows of the day, still down 6%. And Nugent Software at one point was up 13%, but as growth has slowed down in the fourth quarter, they've seen the stock come off too from the highs of the day. Pharma as a sector has been sulking today, barring a few names, but most of them on the losing side. Ajanta Pharma after its earnings, Mankind Pharma too at the day's low, as is JB Chemicals. Stocks that are doing well on volumes, RailTel is one of them, and that is also an earnings reaction. Of course, at one point was up around 12 to 13%. That too is off the highs of the day. Sonata Software and Indian Oil Corporation, after some positive brokerage commentary, is doing well on very strong volumes. And lastly, some stocks that are not doing well other than the ones that we just highlighted before. Data Patterns is one of them, seeing some profit booking after the tearing move that defense stocks saw earlier in the week. Aavas Financiers is down to the day's low, as is KFin Technologies down 5%. So not good going for these names as well, Vamakshi.
Well, absolutely, Hormaz, not such a great going for these names. But, you know, just to add to your list, as far as earnings impact is concerned, let's pull up the chart for Ami Organics. The company reported its numbers just a short while ago. The net profit has doubled for the company. The margins have also improved substantially to nearly 28%. That stock has seen a very sharp surge. As of now, it's cooled off from the day's highest point, but nevertheless holding with gains of 4.5%. But, you know, let's slip into a very short break. We'll get you more on the markets and stock-specific action on the other side, so don't go anywhere.
Welcome back and on to corporate conversations. Then Embassy REIT is the first management on the show after a good fourth quarter. Revenues rose 15% on strong leasing, and we are now being joined by Ritwik Bhattacharjee, who's the CEO at Embassy REIT, who is joining us. Ritwik, good afternoon. Thank you so much for joining in.
Nice to see you.
And you spoke about your FY25 leased area. You exceeded your guidance that you had projected for 5.4 million square feet to deliver 6.6. How are things shaping up now, and what are you projecting for the new financial year?
Well, first of all, thank you very much for having me on the show. It has been a bumper year for us, and we couldn't be more pleased with the way things have panned out. We leased 6.6 million square feet and beat initial guidance by 24%. Most notably, we grew distributions by 8%. They're the lifeblood of a REIT, as you know, and we're pointing to double-digit growth in FY26. And really, it's fundamentally predicated on the fact that business for us and business in commercial office in India hasn't looked better. If you just think about the fact that there is active dialogue between a lot of GCCs who are still rushing to set up shop in India for the talent, for the ability to service their entire operations out of here, we're the fundamental beneficiary of that in our portfolio. We run a 51 million square feet portfolio that continues to fire on all cylinders. We've got 6.1 million square feet of development coming up that is highly yield accretive, and by any single parameter, we are firing on all cylinders and feel very optimistic about the year ahead.
Optimistic about the year ahead, and that sure shows in your guidance. You've guided for distributions in the range of 24.5 to 26 per unit for FY26. So largely, where is this kind of growth that is expected to come from, and how much growth over the longer run can we expect from you? Also, could you also speak about the occupancy levels that you're seeing?
Sure. If you really think about sort of where office is right now, we're really still in an early cycle as compared to maybe you see sort of residential, obviously sort of falling off a little bit. But that is something that's predicated, again, there are GCCs coming in. We see it, so the 10% growth that we are projecting at the midpoint next year is something that we feel very comfortable thinking about, making that sort of a fundamental sort of going forward. We are putting in 3.2 million square feet of development over the next year, and that's in, cities like Bangalore, which is India's biggest market. We have 75% of our portfolio there, and just really the best assets, we think, sort of in India that cater to companies like JP Morgan, Novo Nordisk, and other bellwether names. Occupancy for us is over 90% by value, if you just look at how big our portfolio is, and we think that ticks up to the mid-90s over the course of the coming quarters.
Bangalore, you said it's your largest market with 75% of your portfolio. Any plans on bringing that number down just to avoid that concentration concern?
We don't view that as any sort of concentration risk. In fact, that's something that we consider to be a strategic weapon for us. If you look at Bangalore, which is India's largest office market, and I know there's a lot of talk about being Silicon Valley and all of that, but for us, it is absolutely a fundamental, the biggest weapon in our arsenal. And we are pan-India. We're in Mumbai. Our portfolio here is 100% occupied. We expanded into Chennai. We are in Noida as well, and we're in Pune. Really, a pan-India portfolio of 50 million square feet, and having Bangalore there that continues to fire on all cylinders for us is something that we consider to be very important.
Sure, and a couple of quarters ago, there was a development that came through on the SEZ demarcation. So, what is the kind of conversions that you expect from SEZ to non-SEZ, and what would be the occupancy levels there?
Yeah, so we've actually done sort of 6.6 million square feet of denotification and demarcation, and we've got a couple more million square feet planned. That process, I think the government's been extremely pragmatic and helpful in making sure that the conversions and that process is something that is as easily facilitated as possible. What was obviously a lot of uncertainty in the market has just become very routine and run-of-the-mill. So for us, we don't even actually think about sort of the SEZ conversion process. What we do see is demand firmly falling in the non-SEZ space. Our portfolio by the non-SEZ numbers is around mid-90s at this point in time. And we are opportunistic and continue to evaluate denotification and demarcation as the opportunity presents itself in our space.
What about the hotels portfolio, Ritwik? And if you could share a mix between the two, where is it skewed towards right now? Mostly office, yes, but how is the hotels portfolio shaping up?
Our hotel portfolio is a very small percentage of our entire asset value, right? But what we see is the hotel
business is really picking up for us. EBITDA growth was 25% year on year. We're looking at, and these are business hotels. They're not sort of on the luxury end of the market, but they're following the boom in office because there is clearly travel. You can't sort of get a room anywhere in India these days. If you think about, the quality of the hotels that we provide our office tenants as well, and it's really something that we feel will continue to grow in the quarters to come.
So are you looking to expand that and ensure that people get rooms?
Well, we are building out 2 hotels in one of our marquee parks at Embassy Tech Village in Bangalore. But beyond that, no, we're not a hotel portfolio business. We're an office business with the hotels acting as an ancillary part of it that we continue to make sure provides value.
And what would be your outlook on the kind of rentals? Are you expecting any sort of growth-related concerns on the rentals, especially given how the economic situation is panning out globally, especially from the global clients? Do you see them sort of slowing down on their decision-making with respect to leasing out of spaces?
No, look, at this point in time, we've got potentially 20 million square feet of RFPs in the market. Bangalore and GCCs continue to dominate that conversation. And I think for global clients, if you really think about rentals per se in India, they're a fifth of what they play globally. So that's never really the biggest sort of item when you think about sort of the cost proposition of what India is. India is very cheap relative to what you pay in markets like New York or Hong Kong or Singapore. So I think what they look for is scale. What they look for is obviously the talent base. And I think rental growth will continue to sort of be somewhere in the mid-single digits, as we've sort of seen in the past. But it's a very, very attractive proposition for all the companies who continue coming to India.
What about debt? Final question. You refinanced around about 6,000 crores this time around. What's the balance sheet looking like? Any plans on trimming debt down this year?
Yeah, so we're a 32% LTV book. We're very, very prudent about the way we think about debt. And that's around 20,000 crores of debt. I think fundamentally we rely on debt to obviously fund this business. And I think our fundamental focus is to make sure that, we're always prudent on interest costs, on making sure that we get the best financing rates. So we think we're the best credit in real estate credit in India. So, and we aim to make sure that we get the best rates at all times.
All right, Hrithik, thank you so much for spending time and joining us. Wish you good luck for the rest of the year as well. And the management there of Embassy Office Parks REIT, a good quarter and even better projections for the current financial year. Take a short break. Up next, continuing with corporate conversations, the management of Aeroflex Industries joins us on the other side. Stay tuned.
Welcome back. You're watching Midcap Radar on CNBC-TV18. From one management to another, Aeroflex Industries is the next management on our radar. The company posted a good set of Q4 earnings with EBITDA margin expanding and revenue growing 18% year on year. To discuss this and more, we are now being joined by Asad Daud, MD, Aeroflex Industries. Good afternoon to you, Asad. This is Vamakshi joining in. Well, I'd first like to start off by asking about your revenue because, your revenue for the entire year has seen an uptick of almost 18% now. Now, this is much lower as compared to what you had earlier guided for, that was in the range of 20 to 25%. So, would like to understand from you, where is this shortfall actually coming in from, and what is your outlook going forward looking at FY26?
So thank you so much. So in terms of our guidance, so our major guidance was for growth in our EBITDA and our profit margins, where we had predicted a growth of about 25%, and we have achieved that. Yes, in terms of revenue, there has been a slight shortfall in terms of our expectation. I think in the last year, you would have seen that there have been a lot of geopolitical situations, including the Suez Canal issue and recently the tariff issues. So those were some of the reasons where we were not able to achieve our targets. But I think if we talk about our targets for EBITDA and for profits, I think we have been able to achieve those. So overall, I think the last financial year was a very good year for us.
What about FY26 then, Asad? What are you guiding for?
So similar growth in terms of both the top line and the bottom line. Obviously, with our increased focus on the high value added products, I think we'll be highly focused on increasing our bottom line as well.
Any specific guidance for the top line? Because I mean, I'm sure there is some bit of risk that is coming in, given that 3/4 of your business is export oriented and a major market is the US for you. So any sort of impact from the tariffs? I mean, if you can just give us a sense of what the tariffs were before this tariff came in, and what they are. So they are actually at 10% now. So is it lower? Is it higher? So any sort of risk coming in from the US market, which is why you're not giving us that revenue guidance?
So in terms of the risk, right, I think from the medium to long term perspective, I feel there will be a lot of opportunities for Indian manufacturers and for Indian businesses to export to the US. There might be some short term hiccups for a month or two or for the first quarter, but I think in the medium to long term, I think we can expect much bigger business coming in from the US. In terms of the tariff percentage, so earlier, the tariff for our products was approximately about 4%, which has increased to now about 10%. But yeah, but still 10% is better than what the reciprocal tariffs were going to come. So yeah.
But are you facing those hiccups on the ground currently right now, Asad?
Not much. I think if I see the overall demand, it might be slow for like a few months, but with some of our large customers, we are discussing for a long-term projects as well. So I don't feel that in the long term there will be any impact on these tariffs, as yet.
So your exports growth so far this year has not been as healthy as your domestic growth. So do you expect this trend to continue? If you can just help us understand what would be that domestic growth number, what would be that export growth number, and how would this mix evolve, given that exports was somewhere around 75%. So is the domestic portion now going to increase? And another follow-up to that would be, what would be the impact on margins, especially given that the margins in the domestic market are typically lower than what we see in exports?
So yes, in terms of for this, for FY25, we saw a significant growth in our domestic market. I think that was fueled by a lot of the projects that we got. Plus, also we got a lot of new orders from our existing customers, and we also penetrated into new segments, specifically the segments related to ports and also with the irrigation segment. So that really helped to increase the sales from the domestic market. And earlier on, the ratio of export to domestic was 80-20, now which is 75-25. And I think we will see that over the period of the next year also. I think we'll have a more focus on the domestic, especially with kind of the manufacturing facilities coming up in India. Whether it's your traditional sector or your or the new age sector. So I'm expecting domestic growth will still be more than the export. But saying that, export will also grow. Obviously, as I told you, like the last 1 year has been pretty tumultuous in terms of all the things that are happening in the world market. So hence the reason for the higher growth in the domestic. In terms of the margins, yes, export has slightly better margins, but when we sell in the domestic market, our working capital cycle reduces, which ultimately helps us in better cash flows. So yeah.
So despite this domestic shifting focus to the domestic business, Asad, do you still think you have enough levers to take yourself to that 24 to 25% margin projection that you have for FY27?
Yes, so in terms of our margins, right? So we are entering into high value added products. So if you see the sales of our assemblies business for this financial year is now more than 50% of our overall revenue. So hence these are high margin products. And now like we're going to start with the metal bellows. So those margins are much higher than as compared to what we have margins in the hose business. So definitely over the next few years, our margins would definitely be much higher than what they are right now.
Sure, you're adding capacity, and you've already added quite a bit in FY25 itself. When we look at the SS flexible hoses, the composite hoses, the metal bellows. So what is the kind of capacity utilization for these incremental facilities which have now come on board? And what is the kind of revenue as well as margin potential that we can see at peak utilization from these facilities? And just to add on to that, you're also planning to further add capacity in FY26. So for the medium term, any sort of guidance in terms of what is the kind of revenue margin potential from these additional facilities that will come through?
So in terms of the capacity, so the last year for the hose business, we had a capacity utilization of about 75%. Obviously, some of the additional capacity came in from the Q4. With regards to the metal bellows, so it is at a very early stage because we have just started the production in the last quarter. So optimum capacity of metal bellows would reach probably in the next couple of years. In terms of the margin, so at the peak utilization for all these capacities, our margin should be well north of 25%.
Final question then, Asad. What about your QIP? Is a question that we ask you every single time you speak to us. When is that happening? You had mentioned earlier that it will happen in Q1 of FY26. We are in Q1. We are done with the first month of FY26 already. So when is that happening? And of course, what about inorganic acquisitions? Once the QIP happens, is there anything that you have set your sights on?
So yes, so as of now, it seems that it will not be happening in Q1. Honestly speaking, but obviously in the past 2-3 months there have been a lot of I would say the headwinds that have happened both in India in terms of the markets and also internationally in terms of the tariff wars. So hence we are taking it a bit slow, but the QIP is part of our agenda, and we are in talks with a few companies for acquisition. So hopefully in the near future we'll update when the QIP will be launched.
How near is too near, Asad? They say Q2, Q3?
I would say this financial year before Q3.
All right, Asad, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. That was the management there of Aeroflex Industries. An important clarification, the QIP that was planned earlier for the first quarter of FY26 will mostly not happen in this quarter. But with that, we call time on this edition of Midcap Radar. We leave you with the Nifty at around 60 points higher. From Amakshi, me and the team that put this show together, thank you so much for watching. Your stocks on the other side. Good afternoon, you're watching Your Stocks live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Patakia, and joining us today on the show are independent market expert Shahina Mukaddam and Chandan Taparia of Motilal Oswal will be joining us shortly, or is joining us on the show as well. Shahina and Chandan, good afternoon to both of you. Thank you for joining in as well. Just before we get to our viewer queries, numbers from Latent View flashing on your screen. A 35% growth in revenue for the quarter to 232 crores, a 36% jump in EBITDA as well, and the stock too has surged to the highest point of the day, 4.5% higher on Latent View after the results announcement. By the way, the markets too have cooled off from the highs. At one point the Nifty was up to around 24,500 levels, but we've cooled off from those levels, marginally briefly dipped into the red, but have recovered some ground from the lows as well as we go into the weekend. But starting off with our viewer queries, then Nikhila Das is writing to us from Coimbatore, and she has 15 shares of the Bombay Stock Exchange at 4670. Now he wants to know the long-term view on the stock and whether more can be bought at current levels. Well, Shaina, what about BSE? There has been a lot of talk about the derivative market share, the slowdown in the market as well, the upcoming NSE IPO. What's your call on BSE?
I don't really want to comment on the stock because not only do I hold it, but I also have done some few trades in the last couple of weeks. So I'll avoid, but I just want to point out that they have a board meeting on the 6th where the 2:1 bonus, a dividend, all those issues will come up for consideration. So I'll just pass the question to the technical analyst.
What about you, Chandan? What are the charts indicating here for BSE?
Yeah, so I take this counter very closely. In fact, we are recommending from last couple of weeks and months, one of the strongest counter in the market, and the way the demat accounts are rising in Indian market, and BSE also contributes around 17 to 18% derivatives turnover of the Indian market. Earlier there was concern about shift in the expiry of two exchanges, but now it seems that both the exchanges will continue with their existing expiry. So I believe the overall setup is positive and decline could be bought. If you look at the price behavior of last 2 months, we have seen a rally from 3,700 to 6,800 marks. However, some consolidation is clearly visible, but I believe one can hold the long position or in fact can accumulate if any small decline happens. As of now, 5950 to 6,000 is major support for a positional target towards 7,000 to 7,200. And same time, I believe that till NSE IPO comes, the price momentum and trigger and focus will be there on the BSE. So one can continue to hold or can use any small decline as a buying opportunity in the counter.
Use any declines as a buying opportunity in BSE. So 63.59 is where the stock is, and handsome returns over the last 12 months as well. And Ritesh Kumar is now writing to us from Noida. He has 50 shares of Power Grid at 245. He's a long-term investor, wants to know whether he should hold or exit at current levels. Now, Shaina, there are a lot of options that one has in within this power PSU space, right? Be it Power Grid, be it NTPC or the power financiers as well. Is Power Grid an attractive bet at current valuations, or do you think there are other more lucrative opportunities within this space?
After the correction that we had seen during the year, at current levels, valuations do look attractive, especially given the fact that they are talking of higher capex spends during FY26. They are talking of now something close to 23,000 capex, which actually adds to their bottom line because it's on a percentage return basis. And also, they have recently had their solar power plant in Ujjain, 85-watt commence operations. So these are positives which are likely to see the stock remain buoyant. At the same time, I would say that you can keep a stop loss maybe close to 280. But of course, Chandan would be in a better position to give those levels.
Chandan, 280 stop loss, a valid one, as Shaina is recommending for Power Grid. The stock hasn't done much so far this year. It hasn't gone up, but it hasn't fallen much either. So what are the charts indicating here?
So if you look at the power and power PSU, Power Grid comparative has done well. However, in last 5-6 days, we have seen some consolidative move. But the strong part is that corrective move has completed and reversal is seen in the counter. And after the reversal, some consolidation is clearly visible. If market manages to hold 24,000 or starts the next leg of rally, I believe Power Grid has potential to spike towards the new lifetime high territory. So as of now, the support level is clearly visible near 285 zone if someone is looking for positional point of view. If someone is looking for immediate point of view, then I believe 298 will be the support. So those who are talking about positional point of view, 285 can be utilized as a major support for an upside target towards 322 for short-term point of view, and 365, that is the lifetime high for positional point of view. So one can continue to be with this power name for short-term to long-term view with the potential of 10 to 15% upside from current zone.
10 to 15% upside potential to test record high levels of 366 is what Chandan's recommending on Power Grid. Moving on then, Nitish Agrawal is writing to us from Jaipur, and he has around 100 shares of Titagarh Rail, which he purchased at around 1600 rupees, and he is a long-term investor, has a 3-year time horizon, and he wants to know whether he should hold or he should sell. Now, Shaina, Titagarh is one stock that has been bashed from its record high levels. It's a significant correction from the top. For a 3-year time horizon, is this price an okay level to enter and say, okay, let's wait for 3 years? If this person is not making any money right now, but do you think that he will recover his buying price in the next 3 years?
Yeah, I think so. It's better to hold at current levels. This year, as you mentioned, stock has corrected. And this is on back of very disappointing numbers that they showed during the first couple of quarters in this year. And this is largely, initially we had the elections and the orders were not really flowing in. I believe these issues, and also with the number of states expanding their metro and rail network, the orders are likely to actually go up from here. They already have over 13,000 crores worth of orders in hand. So basically the problem over here is the execution rather than, having orders. I think these things should be sorted out over the next year. And valuations, are not too expensive. I think these are in this space, these are one of the better, more attractive valuations that Titagarh enjoys. So I would say you continue to hold, and you can, hope for getting your, buy price over the, I would say, very, very long term. I don't think he'll get his buy price, but at least he'll be able to get a better level to exit.
Get a better level to exit. Well, what about you, Chandan? What are the charts indicating here for Titagarh from levels of 1900? The stock is now at 750. What do you do when a chart just shows anything but green?
So if you look at the price behavior, the stock has been making lower top, lower bottom from last couple of months. As you said rightly, it has seen a corrective move from 1900 to 650 marks. The good part is the stock has been consolidating, but the concern is it is not ready to surpass any immediate barrier and holding well below its 50-day exponential moving average. So someone asked about 3-year point of view. So in three-year point of view, risk reward ratio might favor. But on immediate point of view, it would be tough for a stock to hold at higher zone. As of now, I believe that 800, 830 is the multiple resistance area. But at the same time, 700 zone can provide a support. So if someone is already holding, then he has to hold. But if someone is interested to buy new, then wait for further decline below 700 to get a better risk reward opportunity in the count.
Wait for a better opportunity towards 700 to get a better risk reward for Titagarh if you want to initiate new positions. Now, Roshan Sharma is writing to us from Bengaluru. He has 200 shares of Mahindra & Mahindra that purchased around 2193 and is a long-term investor, and he wants to know whether he should hold on to his positions. Now, Shaina, there has been a lot of chatter about Teslas and the BYDs trying to make their entry into the Indian markets. With concerns around M&M, it's now become the second biggest passenger vehicle company in the country. What is the scope for M&M going forward?
Yeah, the biggest, negative possible in the, I would say medium to longer term is the Tesla launch in India. And with very negligible duties, they will be able to match the EV, price points of M&M and the other EV products in India. So that could be a risk for the long term. Having said that, I would still say hold M&M as of now. You can review it later. Basically, they're doing well both in domestic market as well as in, that is both tractors as well as their PV, their EV. So everything is doing well. Domestic numbers that came out today for auto, there also they have done well in domestic market. They don't have exposure to the US market. They have recently, they are looking to, add to their portfolio, especially increase market share in LCVs by their latest, bid, they are likely to buy out at least a substantial stake in SML. So to that extent, they will increase their market share in LCVs. Numbers will be there next week, which I think should be good numbers, given the fact that they are doing well both on the revenue basis as well as I think margin should be better. So I would say hold now and review a couple of months down the line.
What about you, Chandan? There's a bit of a reversal from the 52-week highs, but the stock seems to be clawing back that lost ground. What are the charts indicating here?
Yeah, it seems that the stock is all set to move higher side. However, we have seen a decent run up in last 15 days. After the news of Tesla, the stock fell to 24.25, but we are back to 2900 marks. If I look at the monthly chart, on bigger time frame, the stock is forming a pole and flag pattern, which has bullish implication if someone is looking for bigger picture. So I believe that this bigger picture could really do well if someone is talking about 1 year to 3 years, then stock has potential to rally by 50 to 80%. But we are more concerned about the short-term view, and I believe the stock has been making higher top, higher bottom. Even after the market corrective move, the stock has been holding the higher zone. Immediate supports are shifting to 2800 marks. So with the support of 2800, Mahindra and Mahindra has potential to rally towards 3200 levels, and above 3200, I believe it has potential to even climb to the new lifetime high territory and the commence of the next leg of rally in the counter, despite all the challenges from other competitors.
Indeed, we'll keep an eye out on that. Shaina, Chandan, stay on. We'll be back with more queries, but it's time to take a short break. Just before we do that, here's some good news for our viewers. And India's business news leader is now just a click away, and that, of course, is CNBC TV18's all-new app, where you get breaking news, in-depth articles, and financial world updates, all of it at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screen. Take a short break. Back on the other side with more queries. Welcome back, and Chandan and Shaina are still with us to answer some more viewer queries on your stocks. And Muni Rajulu is writing to us from Telangana, and he's saying that he wants to invest in stocks like Dixon Technologies and PC Jewelers. You know, he wants to know which of these stocks are good for the long term and for the short term, and he also wants to know the entry level for both of these names. Well, Chandan, Dixon Technologies has had a one-way move, right? It's still at 16,000, 16,500 odd levels. Do you see that as a good entry point? What are the right levels for Dixon and even for PC Jewelers if you have the chart with you?
Yeah, so first to comment on Dixon, in the end of December 2024, stock made high near 19,000 marks. Then a corrective move came till 12,000, and the rally has seen till 16,500. So a tremendous recovery has clearly noticed in last 1 month, which clearly indicates that there is inherent strength in the counter, which clearly suggests that fresh leg of rally cannot be ruled out as per the price pattern. If I look at the entry level, I believe 16,000 or 15,750. So 15,750 to 16,000 zone provides a better bargain buying opportunity for the counter, and upside it can head towards 17,800 to 18,000 marks. So one can stay positive or can utilize any small decline for buying opportunity in the counter. Looking at PC Jewelers, I'll suggest to avoid. We have seen a corrective move in the counter. As of now, we don't see any kind of structure. Low value counter usually underperform the market. So my advice is to avoid.
What about you, Shaina? Stocks are two extremes, right? One being Dixon and the other being PC Jewelers. Do you share similar views as Chandan? What do you see as an attractive entry point for Dixon?
I think it's just too expensive at current levels. And I'm more of a value investor. My whole concept in investing is value investing. So while Dixon is doing very well, they've got, even mobile phones, the new orders that they're getting are likely to see them continue to do very well operationally. I would prefer to wait for corrections, weak market to actually enter into stocks like both Dixon as well as PC Dwellers, which in my view are expensive. And in gold, of course, they are expanding. PC Dwellers is expanding in a big way. At the same time, if I was to buy a stock at current levels in that segment, I would still go with the leader, so Titan. So I think, in my view, if I'm looking for short term, I would look at stocks like ICICI Bank, in those type of investments for the very short term.
As the old adage goes, follow the leader, and Shaina is recommending following the leader here as well with Titan. Now, Samira Banerjee is writing to us from Kolkata, and she has around 25 shares of Tata Motors at 937. Now, she wants to know whether she should hold or sell at current levels. Now, Chandan, from 1180 to 600, still languishing at around 650 is Tata Motors. Does it have the potential to go back to 900 anytime soon?
Yeah, it's very tough to comment on Tata Motors because it has nature of being volatile. If I look at the price behavior of last 40 days, we have seen a rally from 600 to 720. It fell to 535, again headed to 680, now back to 650. So very volatile swings in the counter. It's very tough to trade such name. But if someone is looking for positional point of view, the concern is the stock has been making lower top, lower bottom from last 10 months. It has seen a corrective move from 1180 to 535. So risk reward ratio wise, it favors, but I believe other counter like M&M, Maruti, Ashok Leyland can do better with margin of safety. Tata Motors can see recovery from current zone, but again, the margin of safety and the beta will be high. So if someone is looking the bigger horizon with the view that he or she can do the averaging 2 times, then I believe one can accumulate in between 550 to 600 zone for positional target towards 800. But it will take time, patience, and volatile cues in between.
Time, patience, and volatility. Shaina, what about you? With Tata Motors, there are a lot of concerns with regards to JLR, right? They've already paused shipments for the month of April to the US. Still no clarity as to what they are going to do this month. What's in store for Tata Motors here?
Yeah, it will remain a high beta stock and volatile. So I would say that, you should take a book part loss as of now, because while there are positives, being valuations are very attractive. Price to book is just about 2 times, EV by EBITDA is 6 times. But this is based on historical earnings. And as you said, going forward with, JLR accounting for, 20%, US accounting for 20% of their sales. So the impact of this and what it is going to be on the profitability and how the US market and tariffs are going to, evolve. There is a lot of questions, and it is going to have a big impact on the both performance of Tata Motors as well as the stock performance as well as the operational performance. So I think better to half of it get out now, book your losses, and remaining you can take your call in terms of adding more at a later stage, because they are going to they are talking of demerger CV PV into 2 separate businesses. There are a lot of positives that can happen. Book part loss and then you take your call as to what you want to add or again get out of the stock over a couple of months.
The dilemma of choosing between positives and negatives in a stock like Tata Motors. And Shivani Bhatt is now writing to us from Telangana, and she has 50 shares of Canfin Homes at 804 rupees. She wants to know the outlook on the stock and whether she should continue to hold or sell. Chandan, is below her buying price, is currently at 720. But what are the charts indicating here?
So looking at Canfin Home, first we need to understand that BFSI segment has really done well in last few months, including the heavyweights name like Bajaj Finance and all. And Canfin also seen some decent recovery from the lower levels. It made bottom near 555, now hovering above 723 marks. Major trend is positive, but multiple barriers are clearly visible. So if she can give more time, then I believe price towards 800, 830 could be seen. But I think that require more than 3 to 5 months to hold the position to see some more upside. So measure immediate structure is positive. Recovery mode could be seen. I think one need to hold for an upside target.
What about you, Shaina? Canfin Homes?
I think it's a very attractive stock for in the segment, in home finance segment, small cap stock. Valuations are pretty attractive. FY26, 1.4 times price to book expected. The numbers were decent, and the management has guided for a 15% increase in their loan disbursals, loan book. So I think to that extent, things should look better. Karnataka market is also improving for them, Andhra Karnataka market. So I would say it's a good bet. You can, in my view, you see any dips, you can even add.
See any dips, you can also add for Canfin Homes. And Rakesh Rai is now writing to us from Chennai. He has 250 shares of Samvardhana Motherson at 163. He's a long-term investor, wants to know whether to hold or sell and invest in some other stock if the call is to sell. Now, Chandan, for Samvardhana Motherson as well, there are a lot of concerns, but what are the charts indicating here? 133 right now. Does this warrant exiting a position and investing in some other stock?
So like now at current juncture, it's very tough to advise to exit the position, because in the mid of September 2023, stock used to find hurdle at 103, 105 marks. And then it started the rally at the beginning of the 2024 and headed towards almost 217 marks. So almost 100% move happened from the resistance of 103, 105. Now stock has come to the exact level. If I look at the price behavior, just 15 days back, it made low near 107 and turned high. So I believe that 105, 107 zone provides a better risk reward ratio in the counter to start the next leg of rally. However, it may take some time because selective auto ancillaries are doing well. Because of the Trump tariff war, couple of auto ancillaries name were finding pressure. But looking at the price structure, technically, it has turned from a key retracement zone. So that's why the buying opportunity could continue, but declines will be the best buy. I believe any decline towards 125, 120 can be bought for an upside target towards 160, 175. And I think that is the decent run up, but that will take time. Counter is already bottomed out, so one can hold the positions.
All right, Chandan, Shaina, thank you so much for sparing time and joining us today to answer all our viewer queries. But do remember to email us your queries and we'll address them with our experts. That's all in this edition of Your Stocks. For the final 60 minutes, closing bell up next.
Headlines to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Nikkei 2 trading with gains of 1.25%.
The committee obviously will look at the best practices for other regulators in the world as well.
There's one more level, which is 24,457. That is the high that we saw on Tuesday. It's absolutely flat on the Nifty, 24,340 or so on the Nifty.
We're telling investors to buy, so that's been the case since January.
The intraday high on the Nifty was actually closer to 24,600. So we've slowly given up gains.
Fallen to the lows of the day, though, is JSW Steel, and that is after the Supreme Court verdict rejecting JSW Steel's resolution plan for Bhushan Power and Steel.
So you can go on a review petition only if there is a fundamentally wrong error of judgment made by the Supreme Court, which I don't think is so in this case.
Tariff threats have had some of the biggest companies of the world suddenly loosen their purse strings to pour billions into the US as investment.
Pakistan has violated the ceasefire along the line of control for the 8th straight day.
Well, we are slightly off the highs of the day, though, but still there is some recovery from lower levels, so it's a neither here nor there sort of a case.
Well, the markets, of course, got nothing on them. It's been a roller coaster ride. I mean, 200 points higher, down in the negative, back up about 50 points, down 40. So, depends on which half hour you're looking at, because it's been so many phases. This is Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. Last 60 minutes of trade today and this week coming up. I'm Prashant. With me, my colleagues Surabhi and Rima here. And Nigel is joining us from the newsroom floor. And Nigel is the man with all the news for today.
He's the blockbuster man of the day. Friday action, Friday factor with Nigel. Lots coming.
It's been that sort of a day, right? A lot of news flow, but I think we'll address the big news today with regard to JSW Steel. An absolute shocker, but we'll get into further detail later.
Absolutely, and it is a shocker. I mean, it was not even on the radar. I mean, obviously there was some case going on, but who would have thought that, the Supreme Court comes in and essentially nullifies this entire transaction. It all goes back to zero and years old. So judicial risk in that sense, right? I mean, one thought that is kind of a thing of the past, but obviously it's not. And really a bolt out of the blue. Stocks down 6% as we speak, and it's a big one. We'll, of course, cover this from various angles. We are going to be speaking with a bankruptcy lawyer, an IBC specialist who will join us in about 5 minutes. And of course, at 3 o'clock, we'll have Abhizar Divanji, and we'll sort of ask him from a banking perspective what this means. Because, JSW paid the creditors when that resolution happened and they got the Bhushan asset. Otherwise, it's very, very stock specific. Market breadth is negative. Some 1,600 stocks are lower, 1,100 stocks are higher. So doesn't look like there's any direction at all in trade today. Rima.
Well, as we speak, virtually at the day's low, the Nifty is below or at 24,300. The day's high was 24,600. So from the high, we've given up close to about 300 points in all the intraday gyrations. The mid-cap index is down close to about 0.8%. The advanced decline ratio, 2 stocks advancing for 3 in the red. In terms of individual stocks, it's JSW Steel, which has taken the hardest knock, 6% down. Two-wheeler names, X of TVS Motor. So Bajaj Auto, 2.5 lower. Hero MotoCorp has declined by 2.3%. And you've also got cuts in Eicher Motors. All 3 two-wheelers down over 2%. And other notable drags include a Britannia, a Sipley, a Nestle, HDFC Life. On the way up, Adani Ports has crossed the 200-day moving average. The top Nifty gainer, 4% higher. Bajaj Finance rebounds after the fall that it had in Wednesday's trade post numbers. IndusInd Bank too is recovering. As I said, TVS Motors is higher. Maruti Suzuki, good numbers, auto sales numbers for the month of April. And Reliance Industries, the star stock of the week, up today, up every single day of the week, posts the numbers, 9% gain for this week.
Absolutely. That's the stock-by-stock reaction, stock-specific reaction. But guys, I have to point out something is shifting in the overall trend. April was a great month for India. We outperformed almost all global markets. But look at the underperformance today. Actually, global markets doing very well. Asian markets closed with gains of 1%, some markets 2%. In fact, just for that reference, we should pull up Hang Seng. Let's see the final close on the Hang Seng. 1.7% up on the Hong Kong market. China, everything. Japan was up about 1%. Europe right now is powering through 1 to 1.5% up on European indices. If you look at the FTSE, the CAC and the DAX, those markets are roaring. The German market's up 1.6%. US futures are higher. So the global markets are doing their own thing. You can say they're catching up, and India kind of was, bolting out the door earlier. But the fact is that it's becoming quieter. And Tuesday and Wednesday were just quiet days, consolidation days. Today is a day of volatility, first day of volatility. And that's really showing up in the broader market, because on the broader market side, the index is down 1%, but the advanced decline ratio has been negative for the better part of the day. And a lot of the result reactions, Federal, Bandhan Bank, a lot of these reactions have also played out on the downside. But Nigel, the star of the day has to be JSW Steel. I mean, just when you think the market is all about the earnings of the day and you're looking at US and Meta and all from the blue, like you said.
Well, that's right. It's going to have bigger implications as well with regard to what goes on from here on. Because for JSW Steel, what happens? They've paid 20,000 crores, they've incurred some capex, and they've used the cash flows as well. They've ramped up this asset from around 2.75 million tons to around 4.5 million tons, and they have plans to take it to around 5 million tons. How does the Supreme Court unwind all of this is going to be a question. And just one more point, JSW Steel's pain could be the other steel companies' gain. And I'll tell you why. Because if in case JSW Steel cannot operate this 3 million ton plant, effective capacity is 4.5 million tons, they're operating it around 3.5 million tons approximately. If this goes out of the system, there's going to be a domestic problem here. There's going to be a bit of a shortage. We have safeguard duty that's implemented on imports. And if you take 3 million tons, 3.5 million tons out of the system, that's talking about 2.5 to around 3% of the total capacity here in India that goes out. So that's going to be very, very important. Will there be some more pain then for the customers? Because steel prices, in all probability, will go up. It's going to be very, very interesting to see how this pans out. I'll want to know whether or not JSW Steel has to stop operating the unit from today or tomorrow, because that will have bigger ramifications for the industry on the whole. Let's see how this goes.
Okay, no, absolutely. And, discussions coming up. Mitesh is with us. Mitesh, what does one do in terms of trades?
Prashant, so I think, there is a stock called PI Industries, which I think is still looking good in this market. So buy here with the stock below 36.55 for targets of 37.50. And on the other side, a couple of stocks are also turning slightly negative. So I'll have sell on Tita Wagons, keep the stock at about level of 760 for a target of around 705. And on the index, I maintain the range-bound move, despite the fact that today morning we had moved up beyond the upper end of the range. We're back there. I think the hourly indicators still look very tired. So I think I still believe that there will be consolidation going on, and 24,500, 24,000 broadly remains the range.
Okay, got that. So a couple of trades coming through and range kind of markets. Mitesh, we'll come back to you with more. We have PV Shiju joining us, managing partner at India Law LLP. Shiju, good afternoon. Good to have you with us here. Thank you for your time. I think we all briefly alluded to the judgment from the Supreme Court. As a sort of IBC specialist, Shiju, what is your take on this? And is there any precedent? What happens from here? What does JSW need to do? Does this asset go back to a newly formed committee of creditors? What's the road ahead?
Yeah, the initial reaction is quite shocking, but at the same time, Supreme Court has reiterated that also the IBC process should be transparent, fair, and also a timely implementation of the plan. These are the basic principles of IBC. So Supreme Court has reiterated that. As far as the whole plan is concerned, the major problem, the Supreme Court has stated that, I have not seen the judgment yet, but it basically does not comply with the legality provisions under the IBC, and also it does not process, it's not a fair or transparent process, and also not providing for a timely implementation of the plan. Only the reason for that, because of the use of the optional convertible debenture route, it is not bringing the money upfront instead of an equity infusion. That is the major reason. And Supreme Court, it looks like came heavily against the resolution provisional and CUC also. So the next ground, yeah, it's very challenging. The whole process has to be revamped. And as far as the JSW is concerned, court clearly stated that it's going for a liquidation. So a liquidator will be appointed, a new liquidator will come into play. And basically he has to put the company through a liquidation. So yeah, JSW is not going to get the assets directly. Only through a liquidation process, anything is possible. That is open for everyone.
But Shiju, what happens to the sunk costs, the investments that JSW Steel has already made in Bhushan?
Basically, I came to know that some sort of statement made by the lawyer earlier regarding how the money will be gone back or will be distributed back. So there was a statement in the court, but that's what I heard, saying that if the plan failed, how the money will be paid back. So it will be clearly written down in the judgment.
Siju, what happens in the interim? From today onwards, JSW Steel will have to stop operating the unit?
See, basically, since the plan is under the implementation schedule, there will be a monitoring committee already. So the monitoring committee will be continuing till the liquidator will take over the company.
Okay, so that means the plant continues to function, right? According to what you expect?
Not the plan. The company will be kept as an ongoing concern as of now by the monitoring committee. Maybe a resolution plan, maybe a part of it. Generally, resolution applicant is also a part of the, not applicant, resolution provisional is also a part of the monitoring committee. So till the liquidator takeover, the company will be kept as an ongoing concern. Then liquidator will come into play and he has to sell the assets now. In the CIRP process, the company is sold as a going concern altogether. Now he has to sell the assets of the company, which is even the plant.
And JSW Steel, and when it comes in for liquidation, JSW Steel can be one of the participants?
It can be one of the participants. There is no, because it's there is no disqualification as such. It can participate.
Interesting, because you know the company does roughly 3,000 crores of EBITDA, and it could be valued at 21 to around 24,000 crores, very roughly. And they have already paid 20,000 crores. So, you know, they could be best favorably placed if in case they are allowed to go ahead and bid for this unit. But it's unclear about how they get, you know, how much of the money they can get back and how that is worked out. Guys, you want to take over?
Shiju, I just had a question. Even before we talk about the liquidation process starting, wouldn't you expect JSW to file a review petition? Do you think that route would be open? And since you're saying the problem seems to be using these optionally convertible debentures and not bringing in equity upfront, could that be a possibility that the company says that, okay, we'll bring in the rest of the equity upfront and, you know, please review this judgment? Would you expect that?
See, basically, review petition is on a very limited ground. Okay, it cannot just go and say that we'll bring it upfront. It can only go for a review petition on the same bench, saying that there is some apparent error or some technical mistake or some new facts. So review petition ground is very limited, that perspective. Yeah, I believe that the JSW will try to go for a review, but a very limited ground for review.
Would you be, are you a bit surprised, Shiju? I mean, the market absolutely is shocked. So would the business fraternity be, because this was all done. I mean, it was approved at the NCLAT, it was approved by the company of creditors, the money had come in, you know, the plant was up and running. And for this judgment to be coming today, I'm not too sure if this was the court taking some sort of suo motu cognizance, or, I mean, just walk us through how you think this has come about today, because this will make any other ongoing resolution processes perhaps a bit in question as well.
See, as an IBC lawyer, I've been in the IBC since its inception. First, when it came, because JSW takeover of Bhushan Steel, highly contested and very successful resolution process, a success story for IBC, which we desperately needed. So yeah, the first stage came as a shock to me, even though I know the implementation was delayed. There was a lot of ED issues in between, so it was not completely a smooth road. There was ED attached the property, there was some discussion, there was some issues regarding detachment of the property, then High Court has to intervene. Issues were there. So, however, Supreme Court striking down the plan, the first reaction is shocking, but at the same time, I would not completely shocked also, because at a later stage, when I think now, because see, the IBC is not like your M&A transaction where you structure the plan like a real M&A transaction. So it has to be clearly a transparent and timely mechanism where a fair and equitable treatment and a quick resolution is provided. That's what the sole purpose of IBC. So when you do a lot of structuring like through OCD, debentures, such instruments, a lot of uncertainty also kicks in. So that is one of the reasons IBC struck down. So in future plans, when you structure, so the participant would be more careful to make sure that the instruments and the structure is very easily and transparently and fair.
Are you, Shiju, are you sure this is the reason? The OCD?
The reason OCD is one of the main reasons because of the Supreme Court. See, basically there are two reasons. One is OCD, then there is delay in implementation. But I have noted that Supreme Court stated that NCLT and COC should not have approved the plan. Such course arises only if the plan itself is per se contrary to the legal provisions.
A lot of the resolutions which are underway, are these instruments involved in other ongoing sort of resolutions? Is it a much used route?
Yes, it is a frequent problem we always see because there is a tendency to structure and defer the payment through other instruments. So even when we raise certain objection to that as a lawyers and all, but IBC per se does not prohibit that. But
I think this now sets a precedent, right?
Yeah,
it'll have to be.
So when you use a structure like this, you should be able to clearly justify why it is used. It should not be only for the purpose of deferring the payment.
And you don't see too much of a case of a review petition like you're saying. You don't think that there is a case for it?
I really doubt. I'm very skeptical. I would not say there is no, but I'm skeptical. That's all.
Okay.
We spoke to HP Ranina on this, and he said that you can go to a review petition. I mean, they can go with new facts, and the new fact is that they will now, implement this via the equity route only. So they said the review petition on existing grounds is not possible, not legally tenable. But if you change the facts, that is a new method of completing the transaction that is pure equity as was earlier planned, then they can go ahead with a review petition. Just one final question, Shiju. Are there any other instances where the implementation was not executed as per plan or within the stipulated timeline? Is there any other case which could face a similar fate?
There are many plans. There are a number of plans which are really delayed.
A lot of sleepless nights then, I think, within the legal as well as in the business fraternity. I mean, these ongoing IBC resolution cases that are going on. Thank you very much, Raju. Very, very helpful perspective on this. And let's see what the next couple of weeks bring on this matter. That's JSW Steel, landmark judgment today from the court, striking down the resolution of Bhushan Steel. I think we have Prakash Diwan with us. Prakash, we spent a lot of time on this because it's been such a big story. Now, if you were a JSW Steel holder, this has just hit you like a bullet from the blue. What should you be doing? Because you're suddenly down 6% in one day.
Yes, Sylvie. And in all fairness, this is something which, it's been too late, too delayed in terms of whatever the verdict is, whatever the, identification of discrepancies that has been explained. My sense is there will be a review petition for sure, and there will be some grounds, middle ground on which there will be a resolution that would probably come at some cost, of course, at some cost, because the company will have to meet up with whatever, discrepancies that they've been talked about or they've been asked about. But remember, they've already incurred a lot of expenditure. The plant's already running. So liquidation is something which is not going to work very well. And it sets a very difficult precedent for others to kind of, look at some of these larger transactions. So I would believe this will be painful. And then probably the stock would get into a little bit of a cold storage for some time, not do anything much. And if there is anything, it would only be negative. But I don't expect some sort of a bounce back. So, no point catching a falling knife here. People who have it will have to look at it from a longer term perspective, because when the deal happened, there were certain salience that came in terms of incremental capacity at a particular cost, which seemed very attractive. But given what's come out, it'll probably be neutralized or undone. So that is where the stock would probably move back to in that sense.
Prakash, just to stick on this point itself, would you be a little clever and maybe try to play another steel maker saying that, hey, JSW Steel is going to be in trouble. They have been the preferred name. They trade at very high valuations. If money is not going to flow there, and if in case this unit is shut, it could create a bit of a scarcity, which in turn would result in higher prices. Do you think that's a possibility? Then you would maybe look to play SAIL or play Tata Steel?
Yes, certainly, Nigel. That's the second order thinking that will be very effective. Remember, 3.5 million or 3 billion tons, and then there was plans to enhance it to about 4.5. So, definitely is a bit of a vacuum in a market which is definitely looking at adding on consumption. But I don't know whether, it's just going to be pricing that will get so badly impacted. Even the government would not want, steel prices to kind of generally be increased, just because of this shortage that's been created. But anecdotally, we've seen other players do end up having this much simpler, much more smoother way for, at least their output to get consumed. So from that perspective, Tata Steel, Steel Authority, good balance sheets, are doing the right things. I think SAIL is undervalued from a even if you take this opportunity aside, even from that perspective, it's available at very decent, valuations. And the replacement cost itself is so high these days that some of these stocks are like, some of these OMCs where you may not see great revenue and profitability, but on the sheer replacement cost basis, some of these at 115 SAIL is definitely very attractive. So you will see money coming in, but it probably might take a few days, a week or two for that to happen. It might not be just an immediate move that people move out of JSW and then straight away latch on to one of these. But yes, it makes sense to have that arbitrage trade.
Prakash, in the two-wheeler pack, TVS Motors has stolen a march over the others, literally separating the men from the boys. Today, you've seen correction in all the two-wheelers barring a TVS Motors, and strong number, 16% year-on-year growth. In the two-wheelers pack, would you continue to bet on TVS Motors or any others looking attractive now?
So, Rima, two-wheelers has been a bit of a sideshow, thanks to all the news flow around EVs, four-wheeler EVs, and the Teslas of the world coming in and all. We've seen that two-wheelers kind of got neglected. There are very few brokerages who have positive, views on two-wheelers by and large. And all of them are going through their fair share of struggle. You have an iShare, which is not finding too much of traction in terms of some of the newer launches, which was expected. Bajaj has its own issues with the CNG still to kind of get established. Exports have done a couple of flashes, but it's not something very consistent given the global scenario. And Hero, of course, has just been sideways in terms of whatever they've done. TVS, to the contrary, stands at a very good mix of the executive class, the entry-level bikes, the scooters, and of course, a significant share in the EV market, which has been growing very steadfastly, and they have very decent margins there. So it's one of those few companies that is being profitable while upselling the electric portfolio as well. So I think from that perspective, it does outshine some of the other boys. But whether you want to put more money into this, I would, to be honest, I would wait for the monsoon and some sort of a pickup in numbers and demand that tells you that TVS will start doing well in the segments that it is. And then it will probably be worth it. Till then, you might have a superiority that brings in some premium on the valuation, but it might not last too long, given the overall scenario for two-wheelers still being a bit subdued.
Okay, all right. Got that point. Prakash, thanks very much. You have a good weekend. And let's see, come back to the markets next week. We'll have to take a very quick break. But before we take that break, here's some good news. Network 18 beats Times Internet to become the #1 news publisher on Comscore. News 18 races past the Times of India to be the #1 news brand in the country. That's not all. At the Social Plus on platform leadership network levels, Network 18 is the runway leader as per the Social Plus MMX Comscore report for March 2025 with 315 million unique views, which is 55% more than the nearest competitor, Times Internet at 202 million. News 18 also races ahead of Times of India in terms of Social Plus Max MMX cumulative reach. News18.com overall clocked 251 million unique views to beat the Times of India overall with 183 million unique views as per the Comscore report for March 25. As per Comscore social media metrics report, Network 18 is 2 times bigger than the nearest competitor with a 54% reach within the 389 million overall social population. And speaking about Indian languages, in terms of Social Plus MMX cumulative reach, News 18 Indian languages is the leader in the category with 182 million unique views as per the Comscore report for March 25.
Okay, welcome back. Well, we've got the market, which of course is not doing very much. It is doing a little bit, but not too much. Down, I think down, this is the third or the fourth move. You can just look at what's happened. Surge, sell-off, surge, and sell-off, and surge again. So, you know, lots of moves up and down on the index. Jigar Mistry is with us, co-founder, Buoyant Capital. Jigar, good afternoon. Good to have you with us here. You know, Nigel and I were earlier talking about how metals and cement was your area back in the analyst days, Jigar. So, Don, the analyst, had for a bit. We just had this discussion with JSW. Any thoughts on the situation now that JSW finds itself and implications?
Hi, Prashant. Thank you as always for inviting me to the show. I think it's quite a stock-specific situation, right? So it's not so much as an industry-related question as much as it relates to JSW. And I think all the legal luminaries that you have called on the show essentially point to the fact that there has to be some sort of a petition given how much money has already gone into this. And eventually, if it's a case of business rather than just a letter of the law, then I think they might be keen to look at it. In between, when by the time this happens, you will have some sort of situation. And remember, see, with metals or cement, it's always the marginal quantity, right? It's never the total demand supply. And in the situation that some amount of steel is taken off the block, you will see a situation which will make it an even starker business call rather than sort of the letter of the law. So my sense is that you would see some sort of a resolution come through. What shape and forms it takes in the courts is a little difficult to predict given how long this review has taken the time to come. But you know, steel per se is nevertheless interesting. So the last time I was on the show, we did sort of discuss about commodities, and those businesses make a lot of sense because, you know, if the dollar is depreciating, everything is denominated in dollars. And steel is one cycle where you don't really see a lot of China flooding on an incremental basis. So if this gets resolved, then obviously steel does make for an interesting play.
Hi, good morning, good afternoon, and thank you very much for joining in. Lots of earnings reactions visible on the screen. You've got Industars down nearly 7%. Eternal is holding up despite the big losses in quick commerce. Perhaps the street likes that they are being aggressive to protect their turf. You've got Nugent Software up 3.5%, come off from the highs, but that's up after the recent correction. In the earnings that we've seen today and over the last 48 hours, which one has been the pick of the lot?
Right, Rima. So sort of see as an overall general sense, I would say that earnings should start improving over the quarters, right? So the way we used to do this even during COVID, we used to see like not a FY20 drop and a 21 pullback, but the way we used to see, FY19 over 21, I think a very similar situation will go in the earnings per se. So you will have the April to June quarter last year take a beating because of general elections, and since then you have seen successive quarters really going down. That base effect will now start coming into play. So stock specific, obviously, Indus was not really a great set of numbers. Zomato is not so much, or Eternal is not really so much a question about the cash flow versus sort of the plan that they plan to execute. And given where competition is, on one hand, you have sort of Reliance come through and challenge things. On the other hand, you're having questionable Zepto financials and people weighing that in the process. But my sense is that overall earnings should start improving just basis, the base effect and other than anything else. And given the correction, at least we have seen in a large part of the broader market, few businesses which are even okay-ish result will not really see a large downside.
Okay. That's the sense. Jigar, hi, good to have you on. So, what are you liking in the market right now? Where do you see some earnings momentum? I mean, the tariff news aside, I think the other watch point is earnings. And where do you see that?
Right, Surabhi. So I think, you will see this play out in one sector that we are very keen on, and I'm sure Nigel will want to chip in here, because cement looks like a sector where, you have seen, I remember this time, 2004 to 2008, riding on a very high capacity utilization, the sector's EBITDA per ton overall moved up almost 2x. Since then, since 2008, there have been a lot of capacities that came through, and because of which, and sluggish demand, you saw EBITDA per ton across the industry quite flatline. Now what might actually end up happening is that the industry has gotten consolidated. Two large players have consolidated it. And there might come a time where sort of they start taking price increases seriously in a way where you cover up for inflation and more in the EBITDA per ton. The way to play this thus far has been buying all the acquiree companies, right? So you're seeing multiple sort of deal-related upsides on them. But the way to play them going forward could very well be the larger names, because that's where the impact will be quite meaningful. Like, Ultratech saving sort of 300-400 rupees on costs is thousands of crores in EBITDA incrementally, right? So that is essentially the way what we like in the current scheme of things.
Okay, all right, fair enough. VMart, by the way, numbers at the bottom of the screen, and look at the earnings, 18.5 odd crores compared to a loss of about 39 odd crores. This is what is coming through. Stock spiking as we speak. I think last quarter as well, the numbers were pretty solid, pretty strong after a few years of absolutely lackluster growth that VMart has seen as a tier 2, tier 3. Actually more a tier 3 city sort of operator, retail stores. But now, of course, it is jumping. So 17% growth on top line, and of course at the bottom line it's swung into a profit as compared to a loss same time last year. Jigar, just come in on anything you like in the auto ancillary space. Many stocks here have taken a knock. And the thing with auto ancillaries is not just sort of serving auto markets. So many of these auto ancillary firms now cite non-auto industries as big growth areas. We spoke to one in the morning, Sona BLW. What do you like, Jigar, here?
Not a lot of things, Prashant, here, because incrementally you are accounting for the fact that many of them were supplying to either railways, or some parts of it, reasonable parts of it in some cases, were exports. Till the time this sort of export scenario with the tariff tantrums doesn't get resolved, one needs to look at where the earnings growth could come through. Secondly, even with regards to railways and related capex, I think the way in which things are shaping up both at the central and the state government level, Like we analyzed the state budgets of 16 states, and these are the ones where the freebie bill, for the lack of a better word, is now approaching the capex spends, which means the capex for many of these are going down almost 4-5% on a YOY basis. In that, and with sort of central government also taking a foot off the pedal, the complex of earnings could change away from this railway, defense, PSU to a lot more in consumption. And that's why you are seeing some of these results also play out fairly well, where this incremental money that's put in the hands needs sort of a way where either it gets invested or spent. And we think a better way to play this, given the extremely high valuations in many of these cases, would be the consumption plays rather than capex plays.
Okay. All right, Jigar, we'll leave it on that note. Thank you very much for joining us. Good to have you on the show today and get that perspective. Let's just get back to the market. Not much has changed. The Nifty is absolutely flat. 23 points on this one. The mid-cap index continues to trail down almost 400 points at this juncture. However, I mean, on a day like today also, you have some interesting gainers. CRISIL had a weak quarter, but the stock's doing really well. Perhaps the market's moving on, looking out to the future in the commentary. 5% up on that stock. PNB Housing, after those block trades, has had a decent session today. On a day like today, Credit Access Grameen, 7% on that stock. So all kinds of names. And RailTel obviously was a bumper performance. RailTel has been up almost, in the morning it was up 9-10%. Now it's up about 6%. The quarter has been very good, 50% plus growth at the top line and at the EBITDA level as well. So some green pockets within the mid-cap basket. But for the time being, let's take a very quick break. We'll come back on the other side with some final trading calls coming in with our technical experts.
All right, welcome back. Just 3:05, 25 minutes to go for market closing. Mitesh Thakur is with us with what to buy or sell today for a reverse trade tomorrow. Mitesh, from the time that we spoke at 2:30, another reversal. What's ranged market basically, not really going anywhere in a forceful manner. What's your sense?
Well, I think, it will remain this way. I've been calling for a range, consolidation. Looking at look at the hourly to hourly charts, I think the indicators are slightly tired. So typically, I think this will lead into consolidation. And therefore, I think this movement might continue. On the stock side, STBT or Torrent Power, keep a stop at about 15.07 and look for a 14.70 kind of a target. While the stock, which I would still recommend, buying would be a BTS, would be a Reliance with a stop at about 14.08 for targets of 14.40.
Okay, all right, got that. Thanks very much for that, Mitesh. You have a good second half of the day, a good weekend, and we'll see you again with the trade on Monday. Now, let's move on. Marico is expected to post quarterly results today. Manglam is here to tell us what to expect from the company. Manglam.
Well, Marico has been doing well over the last 1 month or so. In fact, in the consumer space, it's been reporting better performance than all the other companies this time around. And the street expects that to continue itself, because the company in its fourth quarter update itself has said there will be stable demand trends amidst improving trajectory in rural. And they expect consolidated business at low double-digit growth, along with India business posting a sequential uptick in underlying volume growth. They expect marginal growth in operating profit, and that's something that the street has adjusted itself for given the high prices that we've seen in copra. So overall revenue growth seen at 17%, close to around 2665 crores. The EBITDA grows just 4%. That means a margin dip of nearly 200 basis points, and the net profit grows around 5%. The number you're looking at is 335 crores. What the street is working with is a mid-single digit volume growth, anywhere between 5 to 6%. This is largely in line with what the company reported in the third quarter itself. Parachute coconut oil saw some transient sluggishness in volume, so the management is positive about the next year. Saffola did well, and value-added hair oils also exhibited gradual improvement. That was a piece in their business which wasn't doing particularly well. That is showing some sort of improvement.
Thank you very much for that. Marico numbers are today, but State Bank of India's Q4 numbers will be out tomorrow. Abhishek joins in with the key expectations. Abhishek.
Well, Rima, analysts expect the NI growth rate on a YY basis to be one of the lowest that you are seeing in last 5 years or 20 quarters. So the key things to watch out is that the business momentum on deposit growth may be below the industry level. So Motilal Oswal estimates deposit growth of 9.15% YY and about 2.7% sequentially. Advances growth rate to remain healthy. Again, Motilal Oswal estimates advances growth of 13.24% YOY and about 4.75% sequentially. Net interest margin, that can come under pressure both YOY and quarter on quarter. So Kotak Securities estimates a net interest margin decline of 34 basis points YOY and about 12 basis points sequentially. Now, operating profits could come under pressure given the fact that treasury gains would be missing. Again, Kotak Securities estimates a decline of almost 30% YOY in operating profits and about 14% sequentially. Slippages, they can remain stable or improve sequentially. That needs to be seen closely. Recovery and upgrades will be on the lower side, so watch out for write-off, which can actually aid the gross NPA. So gross NPA as per Motilal Oswal is estimated at 1.96% versus 2.07% in the previous quarter. So asset quality can remain stable or improve sequentially. Watch out for management commentary with respect to business momentum going ahead, net interest margin, as well as fundraising and ROE target that they have. Our poll suggests NI growth of just 1.9% YOY. We are working with a profit decline of more than 17% on a YOY basis. Back to you.
Kotak Mahindra Bank, what are we expecting?
Well, again, for Kotak Mahindra Bank, the expectation on NI weakness will persist as, analysts have done with SBI. So Kotak Mahindra Bank, the NI growth on a YOY basis could be at 14-quarter low, while the PAT could decline the highest in last 20 quarters on a YOY basis. A key thing to watch will be the business momentum. That will be the key. Deposit aggression has been seen with large private banks. So will Kotak Mahindra Bank to sustain it or not, that will be seen closely. So deposit growth and loan growth as per Motilal Oswal is estimated at 5.5% YOY and about 6% YOY for advances growth. A net interest margin can decline YOY but remain stable on a sequential basis. DAM Capital estimates a net interest margin to be at 4.93% versus 5.28% in the same quarter last year. You need to watch out for the low-cost deposit momentum with other private banks. They have gained, CASA ratio on a sequential basis. So whether that will be seen in this result or not will be seen closely. Last quarter, their CASA ratio was at 42.3%. Slippages can remain elevated, especially from the unsecured portfolio, which can cause pain, and personal loan slippages may taper off in this quarter like we have seen with other private banks as well. Asset quality too remains stable. Motilal Oswal estimates gross NPA ratio at 1.5% versus 1.5% in the previous quarter. Management commentary and outlook will be an important factor to watch out with respect to business momentum and credit costs going ahead. Our poll suggests NI growth of just 7.6% YOY, while we are expecting the profit to decline by nearly 9.5% on a YOY basis. Back to you.
Thank you very much for joining in. Anand Tandon is now joining us on this last leg of the show. Anand, thank you very much for joining in. Very, very choppy for the markets. Last two trading sessions were quiet, but today the mid-caps are giving way. The advanced decline ratio is negative. Your thoughts on the way markets have underperformed globally? There is that, Pahalgam angle as well, which is localized, and that could be a headwind for the Indian markets vis-a-vis the global peers. But how have you approached markets and the way the earnings season has panned out?
I don't think the market is paying too much attention to Pahalgam right now because the rally in the recent past has actually been better than what would have happened if one was worried about the geopolitics. I would argue that at this stage, because the rest of the markets around the world are doing a little better, probably because of the assumption that President Trump is going to kind of step back from the most extreme views in terms of tariffs. So they had performed rather badly, and therefore, now that the assumption is that some of that is not likely to happen, and they may also perform better from here. I guess that you are seeing a little bit of reallocation from the Indian markets. I don't see any major change in mood at the moment because of geopolitics.
Okay. All right. Just stay on. We'll come back, Anand, with some more questions in a bit. But let's revisit the big story of the day. And that is, of course, JSW Steel and the big blow that's come in from the Apex Court, considering the resolution of Bhushan Steel has been struck down. Abhizir Devanji, founder at Neostrat Advisors, is with us. And he's watched a lot of this over the course of many years and decades. And I remember, right from the time the IBC law was framed, Abhizir, we've been having these conversations. So what does this really mean, and where does it leave things? We all know that this use of optionally convertible debentures, this was not viewed favorably by the court. But shouldn't the company of creditors, or shouldn't the NCLT or NCLAT have struck this down at an earlier phase, at an earlier stage?
It should have, but I don't know where in the law it says that all of the funding needs to be done only by equity, first of all. I think this is the first for us. And imagine 2016 is when the law came in, and rightly so, we've been talking since. And we are now 8 years on, and we still haven't cleared everything on the interpretation side, which is shocking, if you ask me. So the new interpretation now is that you can only use equity to fund a resolution plan, which is absolutely incorrect, in my opinion. Because if you look at the IBC Act, it says that you can fund it. You can even lever the assets of the corporate debtor, as long as the equity is owned by the resolution applicant. So in this particular case, the resolution applicant did own the equity. And we are now saying that optionally convertible debentures, which in every form is debt, is not an acceptable mode of funding and should have been all equity.
Abhizar, we just spoke with the partner at India Law LLP, bankruptcy IBC specialist, who've been sort of with since the IBC was introduced. Shiju, I don't know if you know him. His point was that he made this point that under IBC the resolution is not like. It's not his view was that it's not restructuring. You're not putting together an M&A transaction. It's not supposed to be. At least that's not how it was meant. So how do you view that?
It's a resolution. So IBC as a law says that we are not doing a restructuring, but we are doing a resolution. What that means is that we are not effectively restructuring the debt of the company. You have to restructure the debt of the company because that's the reason why a company is in NCLT. But what they're saying is this is not a recovery. This is a resolution. Resolution means you're keeping the enterprise stakeholders intact. What does that mean? You can reduce the debt, which most people have done, by the way. That's the reason why we have haircuts on IBC. You can retrench people. You can reduce operational creditors. You have to correct the balance sheet of the company to be able to revive the company. That's the sole intent. Now, as part of correction of balance sheet, if we are changing the capital structure of the balance sheet, that cannot be not allowed. You cannot say that I will only equity fund it.
Okay, now...
And where is the interpretation coming from, Abhizir? Because, from what our court reporter, what our colleague told us, was there were two major issues that the court had with this. One was the use of these OCDs, and the second was the delay in implementation. So if the IBC law never explicitly stated that resolution will only happen via full equity, then where has this issue arisen from?
So that's really what one needs to understand in terms of seeing the real judgment. Because as far as IBC is concerned, there really is no restriction on cap structure. In fact, it actually says that you can lever the assets of the corporate debtor. What does that mean? That means that the corporate debtor, which is the company which is in NCLT, their assets can be levered to raise money. So, by the way, if you look at what DHFL did, DHFL, the owner, Piramans, who bought the company, did take leverage on their balance sheet, which ultimately moved into the leverage of the corporate debtor's balance sheet because they merged the two companies. So effectively what has happened? effectively in those resolutions also, we have gone and levered the assets of the corporate debtor. So there is precedent of leveraging the assets of the corporate debtor. What is an OCD? An OCD is a form of debt, by the way. Optionally convertible debentures, even in law, is classified as debt. It is not equity. Now, if it was permanently, it was compulsorily convertible debenture, it would have become equity. So now if debt is allowed to be levered, to be taken on the corporate debtor's assets, then I don't see on plain read where is the issue.
We'll have to look at the judgment, as you said, Abhijit, and that will give us more. But now, this is as things stand. What is it? I mean, what happens from here? There are lots of banks involved, exposure. They've been paid money. So what happens operationally?
Another unprecedented thing, but I'll tell you the issues involved. One is that this company has been run by a monitoring committee and the resolution applicant, which is JSW in this case. They've been running the business. The business has turned profitable because steam turned through a cycle. Now they will say that whatever the profits earned during the period is ours. Plus, there is the cost of what we put into the company. There's a cost that will be earning some kind of interest to us. Then what happens to the process now? If you put it in liquidation, just by the way, you will realize lesser value than what you realize under a resolution process. So that is not, it's going against the very tenet of IBC, which says maximization of value. Now, the other thing that the Supreme Court seems to have said is that the creditors have not exercised their commercial wisdom. While the Swiss Ribbons judgment says that the commercial wisdom of the creditors is their problem and something which the courts don't interfere on.
Right. Abhijit, we have a table up on your point taken. You have a table up on which essentially highlights bank-wise recovery from the Bhushan asset. What do these banks have to do? Do they have to put this recovery amount in some separate account? I mean, how do they treat this with the judgment?
So
Indian Overseas Bank, for example, collected some 760 crores. That's the recovery. It's about 2% of the net worth.
So that will have to be put in an escrow account for now, I guess, because till the resolution, what will happen is JSW will clearly go and appeal against the judgment for sure. It will also, if at all the judgment is not appealable, then they will file for damages. And those damages will have to be met out of this. This particular consideration will have to be paid back, whatever they have actually paid. And a new process will have to be run wherein the assets will have to be liquidated now because the court has requested liquidation.
Just a quick clarification, Abizar. So the IBC law is not prescriptive. You can structure the deal the way you want it, correctly? But in this case, isn't the issue that JSW Steel has not done what they had proposed to do? They proposed to fund it via equity. Instead, they have done it via equity plus OCD. Isn't that the crux of the issue in this case?
No. So they would have specified in the resolution plan that they will do a combination of OCD and equity. Now, that is what the court seems to be saying, that this is something that the COC as well as the insolvency professional should have picked up and not allowed. So ab initio, this resolution plan is not valid. And that is why they have said that, of course, the other reason being the delay. But the delay was also on a lot of other things. For example, Section 32A came about to basically give an exemption from ED acquired assets, which is basically saying that any assets which is encumbered through any other process against the promoter is released to a resolution applicant. So those kind of questions are also there. So I think that the delay has happened because of matters being sub judice and certain matters being resolved in the courts. So that is one of the reasons of the delay. The other reason of the delay, of course, is the other reason of the rejection is the capital structure, which the court seemed to have objected to, which we should look at the court judgment to figure out exactly where they opposed it. But at the end of it, what seems to be a problem is unwinding these kind of transactions after such a long time is going to be a super nightmare to do. And if it is now put into liquidation, historically liquidation has earned only a fraction of what resolution has earned. So the banks will have to provide it, maybe at some stage more to what they currently are recording in their books.
What complication. Just when you think at least this one large asset was all done and dusted, simplified. By the way, I did check with our colleague Ashmit. I was very curious to know where this arose from. So the petitioner is an operational creditor, Kalyani Transco. So the operational petitioner moved this in the court. I'm assuming probably didn't get their entire dues. And then they moved the court on this.
I hope this doesn't open Pandora's box of troubles where seemingly closed transactions are now open.
Abhizir, come in on this. Come in on this. Very quickly.
One more data point on the operational creditors. Overall, the operational creditors, from what I saw of the plan, have been proportionately paid better than the financial creditors.
Oh, and then, even then they're miffed. Wonder what's going on behind the scenes here. But thank you very much. Very complex, and we'll need more of your perspective perhaps in the days and weeks ahead as well, Abhizir. Thanks for taking this one. You have a good rest of your Friday. Thank you. We'll take a break on that note, come back with more market talk in just a bit.
Three minutes to go before we wrap up trade. It's been an exceedingly volatile one, but we end pretty much flat on the Nifty and the Sensex. The mid-caps underperforming, negative advance decline ratio. For the week so far, the Nifty is up 1.8%. The mid-cap index is just up close to about 0.2%. So that's the tally as we close out this week. In conversation with Anand Tandon. So Anand, based on the earnings that we've seen so far, where would your preference lie? Have you been purchasing any stocks?
I don't think the overall strategy of the portfolio could have changed very quickly, given the fact that most of the earnings have been a little tepid. So if at all you are still anticipating how much kind of degrowth from what the analyst estimates, you should be factoring in for the next year. The only thing you can say is that it is not looking as bleak as it was, let's say, a month ago. But at the time when the US decided to impose tariffs, but it is not going to be back where it was. So actually, you will have a slight slowdown in the overall economic growth of the world. So the changes that will happen will take a while to go through, because you are already seeing a 70% drop in container traffic going to the US, for example. It will take at least 3-4 months for that to come back, even if everything were to go back to normal. So this year is pretty much a washout. You have to look a few years ahead. So I think the secular trends are what you should be looking for.
Had a few more questions, but out of time, Anand. So speak to you again soon. Thank you very much for joining us today with that quick one. Well, I think you got the market, which is ending absolutely flat, 20 points lower. And I think nothing very much as far as the overall market is concerned. 1,600 stocks lower, about 1,100 stocks higher. So market breadth was slightly negative. Nifty Bank ends, way off the highs. For the Nifty Bank, the high today was 55,700 almost. And we end about 650 points off the high of the day. Actually, similar is the case for the Nifty as well. The high today was 24,589, which means that the day's high for a brief period, we actually took out that 61.8% retracement of the full fall from the highs late last year to the April lows, and then, of course, sold off pretty dramatically. And I think the mid and small cap indices will come up, down about 1% on the mid cap index, and I think the small cap index ends about 0.17% lower.
Well, we're going to take your leave on closing bell, but it's going to be an action-packed weekend. State Bank of India and Kotak Mahindra Bank release their Q4 numbers, and then always Global watched what happens with Trump tariffs. So those headlines will be awaited. Thank you for watching this show. Don't go anywhere. On the other side is our special editors roundtable.
The last trade gains for the third week in a row, marking its longest winning streak since December last year. Reliance was the biggest Nifty gainer, rising almost 10% this week, and that too, it was a 4-day week. And that's the best performance we've seen from Reliance in 5 years. On this week's edition of the Editor's Roundtable, we take stock of the week gone by. We put the spotlight on FII inflows and decode Eternal's fourth quarter performance. More importantly, Eternal's commentary about what lies ahead. I'm Surabhi Upadhyay, with me Nigel D'Souza and Manglam Balu. Hi guys, good afternoon and happy Friday.
Happy Friday. I mean, it's one of those days, right, where the Friday feels like a Monday and a Friday at the same time, because the Thursday was a holiday. Bad, not bad, nevertheless.
This guy's out for a great week and he's just waiting to get started with a super weekend.
What's your weekend plan?
Well, weekend's supposed to be good, right? I mean, if you're not in office, you should be having a good time. So that's what's going to be, and then get back to business from Monday. But interesting times for the markets, right? Because April, we were the rank outperformers, particularly the first 3 weeks. The last week of April, though, we did a relative underperformance, and that Nifty bank unable to get past that 56,000 odd mark. I think that's going to be the next important trigger from here on. But we're not falling apart. We're getting the flow. So pretty okay time.
I was just looking at some data. 12 straight sessions is what FIs have bought in the cash market for. The last time they did that was October, November 2022. So it's been over 3 years since FIs have bought 12 days on a trot. So let's see how Friday comes up.
Absolutely. Well, we have plenty to discuss today, and Ashwini Agrawal is our guest on Editor's Roundtable this afternoon. Ashwini, it's a pleasure to have you on. First, tell us, let's start with an opening broad thought. Positive on the market, cautious on the market, or negative on the market?
Hi, good afternoon, Surabhi. Thanks for having me here. I think, I'm struggling to build a big upside case for the market in the short run because, the earnings season's turning out to be quite tepid. Economic growth globally is slowing down. And therefore, to build a case to say that the market should go up a lot from here is very, very difficult, barring the fact that, a lower interest rate regime in India and the fact that, we possibly are somewhat of an outlier in the sense that we benefit from what's going on in the geopolitical trade world. Those are the only two exceptions which are holding things up. Otherwise, even if you look at the earnings, there isn't much to cheer about. Having said this, I don't also see a lot of downside. So the kind of lackluster movement that we've seen in the market this week, barring Reliance, of course, as you mentioned, I think that kind of reflects how I'm feeling also about the market.
Okay. Maybe not too much of a pop. More sideways. That actually brings me to the tally for the week. So let's quickly go over the numbers and this tapering off of the enthusiasm that we're talking about here in India. So how do the numbers look? For the week, the Nifty is up about 1.4%. A large part of that is courtesy Reliance contributing a 9% gain. Otherwise, that number would have looked very, very different. The mid-cap index is up just about 0.4%, and the small-cap index has actually declined. It's down about 0.5%. Contrast this with how the world is doing. Let's start with the US markets, and I've taken the last 5 days because we were off for 1 day, so excuse that. Broadly speaking, last 5 days, how has the world done? The Dow is up almost 2%, the S&P is up about 2.1%, the Nasdaq even better, and that's the real story. Is our whole US tech run starting again? Nasdaq up 3.1% for the last 5 days. Look at the other markets. The money's flowing in. Hang Seng has done very well. The Chinese market's up about 2%. The German market is up almost 3%, 2.7 to be more precise. And the Nikkei has surged 4% this week. So it's very, very simple to understand that the rest of the world is playing catch up, and we have taken a bit of a pause. So what are the factors at play, or what are the concerns here? Number one, there's a bit of a tapering in the FPI flows, though for April, by the way, the numbers have turned positive. And we'll talk more about that as we go forward. But net positive, almost 4,200 crores in April. First positive month of flows, the first time this calendar year. But by the end of this week, that cash market positive figure was kind of petering down a little bit. So that's point number one. Number two, what Ashwini also mentioned, earnings are patchy. We're not seeing big positive outliers, big surprises, and huge pops. Companies either are missing estimates on Q4, or Q4 is okay, but they're sounding very cautious about what's coming ahead. And that's not just IT companies or external export-facing companies, even internal or domestic-facing companies. And I'll explain that, with some examples. Look at Shriram Finance. The stock was hammered big time. This week it lost 6-7% after the numbers came out. Bajaj Finance, valuations concerns and, growth concerns kicked in. Eternal, the stock was okay on Friday, but Mangla will talk more about this. The whole point is, what is this commentary, the competitive intensity, how much longer will we have to deal with losses in some of their businesses? So that was the talking point. Bandhan Bank, Federal Bank, TVS Motors, pretty similar for all of these. There were some outliers, I must point that out. And they included, of course, Reliance itself, which was a good set of numbers, PNB Housing, RBL Bank. So all was not lost. But the point is that it's very volatile and very patchy. And last but not the least, the border situation, the Indo-Pak tensions, that's also center stage. And by the way, this week we saw the biggest rise in defense stocks. Some of the names like Mazgaon and Cochin Shipyard were up 15-20%. Hindustan Aeronautics was up 4-5%. But some of the smaller names, Paras Defense, by the way, has rallied over 30% this week. So this is where the market was very focused in terms of at least sentiment.
You spoke about the earnings being patchy. What was even patchier was the reaction to earnings. Yes, Shriram Finance and Bajaj Twins aside, if you look at something like a Trent, we all knew it was bad numbers. The company reported the numbers. There was a mild beat on the EBITDA. The stock ran up about 3.5%. And thereafter the next day, it gave up all those gains. Even Zomato, for instance, it was under pressure going into the numbers. Just a day before the numbers saw a bit of a spike. Numbers weren't all that great. Thereafter, it opened lower and then recovered from the lows. And even the FMCG pack, HUL talking about growth over margins. Instead of street cheering that growth, they're worrying about the margins that stock down 4%. But Nestle saw a big move. So it's been all over the place. It's been fairly patchy.
Well, that's right. Let's talk about a little bit more about the FI flows, because it seems that the FIs, they are in love with India yet again. The last couple of months, they've been showing us some love, and that's encouraging, right? So just to rewind first, between October 2024 and, February 2025, the FIs sold $26 billion. That's the kind of outflows that we saw. But in the last 2 months, we have seen some inflows. So in April, they pumped in close to around $230 million approximately. And, in March, that is, beg your pardon, $230 million. And they followed that up with close to around $1 billion in the month of April itself. Why is this important? Because the FI flows, they have turned positive for the first time in the secondary market. Remember, we are looking at these numbers as primary and secondary together. But in the secondary market, this was the first month that we had a buy number in the last 6 months. So 6 months of sell flows in the secondary market, and that turned into a buy. Not just that, India was one of the only markets where you saw FI inflows. You just pull up some of the other markets, whether you pull up South Korea, Indonesia, Brazil, all of them saw outflows in the month of April. And India, well, we were the lone one in there, seeing $1 billion of inflows, so not a small amount coming in there. What are the factors that have played out? Why the FI is falling in love again? Well, in fact, a few factors have played out. One is their holding in the Indian markets had fallen to the lowest levels you've seen in the last many, many years. So earlier in January, it was down to around 17% approximately. So underweight on India, they're looking to turn that around. Trump's tariffs have taken center stage, but India's exports to the US account for just 2% of the GDP. So India is relatively, protected on that front. Next up, the economy is expected to grow at around 6.5% to around 7%. So that's encouraging, and it's a faster clip in comparison to other economies. And the Reserve Bank of India, what a beautiful job they've done, right? A perfect balancing act. Pivoting towards growth, they have infused some liquidity and taken care of the deficit situation that we had. And also they changed their stance. The Indian rupee, well, it's breached the 84-odd mark this week itself. So that as well was the outlier. And finally, earnings are expected to grow in double digits for the next few years. But you need to keep in mind that the first half of this fiscal itself could be a little bit subdued, just going by what we have seen. Ashwini, what do you think? FI is in love, or is it just a fling?
No, I think, on a global perspective, sitting in India is very difficult to make out what's going on everywhere else. But I would think that the US exceptionalism, which drove a lot of savings and capital into the US over the last 4 to 5 years, that sentiment has changed. Even though the Trump tariffs may have been put in abeyance for the time being, I think the world at large is wondering, if that's the only place to invest. And if capital were to come out of the US, that's such a large amount of money that it's a foregone conclusion that some of it would come into India. So I think that's a positive. And like you pointed out, better liquidity, easier liquidity, relatively domestic-driven economy. And I think one more point I would like to add to, Nigel, whatever you laid out very beautifully, the diversity of India. I think, if you look at several markets like, let's say, for example, Indonesia or Brazil, they tend to be very commodity overweight markets. Whereas if you look at India, It's a very well-diversified market and with a lot of domestic consumption plays. So I think that is, again, a very interesting feature about the Indian market. So I'm not surprised we are starting to see some flows. But more importantly, I just hope that there won't be a big disappointment to the 6.5–7% real GDP growth that we're talking about. My sense is it's a tad lower, but we'll see how that plays out. As of now, like you said, first half is looking to be really hard, and let's hope that the second half is a lot better.
Okay, all right. Just hold on to that thought, Ashwini. More questions. We want to discuss consumer with you for sure. But before that, let's just try and understand what happened with Eternal, Mangalam, because when we were discussing this in the morning, the company's commentary about competitive intensity sounded really alarming. And alarming in the sense they're saying that they're willing to forego near-term maybe margins. They have to invest in the business. But the stock actually took it very well.
So very interesting to see how the stock takes it going forward as well, because one, it is off the highs. And secondly, at lower levels, maybe the street thought that near-term profitability aside, the fact that the company is aggressive on its market share for quick commerce is the right thing to do by the company and not necessarily the stock immediately. So if you're playing for the long term, then this could be one of the opportunities. But all of that in just a bit, just wanted to explain what exactly is happening with Zomato over the last few quarters, now called Eternal. So the question is, the Eternal bounce back, is the worst over or not? There are two things that play out for Eternal. The first part is the food delivery business that continues to slow down when it comes to the growth part. Quick commerce losses expand and the company is cautious on competition. So if you look at the food delivery gross order value, over the last few quarters, it's been coming down, right? So look at Q4 FY24, it was 28.5%. It's come down all the way down to 16%. And this quarter, the most important part was it was not only down year on year, it was down quarter on quarter as well when it comes to growth. And quarter on quarter, there was a decline out there. And the company has given multiple explanations for that. They've said it's sluggish demand environment. There've been shortage of delivery partners. They've delisted about 19,000 restaurants this quarter. But most interestingly, they said cannibalization of restaurant delivery coming in from quick commerce. Why is that? Because if I can get something packaged in 10 minutes, why should I wait for 20–25 minutes for it to be delivered to me from a restaurant? So that was something which I found very interesting. And because growth hasn't come by, the contribution margins also for the last couple of quarters have stayed stable. Now, here's what Zomato's thesis was. You grow the food delivery, which is a mature market. You expand its margins, use that cash to fund the losses on Blinkit and keep growing it. Well, that hasn't happened. Why do I say that? Because while Blinkit's gross order value has increased 134%, much higher than what the street was anticipating, quarter on quarter also it's up 21%, its losses have expanded and ballooned. Close to around 178 crore is the EBITDA loss on Blinkit, which was 103 crores in the third quarter, a negative 8 crore in the second quarter itself. It's ballooning. Why is it that it is ballooning? Because one, there is high competition. Secondly, the company is adding a lot more stores. And they've said they will look to grow market share aggressively and won't let short-term profitability goals come in the way. The question is, what happens from here on? And the one data point that I've always been looking at Zomato, even when the stock was at around 45–50 odd rupees, the one data point that gave everyone a lot more happiness was the cash pile was increasing. But here, for the first time in many quarters, the cash pile has decreased. The company has said they're shutting down Zomato Quick and Everyday. They do not see the path to profitability here, and they may consider first-party inventory in quick commerce once the shareholders' approval comes by. And here's the point I was making on cash. 12,241, 12,539, 10,813. That was then up all the way to 19,235 because of the 8,500 crore cash raise that they did. But between this quarter and this quarter, there has been a reduction in the cash. So that's something I'll be tracking very, very closely going forward as well. Is there any reduction in their cash going forward or not? Because that will tell you whether they have enough firepower to fight this out or not. So the eternal question, whether the bounce back or whether the worst is over or not, the answer lies in their cash balance. Let's ask Ashwini about this. Ashwini, new age businesses, Zomato saw a fall, thereafter a rise, now a new vector of growth coming in, which is also facing a new kind of competition. What do you do with these companies? Because it does not matter what Zomato does or not, because the impact is felt across the board. We have Swiggy and the others as well.
That's right. Very interesting, because if you look at 1.5–2 years ago, it was basically a duopoly in the food delivery business. Now, the driver of value or destruction of value, whichever way you want to think about it, is the quick commerce business. And the quick commerce business doesn't have the two players, it has three players. And I think the jury is still out on whether ONDC-enabled Kirana stores can also pull off, a little bit of a magic and get some of the competitive intensity back. So this game on the quick commerce side is not over. And you have three large players slugging it out for market share, and this is the fastest growing piece. So one has to watch this carefully. Having said this, Eternal, and I don't own any shares here, my sense is that they have the cash pile and they have the bandwidth to be able to stay in this game for a long time, and I hope they create value out of it. But it will take some time, especially as the demand for their food service seems to be slowing down.
Ashwini, buying anything else in consumer?
Not really at this point. I've basically been looking at financials because, they were beaten down on a 2-3 year basis, relative underperformance. So we had been adding to financials in the portfolio, especially stuff down the market cap curve, some of it in microfinance, some of it in the smaller banks, where valuations are now actually very attractive around book value. The environment there is still a little bit hazy with all the legislative proposals going around in Karnataka and Tamil Nadu and what have you. But my sense is that there's a lot of value there. Obviously, it will take time to play out, but that's the only area where, at least I've been seeing some value of late. Otherwise, not anything in the consumer space for sure.
Okay. All right, we'll take a quick break, but we'll come right back to decode this week's market action in just a bit.
Welcome back. You're tuned in to Editors Roundtable here on CNBC-TV18. Well, we're still in conversation with Ashwini Agarwal. Ashwini, I wanted to ask you about this fall in crude oil prices. Now, that's a positive from an India macro perspective, but there are also various sectors and themes that could see that tailwind. What do you like to play this theme? You have OMCs as one. The paint companies that have been big underperformers, they in fact have a bit of a tailwind on that front, and we're expecting demand to pick up. Some price increases that were taken earlier as well will flow through. Or will you just simply go with the aviation company, the leader, or maybe the smaller one in there? How would you play this?
So, great question, Nigel. But for that, for doing any of that, I first need to develop the ability to be able to forecast crude oil, which I don't.
But I mean, crude oil prices right now is sub $65 per barrel. So assume that, sub $70 per barrel as well. We told someone a year or so ago, everyone would say no chance. Everyone's working with that $75, $80, $85 per barrel. So at sub, at sub $70 per barrel, I think that's still a tailwind, right? To most.
So it is a tailwind for India. It's a tailwind for inflation. It's a tailwind for transportation. I think the only disappointment here is that a lot of the fall in crude hasn't really reflected in prices for diesel or for petrol, which might actually help a lot of industries that are transportation heavy, cement, for example. Of course, it's a tailwind for OMCs and it's a tailwind for aviation companies. But it is a tailwind for a lot of the petrochemical feedstock businesses in plastics and what have you, and a lot of the inputs in the chemicals and pharmaceutical industry. But again, the fear is that in many of these places, the end product prices are equally soft because of the disruption in demand patterns that are occurring globally. And one doesn't really know where all of this is going to sit down. The other thing that we haven't spoken about is the US dollar and the rupee exchange rate. So while, a stronger rupee is great for inflation and great for landed cost of crude oil, it also has a significant headwind for exporters, especially in petrochemicals, medicines, and so on and so forth, which have a lot of the petrochemical value in their cost of production. So it's a bit of a mixed bag. You're probably right that airlines offer an idea, but I haven't played it so far, no.
Right. If not airlines, then are you taking the road? Just wanted to know what your thoughts on the auto stocks are, because we had the monthly data for the previous month come by. Not very different from what the street was anticipating, but the leader out there, Maruti, did a shade better. You have, a couple of two-wheelers doing a lot better as well, the likes of TVS Motors, etc. With the kind of headwinds that there are for auto companies that export, do you see this as an opportunity for domestic-focused companies, if the belief is that maybe this year would see some revival in consumption?
If you see, the demand for autos has been fairly tepid after the initial big bounce that we saw post-COVID. And a lot of that has to also do with what's happened to the prices of automobiles. Because of the safety standards and because of upsizing in the four-wheeler market, where everybody's kind of moved on to the MUV bandwagon, I think the entry price car prices have gone up and the average car prices have also gone up. Also, what I'm sensing is that with the IT services slowing down on net employment, if you look at it on an industry basis, and a lot of purchases being made in real estate, I think some of the discretionary consumption is coming under pressure. Frankly, I don't like the auto numbers that much. I mean, we talk about 6-7% real GDP growth, but if you look at auto sales, which we get hard data on a month-to-month basis, that would hardly indicate that, our economy is expanding at 6 to 7%. So I'm not 100% sure what's going on out there, but the demand looks to be quite weak.
All right. Well, those are some of the challenges that some companies in several sectors actually are dealing with. The challenge of low or no growth. Thank you for the perspective. Really good to have you on, Ashwini. Really appreciate you taking out the time this Friday. Thanks. Well, with that, guys, I guess it's a wrap.
It's a wrap. Nigel, you said you'll be having a good time during this weekend. What about you?
Sleep.
Sleep? Okay. What about you? There's some fitness test tomorrow that I'll do. Maybe then catch a couple of these games. The boys in blue. So happy about
Indians,
that.
The way they have come back and the way they start is more interesting, because they start off slow and then they've got the momentum with them. My son was looking at the table and I said, Papa, just look at the number of green ticks, because the last few they have got the
last 7 games is what they've won.
Last 7 games they've come back and now they're top of the table.
One of the stats said that if Mumbai Indians has won 5 games on the trot in any season, they've reached the final.
Oh.
Let's see whether they go ahead and reach the final this
Speaking
time.
of cricket, maybe I'll watch out for Vaibhav's next innings, wherever he's playing next.
He played yesterday, didn't play very well, to be very honest.
That's okay, that's okay. You can grant him that.
The kid got fire. The kid got fire. He's got guts, to step out and hit a pace bowler over his head. Wow, and bring up a century with a big 6, That boy's got talent.
The only game I'm looking for is the battle of the old ones. I'm looking for Mumbai versus RCB at Chinnaswamy this weekend. Let's see. I mean, it could be the final before the final. Who knows?
Okay, so plenty to keep us busy. And we hope you have a great weekend as well. Thank you so much for being with us on Editor's Roundtable. News and updates continue right after this short break.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty gain 1% for the third straight week. Mid-caps and small caps underperform. Reliance Industries rallies 10% to mark the biggest weekly rally in 5 years. Supreme Court rejects JSW Steel's acquisition of Bhushan Steel, citing gross violation and non-compliance of the bankruptcy laws. JSW Steel shares plunge after the top court rules the insolvency proceedings are vitiated and orders liquidation of Bhushan Steel. China says that it's evaluating the possibility of starting trade negotiations with the United States, but reiterates its request that the US remove all unilateral tariffs, adds that failure to do so would indicate an outright lack of sincerity on Washington's part. Apple CEO Tim Cook confirms majority of iPhones sold in the US will now originate from India and Vietnam as it looks to offset the impact of US tariffs on China, warns of a $900 million hit if the current tariffs persist. Apple still manages to report a profit of nearly $25 billion in Q1. Pakistan violates ceasefire again at the LOC for the 8th consecutive day. Indian Army says it responded in a calibrated and proportionate manner. Air India says that it could incur an additional loss of $600 million if Pakistan's airspace remains closed for a full year. Requests government for a subsidy model for its international flights. Government clarifies on converting spectrum dues to equity after Bharti Airtel sought similar treatment to Vodafone Idea. Sources say only dues for spectrum acquired before 2021 will be considered for conversion to equity. Cognizant's top brass says 20% of its code is presently written by machines and this could rise to 50%. Expects the focus to shift from services to embedding technology in products. Hamdard informs the Delhi High Court that Yoga Guru Ramdev's videos targeting Ruh Afza have not been pulled down from YouTube and have only been made private. This despite Ramdev offering to remove the communal videos yesterday after the court threatened contempt proceedings against him. Instagram CEO Adam Mosseri sees insatiable appetite for Reels in India on the second day of the World Audio-Visual Entertainment Summit. YouTube CEO Neil Mohan says 21,000 crore rupees have been paid to content creators so far and promises to invest 850 crore rupees in India over the next 2 years. And actor Amir Khan bats for a higher number of theatrical screens in India, underlines that even the biggest hits have a theatrical footfall, accounting for only 2% of the entire population. Also calls the short time window between the theatrical and the OTT release of a film a faulty business model. All right, let's start with the market action. Sensex and Nifty ended flat on Friday to end the truncated week with 1% gains. Mid-caps and small caps underperformed on Friday and the week. Reliance Industries was the star of the week, gaining 10% in what was the biggest weekly gain in the last 5 years. Prashant Nair is here with a market wrap.
Well, Friday was absolutely flat, but for the week, the market posted gains. And, the Nifty, the 1.3% gains Friday to Friday. Of course, there was a holiday in between. The Nifty Bank about 0.8%. Mid-cap index about 0.3%. The small-cap index, though, was down about 0.6% or so. So the run broadly on the way up continues. What really stood out as far as the large-cap stocks are concerned, Reliance. RIL went up 9% this week. And that was the big reason why the market did what it did. Adani Ports with a 6% pop, Maruti 6% and BPCL was up about 5% this week as well. JSW Steel, of course, the damage, the bulk of it happened on Friday, actually all of it, 5.5% lower. Ultratech 5% and Bajaj Finserv was down about 4% as well. The broader market, lots of action. I'll start with what was up in a big way, at least 10% and more in terms of gains. I could spot 4 names. Sonata Software, 26%. It kind of ran up sharply. It's a company which depends on Microsoft as a key client. The defense companies had a pretty good week. Garden Reach was up 17%, Mazgaon was up 13%, Data Patterns was up about 11% or so. On the downside, Tejas Network, 18% cut this week. SW Solar was down about 17, 5-star 12.5. Praj Industries was down about 11% or so as well. I mean, as we head into the weekend, of course, all eyes on trade headlines, because that, of course, has the ability to move market, although I must say at the margin, it's moving markets lesser so. You know, we've kind of come up quite sharply. The Nasdaq, for example, is up about 20% from its April lows. You know, once again, are we going to get into that zone where Trump and his statements on trade, etc., start to matter? I think we'll have to see. We heard from the Chinese Commerce Ministry, and they essentially, in a cryptic way, they said that they're conducting assessment on US trade talks, and they're asking the US to be responsible and kind of sort of, you know, behave themselves. There are elections in Australia and Singapore. And of course, locally here, I think while with a few days, you know, more than a few days having passed, with the market waiting for some sort of a potential escalation between India and Pakistan, I think that risk premium perhaps gets taken down a notch, I think, as we saw on Friday as well. Earnings so far has not been all that great. The earnings overall scorecard and picture, and I think that continues to be a key focus area into the coming week as well. Back to you.
Right. Thank you, Prashant, for that. In the money market, the Indian rupee briefly breached the 84 mark against the US dollar to hit the highest level in 7 months. However, the Indian currency weakened in late trade to end with losses of about 9 paisa. 10-year bond yields remain largely steady. From currencies to commodities, crude oil prices rose as China indicated that it is open to talks with the US. The possibility of USA imposing secondary sanction on buyers of Iranian oil also supported prices. Similarly, prices of gold rose marginally after hitting a 2-week low the previous day. However, prices of the yellow metal remained on track for their worst weekly performance in more than 2 months. All right, the top story this evening. The Supreme Court has scrapped JSW Steel's acquisition of bankrupt Bhushan Power and Steel. The apex court cited gross violation and non-compliance of the bankruptcy laws by JSW Steel and ordered liquidation of Bhushan Steel. Shares of JSW Steel plunged in trade. Ashmit Kumar is here with more on the court's scathing order. Ashmit.
Well, indeed, a big setback coming in for JSW. The Supreme Court setting the clock back by about 5 to 6 years as far as its entire CIRP insolvency proceedings are concerned for Bhushan Power and Steel. The big takeaway is that the Supreme Court was unhappy on 2 grounds. Number one, the Supreme Court was unhappy with how this entire process has taken much longer than what had been earlier decided. The resolution plan, there's a window for which there needs to be execution. The Supreme Court said it's been over 2 years since the NCLAT granted its approval, but despite that, there's been little or no forward movement. That is something that, in fact, the Supreme Court has taken very strong objection to. The other is how this entire transaction, where JSW is trying to take over Bhushan Power and Steel, went via the twin route of both the equity as well as optionally convertible debentures. And that, again, is something that the Supreme Court said it is not in keeping with the resolution plan. There's only so much leeway that can be granted, and that the Supreme Court, given the fact that there are multiple deviations from the set process as per under the IBC, the Supreme Court says that it has no option but to set aside this entire resolution plan. So bear in mind, it was in 2019 that the NCLT had granted approval, and since then things had begun to move forward. But the Supreme Court's saying that both at the pre-approval and the post-approval stage, there are a number of violations that the Supreme Court can't keep its eyes shut. It will have to take action, setting aside that JSW resolution plan, with that sending the company, Bhushan Power and Steel, into liquidation, and therefore, in a sense, setting the clock back by about 5 years for this entire insolvency process. Back to you.
Right. Thank you, Ashmit, for that. So how will this order impact JSW Steel? Nigel D'Souza is here with more on this. And Nigel, can JSW Steel ask the apex court to review its ruling?
The Supreme Court's decision to reject JSW Steel's resolution plan for Bhushan Power and Steel and direct its liquidation raises concerns for the company, the steel sector, as well as the insolvency resolution here in India. Well, let's break it down for you. The implications as well as the remaining uncertainties. Can JSW Steel appeal or seek some remedy? Well, Mr. H.P. Ranina says that JSW Steel can file a review petition in the Supreme Court and then work on a possible resolution. But why is Bhushan Power and Steel important to JSW Steel? Well, JSW Steel owns roughly around 83% stake all the way since October 2021. Bhushan Power and Steel accounts for around 10% of JSW Steel's consolidated EBITDA and nearly around 13% of its capacity. It also is strategically located in various parts of East India and helps plug some of the supply chain issues. Well, let's talk about some unanswered questions and also points to ponder. How much does JSW Steel could potentially look to recover? Well, they paid closer to 19,350 crores under the resolution plan. After that, they've incurred some additional capex over the last few years as well. The cash flows, though, from Bhushan Power and Steel would help them offset some part of this investment. But the recovery is unclear without official liquidation proceedings. Well, can JSW Steel operate the unit in the interim? A shutdown will cause 3 million ton drop in domestic steel supply. That's what will lead prices higher, especially amid the rising infrastructure as well as the construction demand. And does this set a negative precedent? Well, possibly yes. If a consummated resolution plan can be reversed many years later, it could deter future buyers. Well, it may also increase the legal challenges and lead to some kind of recovery. So let's see how this pans out. For the time being, it's a blow to JSW Steel.
Right, a blow to JSW Steel. Thank you, Nigel, for that. From steel to telecom, the government has clarified on converting spectrum dues of telecom companies to equity after Bharti Airtel sought similar treatment to Vodafone Idea. Sources tell CNBC-TV18 that only spectrum dues acquired before 2021 can be considered for conversion to equity. Sources tell CNBC-TV18 that dues for spectrum acquired in 2021 or after will not be considered. Sources also clarified that the conversion to equity is not automatic and will be subject to evaluation by the government. Right, the big international story we are tracking. China has said that it's evaluating the possibility of resuming trade negotiations with the United States. The country's Commerce Ministry has reiterated its request that the US remove all unilateral tariffs. The ministry added that failure to do so would indicate an outright lack of sincerity. Beijing indicated that senior US officials reached out for talks through relevant parties multiple times. Apple's second quarter earnings came in slightly above Wall Street's expectations. Revenue rose 5% year-on-year to 95.4 billion rupees, while profits stood at nearly $25 billion. However, Apple shares fell on Thursday after the company warned of a potential $900 million headwind in the June quarter due to Trump's war. Apple CEO Tim Cook said that majority of iPhones sold in the US will now originate from India and Vietnam. CNBC's Steve Kowak is here with more on the tech giant's quarterly results.
Company also giving its first comments on tariffs, saying it expects $900 million in costs in the June quarter because of it. We'll get to the tariffs, but first let's get to the specific results. Apple EPS was a beat at $1.65 compared to estimates of $1.63, and revenues also a beat, $95.36 billion compared to the $94.66 billion estimated. iPhone revenues were a beat as well, $46.84 billion compared to $45.84 billion expected. That's up about 2% year on year. Revenues, though, that was a slight miss and was a drag on the stock in after-hours trading. $26.65 billion. Street wanted to see $26.7 billion. But still, big-time growth here for the services business, up 12% year on year. And China revenues, those were down slightly, 2% year over year to $16 billion. As for tariffs, CEO Tim Cook said on the earnings call the company was able to manage its supply chain ahead of the tariffs going into effect in April. But he said Apple still expects that $900 million charge for the June quarter because of the tariffs. Even with the tariff uncertainty, Apple provided some broad guidance for the June quarter. Company now expects revenue to grow by low to mid-single-digit percentage points, and margins will still be strong, 45.5% to 46.5%, even with those tariff costs. Cook also said on the call Apple moved its supply chain around ahead of the tariffs in April to mitigate their effect in the June quarter, though the company can't predict the impact beyond that.
Amazon's first quarter earnings beat Wall Street expectations. The company reported a revenue of nearly $156 billion and an earnings per share of $1.6. However, revenue from Amazon Web Services grew at a slower pace than expected, missing estimates for the third straight time. Amazon gave a softer guidance for the second quarter. It highlighted that tariffs and trade policies and recessionary fears made its guidance subject to change. McDonald's posted its worst quarterly sales in the United States since the COVID pandemic as consumers pulled back on discretionary spending amid the uncertainty over tariffs. Its overall revenue of nearly $6 billion missed Wall Street expectations for the third time in 4 quarters. On McDonald's earnings call, the company officials flagged a notable uptick anti-American sentiment, particularly among consumers in Northern Europe and Canada. Chinese electric vehicle manufacturer BYD has posted its best month of sales yet for 2025. With this, BYD is on track to hit its full-year target of 5.5 million deliveries. New energy vehicle sales for the month was up more than 20% year-on-year. Furthermore, battery passenger EV sales topped its plug-in hybrid sales for the first time since 2024. Back home, Marico reported a mixed set of numbers in the fourth quarter. Its net profit and revenue beat street expectations. Profit rose by 8% on a yearly basis to 345 crore rupees, while revenue jumped by nearly 12% to 2,730 crore rupees. Margin for the quarter was lower than expected. Commerce Minister Piyush Goyal held a meeting with the European Union Commissioner in Brussels about a trade agreement with the EU. The minister has said that both sides reaffirmed their commitment to concluding the long-awaited trade deal by the end of 2025. Sources tell CNBC-TV18 that the minister will revisit London to finalize issues in the trade deal with the UK. Abhimanyu Sharma is here with more. Abhimanyu.
It has been a week of intense and continuous discussions between India and the European Union as well as the United Kingdom for free trade agreements. The negotiations are already taking place between India and several trading blocs and several countries. India's Commerce and Industry Minister Piyush Goyal had visited London, Oslo and Brussels. He had met a delegation from the European Union and both the sides had reaffirmed their commitment towards proceeding to ink an FTA within 2025 itself, while India also pointed out that not just tariff barriers but also non-tariff barriers need to be removed and any regulations which exist on both the sides should be equitable as far as application of such regulations is concerned. Earlier, Indian industry and also the Indian government has raised concerns over the proposed carbon tax and the EU deforestation regulation and the possibility of such regulations hurting the interests of Indian businesses. India has also earlier termed such regulations or proposed measures as lopsided. It's likely that India's Commerce and Industry Minister Piyush Goyal will go to London again to proceed with further discussions with the United Kingdom for an FTA. Now, a few final pending issues still remain with respect to signing of the FTA, which include issues like a bilateral investment treaty and financial services. It remains to be seen how early the discussions are going to conclude, as there are 3 pacts being negotiated. It's a free trade agreement, a bilateral investment treaty and a social security agreement or a convention agreement between both the sides.
Right, thank you Abhimanyu for that. India's manufacturing sector hit a 10-month high in April 2025 with the HSBC India Manufacturing PMI at 58.2. The seasonally adjusted index signaled the strongest improvement in the sector's health since June 2024. The improvement was driven by faster growth in employment and production. Remember, a figure above 50 indicates expansion, while one below 50 implies contraction of activity. Indian software firm Zoho has suspended its plan to build a $700 million semiconductor fabrication plant, citing technological uncertainties. In a social media post, the SaaS unicorn's founder Sridhar Vembu said, and I quote, "We wanted to be absolutely sure of the technology path before we take taxpayers' money." End quote. Zoho had applied for incentives under the India Semiconductor Mission in June 2023. The government is likely to roll out an electric truck scheme. Sources tell CNBC-TV18 that 500 crore rupees have been allocated to incentivizing sale of electric trucks. The government has concluded inter-ministerial consultations and industry feedback has been taken into consideration. The Karnataka government has amended its motor vehicles tax policy. Under the revised policy, electric vehicles priced above 25 lakh rupees will now attract 10% tax. Meanwhile, vehicles costing below 10 lakh rupees will now have to pay one-time tax of 5% as against 1,800 rupees a year in the earlier regime. The highest tax will be imposed on vehicles costing above 15 lakh rupees, which will be at 15%. All right, on that note, it's time for a short break. Coming up next, actor Aamir Khan bats for a higher number of theatrical screens in India, underlines that even the biggest hits have a theatrical footfall, accounting for only 2% of the entire population. More on that when we return. Welcome back. 10 days since the Pahalgam terror attack that led to the death of 26 civilians, terrorists involved in the attack continue to remain at large. The Indian Army said that Pakistan Army violated ceasefire along the line of control in Jammu and Kashmir last night for the 8th consecutive day. The Indian Army said it responded in a calibrated and proportionate manner. US Vice President J.D. Vance has said that he hopes India's response to Pakistan over the terror attack will be in a way in which it doesn't lead to a broader conflict. Vance also urged Pakistan to cooperate with India to find the terrorists involved in the attack. Remember, Vance was in India when the attack took place. Air India has said that it could incur an additional loss of $600 million if Pakistan's airspace remains closed for a full year. It has made a request to the government for a subsidy model for its international flights. Prime Minister Narendra Modi has commissioned India's first deep-sea transshipment port at Vedanta in Kerala. The project, which cost almost 9,000 crore rupees, was developed by the Adani Group. The event was attended by Kerala's Chief Minister Pinarayi Vijayan and Adani Group Chairman Gautam Adani. Thiruvananthapuram Congress MP Shashi Tharoor was also present. Ruh Afza maker Hamdard has informed the Delhi High Court that Ramdev has not pulled down the video that targets its product. Further added, those disparaging videos have only been made private and can be viewed by subscribers. This comes a day after Delhi High Court ordered Ramdev to remove the video within 24 hours. Meanwhile, the yoga guru maintained that he will take down the video within the time granted by the court. The counsel on behalf of Hamdard said that the video is also available on Astha channel. The court has listed the matter for 9th of May. All right, on to all the action from day 2 of the World Audiovisual Entertainment Summit. Instagram CEO Adam Mosseri called India the platform's largest market globally, adding that the appetite for reels in the country is insatiable. Meanwhile, YouTube CEO Neil Mohan said that 21,000 crore rupees have been paid to content creators so far. YouTube APSC head Gautam Anand also promised to invest 850 crore rupees in India's creator economy over the next 2 years.
India is headed towards becoming a global powerhouse, I think, for creativity. For us, it's the largest country in the world for Instagram at this point. But when I was working on the Facebook app, data here was expensive and networks here were slow. And that has changed dramatically over the last 5 or 7, maybe 8 years, both in terms of reliability, but most importantly in terms of cost. We've seen an immense amount of growth in how much time people spend online. But more than anything, we've seen growth specifically in video. For us, short-form video, for others, short-form and long-form video.
What is the big bet that you have on the Indian market when it comes to the creator economy? What's the kind of investment that we're talking?
We already see on YouTube over the last 12 months, over 100 million channels have uploaded a video. So we're on our way to that billion. We've also paid out over the last 3 years, 21,000 crores to our partners. We're still one of the few platforms that has our partnership program, which has been launched in India for several years now as well, and obviously has continued to scale. We're going to be investing 850 crores over the next 2 years to continue to foster and grow the creator ecosystem.
Can you talk to me a little bit about where this investment is going to go, how that's going to work? What exactly is YouTube's plan in India with this?
We have creator programs that we run all the time. We've also launched commerce and shopping here. We're trying to grow that part of our business. It's increasingly becoming an important part of how creators earn revenue. We understand brand deals are important, and so we're running programs on how to facilitate and grow that pie for our creators as well. So it's a combination of programs that we run, all to help not just new creators come onto the platform and thrive, but also our existing creators, how they can continue to grow their businesses.
Bharat is where it all began. India is the origin of Om, the sound of the birth of our universe, the birthplace of zero, Shunya, the beginning of the infinite, the home of Sanskrit that gave the world language.
Actor and producer Aamir Khan, who was also a part of a panel at the event, has argued for a higher number of movie screens in India. Khan underlined that even the biggest hits in India have a theatrical footfall, accounting for only 2% of the entire population. He also called the short time window between the theatrical and the OTT release of a movie a faulty business model.
Our biggest hits over the years, no matter which film it is, has had a theatrical footfall of 3 crore people or 3.5 crore people. Am I saying the right thing? That's what percentage of our population? 1, 2, 2%? So 2% of our population in a country which is recognized as a film-loving country, only 2% of the population watches our biggest hit in theaters. So where is the remaining 98% watching the film? So my belief has always been that we need to have a lot more theaters in India, and theaters of different kinds. And there are so many districts, there are tracts of areas in India, vast areas, which don't have a single theater for people to watch films. If I have to be very honest to my audience when I'm marketing my film, I have to tell my audience that, guys, my film is releasing. But all those people who are on this particular subscription, on this particular OTT, they've already bought my film. They don't need to come to the theaters. The ones who are not in this OTT, please come and watch my film. This is my communication that I'll have to make in all honesty, which is a very awkward communication. So according to me, that window is too small. That between theatrical and OTT, you're killing your own business. If I tell you buy a Maruti car, and if you don't, I'll drop it at your house after 4 weeks. Why will you buy it? You will say, yes, drop it at my house after 8 weeks. I'll wait. And in a price-sensitive country like India, this matters a big deal. So I seriously feel that you have to, this is something that needs to be looked at, in my opinion.
And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
The newly appointed chairman of SEBI on March 1st outlined 4 key objectives for SEBI: trust, transparency, technology, and teamwork. And today we have a 5th T to elaborate on this. The author of all these statements, Mr. Tuhin Kandapande, the new SEBI chairman. Thank you very much, sir, for your time. Well, let me first start with the trust and the transparency part. The previous chairman had already set in motion the controls on F&O. We saw the first tranche of controls came in, only 1 expiry per week per exchange. We are eagerly awaiting the second set of rules. When do you think we will hear of it, and what will be the main, constraints, if any?
I think the SEBI had put out a consultation paper, and we received about 800 comments. Some supporting the position, some suggesting some alternatives, something in between. So we will take a considered view and will come. Basic premise is that we should make systemic improvements and also provide, while the F&O market is very important market for price discovery, for hedging, we also don't want it to be, like reduced to one single problem that we were facing on index options on the expiry day. That was our key problem area. So therefore, we need to, clearly define the risk metric, and we are trying to, we'll bring the delta in terms of, the options.
Yeah, I thought it was more, besides the risk metric, the end of day counting of options or intraday. And it is now, look, I mean, there were enough articles written on it that the intraday positions are so high that some limits need to be put, and the limits should not only be on end of day. So should we expect that there will be intraday limits? Because that's where the HFTs seem to be taking the game away.
I think we will have to take a clear call on not really exactly what we had proposed in the paper, but exactly what will be more practicable, and taking into consideration all factors. So we will bring about necessary changes accordingly.
Okay, you can't give us any clue on whether it would be intraday or end of day limits?
Not at this moment.
Okay. All right. Let me come to the other issue that is rankling the market on this trust transparency issues, and that is this SME IPOs, sir. I mean, we have seen Gensol is now. Just before that, we had that, I think it was Trifactor Technologies. There are enough number of SME IPOs. Are there some new rules being written? There is an inherent conflict. When you ask the exchanges to control them, they make money out of them. So it doesn't seem to be an effective, they don't seem to be functioning as a first line of control.
I think one of the objectives of bringing SME IPO are a little light touch regulation for them was exactly to facilitate the SMEs to access capital markets, where the cost of accessing we have to see the cost is relatively down, and it is easier for them to access capital markets. So I mean, we have a very large number of SMEs, and so therefore in order to enable them to do that, whether we could have the same onerous requirements as the main board was the issue. And it was, so I think we are watchful if there are certain aspects where we have, for example, brought in some changes in terms of profitability criteria, in terms of usage and deployment of funds post IPO, also on the fact that this money cannot be simply used by loan repayment of the promoters. But I think the merchant bankers, they need to do a better thing on this, and we expect
But do you expect it to remain with the exchanges because there seems to be a conflict of interest?
I don't think that is, in a way, in any in anything, even if it is approved by the SEBI, the exchanges will have to be paid their fees. So therefore, the transactions will have to be carried out in the exchanges. So only the processing part, like, you know, clearing the document, that was what something which was SEBI passed it on to. But we will be watchful of the situation, and if we find that, yeah, if we find that, you know, this is a very widespread phenomenon, even after whatever the changes that we have anticipated, then we will review it.
The second tranche of F&O rules, when should we expect it?
Well, I can't give you the deadline, but...
No, I mean in a month,
yeah,
even a broad ballpark.
I mean, I think very shortly, yes. Within a month, I think we should be able to arrive at, yes.
Okay. Now let me come to the other issue that you have already announced as one of your first announcements. This conflict of interest disclosures by for SEBI's own officers. Do you notice any gaps in the current disclosures?
Well, this is not only for SEBI's officers, but also about the SEBI board members, including chairman.
Yes.
So the gap is, I think, you know, one is 2008. This was set for the board members. Then there are ESR regulations, which are even older, which is employees service regulations. There are certain disclosures which are made within. There are certain conflict of interest clauses are being applied within. People are recusing. However, there is very little public exposure. There is in fact no public disclosure of the conflict of interest. Even we don't have even disclosures of properties and other things.
None of them, even other government officials don't disclose to us. It is to the appointments committee or whoever they disclose. We don't get to hear.
No, but at least some disclosures are there. Even, for example, the property returns, the immovable property, even for all government servant, is out. And I think SEBI also is also you know, slightly a regulator where we find that we should be more proactive in terms of, you know, this regime. And secondly, we also need to have comfort for those who are working within SEBI as to how they need to conduct, you know, in many cases, you know.
You mean the lateral entrance?
Not only lateral entrance, even the people who are employees, they also need to, when they are passing orders or, you know, dealing with the case. They
need to know.
They need to very clearly know where it will fit. So I think we have to update that particular, both the ESR and the board resolution. Secondly, we also need to have a framework how they would be recorded, because we need to know who has recused for what and rationale, so that have some database, and also have public disclosures.
Okay, so that is a big thing.
So
you expect that it will be a public.
So public disclosures, to what extent the public disclosure should be made, in what cases should be made, how, you know, it could be mitigated. Suppose somebody seeks the thing, then how that particular complaint, etc., could be processed. If there is a, I mean, we will, the committee obviously will look at the best practices in for other regulators in the world as well. And I think we will be pushing forward this important subject.
The fundamental difference will be that you will make things more public.
I think both. We have to also need to have more clarity internally as to how they will rest, how they will be processed.
Okay, fair enough. Now, you know, you've made repeatedly a statement that there is a compliance burden. Are you of the view that SEBI is over-regulating?
I think so. I think in many areas we can have a much simpler regulation. Many regulations were, you know, contextual in nature, and some of them have been changed also. For example, LODR was completely changed in 2018. Similarly, other the regulations were updated, but not all of them. So therefore, there is a need for relook at the regulations. Many times context have changed. Many times, you know, a better way of regulation may have come simply because you have a better technology now.
No, my fear is that as it is, there are scams. I mean, we had Gensol. Like I told you, there were 2 or 3 SME IPOs. Even if I do a Google for the last quarter, We have seen 3 or 4 scams come out. It doesn't look like over-regulation. It looks like more regulation is needed.
No, I mean, simply you write a regulation doesn't mean that it is there is a difference between implementation and a regulation. That is what the effectiveness of regulation is. Like wherever the risk is higher, that is where we have to concentrate. If we try and ask too much of micro, that may not be our game. Secondly, we also have to clearly say that we can't be in every boardroom. So the question is it asking too much of a tick boxing? In many a case, it is a false disclosure. The disclosure will come, but that's false.
Yes, that's what we discovered.
So therefore, what we need to do is how effectively you can have a check and balance where these disclosures are stemmed in the bud.
But is there a feeling in government that there is over-regulation? Because that seems to be the general feeling that, and I think it also may kind of demoralize people within SEBI also. If you're constantly told that you have, you've overdone, you're over-regulated.
No, SEBI,
doesn't it?
Number one, this is not something that I'm telling SEBI. All our staff are fully engaged and energized into re-looking at things. Many a time they have been feeling also. See, the question is, it's like a spring cleaning. Many a time what happens is when you are in your house, and not that, this is something which is happening for the first time. I must give credit to successive leadership in the SEBI that from time to time they have re-looked at it, they have contextualized it, they have brought in new regulations, they have, shed the old. So it's not something that, like it is like spring cleaning. Every time you keep on doing it, every Diwali you want to do it something and then you accumulate and then you shed also and you contextualize. This is something which is exercise which is really being done by all the divisions. I mean, they have begun it. They are enthusiastically doing it in terms of, because it is also when you are having a regulation, and if there is too much of information, then you have to also process too much of information. If you just bring that information and just keep it rest, then what's the point? So therefore, they would also like to be, they would like to be smarter. So I think SEBI wants to be a smart regulator.
Okay. Well, let me come to the other issue of, ASBA for secondary market. This blocking of the amount for primary markets was done for IPOs, and we were expecting it will happen in the secondary market. Is that something which is on the anvil?
Yeah, we are looking into it.
Okay.
We are looking into it.
But will it take a long time?
I will let you know. I mean, I just have to take a stock of the situation.
Because the brokerages are sitting on a lot of money. There was somebody the other day who said that some 4.5 lakh crore of, customer idle funds are sitting with custodians, with brokerages. I mean, why are people able to offer zero brokerage? Because float is there, they're making money on that. So will ASBA in secondary market be a priority for SEBI?
No, I think we have to really see the whole ecosystem moves together. Okay. And as you say that, the level of float has come substantially down in our system. The India itself, took a lead in going to T+1 settlement. US has now followed suit. Several jurisdictions. I was in US and we had a meeting with several security regulator in the context of the IMF ISCO spring meetings. And there are many people who are still in a much different regime.
But it is under consideration. Should we expect some rules?
Yes, I mean, it's under examination, as I said.
Okay. Let me take a quick break, sir. Back with a few more questions. In fact, lots more questions to the SEBI channel. Welcome back to this very special chat with the newly appointed chairman of SEBI. Well, not quite newly. He's been around for over 45 days, Mr. Tuhin Kanta Pandey. Thank you very much for your patience, Mr. Pandey. Let me come to this T+1 settlement that we were talking about just before the break. SEBI is also pushing T+0. Will there be more of that? Because that also reduces the float, makes money more active and efficient. Will we see more of it?
Well, T+0 was intended to be optional.
Yes, optional only.
So right now, I think we will rest at that. Let it be optional.
Yes, yeah. Yes, of course. No, the system cannot be imposed, but you will try and push T+0. There is no rethink on that, is there?
No, I mean, we are neutral about it. As I said, we have brought in the T+0. It is an optional system. The technologies, etc., have been tested. So, I mean, we have to really see how the ecosystem moves and how there will be a comfort level of the wide variety of issuers and investors and things like that. And what kind of plumbing is there? What kind of problems are there? There are FPIs. How would they move the money? I mean, there are...
To their advantage. I mean, if they get T+0, they will get money on the same day when they sell. They should be happy, if anything.
No, that's true, but that is not the kind of thing is there. You should ask them also.
No, I did speak, and some of them were very happy.
They may have procedural issues, many of them, of trying to move the money, and different time zones are there, different things are there. I think India has taken an initiative, and our security markets continues to take the initiative in its own unique way, but we should take people along.
Okay. What about the NSE IPO? Can you give us some updated headline on that? They have come to you again. Will it be round the corner?
Well, there are certain issues which are going back and forth. I think they have
Is it that co-location litigation case which is the prime roadblock?
There is, no, I think that is one case where I think some solutions can be found in terms of settlement, etc. And there is a technology architecture issue, then there is a governance, and then is a clearing corporation. In these, all of these things, I think there is an active interchange between the exchange and the SEBI. And we intend to look at positively forward to, not as a procrastinating device, but actually to make it happen.
Okay. But Clearing Corp, their argument usually is that BSE has been allowed. Why are we being asked to reduce our stake?
That's the point. I mean, but at the same time, we have to really keep in mind that, it's substantial, is 90% of the market share, market thing is. So we have to see keeping in view the market integrity in others, how we will basically it's a question of a roadmap. What kind of roadmap we should agree upon.
So should we expect it in a year, in 6 months? Is there anything you have in mind?
We will let you know. Frankly, it's a bit early for me to jump the gun, but there have been technical discussions on, and we'll come to a finding. But again, I said with a view to find a solution, and not to permanently, park that question.
Fair enough. The other issue was, in the previous regime, there was a regulation enacted that if FPIs have more than 50% exposure to one stock, then all the granular details should be revealed. I think it was, they went through the entire stage and almost everyone revealed. But there was still a little bit of people who would have been disqualified because they did not reveal. Can you share any numbers as to how many funds have still to reveal or were disqualified because they didn't give you the final granular details? What is the amount of money involved?
This reduction in cases where
it did not reveal
the full granular disclosures as required, could not be there, and therefore their registrations were rendered invalid. This is about 1% of the total FPI AS.
Okay, I just have a couple of questions on mutual funds. One is the TER, the total expense ratio. What happens is SEBI has a TER limit, that top funds compete and they fix their TER very close to what SEBI has mentioned. So it becomes, it is not related to your performance. Ultimately, your expense should be related to your performance. It doesn't work that way. What happens is SEBI's limit becomes the limit for the market. Any rethinking on the TER?
See, first of all, I will not agree with your point that the fixation of an upper ceiling TER is a way to cartelize, because that is an upper ceiling. You can always compete.
It tends to be, is all I'm saying.
That is always competing. Now, if you see, for example, the brokerage. In the brokerage, you have an upper ceiling of 2.5%. But there are people who are offering zero also. Similarly, debt funds. If there is a ceiling of 2% or whatever, you have people offering much less.
In equity, you don't see that.
So, in equity also, I mean, the people will compete and the people will do that. So, right now, I think what we should say, we should not look at as simply removing the ceiling. Will not mean that, the people will not, you are saying that everyone is crowding around the...
Yeah, somehow the TER is not related to performance. It has become like that. It has become everyone congregating around SEBI's limit. Yeah, in equity, that's what's happening.
I think in many cases, people are looking at performance in a variety of ways. I think when the investors are looking at returns, they are looking at... So they are not necessarily looking at TER also. So,
yeah. But they don't look at TER. They look at performance only. But I'm only saying that funds are getting away with it.
Upper ceiling is not really the reason for which, you are saying they're crowding at that upper ceiling.
It tends to be, that's what everyone fixes as their TER, somewhere close to the SEBI's limit. Okay, while on the matter, sir, there was also that, that investment product between mutual funds and PMS. We were expecting new rules to come on that special investment unit.
Yes, the new regulation framework has already been out. Now we have received 2 applications also from 2 AMCs. So I think in a matter of 10 days, we would have cleared them.
Okay. Just a final question on the market volatility. SEBI had asked previously for stress testing of mutual funds. If there was something very adverse in the global market because of tariff wars or other geopolitical concerns, would you worry about mid-cap and small-cap mutual funds? They have volume only because investors rushed in. But if there is a rush of redemptions, then there will be stress. They may not be able to pay immediately. So any stress testing moves from SEBI?
I think it's a very important question, and stress testing actually not only should be done, but actually SEBI has also got it done for small cap and mid cap in 24. It was done, and the results have also been released. So on directions of SEBI, MFI, directions to MFI, all the stress testing results have been in the public domain. We also intend to do stress testing for others also.
Which would be?
I mean for others. These are the small cap and mid cap, but for others also. So therefore I think it's an important thing to know what happens, and I mean...
Are you somewhat confident that if there is huge volatility, the market will be able to still function normally?
Absolutely. I think we have buffers and we have mechanisms. Just to give you an example, the kind of settlement guarantee fund which is there, that has been more than doubled in the last 5 years, and it has worked as also our system works as more like a counter-cyclical, and the margins are 11% plus, which is much higher than the SGX margin of 5%. We have also, as I said, the funds moved up to clearing corporation. They are lien to corporations, not at the broker level. We are securities directly getting credit, not through brokers, but directly given that. So this is another element. I think at different levels we have created. And then we have also that, CMDF fund, which is the, for any redemptions, etc., on unusual redemptions, we have that support backstopped fund as well.
So we are somewhat prepared, but of course one hopes that we don't have to use them. Finally, as you end, say, one quarter, what is your goal? What do you want achieved in a quarter? What do you want achieved in your first year?
Well, I think it's not my achievement really. I think the SEBI is a very robust institution. It carries on, and we keep overseeing the markets, we develop the markets, we do investor protection. That's our mandate. And we'll continue to improve ourselves, challenge ourselves to do better.
Okay.
With the help of every stakeholder. As I said, 4 Ts. The teamwork, which is more external and internal teamwork, media included.
Okay. We'll try and pose tough questions. That may be our role. Thank you very much, Mr. Pandey, for sparing time for CNBC TV18.
Thank you.
Hello and welcome to News Centre. I'm Parikshit Luthra. In a significant change from its long-stated position, the Union government has decided to include enumeration of costs as part of the upcoming census. The government is yet to announce when the census would be conducted. Key opposition parties, including the Congress and the RJD, has for long demanded for a caste census. The Congress party had highlighted the caste census as a pivotal part of its manifesto. BJP leaders, including Prime Minister Modi, had criticized the Congress for demanding a caste census. In July 2021, Minister of State for Home Affairs Nityanand Rai had told the Parliament that the government has decided as a matter of policy not to enumerate the caste census and also caste-wise population other than scheduled castes and scheduled tribes. BJP's ideological fountainhead RSS, however, has taken a more nuanced stance. They did caution against using caste census as a political tool, while highlighting that the government needs the numbers for all welfare activities. To take this discussion ahead, I'm now joined by Sandeep Shastri, Pro Vice Chancellor of the Jain University and Supreme Court lawyer and political analyst Deshratan Nigam, also an RSS ideologue. Also joining us on the program, political analyst and academician Manisha Priyam. Thank you very much for joining us on the show today. Manisha Priyam, let me begin by asking you, till 2024 Lok Sabha campaign, the Prime Minister and the Union government were saying that the rights should be based on the population. And you cannot be dividing the people on the basis of caste. Why do you think this change in thinking in the government has come about?
I wish there was a government spokesperson who could have spoken to you about why the government has changed its stance. From the outside, we could only be looking at the possibilities within which this decision has been taken. You're right in saying that the RSS for a long time, for the longest time, does not believe in this type of caste-based reservation, and its political leadership has been, of course, with certain upper caste. But what we need to remember that somewhere along the way, even the RSS changed its strategy, the Madha strategy, for example, wherein they built a strong base amongst the OBCs in the state of Maharashtra, where the RSS has its headquarters. So it's not correct to say only the upper caste or only a Brahman Baniya coalition. There were some changes in thinking. You saw Kalyan Singh in Uttar Pradesh or Uma Bharti as important OBC leaders. You also saw very important tribal leadership that was promoted by the RSS, Babulal Marandi, the founder chief minister of the state of Jharkhand, and Arjun Munda. So in a sense, the stance of the RSS is more nuanced than what you think it is. And as far as the inclusion of caste as a category of enumeration when the census will be undertaken is in fact a concession. But at this point of time, the BJP as a political party is poised to take on the erstwhile Janta parties or the Janta Dals or the erstwhile grouping of the socialists whose conventional plank this has been. And without doubt, it is the Bihar election in mind, where if the BJP does not portray itself any longer as a party of the backwards, or it does not pitch itself in the Agada Pichda battle in Bihar, it's also a state where there is a sunset of socialist politics. And I believe the political timing of this announcement has been very, very opportune. In politics, timing trumps over everything else. So the move is certainly political. The plank taken over from the socialists and also from the India Alliance. However, as of today, it's a government announcement. A government announcement led by the ruling BJP and its Prime Minister, the Sri Narendra Modi, as they go into the Bihar state election.
All right. Sudesh Ratan Nigam, perhaps you're in a better position to explain us the thinking of the RSS and the government as to why this was important. What the opposition is asking and what a lot of people are trying to understand, why this particular timing, why was this decision done? Till about a few years ago, you were very clear about this stand, that any kind of decision on rights has to be based on the share of the population. How do you think things have changed? If you could give us a sense of the RSS thinking on this.
Well, in fact, RSS has made it very clear, Parikshit, that this caste census should not be used as a political weapon, like one caste being played another and dividing the entire society. Because the goal of the RSS is to unite the Indian society and bring social harmony. So one has to be very careful while implementing it that it should not create new fault lines. And one caste should not play against the other, and nobody should do it. Because the Congress was demanding this particular aspect and some of the opposition parties in order to counter Hindutva and the cultural nationalism of the BJP and the RSS. So that should not be the motive, because it should only be a scheme which should be data-based affirmative action. So that should be only our goal. Instead of using it as a political weapon, it should be used as data should be used as an affirmative action to uplift certain.
But Mr. Nigam, all right. How is it helpful at this stage, at this day and age where we are right now, and what are the safeguards would you like to have in this exercise as well?
Well, in fact, the timing, well, all political parties are in competitive politics. It's about winnability. And BJP is also a part of that particular setup, but with a difference. So that is why I'm saying BJP's and RSS goal is not to use it as a political weapon and play one caste against another. The safeguards need to be we should be very careful as to how to implement it. Let's say, for example, while enumerating the caste, there are other castes as well, like OBCs. There are state lists and central lists also. And the general category castes also needs to be counted. So it's a very complex task. And there should be some change in Representation of People's Act that you should not vote on the basis of caste. If caste census is being done, only done for affirmative action, not for, seeking votes on the basis of caste. That's one red flag that I'm flagging.
All right. I'll come back to you, Mr. Nigam. Let me also get in Mr. Sandeep Shastri. Thank you, sir. Always a pleasure to have you, Ms. Manisha Priyam and Mr. Deshratan Nigam on CNBC. I would straight off like to ask you, what experts are saying that doing a caste census as part of the larger census exercise that we do, it's not difficult. But the fact is, what are the consequences after that? What would that be according to you?
Parikshit, while agreeing with what the previous panelists said, I'd make in the time I have 3 very quick points. Number one, when a government has to a certain extent back to the wall, you pitch for extra time. And now by saying that you will have a caste census as part of the next census, you are pushing the whole debate by at least a year or 2 now. And therefore, all this discussion of the caste surveys across the country would be put on the back burner, hopefully, because now you're looking at a caste census. Secondly, in important ways, what the ruling party has done is that it has stolen the political clothes of the opposition. The opposition was consistently making the point about the caste surveys. So now you say, yes, we have also adopted that and we have taken it a step forward, and something which has not happened since independence, we have made the caste factor a part of our census. And third and last, let's remember for some time now we have had 2 narratives on social justice. A narrative which the India coalition has come up with about the need to enumerate caste to decide upon what is the type of reservations they should have. And secondly, you have the NDA-led narrative, which talks of everybody being one and the whole question of the whole nation being one. And in the light of that, accepting the fact that there is a need for this enumeration, especially when you're talking about a reservation policy. And lastly, Parikshit, I'd also make the point that however much we may talk about a 21st century Bharat, I think caste continues to be a critical identity. However much we say, no, we don't want to do anything with caste, that continues to be a critical identity. Identity in politics, basically to try and leverage advantages, which you cannot wish away so easily. And therefore, the census becomes so important. But then it's a promise made. You really don't know when that census will happen, when those numbers will be counted, when the results will be out. So you have much more time available now to take forward the debate.
So, Mr. Shastri, that's a very important point.
Yeah, that's a very important point because about how to ensure the transparency in the way you enumerate the caste.
Right. Now, when we speak about caste enumeration, the question that Jairam Ramesh of the Congress is asking, you've got the headline, but what about the deadline? So it's quite possible that the BJP, the government, by announcing that, yes, we will go for a caste enumeration, but not giving an exact deadline for it. And as you rightly said, that this exercise could take 2 years or more to start and conclude. And in the middle, starting with Bihar, in all the elections, the BJP will reap benefits of this. Do you believe?
This is like the women's reservation bill, which was passed. This is like a post-dated check with the amount with the receiver, but neither a date nor a signature. That would be the problem for me with it.
All right. Ms. Priyam, what do you think about the political implications of this? We're looking at, of course, a very divided political structure, a heated opposition, both in parliament and outside. This is a demand that Nitish Kumar had also made. Yes, the BJP and the Prime Minister have managed to blunt the attack of the opposition. But what immediate political benefits do you see out of this?
See, I think this is a great experiment by the BJP. The BJP wants to take on the mantle of the Samajwadis in the heartland of where it all began, in BP Mandal's heartland. Remember, they were able to ease out Mr. Lalu Prasad Yadav as the chief minister when the BJP was not even in power with the Chara Ghotala case, etc. Then they waited in the wings now for close to quarter century, Nitish Kumar as the chief minister. Now, as the two Jayaprakash Narayan chelas and, groomed by Karpuri Thakur himself, Nitish Kumar and Mr. Lalu Prasad Yadav, both of them are fairly senior leaders in the sunset of their health and political career, things that I'm respectful about for their long and standing innings. Now here you have the BJP playing what is called collaborative games, not necessarily challenging either of them, not necessarily being very vitriolic to Mr. Lalu Prasad Yadav, but taking the agenda as their own. Now, if you see, there is no tall Samajwadi leader when the Prime Minister will speak about Karpuri's Bharat Ratan, when the Prime Minister will talk about caste-based enumeration. I can't imagine a political leader from the other side at the hustings in Bihar being able to take on the Prime Minister. So here it is an open challenge. The Congress can try and come into the debate. What the opposition or the India Alliance would need right now is tall Samajwadi leaders who are able to stand up and counter the Prime Minister. Can you name some? And the answer is, I can't find one. So therefore, if the Congress is not able to get their alliance partners, people like Akhilesh Yadav, for example, would have been able to take this up somewhat at the hustings and in electoral battles. In the political campaigning in Bihar, I do not see now a Samajwadi leader stand up as tall as the Prime Minister. And let's see whether the Prime Minister can reinvent himself as a Samajwadi regional leader who's taking on the backwards in the battle. Now remember, the BJP in Bihar has been a party that kind of attracted all those who were opposed to Mr. Lalu Prasad Yadav and a lot of the forwards. This would be a complete somersault, a political risk and a calculation. Let's see how it plays out. But on the other side, I would see the forces weakly aligned for the moment.
Right. Mr. Deshratan Nigam, one important point is the fact that when you have such a caste census, along with that, you must have a lot of data on the economic situation of the people, the social situation as well. What is the timeline? What is the best possible time period within which this exercise should be completed according to you?
Well, in fact, these are very complex issues. And as I said, the danger is always there as to how you do it and playing one caste against the other. If you recall in 1871, when the British started the caste census for the first time, they wanted to divide the Indian society. And therefore, that danger will always remain. The timelines, it's very difficult to give timelines because 2026, I believe, is the new census when the delimitation exercise is also to be done. And that is where I think they'll have to start working right from now. And it will take probably a year or two, probably 2 years to do it. In 2011, socio-economic enumerators was also taken into account while doing the census. So our census commissioner and the staff do have some kind of an experience about collecting socio-economic parameters from the people, but it has to be done in a very different manner now. So far as the time period is concerned, I think it cannot be done, as rightly pointed out by Mr. Shastri, that it can be done in 6 months or so. It will take its own time. And it has also to be very careful about the pitfalls that you have to face on the way. Because Bihar's caste census, there were enough amount of mistakes and errors out there. The numbers were not correct. And therefore, one has to be very clear because people will try to inflate their numbers so that their caste gets more weightage. So all those factors have to be, taken into consideration. Therefore, it is an exercise, a humongous exercise, where it has to be transparent, avoid pitfalls, and not to do in a jiffy, in a hurry, because it will be a record or a base for future census also, where additions have to be done to it. So one has to be very careful and not do it in a hurry.
Right. My final question to Mr. Shastri. Mr. Shastri, do you believe that there could be a legal challenge to this as well? It cannot happen immediately because right now there is only a political intent. You do not have anything in black and white. But as and when that happens, do you think at some point there could be a legal challenge?
There is unlikelihood of a legal challenge until the census per se happens. Once the census happens,
till the findings are out,
and the data is out, then questions relating to X caste, Y caste, enumeration, bringing together, and more importantly, subsequent to that, are you going to use your caste data to redefine your quantum of reservation? Because there is a Supreme Court judgment which says reservation is an exception and the right to equality is a rule. And the exception can never exceed the rule and therefore the cap of 50%. Now, if that caste census is going to be used to expand the quota of reservation, I think there will be a range of legal hurdles that come in, given the light of the Supreme Court judgment on this matter. And given the fact that the Supreme Court interpretation that reservation is an exception and the right to equality is the rule. Now that I think will be an important point which will invite legal attention.
You're right, because the Congress party has also said that we are going to start pressurizing the BJP to remove the 50% cap on reservation. And as you said, this could lead to a challenge once the findings of the survey and what the government does with it is clear. Thank you very much, Ms. Priyam, Mr. Deshratnagam and Sandeep Shastri for joining us on the program. It's been a very interesting discussion. We're taking a short break here, but coming up 10 days since the Pahalgam terror attacks, as India weighs its response, several conversations have been held between Indian cabinet ministers and their US counterparts. We take stock of all the action after this break. Welcome back. It's been 10 days since terrorists gunned down 25 tourists in Jammu and Kashmir's Pahalgam. The manhunt for the suspects continues. Indian Army said Pakistan violated ceasefire at the LOC for the 8th consecutive day. US Vice President J.D. Vance says India must respond to the terrorist attack in a way that avoids broader conflict in the region. Speaking to Fox News, Vance urged Pakistan to cooperate with India to hunt down and deal with terrorists operating in their territory. The comments echoed US Secretary of State Marco Rubio's plea to both India and Pakistan to de-escalate tensions. In a conversation with External Affairs Minister Subramaniam Jaishankar, Rubio reaffirmed the US commitment to cooperate with India's fight against terror. Defense ministers of India and the US also had a conversation about India's response. India's Defense Minister Rajnath Singh said his American counterpart Pete Hegseth said US supports India's right to defend itself. Joining me on the show is former diplomat S.D. Muni, who is also Professor Emeritus at JNU. Professor Muni, thank you very much for joining us on the program. Let me begin by asking you, do you see a coherent response from the US right now? Are they saying that, yes, we support your right to respond, but please exercise restraint?
Well, I think we should understand the nuance inherent in it. The nuance is that US supports us in fighting terrorism. US does not support us in fighting Pakistan. This is precisely the difference between the two. And if I may underline that this has been a traditional approach of the US to ensure that India and Pakistan do not fight with each other. And if there is a chance, they are always willing to mediate. This is traditionally so since the 50s. But even President Trump, after his victory in the second term, made it very clear that he would be very happy to mediate in the conflict. And as you know, that he wants to project himself as a peace president and has already started mediating in two other conflicts, which is Gaza-Israel on the one hand and Ukraine-Russia on the other hand. So I think this is a very nuanced policy on the part of the US to publicly say that we stand with India and we want India to we would support India fighting for its own defense against terrorism, but they do not want a regional conflict. And they have said so in so many words. Vice President Vance has said so, Secretary of State has said so, and I think even the Defense Secretary, while talking to our Defense Minister Rajnath Singh ji, must have conveyed the same feeling.
Right. So, Professor Muni, you're saying that here the US is aware, and probably we may have even conveyed to the United States, and that's what seemed from J.D. Vance's statement, that there is going to be a calibrated response, because J.D. Vance categorically said, we only hope that India's response does not in any way lead to a regional conflict, a broader regional conflict. So do you believe that by now, as part of the larger exercise to look at our options, India may have conveyed that it has a right to respond, and the US has accepted that?
Well, that's what it is, and I don't really understand. Firstly, you know, I am not quite privy to what exactly the objectives of us in this eyeball-to-eyeball situation with Pakistan is. Do we want to eliminate the terrorism and terrorist hubs in Pakistan? Do we want to cripple the Pakistan army, which is really behind it? Or do we want to see that Pakistan state is brought to its senses, or all of them? Now, that much depends upon it. Let me recall again what the Americans did vis-a-vis the US when the 9/11 question was involved. They wanted to take Osama, they wanted to get out of Afghanistan, and to prepare legitimacy for that, it was necessary for them to show a major achievement. And that major achievement came as taking out Osama. And have no mistake, in taking out Osama, the ISI of Pakistan collaborated with the CIA. They knew how this operation will be carried out, and that's why the whole operation by and large was very smooth, despite some of the contrary claims that the Americans came quietly and they did this job. So I don't know if that kind of a message is being sent that, look, Pakistan must cooperate with India in handing over some of the key terrorists, or India is thinking of taking a kind of an operation where people like Hafiz Saeed or other terrorists which are involved are taken off, because these people have now been hidden and replaced into, I understand, army cantonment areas and are quite well defended. So it creates a dilemma for India. It also creates a dilemma for India because diplomatically, while we are seeking international support for us, this is a kind of a truncated support, if at all, which is more rhetoric than real. No country has said it's not only the US, I would say, even Saudi Arabia, even all other countries, European Union, UK, they have all said the same language, that we support you against terrorism, but please restrain yourself. Don't
Professor Muni,
don't
my final question, my final question to you would be, how do you see India's current response? The Prime Minister's speech in Bihar last week was unusually strong. Now, there is a pattern, and that's why there is a general assumption that there will be a response. We saw that during Uri. We've seen that in Pulwama. And even now, there is belief that there will be some sort of cross-border operation or maybe a calibrated strike against terror camps. But this time, and the way you are seeing things proceed and the Indian government's actions, the Indian Army's exercises, the Air Force, Navy exercises, has anything changed in India's playbook right now?
Well, nothing has changed in India's favor except that Pakistan is really under great kind of duress and stress. And they do not know what exact action India is going to take. And that's why they are going all over the world to tell other countries to please intervene and ensure that India does not take a major action, military action against them. But, creating pressure is a part of a strategy. And you would recall that when attack on parliament took place, even during Atal Bihari Vajpayee's government, we had put the forces on alert and created tremendous pressure on Pakistan for that. Similarly, all these exercises which are being done, I mean, on the Ganga Highway, we are taking Jaguars and all kind of fighter jets, which is only creating a pressure on Pakistan. This is not directly a war action as it is. And Pakistan also is preparing for it to retaliate. So what precisely is India having its objectives in this kind of a confrontation remains to be seen. None of us are privy to that. I think the Committee on Cabinet Security will work it out. Defense Ministry will work it out.
Right. But clearly right now, the strategy seems to be to keep the enemy, to keep Pakistan thinking, and the world also confused about what the possible next steps would be. And of course, all of that will happen only at a time and place of our choosing. Thank you very much, Professor Muni, for joining us. It's been an excellent conversation. That brings us to the end of News Center. Thank you for watching. Goodbye.
Starting up wasn't an idea that the two of you talked about when you were in college together. I mean, it wasn't something that you considered doing, I would imagine, at IIT.
For me, the aha moment was just us deciding that we were going to do something together. And what exactly that is, that actually came second. If I had not started up with Srinath, I probably would not have started up.
So if he hadn't made the call, would you have thought about it?
I was pretty comfortable back in 2017-18. I was not giving this serious a thought. When he proposed, I couldn't say no.
We're now at Trump 2.0. Yeah. Tariffs are playing havoc at this point in time. How do you read the latest set of developments in the US?
These kind of opportunities like tariffs, etc., they really allow you to shortcut your sales cycle. So what you would have otherwise achieved in 1 to 2 years, you're able to achieve it in 1 to 2 quarters. I would say in 3 to 4 years from now, these things should be good for India and by extension us.
In 6 years, to go from starting from scratch to being able to take this business global, I mean, it's a turbocharged journey.
The first US thought came to us back in 2019 when Trump 1.0 and there was 25% tariffs on China. Okay, now with this 25% tariff, can India compete with China? Because we have this 25% delta.
Hello and welcome to the Young Turks Reloaded podcast. I'm Shireen Bhan. While everyone's talking about the possibility of India having its manufacturing moment, a 6-year-old company is quite literally having its moment in manufacturing. We're talking about Bangalore-based Zetwork, a company started in 2018 by founders who decided that they wanted to give up their cushy corporate jobs to actually get into the manufacturing space in India. To talk to us about the Zetwork story, how it began, and more importantly, where it's headed. Joining me now are Amrit and Srinath. Thank you very much, gentlemen, for joining us here on the program. So I want to start with that. It's been just 6 years. It seems like much longer, but it's actually been just 6 years that you started this company. And you've been able to do what? More than $2 billion in revenue already. So the manufacturing moment for you has been real.
Yeah, I mean, sometimes when you say it out loud, yes, it's been 6 years. Sometimes it feels 10 years, sometimes it feels 1 year. You know, I go through those extreme moments. Where
What are you feeling right now?
Right now, I feel 10 years.
10 years?
I think it's just, yeah, you're right. Like, and I would say out of those 6 years, 2 years were COVID. So in reality, a lot of our growth has happened in the last 3.5, 4 years. So it's been pretty frenetic. And I think what excites us is we actually really like what we do. It's like when we were first starting out, I think me and Srinath, when we were first pitching investors, the common feedback we got was, you guys sound really smart, but why are you doing this? Yeah.
Like, why are you going into manufacturing?
Why are you going into manufacturing?
Yeah.
And amongst all the rounds we have raised, I still feel our seed round was the toughest.
But that happened fairly quickly, right? I mean, you managed to close that in record time, I would imagine.
No, our seed round took us 3.5, 4, no, almost 5 months.
Okay, 5 months is not that long.
Yeah. I mean, compared to, other things, I think we've taken a little bit shorter. But it was more around the uncertainty. Like we got a lot more no's around that time. And the no's were less about people not liking us or the idea, but they were just not comfortable around that. There was no comparison. There's not an Uber for India or a Airbnb for India. What's the US equivalent? What's the China equivalent? And we honestly, when you start a company, you don't always think, okay, I'm starting the Uber for India.
Yeah.
You just, in our case, we had empathy for the problem basis our first jobs. I started my career at ITC, Srinath as well. We've seen shop floors up front, and we had empathy and attractiveness from that unique vantage point. But suddenly you're being asked all these questions of what is this the US equivalent of something else?
Yeah. So you're not the Uber of India, you're not the coup of India or any of the other sort of templatized models that we speak of. But Srinath, starting up wasn't an idea that the two of you talked about when you were in college together. I mean, it wasn't something that you considered doing, I would imagine, at IIT, or was it? Or did you ever kind of have that conversation back then?
No, we did have conversation about starting up even in college. In fact, back, I don't know if you remember, G. Edison Challenge and things like that. So there was this big competition.
In IIT Madras.
In IIT Madras. And back then it was a very coveted thing to win. And for a while, we were even contemplating if we should actually work on that problem statement. It was something around energy. And work on that problem statement and convert that actually into a business. But we were, I think, also very clear that after college, it's important that we start a career in a company. It's important that we work in a big company setting. And I think I think that experience is equally shaped how we work, act, take decisions, and a big part of it is people leadership. Today you run a big organization, right? And we look up to leaders whom we had actually looked up in our ITC days, and I think it's important that that we never thought of it in those days in college so deeply about it.
Yeah.
But today when
But there
I
was
reflect,
a germ somewhere.
yeah, the germ was always there. The germ was always there, and glad that it worked out after 8 or 9 years after graduating from college.
After graduating from college. But what was the trigger? I mean, what eventually made you say, I don't want the McKinsey job. I want to go back home to India and get this started. And between you having that realization and convincing him, I mean, how long did it take?
I think, in my case, I was in the US and we had a lot of common friends from our time at ITC, and they were starting companies. One of them just went public a few months ago, a company called Blackbuck. Again, the founder was basically grew up with us.
Yeah.
And at least for me, I was seeing all of this from outside and
getting FOMO.
And I just, FOMO. I should not have left India. There was just a lot of energy, a lot of excitement. And in US, I basically had to build my life from scratch. When I went there. I had some network from my friends, etc. But I just felt that should I spend my 20s and early 30s chasing, getting a green card, getting a visa,
the American dream,
and rebuilding my life, or should I use what I felt were the most productive years of my life to start something in a market I was more familiar with. So moving back to India was actually independent for me to start a company. I just felt that I should spend my career in India at least for the next 5-10 years. And when I came back, I reconnected with Srinath. He was the first person I called because we were colleagues together at ITC. We were batchmates. We were in the same hostel. I just had a lot of familiarity.
He was your wingman in college as well. Your alibi, go-to alibi.
So we just had a lot of comfort with each other. And I think for me, the aha moment was just us deciding that we were going to do something together. And what exactly that is, that actually came second. For me, if I had not started up with Srinath, I probably would not have started up.
Yeah. So you wouldn't have gone it solo?
I would not have done it. I don't know about you. But
so if he hadn't made the call, would you have thought about it?
I was actually not gonna. I was pretty comfortable back in 2017-18. I was not giving this serious a thought. This was always like in the plan, but let's think about it later. But when he proposed, I couldn't say no.
Did he go down on one knee?
Actually, there was a moment where he backed out.
Really? When did that happen?
I think we had just about to get our first term sheet, or we were struggling to get our first term sheet, and there were some moments of doubt.
Cold feet.
Yeah, I mean, it's those days were very different. Yeah. So, but it was momentary. I mean, even today, before taking a big decision, it's important to have those moments.
Your family supported your decision, and in fact, your father also turned entrepreneur around the same time as you. But your father has taken only 6 years to be able to figure out what you actually do.
Yeah. I mean, I come from a very traditional family. Like my father is a professor, and my mother actually, she's more entrepreneurial. She runs an NGO of her own. And actually, when I came back, it was a tough decision for 2018, actually very transformative for me, because I decided to come back to India. I got married that year, and we started the company.
So all happened at the same time?
All happened at the same time, and there was too much change for my father. Like, he was thrilled when I got into McKinsey in the US. And, because in many ways, that is a dream come true for a lot of, especially families of my background, where we haven't seen that kind of familial success. And so for giving that up to start something which wasn't clear, in a year I was getting married, that felt like a lot of change. So in a way, actually that was also helpful in hindsight, because my father gave me a deadline that, look, by the time you're getting married, which for me was December, you need to figure it out, because I don't want to introduce you as my unemployed son. So, and in fact, we closed our Series A 1 week before my wedding. So sometimes constraints help. It gives you that extra push.
It gives you the extra push. But let's talk about where we are today, Srinath. And, I don't know how many people know this, but you have facilities here in India. You're also now global,
Yes.
and about 25 to 30% of your revenue now comes from the US market. So again, in 6 years, to go from starting from scratch to being able to take this business global, I mean, it's a turbocharged journey.
No, it has been, yes. I think I would be lying if I had said in 2018 we really imagined 6 years from then we would have the form factor that we have today. We would have the kind of global footprint that we have today. That way, this journey has been incredibly gratifying. But each of these decisions, we never approach with a very super grand plan kind of a mindset also, So you take one step at a time and are you feeling really reassured about that step that you're taking forward? And that's really how we have taken decisions, right? So the US, the first US thought came to us back in 2019 when Trump 1.0 and there was 25% tariffs on China. It was just this first principles thinking, right? So okay, now with this 25% tariff, can India compete with China? Because we have this 25% delta, right? Where we can really have a play. And this change has occurred now. And that's why there could be a here and now opportunity. And hence, and when we look at our suppliers who are really small Indian manufacturing MSMEs, they don't have the wherewithal to really knock doors with a US customer. So we thought, why can't we do that? And started with like one person, spending like full time into that market, talking to a bunch of customers. And I think really COVID, the second wave of COVID is when we experienced acceleration, So I remember in the first 1 year of knocking a lot of doors, we acquired like 2 or 3 customers. And after the second wave of COVID, like I think 21, 22 year, every single quarter we were acquiring like 15 enterprise customers.
Because then the China plus one became
That
real.
is when the terminology of China plus one and the concept of,
diversifying supply chains.
Otherwise that's been like we talk about bread basket of the world, and this is like the manufacturing basket for the entire world, right? So nobody really thought outside until this event happened. And that forced everybody to actually think outside of China.
you're talking about Trump 1.0. We're now at Trump 2.0, and tariffs are his favorite word. And tariffs are playing havoc at this point in time with businesses because of the uncertainty. Now, as companies like yours, how do you read the latest set of developments in the US? What does it mean for you as a business?
I think it's a little early days because a lot of the detailing happens in the fine print, and those fine print are yet to be known.
And the fine print, typically, if your 1.0 experience of Trump has been the case, hasn't been as bad as the headlines.
Yeah. I mean, in fact, it's been great for us. Like, so I would go on a limb and say that in 3 to 4 years from now, any kind of I would describe our industry as a hard to get in, hard to get out industry. Like, our customers are large companies. They're not always looking for changing their supply chains every day. So that means that for us, sales cycle is a constraint. It takes us sometimes a year to win a first order. But then we convert that customer from a small company to a large account. So getting in is really hard. But the flip side of that is once you're in for the rest of your life, unless you screw up, right? So these kind of opportunities like tariffs, etc., they really allow you to shortcut your sales cycle. So what you would have otherwise achieved in 1 to 2 years, you're able to achieve it in 1 to 2 quarters. So that is really how I look at it, and that could be tariffs, that could be war, that could be any change in the status quo. So I would say in 3 to 4 years from now, these things should be good for India and by extension us. It's just that there is a short-term chaos that you have to navigate because when there is tariffs, etc., people want clarity. Businesses want clarity before they invest.
Yeah, especially if you're making significant capex decisions.
Yeah. So my guess is in 3 to 6 months we should get that clarity in terms of some stability into that environment. And these could be famous last words. I don't know, but that's the hope.
But is there a sense of pause right now? I mean, especially US customers, etc.
Yes, of course. Of course. I mean, people are right now behaving here and now. Let's not think too much long term right now. And there is a lot of confusion right now in supply chains as we speak. And even the here and now decisions are sometimes unfortunately getting paused, which I think is not good for the industry. But hopefully, at the end of the day, we should go back to first principles thinking. I mean, if something that is damaging the economy, damaging supply chains in a big way, should not happen, in my opinion.
So you are hoping that there will be a review or a rethink or possibly even a rollback.
No, ultimately there is laws of gravity apply. Like for example, even now when there's tariffs or threat of tariffs, what we are seeing is for some of the products we supply, the local US equivalent prices have gone up almost similar to the value of the tariff. So if previously it was $100, now it's become $120. So that's in a way negated any impact of the tariff. Right? So there are certain just laws of gravity which generally apply. Now distorting market price through regulation has historically never worked. And there may be some short-term kind of chaos that gets created, but eventually it gets smoothed out over a slightly longer time period. So as you rightly pointed out, we are a 6-year-old company. We have a lot of room ahead. So we'll wait it out. But in the interim, what we're doing is we have started Europe as a second market for us. We now have a couple of very large accounts there. We think it can become 5 to 10% of revenue. Now that's a decision which we have preponed.
Right.
I would say
there's
that
been an acceleration of the European expansion on account of the Trump uncertainty.
It's just that something as a I mean, even I would say for two of us, when we started the company, words like diversification does not apply because as a founder, you're all in. This is that one idea you're working on, you're making it successful. And in fact, for the first 3 years, we were doing a single SKU, single category. Our diversification journey started post-COVID. It's the analogy of books for Amazon. We were doing just that for the first 3 years. But now, as we are getting larger, diversification is good from a risk management point of view. It's good from bringing more certainty to the business. In a way, I see our role as that. Like, we live in an uncertain world, but as a CEO, as a founder, we have to give certainty to our investors, to our employees, to our customers. and just spreading your bets a little bit is not a bad idea.
Yeah, and that's a dilemma for many founders. I mean, between diversifying and spreading yourself too thin, you've got to find the middle path. So how have you arrived at what that middle path should be?
Just experience. We also overdid it. When we went for diversification, we went into too many things. Then you realize, oh, this is not simpler. And it does consume management bandwidth. It's not, you cannot mechanize decision making. And then, you strike a balance between it. You consolidate a few things but you do pursue things very seriously when you see that the conviction is coming from a long-term purpose than a here and now opportunity. That's I mean, if you look at it, the decisions that we've taken over the last couple of years, none of them are here and now. None of them are like electronics 2 years back when we diversified and went big. We think about this as a 15-year opportunity, right? So renewables, we are spending a lot of time in renewables today, not just in India, but also in US and Europe, because we think that's the answer for the world today, for the energy security needs that the world needs. And we are comfortable today taking big decisions coming from long-term conviction like this.
You know, speaking of long-term convictions and making big bets, let's talk a little bit about these big bets. And let's start by talking about the electronic bet, which, you know, as you said, was something that you decided to do 2 years ago. And you've just opened your facility in Sri Perumbudur in Tamil Nadu. Ashwini Vaishnav was there for the inauguration. You know, to go from that point 2 years ago to say, look, we want to ride on this opportunity, and the government has, of course, been pushing it as well, to where you are today and where you see the headroom for growth. I mean, everyone's talking about India's having its Apple moment, you know, as far as the electronic space is concerned. How do you see it?
Yeah, I think the analogy is more like IT services, where, the IT services industry essentially created a model where we use India as in some shape or form a backbone for the global economy, and I think that opportunity is true for electronics and a bunch of other industries that we are in. The underlying, I was reflecting on what Srinath was saying, like I would go one extra step and saying wherever we have made short-term decisions, that is what has not worked in our favor. And wherever we have taken slightly longer-term positions, and this factory opening is a good example. Like historically we were asset light, which meant that, look, if any, we don't deploy capital beyond any large opportunity we're in. But now that we are actually setting up a factory, we have put our own money, we have set up this factory. On day one, when you set up a factory, you have no customers. Because no customer will come and say, okay, you're promising to open a factory and hence I'll give you business. They will want to see the facility, they will want to underwrite. It will take 6 to 12 months before you get the production rolling. In that moment, you're losing money. Only in the second year and third year is when the P&L really kicks in. So these are again decisions which you cannot take with a 1 year, 2 year time horizon. You have to have a 5 year, 10 year time horizon. The benefit we get as a business is because of the underlying marketplace model, we notice patterns of demand and supply. And sometimes you see that, okay, I'm getting 100 million of demand for electronics.
And there's no capacity.
There's no capacity. Or the capacities that are there are already full. So then this gives you a very clear signal that this is probably a good area to spend time, good area to invest. Even then you try and risk mitigate to the extent you can, and then you take risks that you're comfortable with. And I would say us as a business, we are getting more and more comfortable with taking risks. That risks which we were not comfortable 3 years back.
You haven't really been wedded to a particular way of doing things. You have had the agility to kind of make pivots very early on in your journey as well. I mean, from software to marketplace, now from marketplace to actually getting into manufacturing and kind of like flitting between all three simultaneously. How did you think about that, and how do you develop the ability to deliver on that kind of agility?
I would say long term, that's the only moat or advantage we have compared to the
big boys.
And in a way, we have taken on the hardest task possible, where our competition is not other startups. Our competition is large incumbent companies who've been around for 20 years, 30 years. If I have to say purely from a running factory point of view, they run factories far better than what we do today. We will get there. But we are competing with them and we are winning. One of the competitive advantages is just our ability to react fast and take decisions quickly. But at the same time, not take decisions carelessly. Because if you take a careless decision, of course, you'll hurt yourself, but you'll also hurt your market reputation, and you'll also hurt that customer relationship against which you've taken those decisions. So, finding that balance is tricky and important. What we have also learned along the way is we don't need to do everything ourselves. So, at some point, founders become the bottleneck in the companies they start. So, our goal has always been to get the best people who are smarter than us to help us, achieve this journey together. So in electronics, for example,
a lot of people say that, but is that the cool thing to say, or I mean, how do you actually make it work?
I mean, the way at least I think about it is I want to do as less work as I can. So if somebody
so that you can do what with your time?
Something else. But the idea is electronics is a good example. We brought in this person called Josh. He was the head of Bharat FIH, Foxconn India, and honestly, a lot of the insights we derive from him in terms of, these are the, now that doesn't mean you just do everything that this person says. And that's the partnership they also see with us. That we bring in our unique way of thinking, we blend it with that industry knowledge and insight. And that is where 1 + 1 can become 11 versus 1 + 1 becoming 2, right? So, and you still rely on the fundamentals of the business, which is software, marketplace, the multi-industry nature. That also is helpful, where patterns that you're seeing in renewables can influence some of the decisions you make in an unrelated industry. Like these are all the strengths that we have as a company, which are unique to us. And then we marry it with the industry-specific nuance.
Right.
And that is what allows us to be ultra competitive in the long run. So
speaking about your competitive advantage, and it's an interesting point that you made about bringing in somebody from Foxconn to actually run your electronics business. Do you believe that you're at that stage in your journey where the need for specialists like him is something that you want to focus on? Is that the kind of capability that you're now looking at being able to beef up, bolster? Is that where you find yourself at this point?
Yes, in very select areas where we are going deeper, yes, and we are doing that. We are not just in the electronics, even in renewables, even in battery energy storage, for example. You really, where the supply chain itself is very, very nascent and does not sometimes exist within our country, you need to really look at that talent beyond just looking at manufacturing or just looking at supply chain. You need to understand and appreciate how naive or stable the technology itself is, right? So those are the situations where you have no choice but to actually embrace it, that this is the uncertainty, and hence you have to work with specialists.
One is, of course, working with specialists as a way of enhancing capabilities. Another strategy that, many companies, including yours, have taken is the inorganic route. Take me through some of the lessons of what it's taken for you to do M&A, to do it successfully, what has worked, what would you not want to repeat in the future? What have been some of the lessons? Because again, within 6 years to do almost half a dozen, deals is a lot.
No, we have done only 4.
Yeah, so half a dozen is like close to 4.
Yeah. The dozen word makes it sound better. No, so we have done 4, and I would say our largest acquisition has been around $20 million in size. I would say our M&A journey has again been very first principles. Like we have bought either one of our existing suppliers or one of our existing customers. It's not like a banker came and pitched this company and so we evaluate. We have not done that kind of process. Not that I find any fault in that process. It's just that when your deal flow is coming from your business, that is the highest quality deal flow compared to when a deal flow is coming from a third party, because your business person understands how buying this asset can actually generate 1 + 1 = to kind of 10 scenario. In our case, I'll give an example. Like the US business we bought, we were selling to US customers directly, and we were selling it via a distributor. And this company that we bought was one of those distributors. What we were noticing is that because we were servicing that end market via distributor, we could not go direct. And our distributor was a comfortable business running a certain size and had a certain ambition. And by buying them out, we were actually able to go to that customer directly and say that, look, historically you've been spending 1 million via the distributor, but we can service 50 million. The bottleneck is all on the supply side.
Right.
It's not on whether the customer wants to spend or not.
Yeah.
And that is a scenario where we were able to convert a $1 million a customer into today we do $80 million, $100 million a year. So it's just recognizing where the bottlenecks lie. And then acting is always a choice. We could have chosen not to do that, but we recognize that you could create a non-linear outcome. I think what we did not expect was the whole explosion of the US market from a China +1 and all those other things. Those became extra bonus points.
Yeah.
But the underlying thesis was, okay, there's an existing segment I serve. I can serve more if I just debottleneck this sales issue.
So given the opportunities as well as the landscape, I mean, is that going to be something that you prioritize at this point in time, especially as far as international expansion plans go?
Yes, but we don't. Just the analogy that comes to my head is the love marriage versus arranged marriage kind of an analogy. So we wherever we see an incredible synergy, we act fast, and we love the team. We love the opportunity that the team is working on. We moved fast and broken things and made things happen. And that love exists in a few other places as well as we speak. It could be renewables, it could be US, Europe, very few specific categories that we're looking at, and
So where are we currently, at the engagement phase, or you know, a little distance from that as well, or the courtship is on currently?
Courtship is on, I would say. Yeah, we found somebody, and we are and also see the way we have done these. That's why I don't think of us as a very acquisitive kind of a company, right? So not that I have any problem with acquisitive companies, but we've taken a lot more time, right? Every single of asset that we've acquired over the last 5-6 years, we've spent a lot more time. Our teams have engaged way before the marriage finally happened, and hence this. And when you do things like that, you don't even worry about something like business continuity risk, or because you're supercharged in actually what this 1 + 1 can actually generate, you know, and that's why we've our whatever limited M&As that we have done, they've done pretty well, and our board has been pretty happy with how these have performed.
And the philosophy also is, when we do it partly stock swap as well, because that really incentivizes and aligns the seller to be part of the value creation journey. And not everybody is willing to take stock. So that itself is a filter. That, okay, if somebody is not willing to take, then it's just a transaction, and and for us that's less interesting.
Not a relationship.
And so, I mean, to quantify what Srinath was saying, any M&A we've done, it's taken us 6 to 9 months. From start to finish, and that means we can do maybe 1 a year max.
Right.
So that will never make us a very acquisitive company, because I mean, your bottleneck, unless we relax at 6 months to 3 months, and which is a bad idea. So you should not do that. And hence I don't see it as a big part of what we like to do. But again, you can't model it, because most of our deal flow comes from our business. And hence you can't predict that this year I'll see 10 companies and I'll, like a VC, I will pass on 9 and I'll buy 1. That's not the way we do it.
You know, speaking of marriages and bankers and proposals, I know that you've been courted as far as the public markets are concerned as well, and that is now, today, 6 years on, a much more real possibility. Going to the Lal Street listing, work has already begun on that?
We have started that work. Like, I mean, I like to say that this is I think the first time we've been serious about it.
Huh.
I think the question keeps coming. I would say sometimes unfairly because we are a young business and we get compared with other companies which are higher vintage. But I would say we are pretty serious about it in the sense that we are engaging with banks. We are doing all the prep work. What I realize is it's from the day you start thinking about it, there itself it's a 9-month process before you even ready. So the longer you delay thinking about it, you're moving that clock even faster, further along. But that being said, I think we are more serious about it today than at any point in the last few years.
And why, if I may ask, are you more serious about it today? Is it because of the environment and what we've seen happen as far as companies like yours are listing in 2023, 2022 to 2024? We've seen a whole bunch of them
I can
go
tell you
public.
my thinking, which may converge with how the market is thinking. But the way I think about it is we are building a generational company which will hopefully outlive us, and hence by that logic, it will spend way longer in public markets than it will as a in the private markets. And hence the earlier you can communicate your story to who your long-term shareholders are going to be eventually, that makes a difference at the margin to the decisions that you can take as a company. Now, there's this whole thinking that, if you go to public markets, you'll suddenly be constrained by quarterly results and you'll have to take short-term decisions versus long-term decisions. But I would argue the opposite. Like, the best companies are those companies which operate with a private company mindset but exist in public markets. Like, I'll say Zomato is a good example of that. They get that institutional love from a long-term oriented shareholder base, and they're still allowed, and they're actually having a higher risk-taking ability, I would argue, than they had when they were a private company. So I would want the same for us, that we think we can take, us as a business can compound for the next 20, 30 years in the Indian economy. And if we are able to attract the right long-term shareholders, it will be a true unlock for the business over the fullness of time. And hence, when you think like that, why delay the decision is how I come to it. Now, there is a little bit of tacticality around it on what is the exact time, when do you think the story will resonate well. Fortunately, we are having the opposite of what we faced 6 years back. When 6 years back, why are you starting manufacturing? Today, it's a very well loved and very well appreciated story in public markets. So luckily, we don't have to do that hard sell. And hence there is some of that which also plays in that, this is the time, the China Plus One movement
this
is
year,
happening.
I mean, what are you targeting? Are you targeting this calendar year, next calendar year?
I would, it's hard to pin it down like that, but we are starting our work. We'll most likely try and see if we can file later half of the year or early next year, and then how long it takes to
for
get
the
rest of
regulator to give the approval.
my idea of being overweight in financials this year was a pretty broad-based one because I had a fairly large overweight. So this was my highest overweight sector heading into the year. Part of that was my view that cycle is essentially going to favor growth. A change in dispensation with respect to approach to liquidity from RBI, which was more visible from December last year, also gave comfort. So lower regulatory scrutiny, these are all the aspects which positively play into the overall financial sector in terms of opportunities. So the way we were looking at it was banks. I wasn't a big fan of NBFCs per se. Of course, you can selectively pick things here and there, but my portfolio was stacked up more towards banks, followed by insurance, which was more defensive for me as well this year, given that a lot of the regulatory noise I felt had already reflected in stock prices. So these are the two ways in which we've been essentially trying to play the financial sector. And I think the question from here would be that, look, this sector is already outperformed. So does it really make sense to remain invested? I really think it's still early stage in the sense that, look, stocks have moved up, but they're still not as costly as they used to be in the past. And relatively, you don't really have other sectors which are cheap. So we're still playing for the next 10% return from here. And I think financial sector can over deliver on that. So we're telling investors to buy. So that's been the case since January. When I changed my view from being cautious to relatively more positive on the Indian markets, and as you know, my Nifty target is 26,500. We are still pretty much some time or some large gap away from there. So
as you look at this Make in India opportunity today, as you look at China +1 and what's happening in America with Trump and so on and so forth, where do you believe you're likely to place the strategic bets today? More India or more international expansion?
International with the foundation of the supply chain being in India. You know what I mean? Today you can always look at design supply chains. You have to be blended in your supply chain when it comes to international markets. You cannot put, particularly in today's geopolitical situation, you cannot put all your
eggs in one basket,
yeah. Right? So I mean, yesterday it was Mexico, today it was no Mexico. All these things happen, and but if your foundation of your supply chain is very strongly built in this country, and you can always add an engineering layer, or you can always add a tertiary value addition in the country, which is the right answer for the customer. I think that's a pretty resilient supply chain. So today we are thinking about global supply chains like this. It is not one single country. It is multiple country, and it is not one single capacity footprint. It is multi-capacity footprint, and it is not only manufacturing, but it is manufacturing plus value-added services. Could be engineering, it could be logistics, it could be warehousing or inventory management for your customer. So through these models, you can really build resilient supply chains which don't shake even during events like war or COVID
or Trump. But what has been the experience? As we talk about making in India, there is of course the perception of how difficult it is, ease of doing business. Of course, there has been improvement there. But as you look at this multi-facility, multi-country strategy, what's been the experience of working in the US? What's been the experience of setting up things in Europe? I mean, does India get a bad rap sometimes?
See, I think credit where it's due, right? So India, we are comfortable. We kind of we have done multiple things here. So even though the ecosystem may not be ideal, you still know how to get things done here in this market, right? So US, just because it was the first time we were doing something there, we were setting up a captive plant there, we went through challenges, and a lot of statutory things are very simple, straightforward, right? But a lot of anything that is non-BAU, I've realized in US takes even longer time
Than India.
But India, a lot more things are even BAU things are non-BAU. So, but then you have made things happen. So that's really how I would summarize. BAU things happen like really fast.
Yeah.
But anything that's non-BAU, people are also confused, and there's to approve or not to approve. Dilemma sets in, and things take time there as well.
So in terms of capex, given the fact that you have expansion plans at this point in time, what are we talking about in terms of the kind of capital that you will be deploying in the next few years?
So we've publicly announced our plans to deploy close to 1,500 crores across not just capex, but generally investments in totality across renewables and electronics. I would say we're halfway there in terms of already having spent that budget. So first is we have to spend the rest, then we will see if we want to spend more. And again, the idea is these are you can't always plan for it. We expect to spend, but we may not spend if there's no need, right? Because the business has a marketplace model which is complemented by the capacity in-house model, and you discover these things along the way. We don't have always don't have the clarity on day one that whether this is sufficient or even required. So it's just that you budget for it with the intention to spend, but you may realize that you may not need to.
Yeah, deploy it only as and when it is necessary. But we're living in an era where tech cycles are shrinking. Now AI is the rage. Every company claims to be an AI first or an AI driven company. How are you seeing that from your vantage point as an opportunity, but also as a risk?
I would say, we are a user of AI, so our speed of shipping code has dramatically improved in the last 3 to 6 months since we started using tools like Cursor and a few other things. So that is one benefit. The second thing that we're starting to see is, so we sit on a library of designs of various kind of products, and the next iteration of the design could be done through AI. Of course, that's something our customers do, but that's something we think we can help them with by building the right set of tools to shortcut the time it takes to design new products. So those are direct ways. Indirectly, I would say, because we do close to a third of our revenue is renewables led, that is fundamentally linked to power consumption of economies in general, and I think AI will turbocharge that. If you look at even advanced economies like the US, their electricity consumption is growing higher than the GDP growth rate of those economies. Same thing is happening in India. And at their scale, and even at India's scale, that is like a vast amount of absolute addition. So energy as a theme will be a very important theme for the next 10 years. And some of that energy will be renewables, but some of it could be traditional energy as well. And that's I would say, our core business. So we are looking to, increase our portfolio of products that we offer. So historically, for example, in renewables, in solar, we started by doing everything below the solar panel. We started doing the solar panel itself. Now we're looking to add some of the electrical components like transformers, conductors, etc. So AI, I think, will be a important part of global economy for the next 10 years, and every company should have some ways of playing that market.
Before I end, what is the trip at this point in time? What's driving all of you in terms of next milestones, in terms of where you see yourselves and the company over the next 5 years? I mean, what's that one kind of rallying call to action?
I think we are at a very interesting point in our journey. I think this could be, if we pull this off, we would be in a different form factor altogether. I think last couple of years we have slightly paused, I would say. I mean, we've been more doing sharpening the edges kind of actions. But right now, I mean, between India and international markets, we are taking multiple big bets. And these are not it's a departure from the typical iterative, experimentative kind of decision making. This is big, bold, long-term conviction-driven kind of decision making, and this could definitely add more surface area to what we are doing. Amrit did talk about electronics, electrical parts manufacturing. These are fundamentally 10-15 year trajectories, and the way we are going about it is also very different. We are not starting doing small things. Okay, let's make 5 steps forward, see how things are going. No, we are
going all in.
We are going all in. Yeah. So that's why it's exciting.
Nervous as well? Anxious or?
Yeah, I mean, like, I'm not an anxious person, so I always try to look forward versus looking back, and I would say there is many things that we don't know in terms of our next few years or future, but I think one thing we know for sure is that the time for Indian manufacturing is here to stay. I think India can become a $1 trillion economy in manufacturing alone. It will probably happen sooner than later. And whatever we can do to catalyze that journey, if it would happen in 10 years and we are somewhat helping that happen in 5 years versus 10, we will take a lot of joy in seeing that. Ours is a very physical business, so we actually get to see the products we make. For me, that's a source of personal joy. Like, I have a photo of me as a kid building windmills using Lego blocks. And now we're actually building windmills for other customers. And you take that arc and you take it forward, it sky's the limit that way. So we are very excited about the next 10 years. I think what is happening today will probably happen only once in our lifetime in terms of the shift that is happening globally. If we can take this and get as close to the sun as we can, then we'll hopefully create a bright spot for.
Well, I hope you get as close to the sun as possible without getting burnt. But we wish you the very best of luck as you take this journey forward with the bigger, bolder bets that you intend to make. And we look forward to hearing more from you about each of those decisions. And of course, we look forward to seeing you in the public markets as and when you do decide to list. But thanks so much for joining us and taking us through the Zetwork journey and your plans for what the road ahead looks like. Well, with that, it is time for us to wrap up this edition of the Young Turks podcast. From all of us here on the program, many thanks for watching. Do stay tuned to CNBC TV 18. We'll be back in a moment with plenty more.
Changed in terms of what investors should do. We use the operating word selective, but this idea was more to believe that we'll have a 10 to 12% returns for the headline indices, especially the large caps this year. So this market is not going to be a straight line up. So you will see volatility given all the global factors. But at the same time, if you were to just compare the earnings element of the risk, the earnings element of risk was substantially higher at the peak of the market middle of last year. It was fairly frothy, both for large caps and mid caps. To a large extent, you've seen downgrades and revisions through the year. Many fag-end downgrades that we see today is more, I think, accounting and calculation related rather than macro narrative related. So I would look at the underlying positives, the fact that we have essentially started to improve on the macro front. We are relatively less impacted on the US tariff regime. That's the second positive per se. We're heading into perhaps a decent phase with respect to the rural environment. And more importantly, consumption and capex in our view are going to be better than what it was last year.
India's media and entertainment industry today stands at $28 billion. We can easily grow this 5 times to over $100 billion in the next decade. This will give birth to huge new opportunities in employment and entrepreneurship in diverse fields. To achieve this, India should invest
in state-of-the-art content clusters across India. India should train tens of thousands of our talented young people in animation, VFX, and other technologies. India should incentivize IP creation, AI-powered innovation, and gamification. India should have a new investment avenues for this industry, and India should create an enabling and encouraging and empowering regulatory environment that rewards imagination and inclusion. My second idea.
Hello and welcome to Startup Street. I'm Arundhati Ramnan and these are the top headlines from the startup world. The Maharashtra Cabinet approves the aggregator caps policy 2025 in a bid to make app-based cab travel safer and more transparent. The policy puts a cap on surge pricing at 1.5 times of basic fare, seeks women-only ride-sharing and penalizes drivers if trips are cancelled. IPO-bound Urban Company winds down its Saudi Arabia step-down subsidiary Urban Company Arabia for Information Technology. This after losses widen and became financially unsustainable as per company's DRHP. ONDC postpones the implementation of network fee for sellers app yet again, sets 1st of July as the new date for implementation. The decision comes after the stakeholders' request for more time to adapt. Fintech firm Kaleidofin bags $5.3 million from the IDH FarmFit Fund. This fundraise brings the total funding in the company's current round to $19 million. This capital is set to scale its lending portfolio, expand credit scoring and technology stack. Hospitality firm OYO delays its IPO plan for the third time amidst opposition from SoftBank and market uncertainty. As per Bloomberg, it is now mulling to make its debut in March 2026. Zomato pulls the plug on Quick and Every Day due to tepid demand. The company CEO, Deepinder Goyal, says the call was taken as it did not see the path to profitability in these entities without compromising on customer experience. Chemists Association flags concern over sales of medicines by quick commerce platforms. The body seeks government intervention as it states sale of medicines by these platforms is illegal, violative of Drugs and Cosmetics Act. Those were the headlines that we're tracking for you this evening, but on what's brewing today, Ahmedabad-based space tech startup Satio Labs has raised $3.3 million in a pre-seed funding round led by Mirak Ventures with participation from Huddle Ventures, GVFL, Java Capital and others. Now, the funds will fuel the development of Satio's proprietary thermal imaging payload, team expansion and pilot testing. This as the company aims to transform Earth observation and position India as a global leader in space-based intelligence. Joining me now to elaborate on their growth plans is Urmil Bakai, the co-founder of Satio Labs. Urmil, thank you so much for taking time out and being here with us on Startup Street. You know, before we get into the nitty-gritties of the fundraise, if you could sort of tell us what makes Satio Labs' thermal imaging technology unique compared to existing Earth observation solutions, and if you could sort of, explain that to us in layman's terms, and how soon will you be able to make this commercial and launch it in the markets?
Sure, thank you. Thank you for having me. I am Urmil Bakai, co-founder at Satio Labs. See, look, our Mother Earth has a fever, right? And that fever is global warming. The rising heat is just not the climate statistics, but it is already impacting our agriculture, our cities, and the frequency of natural disasters. So at Satio, we are building India's first high-resolution thermal intelligence satellites to track the temperature in real time. By turning space-based data into actionable insights, we aim to help governments, industries to respond faster with the environmental change and protect our planet more effectively. We're going to have a constellation of satellites which will basically capture high-resolution thermal and optical data, and which will enable smarter decisions for the industries like agriculture, infrastructure, energy, and defense. Not to forget that as well. So what is happening is today's our Earth observation focuses on visual and radar imagery board. But thermal data, which tells us about heat and energy, remains largely underutilized. This data is critical for maybe overheating, monitoring overheating transformers, to stress crops, to leaking pipelines, and even border intrusions. All of them, giving heat, long before they fail to escalate. So that's what Satio is all about.
Absolutely. If you could sort of, quickly in 30 seconds, let us know the kind of, economic and environmental impacts that Satio Labs' technology can have on India's space economy. And if you could give us some use cases, you've implemented some smaller pilots at a much smaller scale.
So, the Earth observation market is around $700 billion, turning out to be a $700 billion by 2030. Out of which, $300 billion will only come from optical and thermal data, because getting GHG gas emissions. When we talk about monitoring our environment, to track GHG gas emissions, it becomes very, very, very evident. And that's how Satio Labs, by having very, very high resolution thermal patterns of the globe, can also identify GHG gas emission, and that's how it will help unearth these insights very deeply.
Right, absolutely. And you've raised this $3.3 million of pre-seed funding to scale your operations as well as validate your technology, right? So if you could sort of explain to us or elaborate on the plans you have for this money that you've raised.
So this is our pre-seed fund. It's a maiden fund for us. We have so far carried on as a bootstrap. But now this will help us complete our design, and by December we are planning to have our test launch. And by mid of next year, we are planning to have our first satellite launch. That will, the money basically will be utilized for testing, manufacturing, and developing these payloads, and also to expand our team in terms of the data science, the AI and ML platform, which we are also going to put across.
Right, absolutely. So that's the plans for the money that you've raised. And how, you've also said that you have $25 million in letters of intent. If you could sort of tell us what industries are showing the most early demand for your product, and how soon will you be able to, sort of fulfill these to have a sustainable revenue stream?
So, as you mentioned earlier, we've already started deploying some pilots. Now, these pilots, we still don't have our first satellite, but we have developed a small payload which we are utilizing in a drone kind of a setup, and capturing data for a small area. For example, when municipal corporations want to track GHG gas emissions around the solid waste dumps, or a solar farm want to basically have exact faulty panel identification, which thermal data can do. This kind of pilots, we've already started doing it, and the LOIs are generally across. There is a European giant in agriculture which has shown early partnership with us. There are system integrators, technology providers, which are closely working with governments to solve heat island problems, to solve agriculture problems, and not to forget the defense. Defense is also from the early surveillance perspective showing huge interest in having this thermal data, and specifically having a fuse of thermal as well as optical data from our side.
Right, absolutely. And if you could sort of tell us, what kind of role do you think collaborations with ISRO and InSpace will play in Satio Labs' growth and regulatory strategy?
Yeah, so this is actually startups like us have been now getting into this only because regulatory bodies like InSpace has been huge support. Not to forget ISRO. I mean, we are fortunate of being here in Ahmedabad, where we get huge talent pool from the existing ISRO facilities here in Ahmedabad, as well as the InSpace facilities. So, startup like us don't need to invest in huge testing and calibration and those kind of facilities, and huge support from both of this organization. It is a kind of a backbone to us in terms of getting these things going on at a very fast pace.
The government has given a lot of companies like yours a lot of impetus and they've done a lot in terms of regulation, in terms of funding for companies like y'all. What else do you think the government needs to do at this point to boost, India's solar space?
I think, yes, they have given a huge, support to us. Going forward, I think it is more of an industry collaboration, right? More and more, government departments who wants to use this data. If government can facilitate startups like us, where, there is a platform where, they can consume this data on a commercial base, right? As we all know that, government, the life cycle of adoption of this technology because of, certain processes is very slow. That's where I think government can still support startup like us by having some kind of a preference to the startups, and that we feel can really aid this economy and this sector very well.
Right. And what are Satio Labs' key milestones and geographic targets for expansion for the coming year?
So we'll start with India, like our first satellite, and obviously that satellite will not only capture India, but will also cover, some kind of some part of Middle East as well, where heat island edification is very, very critical. And then we will expand to, other geographies like Southeast Asia, as well as part of Europe and US as well. It's going to be, this is a disruption, right? So it's going to be definitely, consumed by the entire world as such. We see huge market globally as well.
So big expansion plans there. All right, Urmil, thank you so much for taking time out and being here with us on Startup Street. We wish you all the best with this journey going forward.
Thank you so much. Thank you.
And moving on the hot seat, Kirana Pro, India's AI-powered quick commerce platform, has onboarded Arjun Vaidya, the co-founder of V3 Ventures and former CEO of Dr. Vaidya's, as an investor and mentor. Vaidya joins a growing list of strategic backers, including Olympic medalist PV Sindhu and retail veteran BS Nagesh, to support Kirana Pro's mission of digitally empowering over 1 million Kirana stores by the end of 2025. Now, the startup, which recently acquired hyperlocal delivery app Jopa and integrated with ONDC, is redefining grassroots retail with a zero-commission model, AI-driven personalization, and flexible monetization tools. Joining me now to discuss this further is Deepak Ravindran, the founder and CEO of Kirana Pro. Deepak, thank you so much for taking time out and being here with us on Startup Street. We last spoke in December. If you could sort of take us through, how Kirana Pro is scaling its operations across India, following its integration with ONDC, and the kind of key milestones you hope to achieve in 2025.
Sure. Thank you for inviting me again. So I think the biggest thing that we have achieved is that we are completely onboarded into ONDC. That means we are able to do the same fulfillment service through probably the better network, and the scope and length of service that can be provided through ONDC is priceless. Like, we can expand to any small cities in India. We can go live pan-India with the support of ONDC. So that's a basic advantage. But we have decided to focus only on tier 2, tier 3 cities where we are strongly present, and we are getting good number of orders and processing.
Right. You just mentioned how you're leveraging ONDC. If you could sort of also explain how you're using it to onboard over, sort of 7 lakh vendors. You have a big milestone there on how many you want on your platform. What are the kind of benefits that you bring to local Kirana stores, and how are you helping them compete with the quick commerce giants,
Yeah. So, Kirana was there forever, right? Like, right from older days to now quick commerce era. The only challenge was that how they can actually enable technology, and how simply can they provide online orders. So the advantage of ONDC as well as the advantage of quick commerce has given us the right timing for a service like Kirana Pro to exist. And beyond that, the best thing that we are right now seeing is that the supporting partners like on ONDC and the network providers like delivery partners are doing an excellent job. So for us, we are just a front end, right? We try to become the Google offline, where we want to be the equivalent for Google to get any number of products offline. So that is being able to successfully capture only because of ONDC support. So, I'm extremely glad that everything is coming on the map. So things are going good at Kirana Pro right now.
So things are going good at Kirana Pro. You recently got Arjun Vaidya's investment and mentorship for Kirana Pro's expansion and AI-driven capabilities. What is the kind of impact that you see he will have on the company, and how do you plan to use the funds that he has invested into the company? Can you give us a number?
Yeah. So Arjun Vaidya has been supporting me for in my career for the last couple of years. So before even starting Kirana Pro, we've been a mentor, and now the good news is that he's becoming an official investor in the company and also helping us in scaling the platform. So the best thing that he could provide is that his vast knowledge in D2C brands, because we want to expand beyond the scope of just groceries. We want to include everything under the sun. We are rebranding ourselves to K Pro from Kirana Pro. So these are some of the things that we are doing on parallel. So bringing Arjun Vaidya on board will definitely help us in the D2C side of things. And also people like PV Sindhu supported us, will help us in building a brand altogether. So
right, and you just also mentioned that you're looking at rebranding from Kirana Pro to K Pro. So what's the rationale behind this rebranding exercise?
Because the thing is that Kirana is a term that is only known for few places in India. Like if you look at our majority of penetration is in Kerala, where Kirana is not a term that is prominently used. Whereas K-Pro is short and cute, people like to remember that easier. And we want to build beyond Kirana network to, like I say, build bigger O2O commerce network. And that is the ambition. So for that, we decided to go with the shortest name possible. So K come in the picture, and K Pro is the domain, K.Pro. So we are moving towards that direction.
Right. So you're going to be rebranded as K Pro. If you could sort of then let's talk numbers, right? You've introduced sort of a zero commission model, which sort of includes subscription-based pricing and hyperlocal advertising, right?
That's right.
How will this sort of impact your revenue generation and financial sustainability? If you could take us through what you're clocking now and the targets for this year as well.
So the numbers haven't disclosed publicly, but I could say we have decided to go beyond revenue share with the Kirana stores, which is what ONDC and other network providers give us. So we decided to give back that to the merchant itself and say, like, why don't we go with the brands and get an ad model like similar to what Google does online. So something similar to Google AdSense, we have created something called K Ads, which will help us to discover brands for Kirana networks to sell to the end consumer. So let's say somebody is searching for butter, we can actually recommend Amul or some other brand, and these brands can provide us the revenue source rather than going and piggybacking the Kiranas who are like getting 1% or 2% max to max commission.
Right. Okay, and you also acquired Jopper.app to enhance Kirana Pro's capabilities in the hyperlocal grocery delivery, right? What are the synergies from this, and how has the integration been going? Are you looking for more such acquisition? What's the inorganic growth plan for Kirana Pro?
So the reason why we decided to acquire Jopper was that Jopper has built a POS technology which is already accessible to over 30,000 Kirana stores. What we have done is that after integrating Kirana Pro into the POS terminals that we have, we are going beyond ONDC network. Like we are interoperable. Like we can work with ONDC as well as without ONDC. So we are working with, for instance, sound boxes, like the Paytms of the world. And we are working with other network providers. So this all will help us to become Kirana Pro an omnipresent app, something similar to what Alexa is or what Siri is to the world. So something like an AI assistant. That's what we envision Kirana Pro to be.
Right. So looking at an AI assistant, and you're looking for any more acquisitions like this?
Not really. We have decided to build everything in-house. The reason why we decided to acquire Jopper was that one, the founder was extremely brilliant. He himself is a Kirana store owner and he has a wide network in his kitty. And secondly, the fact that we found the fact that, we can acquire that 30,000 Kirana stores, which he already have the software on, which we can piggyback for orders. So these are the reasons.
All right. So no more acquisitions in the pipeline there. All right, Deepak, thank you so much for taking time out and being here with us on Startup Street.
Thank you.
On that note, it is time for us to head into a short break. But coming up on the other side, Nomad Pizza has established 65 outlets across India and is nearing the 100 crore mark in revenue. A special conversation with Amit Ajwani, the founder and CEO of Nomad Pizza, on its way forward. Stay tuned for that.
The best among our content creators need to start thinking of the world as a market and start creating content for global audiences. We should nurture even our regional creators to go global. Decades ago, when technology was not highly advanced, Raj Kapoor and other doyens of Indian cinema made films that became immensely popular in Russia, China, Central America, and elsewhere. Satyajit Ray mesmerized global audiences with his black and white movies. Gandhi reintroduced Mahatma Gandhi to the Western world. In recent years, more.
Welcome back. You're still with us on Startup Street. From just 6 outlets to 65 and nearing the 100 crore mark, Nomad Pizza's journey under Cure Foods has been nothing short of explosive. As the premium pizza brand expands beyond metros into smaller towns, founder Amit Ajwani speaks to my colleague Aishwarya Anand about scaling through strategic offline bets, high street presence, and why customers are paying nearly double for quality. Take a look.
First question that I want to ask you is, since joining Cure Foods portfolio, tell me, how has Nomad Pizza's growth trajectory evolved over the years, and what kind of new development has come on board?
See, it couldn't have been a better partnership is what I would start with, because they don't come just with funding. They come with a lot of strategic inputs. So they will exactly guide you in terms of the whole growth. So when we started our partnership, we were like 6 to 8 outlets. Today we are 65 outlets, 4 brands. But within one kitchen, we try to maximize our employees, our space management, and all those inputs, they come from Cure Foods. Yeah. So because they've been in the business for the longest time, they know what not to do. So it's like an everyday call with them, and really helps us to grow. Yeah. So I think so. It's with them coming on board, the growth has been phenomenal. Yeah.
On that note, I also want to understand from you that Cure Foods is looking at hitting the 1,000 crore revenue mark, right? What percentage of it will come from Nomad Pizza, and how close are you to hitting the 100 crore annualized sales revenue?
So we're very close to hitting that 100 crore number. Like we're almost there. And I think so from the portfolio point of view, I think we contribute anywhere between 10 to 12% of the total portfolio to them, which started as a much smaller portfolio. With all the support from them, I think it's become almost 10%, 10 to 12%.
Okay. And where, how many stores are you present in? I mean, you've expanded to offline as well, right? So how many such, offline stores do you have? And are there plans on expanding that? And what made you want to shift from online to offline? What was the idea behind that?
So we believe that pizza is, when you eat straight from the oven, is you get the best experience, and also like it gives you a presence. Like, you know, a dark kitchen or a cloud kitchen will not become a brand unless it comes on the front. Yeah. So we strategically take places which are very prominent on a high street, like on a Linking Road in Bandra, like on a GK in Delhi, or an Indiranagar in Bangalore. So it just creates that curiosity. There's a new brand which has come, which is just not a cloud kitchen. Yeah. So that was one of the strategic moves. Now, moving to smaller towns where real estate is smaller, we take a hybrid where we have a sit down and a delivery both, because from the economics point of view, it really works out beautifully. So I think so going forward, any small town we move, we will have a sit down plus a delivery. Yeah.
Okay. So how many sit downs do you have currently?
In total, we have 12 of them now.
12 of them. And by the end of this year, are you planning to open some more?
This expansion is every month. It's like there's a lot of pressure. There's IPOs on the line. Procure food. We need to expand. So of course there'll be many more which will be we will be opening this year. Yeah, I will not be able to comment on the number, but definitely a lot. Yeah, now.
Okay. Considering the investment of approximately 75 lakh per Nomad outlet, I want to understand how does the return on the online and offline compare, and especially in terms of average order value and customer retention.
See, we are a digital only. We started as a digital only brand. We were the delivery only brands. For us, the ROI was amazing. We were working with things like there's no better way to grow the business, but to just focus only on delivery. But the moment we pivoted to offline business, I think overall the online business has grown because the brand came in front. So for instance, Bombay used to contribute really small. Now it's become the largest contributor, right? So it is all because we're sitting at linking roads. We don't look at this investment as from the ROI point of view. It will be looked at from a marketing point of view.
So if I want to understand from you, help me understand the number of SKUs that you currently have on the platform. I think you have 11 different kind of pizzas that you are currently, right? Of that, I want to understand that as a consumer, if I'm carting on your platform, what would my average order value look like? And where are most of the consumers coming from? Do you see a lot of traction now coming from the Bharat market as well? How do you see that demography play out for you?
So we were very scared to enter B towns, but now we basically available in most of the B towns, and the response has been amazing. So if I look at the numbers of Indore, if I look at the numbers of Dehradun or any of the smaller markets, people have a lot of money. Yeah, if you give them a great product, average AOV is like order value is 1,300 rupees versus what the competition is selling is for 700 rupees. There's a huge difference. Yeah, but people are paying the premium purely because of the quality.
All right, Avid, thank you so much for speaking to us. It's been lovely interacting with you.
It is Friday, and before we hit the weekend, let's take a quick stock of all the startup deals that happened over this week. This week saw a total of 18 deals worth $87 million. First up, beauty tech player Cult added $20 million to their cart. Healthcare platform Hexa Health bagged $12 million from 314 Capital, Chirate Ventures, Enziup Ventures, and others. Solar financing platform Metafin raised $10 million in Series A from Prime Venture Partners, Varanium Capital, Vertex, and others. That's not all. Cybersecurity firm QNew Labs filled their pockets with $7.06 million from Singularity AMC, Speciale Invest, Tenacity Ventures, and others. B2B platform Sedna also bagged $5.3 million from Anicut Capital. According to Venture Intelligence, this year saw a total of 306 deals worth $2.5 billion. And with that, it is a wrap on this edition of Startup Street. More news and updates continue right here on CNBC-TV18.
Dangal, with a story set in rural Haryana, became a blockbuster in China. Since sports is also a new genre of entertainment, IPL has now gained phenomenal viewership around the world. All this shows that the global market for India's entertainment and cultural products will grow exponentially by leaps and bounds in the coming years and decades. My third idea is that we should forge partnerships and collaborations with innovative entrepreneurs, artists, and studios from around the world. The Prime Minister has given us this mandate. India should become the modern global center for content and creativity. My fourth idea relates to the fundamental purpose of all creative industries. I believe that the purpose of all we do is to build a better world for our future generations. A more harmonious world, a world that realizes the motto that Prime Minister Modi gave to G20 in New Delhi, Vasudhaiva Kutumbakam. The whole world is one family. Today, we are living in a highly polarized world. It is full of turbulence and uncertainty. As a result, people all over the globe are hungry for entertainment that is healthy, wholesome, and brings hope and happiness. India can satisfy this hunger better than any country in the world. This is not just an unprecedented economic and cultural opportunity, it is a strategic opportunity. India is now amongst the world's most populous nation. Soon, our economy will become the third largest globally. This will potentially make India the world's largest media and entertainment market. Just look at the numbers. 1.4 billion creators and consumers with an average age of 29. This is not just a statistic. It is a profile of a demographic, economic, and creative superpower. India's third advantage is technology. India is not following the technological revolution.
Time exchange of the big board. It's Ring Magazine celebrating its boxing event tonight in Times Square. Oscar De La Hoya is here, legendary boxer, chairman and CEO of Golden Boy Promotions, doing the honors.
Welcome to Indianomics. Today's debate stirs or questions the very heart of Indian policy and Indian economy. A 60-year-old trend of greater globalization is set to take a U-turn because of President Donald Trump's tariff war. So far, state-of-the-art consumer products like, say, iPhones or iPads or semiconductor chips were designed in the West, manufactured in emerging economies, and marketed again in and by the West. Now every country, including India, has to produce for itself, and accordingly, India's laws and policies need to change away from global scale and focus on domestic demand. Tax laws should encourage consumption and not savings. Airlines should connect not Bangalore with Boston, but Coimbatore with Kanpur. This is the thesis put forward by Jahangir Aziz, the head of emerging market economics with JP Morgan and a veteran India watcher. Is such a dramatic change called for in India's economic policy? That's the debate in today's Indianomics. I have with me Jahangir Aziz himself to present his thesis, and two other well-known Indian economists, Ratin Roy, who's a distinguished professor at the Kautilya School of Public Policy, and Pulapre Balakrishnan of the Center of Indian Economics. Thank you very much, professors, for joining me. Let me start with Jahangir himself. Jahangir, please restate your theory as briefly as you can, and what exactly needs to change in India's policy.
Morning, Lata, or good evening. So there are two ways of looking at the world the way it stands today. So one way of looking at the world is to say that, look, the largest economy of the world most likely will go into a recession. The second largest economy of the world is going to not have a technical recession, but likely will have a severe slowdown in the economy. And all of this is happening in the midst of a tariff war that is no longer confined to US and China, but has spread to other countries. If that's the way in which you want to look at it, or one wants to look at it, then what happens to the rest of the world is by and large going to be governed by the spillovers that happen from these two economies slowing down onto the other economies. And over the last 50 years, we have gone through at least 5 US recessions. The world has survived, and we've come out of those recessions. The alternative way of looking at it is that this is a broadside against a 80-year-old global trading system by the very country that built that system piece by piece, and that the damage that we are looking at, or we are fearing is going to happen to the US economy or to China or the rest of the world is just a spillover from that breakage in the global trading system. The problem with this view is that if that is the origin of the shock, that this is a resetting of global trading system, Then over the last 8 years, every country, whether it's an advanced country or whether it's a developing country or an emerging market country, has been built around this global trading system. The economic structure therefore needs to change if the global trading system has to change. And that was basically my point, that the economic structure of almost all economies in the world, including India, is built in some way or the other on the basis of this global trading system continuing with all of its unfairness and all sorts of concerns, but broadly continuing. But if that no longer is going to be the case, then the economic structure itself has to change.
Okay. Well, let me question that thesis first. Ratin Roy, would you agree that it changes so dramatically that every country becomes inward facing? Or is it going to be an incremental change where the US perhaps extracts some mileage, some production and, trade surplus from other countries? But basically, we all still play to our strengths. And we will do it through, FTAs with like FTA UK, India UK, India EU. Will it be really such a dramatic change that everyone produces for themselves?
Well, there will definitely be more autarky in the world. And if you're asking me whether every country will produce for itself, probably not. In the sense that, as Jahangir, I don't think even Jahangir was saying that. I mean, there are small open economies which really have no choice but to produce for other people. Many of them don't produce goods, although countries like Singapore do have a very high manufacturing share. And they will have to navigate these headwinds somewhat more carefully than India. India, of course, has another great advantage. It's a busted flush when it comes to world trade. India's share of world exports is piffling. India cannot even compete with Bangladesh and Vietnam, especially Vietnam, forget China, for many of those things that we ought to be producing. Our share in manufacturing is anyway declining. So I rather hope that Jahangir is right, in the sense that if he is right, then India will do what I've been urging all along. Mahatma Gandhi once said about Western civilization, it would be a very good idea. When people talk about India exporting, I say it would be a very good idea because I've been hearing that line since I achieved puberty. And India has not been an exporter since then. So if we then turn inward finally and stop dreaming these pipe dreams about being a global manufacturer based on a relatively small shift in where iPhones are manufactured, that can only be a good thing for India. If we focus on home market demand, which is huge, that can only be a good thing for India. I'll leave the consumption point for later. I do slightly want to nuance what Jahangir said in the Indian context. But otherwise, I think Jahangir is probably right when it comes to large countries. But large countries anyway, like India, especially India, which is a busted flush globally, should have been always focusing on domestic markets. And I think Trump has done us a favor if he impels his government to do that systematically in a more disciplined way than it has been doing in the past.
I am not sure of the end game of this trade war. My guess still is that it is going to be incremental changes. But Dr. Balakrishnan, your first thoughts. There is clearly a challenge called to globalization. But is it complete deglobalization, or is it just going to be some stalling and plateauing with perhaps the US extracting some advantages? What's your best guess?
Well, let me start by saying that I do agree with Mr. Aziz that we are seeing some serious disruption here. Now, what will be the magnitude of that disruption is certainly uncertain. The only thing that we can be certain about is that there's going to be some uncertainty. So that's the first thing that I'm going to say. Secondly, I would say that India certainly does not have the luxury of producing for itself for the simple reason that about 80% of its oil consumption is imported. So jolly well export in quite a big way if it wants to at least take care of its balance of payments. But exports as a means of actually growing the economy has not been part of India's history ever, not even after 1991. So I'm not sure if the disruption in world trade is going to make a great difference to India's growth prospects. But there's certainly going to be disruption. And the United States is a major trading partner of India's. So how we come out of all of this is also going to be related to what sort of trade agreement we are able to negotiate with the United States. So I'll say that for a start and keep everything else for later.
Okay. Okay, then Jahangir, I'll come back to you with the same question I'm asking the other two. Is it going to be such a big U-turn? For instance, do you think seriously that iPhones are going to be made in the US, even for the US?
No, iPhones may not be made in the US for the US, but as you ask the question, what is the intention of this, these trading moves? If you look at the manner in which the reciprocal tariffs were imposed, these were not imposed based on, okay, India has these amount of tariffs and these amount of non-tariff barriers, these amount of other things, and therefore the non-tariff barriers have costed X billion dollars to the American taxpayers, and therefore the US will reduce its reciprocal tariffs by this amount if India reduces its non-tariff barriers.
Jahangir, they're based on trade deficits. That was very clear.
That's correct.
Higher the deficit, higher the punishment.
Right. So let's look at the trade deficit. It's 1.1 trillion is a trade deficit. Let's say even 1.1 trillion goes to $500 billion. So I'm not being as dramatic as you were being, Lata, and I'm glad that Rotin pointed out I wasn't being that dramatic.
Okay.
All I was saying is that if you take away from the largest economy in the world, their trade deficit going by $500 billion every year, and let's say that leads to a significant reduction in their imports. US imports about 4.1 trillion every year, which is larger than India's GDP. If that economy is turning autarkic, whatever the reason may be, if that economy is turning autarkic, it will force every other economy that trades with it to turn autarkic.
One minute, Jahangir. I'm not denying that it is turning autarkic. What I'm saying is that they can't take away 4.1 trillion of imports in 1 year, 10 year, 100 years. It will only be a little less than 4.1 trillion incrementally. So
the little less was done in global financial crisis. So go back to the global financial crisis. Look at the period before the global financial crisis. Those were, quote unquote, the golden years of emerging market, including India. Why was it the golden years of emerging market, including India? It was because globalization was surging at that point in time. We were establishing supply chains. That was what was driving our investment. That was what was driving our growth. If you look at what happened to the world since the global financial crisis, across the world, the potential growth, the medium-term growth of every economy has actually ratcheted down. And that is because global trade has ratcheted down. Now you're telling me that let's look at another small ratcheting down. I have no idea whether it's going to be a small ratcheting down or not. In the global financial crisis, there was some opposition to deglobalization. I will grant you that, but it was a political opposition in Europe and the US. It wasn't that the opposition was on the policy front. This is an opposition that is taking place against globalization, not just politically, but also actually in actions. And you are not even looking at the retaliation that will happen. We are assuming that the 90 days you will actually get trade deals with the Europeans and other countries. We haven't seen any of the trade deals apart from the India trade deal is being talked about. And as Rotin said, India doesn't really matter in the global trade. What matters is Japan. What matters is Mexico, Canada, and Europe. And we haven't seen anything of that sort. We don't even know what retaliatory steps these countries will take. So the ratcheting down of global trade can be significantly larger than the ratcheting down of global trade that occurred in global financial crisis, where the only thing that happened, by the way, was that trade financing was frozen.
Yeah. Okay.
So my point being that you can see another ratcheting down of trade and therefore another ratcheting down of medium-term growth because we in the emerging market world continue to believe that being part of the globalization world or being part of the global trade is our ticket to greater prosperity. And that was what I'm questioning.
Okay. Well, I have to take a commercial break. Let me come back and ask you professors what will be, what should be India's policies going forward. Back in a minute. Welcome back to this all-important Indianomics, where we are discussing whether the challenge by President Donald Trump would mean that most economies will start having to become domestic demand-based, especially India. I've been speaking with Jahangir Aziz, who wrote this excellent edit in the Indian Express. I have also been speaking with Professor Ratin Roy and Professor Pullapre Balakrishnan, both prominent Indian economists. Gentlemen, thank you very much for your patience. Ratin, Jahangir had a say. What is your best guess of how this challenge to globalization will turn? Will it mean that US imports reduce from, say, 4.1 trillion to, say, 3.5 trillion? Is that the end game, or is it much more dramatic?
If I may respond to your question from a purely Indian perspective.
Yes.
My trade surplus with the US is a little north of $100 billion. I think it's 120 or 130. Let me assume that halves. Worst case scenario. Responding to what Pullapre said, that we have to worry about the balance of payments. So I now have to find $70 billion to close my balance of payments deficit. Now, the good news for India is we have never managed to close that by increasing exports. The way we close our balance of payments deficit is that our total foreign inflows, which is remittances plus FDI plus FII, exceed our current account deficit.
Yes.
That excess is more than financed by these three things. So the question here is, will this trade war in any way inhibit that process from happening? That is where I think our policy needs to focus. Let me give you one very good example. I have been working on this with the state governments here where all the Indian action really is south of India. Nothing much happens up north. There's a Darbar and that's it. The interest of the main hit that's going to come to American service producers is going to be the more or less abandonment of the H-1B visa policy and the entire green card pipe dream route. That could seriously affect the fortunes in the south. The reason it may not is that the response I'm seeing, and you can look at this by looking at rental yields in South India and Hyderabad, which have gone up by 45%, Bangalore by 40% in anticipation of the last 6 months, is that global capability centers of various types, not just IT. We're looking at services, we're looking at Accenture, we're looking at knowledge industries, looking at banks. There's a plan for a rapid expansion in that. Now, what that would mean is we'd get in FII, and that would become part of domestic GDP almost, because the FIIs would then produce these global capability things which we would sell to the US. Now, if that trade in services is interrupted, that would be a serious blow. But that itself should take care of about 80% of our balance of payments deficits.
Yeah.
Then with a little bit of smarter, with slightly smarter import strategies, we should be okay. So and here I'm looking at a pretty non-marginal impact like you are. I'm saying our trade surplus with the US on goods halves. Even that, I think we can manage fairly smartly over the next year or two. Now, the only thing we have to do with Trump, because he's not a stable person, is what the Indian government, to its credit, has been doing against its normal track record, which is to talk too much. We mustn't talk too much. We should quietly try and engage with the US and get what we can out of them while making sure that our strengths, which are services, etc., those grow in India. And I agree with Jahangir, we also have to come up now, like all other countries, major countries will do, not Switzerland, but certainly the UK or France will be forced to do, which is focus more on home market demand.
Okay. Ratin, this is exactly what the Indian market is also going with. Our trade surplus with the US is only 42 billion. Our total exports to that country is $130 billion, but the surplus is only 42 billion. If that has to be halved, it's only 21 billion. That's not a great deal of money.
No,
as you say,
we lose our
services,
trade surplus.
services,
We lose our trade
exports,
surplus, and our trade with the US halves too. Our exports to the US halve to about 70 billion. We can even manage that.
Yes, and in any case, the GCCs or services exports is not in Trump's radar at this point in time. So both the market and I were of the assumption, or seem to be of the assumption, that it is going to be an incremental problem that India has to deal with. But Jahangir seems to be saying that we could be impacted much more. Let me first get Dr. Balakrishnan to respond. Dr. Balakrishnan, how seriously should India change? Jahangir says that even tax concessions given to savings need to go away, and we have to actually start encouraging consumption because domestic demand will become much more important. Does it get that far, sir?
I think that is a very important point, and I generally agree with that. But I just want to say something about part of the discussion that went on a minute ago, which is that we can't do the calculation entirely in terms of how India's trade with the US will be affected. US's actions are going to affect global trade, and therefore India's exports are going to be affected by much more than what is going to be part of the Indo-US trade agreement. So I just want to keep that in mind. Now, the other thing that I want to say is that the general point about domestic demand is absolutely correct. And this is not the first time we're talking about it, or if I might say so, I have been talking about it. I think this became apparent even after the global financial crisis of 2008-9. Even international bodies like the Asian Development Bank were already talking about the importance of domestic demand for Asian economies. Now, the question, however, is that how do you spur demand? You can't say that this can be done by raising consumption alone, because consumption is a function of income. So you must increase income to start with. And one way of doing that, of course, is via investment. And here I want to say that, as you very well know, private investment as a share of GDP in India has been stagnant for over 10 years. And I don't see very much happening on that front. So really, all that we have left is public investment, which, despite the noises that the government has been making and some increase in roads and ports, etc., has increased only by 1 percentage point or something in the past 10 years, from 7% of GDP to 8% of GDP. So clearly, public investment is part of the story. And the other is something which cannot be fixed very easily, which is that there is shrinking demand in the economy for anything other than food, mainly because of inflation. Inflation is shrinking household budgets, which is being directly reflected in manufacturing output. In particular, manufacturing, as you know, has slowed despite a kind of aggressive policy by the government for over 10 years in terms of Make in India, for about 3 years now. In the form of production-linked incentives.
That is a larger debate, sir. We will not have time for that. We have to have concluding points from all of you since we are out of time. Well, Jahangir, what Ratin is also arguing is that this is going to be incremental in terms of the trade surplus we have with the US. But as Balakrishnan agrees with you, that it is not just a question of our deficit with the US. We are going...
This week, Chipotle. Today, it's Wendy's. Comps were negative, just like a bunch of others have been, down 2.8, weaker than expected. Revenue was a miss as well, Jim.
Dividend cut, that's not so good there. A tough industry.
Yes.
Yep, very tough.
Talk about pressures for consumers making less than 75K.
Yes, indeed. That's the weakness right there.
But pretty good tape, very strong breath. Dow's up 320. Stay with us. Stop Trading with Jim is next.
Global economy. So do you still think we have to go that far? That, you have to stop encouraging savings and go to encouraging consumption. Does it get there?
So first, let me just tee off from Professor Balakrishnan's last 2 points. The first point, thank you, Professor Balakrishnan, for mentioning that it is very narrow. You'd be missing out the forest for the trees if you only focus on Indo-US trade. It's that the US moving out of the global trading system is going to affect global trade. The second point, which is the point that you made, which is about investment, and I completely agree with it. And obviously, for many sessions I've had with Lata, we've talked about the languishing of investment. So there's a very easy chart, and you can do that one of these days, Lata. Whether you look at growth rate of exports with growth rate of investment, or growth rate of investment as a share of GDP versus exports as a share of GDP in India. And I'm not talking about other countries. In India, it is true also in other countries, but India, there is no daylight between the two lines. The reason in the global financial crisis period that we had that rapid expansion in investment is that the investment directly or indirectly was related to the expansion of supply chains and export markets. Since global financial crisis, that has come down. And that has come down because we are no longer expanding supply chains to get more more connected to the global trading system, because the global trading system itself is pushing back.
I agree. Jahangir, unfortunately, out of time. Tell us one key change you want to see in Indian economic policy.
For example, I would really want to see, the entire basis of our discussion, that India is a supply-constrained economy, and therefore we need to keep on easing supply constraint, simply being changed to India is no longer just a supply-constrained economy, but a demand-constrained economy. Okay. If we just accept that as a starting point, I think the rest of the policies will actually come through.
Okay, well, unfortunately out of time. Gentlemen, thank you very much for starting this conversation on how Indian economic policy needs to change in a changed global order. That's it on this edition. Thanks for watching. Welcome to Indianomics.
Hours trading, it's now come back down, and I think that's wrong. These guys can do a lot of what people call training with all the different chatbots, and you get all your information. You're obviously, like, I'm on Grok, and Grok constantly finds out what's saying on Reddit. And Reddit is a big budding star with tremendous gross margins. I think that Steve Huffman's doing a remarkable job. I want to own that stock right here, right now.
Yeah, we got Oppie upgrade, and then I think Needham goes to 145.
Yeah, down 28% for the year, with what I think is a model that may allow them to charge everybody in the end to get their information. The information is very organic, and I think maybe people should check out the site. They don't realize if you have something. I mean, my daughters are on it constantly, and because it's content that doesn't force you to do anything. It's just informative. I really like it. It's a good site.
How about Ty going to wrap up this week, Jim?
Well, man, I find that when I have a utility on, which is doing better than everybody, but we're going to take a look at some things that were oddities this week where people can still buy things. Calvin Butler does a fantastic job. This is the old Philly Elect and ComEd, and look, the utilities have outdone everybody here. Even Dominion yesterday had a good number. Wow.
And meanwhile, next week, we're going to get Ford and Palantir and ARM.
Well, Palantir's going to 150. What can I tell you? It's a meme stock. They won't stop. They start buying Palantir at around 345. I'm going to get up at 344 and watch them levitate that stock. It is the greatest meme stock I've ever seen.
Those are pajama traders you don't mind.
Oh, those guys. I bask in their success. It's all they do in their lives, and that's what their lives are about. And I salute them. They have big lives.
Jim, have a great weekend. We'll see you tonight.
Thank you, too.
Mad Money, 6 p.m. Eastern Time. Dow's up 340. Don't go away.
Or questions the very heart of Indian policy and Indian economy. A 60-year-old trend of greater globalization is set to take a U-turn because of President Donald Trump's tariff war. So far, state-of-the-art consumer products like, say, iPhones or iPads or semiconductor chips were designed in the West, manufactured in emerging economies, and marketed again in and by the West. Now every country, including India, has to produce for itself, and accordingly, India's laws and policies need to change away from global scale and focus on domestic demand. Tax laws should encourage consumption and not savings. Airlines should connect not Bangalore with Boston, but Coimbatore with Kanpur. This is the thesis put forward by Jahangir Aziz, the head of emerging market economics with JP Morgan and a veteran India watcher. Is such a dramatic change called for in India's economic policy? That's the debate in today's Indianomics. I have with me Jahangir Aziz himself to present his thesis, and two other well-known Indian economists, Ratin Roy, who's a distinguished professor at the Kautilya School of Public Policy, and Pulapre Balakrishnan of the Center of Indian Economics. Thank you very much, professors, for joining me. Let me start with Jahangir himself. Jahangir, please restate your theory as briefly as you can, and what exactly needs to change in India's policy.
Morning, Lata, or good evening. So there are two ways of looking at the world the way it stands today. So one way of looking at the world is to say that, look, the largest economy of the world most likely will go into a recession. The second largest economy of the world is going to not have a technical recession, but likely will have a severe slowdown in the economy. And all of this is happening in the midst of a tariff war that is no longer confined to US and China, but has spread to other countries. If that's the way in which you want to look at it, or one wants to look at it, then what happens to the rest of the world is by and large going to be governed by the spillovers that happen from these two economies slowing down onto the other economies. And over the last 50 years, we have gone through at least 5 US recessions. The world has survived, and we've come out of those recessions. The alternative way of looking at it is that this is a broadside against a 80-year-old global trading system by the very country that built that system piece by piece, and that the damage that we are looking at, or we are fearing is going to happen to the US economy or to China or the rest of the world is just a spillover from that breakage in the global trading system. The problem with this view is that if that is the origin of the shock, that this is a resetting of global trading system, then over the last 8 years, every country, whether it's an advanced country or whether it's a developing country or an emerging market country, has been built around this global trading system. The economic structure therefore needs to change if the global trading system has to change. And that was basically my point, that the economic structure of almost all economies in the world, including India, is built in some way or the other on the basis of this global trading system continuing with all of its unfairness and all sorts of concerns, but broadly continuing. But if that no longer is going to be the case, then the economic structure itself has to change.
Okay. Well, let me question that thesis first. Ratin Roy, would you agree that it changes so dramatically that every country becomes inward-facing? Or is it going to be an incremental change where the US perhaps extracts some mileage, some production and, trade surplus from other countries, but basically we all still play to our strengths, and we will do it through, FTAs with like FTA UK, India UK, India EU. Will it be really such a dramatic change that everyone produces for themselves?
Well, they will.
My idea of being overweight in financials this year was a pretty broad-based one because I had a fairly large overweight. So this was my highest overweight sector heading into the year. Part of that was my view that cycle is essentially going to favor growth. A change in dispensation with respect to approach to liquidity from RBI, which was more visible from December last year, also gave comfort. So lower regulatory.
Tariffs were also imposed on steel, aluminum and automotive imports. Trump claimed tariffs are good for the economy. But here's what has actually happened. GDP contracted by 0.3% in the first quarter as imports surged. Inflation is above the Fed's 2% target. Jobless claims are at a 2-month high. The S&P index fell 7%, the worst start for stocks since Richard Nixon's second term in 1973. The dollar index fell 9%. Brokerages project odds between 40% to 65% for a recession to hit The US this year, Trump's approval ratings have slumped, with less than half of the Americans approving of his performance. At the moment, the Trump administration is negotiating bilateral trade agreements, and India could be among the first countries to clinch a deal. However, China continues to face tariffs of 145%, with no sign of direct talks yet. Trump 2.0 has already witnessed its first major overhaul with the removal of Mike Waltz as National Security Advisor. Remember, Waltz took responsibility for a chat leak on America's strike on Yemen's Houthi rebels. Secretary of State Marco Rubio will be taking charge as NSA in the interim. So what next for the Trump administration and India-US ties? Joining us now is Atul Keshup, President of US-India Business Council. Ambassador Keshup, thank you very much for joining us on the program. Always a pleasure to have you on Global Eye. Let me begin by asking you, the mood in the American industry today. Donald Trump has completed 100 days as president. There have been concerns among industry chambers. The outlook on his tariffs, not very good. As someone who heads one of the most prominent US industry chambers, what would be your view?
So, Parikshit, it's great to be back on the show. Thank you very much, and warm greetings to you and to the audience. Look, business craves predictability, right? If you're a CEO or you're the investment committee of a major global company and you need to make a $10 billion bet on where to build semiconductors or some other critical element of the supply chain, you want regulatory and tax and policy predictability. It is the most important thing if you're going to make a 10 and 20-year bet that impacts your job, it impacts your share price, it impacts the well-being of your shareholders, it impacts your company and your workers and everybody else. So I think that getting to that point of predictability is really, really important. And in this regard, there is some good news. India is looked at, I think, widely around the world as one of the most stable polities right now. And I think that what we need to do is capitalize as soon as possible on the potential for a US-India trade agreement that would give a very clear and strong green light to those investors that investing in America and India for long-term success and happiness is the best and smartest possible thing they can do. So I encourage both sides great success and great ambition to lock this deal down.
Right. Those hectic negotiations are underway. In fact, different members of the US administration have said that India could be one of the first countries with whom the US will sign a trade deal. How soon do you expect that to happen?
Well, who knows? I mean, this is where the two sides are working with great focus. You saw Secretary Besant's remarks that India may be the first one off the mark with a trade deal with the administration. I think that's wonderful news. As the president of USIBC, we've been praying and calling for that for a very long time. So I wish them great success. You know, there's a lot of rumors swirling about when the Quad Summit might take place, which is supposed to be hosted by Prime Minister Modi in India this year. I would very much hope that that trade deal between the United States and India will be finalized before the Quad Summit. That will send an enormous message of confidence to the entire world, not only strategically, but also economically.
Right. Ambassador Keshup, right now there is a lot of talk of having a interim trade deal or an early harvest deal in the next 60 days or so, 60 to 90 days for that matter. If there were an interim deal to happen before the full-fledged BTA in fall, what do you think would be, or according to you, should be the essential ingredients?
So thank you. That's a great question. I think that the investor communities in both countries, Indian large companies, American large companies that have vast amounts of available investable capital, are looking for reassurance from both Delhi and Washington about their plans for semiconductors, their plans for critical minerals, for energy, for nuclear, for pharmaceuticals and life sciences, for artificial intelligence. You know, ours are the two leading economies on earth for trusted collaboration. And these CEOs need to hear loud and clear from the Indian and US governments that working together in collaboration on these critical and emerging technologies is something that is strategically and economically desirable, and that their investments in each other's countries and in their own countries in these critical fields and with key partners around the world, especially on critical minerals, is acceptable. So if there is an early harvest, I hope that it would certainly be in trade goods, and it can help ensure even freer trade between our two countries. But it's that signal, that framework, that green light, if you will, that is the most important needed thing right now.
Right. US IBC, in a statement in early March, had said that non-tariff barriers and red tape must be dismantled because these are hurdles to business. What would be some of the top 2 or 3 pain points, according to you?
Well, this is where every country is sovereign, and every country has its full right to make its own decisions about its national happiness and prosperity. I certainly respect that as a former diplomat. It's very important. But what we try to do very respectfully and very constructively is convey the perspectives of our members, who are Indian and American leading companies and a few international companies from Europe and Japan and Korea, to give granular insight to policymakers and decision makers about ways to advance their own policy goals. So, for instance, India has made it very clear that they want more FDI and that they want to have companies build in India and make in India. We encourage and applaud that. It's good for our national security from the perspective of Americans. And so what we try to do is offer insights into how to smooth that out in terms of ease of doing business, speed of doing business, bureaucratic decision-making on key issues that companies need to face, and then also regulatory and tax policies. I'll give you another example. International banks are taxed at a higher rate than Indian banks. It precludes a lot of them from expanding more in India in ways that would flow more FDI into India for these various enterprises. Government of India has taken steps to reduce that tax rate, but there's more that can be done to ensure parity that would really send a signal that India is open for business and open for foreign investment and open for putting that money to work in India, creating jobs and taxes and so much else. So we say these things privately and respectfully, constructively, with a view toward helping India succeed and helping US and India succeed. We do the same with the US government because the US Chamber is 120 years old. It is an institution that was designed to be independent, absolutely a clear voice of business, and to be able to use that voice with government, not in opposition, but frankly to help fuel government success by helping it understand the insights of the investor and business community. So it's a privilege to be in this job. I appreciate the fact that we are able to speak clearly and independently. We don't take any government funding from any government, and we never have and we never will. It's a founding element and principle for us so that we can convey the members' perspectives. And, you know, for things on like data, digital economy and the use of data, on energy, on life sciences, we are constantly offering inputs into both governments.
Right. You know, when it comes to the average applied tariff, the US Trade Representative's Office has been constantly talking about how certain countries have been treating them unfairly. They've also been speaking about a high rate of applied tariff by India, whereas the US average applied rate is somewhere in the range of 3% or so. What is the benchmark, according to you, a sweet spot where the average tariff, applied tariff by India should be brought down, or what should be the bare minimum in any deal, according to you?
Well, a lot of folks have been talking about 0 for 0. At the end of the day, free trade, when it really is free and when it really is fair, is really, really good for companies and countries and consumers. Look at how much the United States has grown over the past 70 years after the war. Look, and a lot of it has been predicated on free trade. Now, I think there is a sentiment, and President Trump has articulated that our openness, our willingness to lower our tariff barriers has been taken advantage of by some countries that have not reciprocated. So I think that he's trying to renovate and update our approach toward the world. But if we can get to 0 for 0 with India and on the vast majority of goods, I think that would be a great thing. You know, it's time to dream some very bold dreams. Why can't we do this? You know, how can it help us strategically in an era where we face shared challenges around the world? Let's strengthen our relationship. Let's make sure that Indians and Americans are prosperous and happy through the entire 21st century. So I say, be ambitious, revert to the real principles of free trade.
Right. My final question would be about American companies deepening manufacturing in India. We've just got confirmation from Apple CEO Tim Cook, and he said that in the earnings call, that a bulk of Apple iPhones for the US market will now be manufactured in India. And in fact, probably as early as end of 2025, all phones for the US would be made in Indian manufacturing centers. So this is indeed good news. But what does this indicate about closer manufacturing cooperation, closer supply chain cooperation between US and Indian industry? And do you see this happening more across businesses in the US?
So I think businesses are being compelled right now by geopolitics and by rising problems between the US and China to find different and more diverse sources for their supplies of items that go into manufactured goods. India is perfectly positioned to take advantage of this situation. It is a trusted economy, a trusted geography, a trusted partner. Look at all of the joint statements between the Prime Minister and the President that emphasize trust. And this is where I would say to Indian friends, this is your moment. This is your moment. Seize full advantage, but then also apply the instruments and levers of the Indian state in a way that is enabling and helpful to the foreign investor. You know, India is complicated. It's diverse. It's a proud democracy. It has many, many layers of government, just like the United States. Everybody can speak freely. This is not China. It is not Vietnam. It is not some of these other countries where you talk to one person, you get an answer, and everything's done. If the Indian system, top to bottom, can realize that this is an enormous and historic opportunity, I think India can capitalize very greatly. But what the investor wants is predictability. They want an easily understandable system. They want clear answers. They want speedy implementation timelines, and they don't want surprises. You know, I know of a case where a company wanted to move an entire supply chain to India. This was a couple of years ago, where they had seen the wonderful statements by the Prime Minister and by the leaders of the government. And yet when they got into the process, they were sort of being pushed toward doing things that didn't make it as economically advantageous for them. It didn't link closely to the port infrastructure. The project site that was being suggested was hundreds of kilometers away. So my suggestion would be, think with the psychology of the international investor, put yourself a little bit in their shoes, and then take maximum advantage of this moment of huge strategic and economic opportunity for all of the people of India, and hasten India's rise to being a developed country by 2047.
All right, that's a great note to end on. Thank you very much, Ambassador Keshav, for joining us with your view. Clearly, you are articulating that it is India's moment. Seize it, but also break down those barriers and think how global investors would be looking at India. Very well said. Thanks, Ambassador Keshav, for joining us once again. We're taking a break here on Global Eye, but coming up on the other side, US and Ukraine have signed a deal to share profits and royalties from future sale of Ukrainian minerals and rare earth elements. We speak to Shelby Magid, Deputy Director of Atlantic Council's Eurasia Center, on the other side. Stay tuned.
India's media and entertainment industry today stands at $28 billion. We can easily grow this 5 times to over $100 billion in the next decade. This will give birth to huge new opportunities in employment and entrepreneurship in diverse fields. To achieve this, India should invest in state-of-the-art content clusters across India. India should train tens of thousands of our talented young people in animation, VFX, and other technologies. India should incentivize IP creation, AI-powered innovation, and gamification. India should have a new investment avenues for this industry, and India should create an enabling and encouraging and empowering regulatory environment that rewards imagination, and inclusion. My second idea is that the best among our content creators need to start thinking of the world as a market and start creating content